I mean, it's sizable on several different levels. Of course, we have the political element, this concern about, in the UK, the fact that our biggest tech company is going to be listing in the US.
Quite an embarrassment, really.
Well, yeah, I mean, that's one way of looking at it, not if you are ARM itself. The other level on which it is quite significant is, of course, the IPO market more broadly. There are plenty of companies out there, not least ones owned by private equity firms, that are looking for an exit. The IPO market's sort of been shut for much of the past year. This will be a big test of whether it can open again, particularly given some of the appetite towards AI applications. There are lots of other companies chomping at the bit, ready to go. If this is a bit of a bomb, they may be a little bit more nervous about doing so.
And I know you've been combing through the filing documents. What more did we learn about ARM's business from them?
I think it's quite interesting. It's not growing right now. That's been the case, of course. There are large swaths of the chip industry that haven't been doing terribly well, but it is seeking a very generous multiple, if we're to believe the reporting, between $60 and $70 billion. That would value it at something like more than 100 times its earnings, its historic earnings. We, of course, don't have a forecast of what they're expected to do in the coming 12 months. Now, that is a very generous premium to what semiconductor stocks, even in the US, are doing right now. The Philadelphia Stock Exchange Semiconductor Index, those stocks trade an average of 85 times forward earnings, heavily skewed, of course, by the likes of, 85 times historic earnings, my apologies. That is heavily skewed, of course, by NVIDIA and AMD, which have very generous multiples because they are growing very quickly. ARM is not. Of course, it doesn't have quite the same AI exposure that those companies do. So there will be hard work to get that valuation. That might explain why they've mandated quite so many banks on the IPO to make it happen.
And obviously, if this debut goes well, it's going to give an enormous windfall for Masayoshi Son. And of course, his vision fund lost that record $30 billion last year. What is this going to mean for SoftBank?
Well, actually, there are two pieces to this. There's the Vision Fund, and then there's SoftBank itself. SoftBank controls the Vision Fund. It is not the only investor in it. SoftBank has bought out the Vision Fund stake, which is 25% of ARM. That's generated double the returns, essentially, for it. But if you had put that money, the $30 billion odd they paid for for ARM back in 2016, if you had just put that money into an index that tracked the Philadelphia Semiconductor Index, you would have had a better return. Like the excluding dividends and things, but the share price or the price return looks to be just over 100% versus that, again, if they get that valuation. Going into that index, you would have got about a 300% return. I think there are a lot of SoftBank investors out there right now who are like, let's just capitalize on this. Let's just try to get some money out of it. They are only selling, as we believe the reporting, a minority stake at this stage. If it then performs better further down the line, they have the opportunity, of course, to sell bigger stakes. If they don't, well, they can sit in it for as long as they want.
Now, there was a lot of focus on the fact that ARM had chosen to list in New York rather than London. I flippantly said that it was embarrassing, though, of course, the UK government did put a lot of energy into trying to keep ARM here. Do the numbers that we've now seen further explain that choice?
I'm not sure there's anything particularly in these numbers. We know more broadly the market conditions, namely that if the average multiple at which companies trade in the UK is about 13 to 14 times their forward earnings. That's the FTSE 100. In the US, the S&P 500 trades an average 20 times forward earnings. Now, of course, that's heavily skewed by the massive tech companies that have enjoyed significant growth over the past year. Your SoftBank, you're probably hoping that ARM starts to ride those tailwinds. And we've seen tech-adjacent companies. I'm not sure you'd call Deliveroo really a tech company, but Deliveroo and Darktrace, they have not done brilliantly since listing in London. So when you speak to particularly VCs thinking about taking their companies public, sometimes they go, if they have listed the company here, we wouldn't have it, we would have done it in the US. Or they go, in future, we only want to list in the US, because they would say, oh, investors there understand tech companies better. We think about that growth piece. In the UK, the argument could be made that that'd be punished a little bit more than it would be in the US, where they would say there is more bullishness around tech.
I also just want to pivot from ARM to Zoom, because of course we had earnings from Zoom overnight. What's your read?
I mean, look, Zoom, it's interesting the way that it's been developing. Of course, the numbers were slightly better than anticipated. There had been some skittishness that coming out of the pandemic, appetite for Zoom was waning. It's not quite as fast as it was.
All right, thank you. told Pentagon officials that he'd spoken personally with Russian President Vladimir Putin. The New Yorker says the SpaceX CEO volunteered the information during an October conversation with a top policy official at the Pentagon. Musk later denied speaking with the Russian president. All right, let's take a look now at some of the other events we're watching today. The BRICS summit kicks off in Johannesburg later. South African President Cyril Ramaphosa is expected to meet with Chinese President Xi Jinping this morning, and we'll bring you the live pictures just as it happens. At 9 a.m. UK time, Thailand's parliament's due to hold a fresh vote to install a new prime minister. A coalition of Thai political parties is seeking to form the next government, pledging to stimulate the economy through a mix of fiscal measures. And stateside, we're expecting earnings from Chinese internet firm Baidu in just a few hours. And at 3 p.m. UK time, we'll get a check on US existing home sales for the month of July. Well, I mentioned the BRICS summit coming up. BRICS leaders are going to kick off those talks later. Chinese President Xi Jinping arrives in South Africa, where he'll be hosted by his counterpart. And we're going live to Pretoria next. This is Bloomberg.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to Bloomberg Daybreak Europe. Now, the BRICS Leaders Summit kicks off today, but before that, Chinese President Xi Jinping is being hosted by his South African counterpart, Cyril Ramaphosa. And for more, Bloomberg's Jennifer Zabasajja joins me now. Jen, what are these two BRICS leaders discussing?
Yeah, Lizzie, this is significant. This is the only state visit that we are going to see amidst the other BRICS activities and meetings that are happening this week. And this is significant for both of these countries. They are also celebrating 25 years of diplomatic relationships and flourishing, as they call it, economic ties. But what we're anticipating that these leaders are going to talk about is how to deepen those ties and to strengthen their collaboration and the partnerships that they already have. And they do have a lot. I mean, China is the biggest investor into the South African economy. And on the other side of things, South Africa has been China's biggest trading partner for 13 years straight. So there is a lot of opportunity there for them to deepen that investment. And we've seen over the past few weeks a number of trade ministers have been talking about what it is that they can do, and in particular, how South Africa can reap more benefits and export more things and raw materials, or not necessarily raw materials, but produced materials into the Chinese economy. So we're anticipating that, and also talking about the role that both of these countries have as leaders of the global south and what that could potentially mean as they try to reform a lot of these global governance institutions and multilateral forums. So a lot for them to pay attention to, and we're going to wait for Xi Jinping to arrive here in just a few hours.
Yeah, and it looks like it's going to be a busy week for Xi. Everybody wants him. Reportedly also a meeting with Indian Prime Minister Narendra Modi. What's on their agenda?
Yeah, I mean, so this is still reports, and this is significant because these two leaders, these two countries in particular, share very close economic ties. Of course, they share a border, and that border has been the reason behind a lot of their strained tensions over the past few years. But what we are confirmed going to see is the first time that Xi Jinping and Prime Minister Narendra Modi are going to share the stage for the first time since the G20 last year. Now, whether or not they are going to meet is still up for debate, but these are the two biggest countries at this point in time within the BRICS coalition, and so they carry a lot of weight within the bloc, and of course carry a lot of weight about whether or not this expands. And so we're unclear whether or not that meeting could happen, but we did get indication from the Indian delegation that the Prime Minister's schedule is still being finalized in terms of see whether or not that happens. And of course, there's a lot to pay attention to if they do meet.
Yeah, I say everybody wants to see Xi. We learned yesterday that the UK Foreign Secretary James Cleverly's got a trip to China in the last week of August for talks on Russia and Ukraine. That report on the terminal. But let's just go back to BRICS, because in these conversations, Jen, it must be difficult because all the different country leaders have their own problems at home, and yet they have goals to achieve together at this year's summit.
Right, and Lizzie, I think that is really at the core of why people are calling this really the most consequential BRICS summit in a number of years since we saw voice of the global south, and I'm talking about places like the United Nations, the G7, or excuse me, the United Nations, the IMF, and other multilateral forums. And so we're going to have to hear whether or not there's actually cohesion on what that reform actually looks like, especially because, as you mentioned, there's a bit of competing interests based on what they want on the global stage versus what they need at home.
All right, thanks to Jennifer Sabasadja across every twist and turn of this BRICS summit. Great to have you. Coming up, not just gassing, Woodside Energy says it's having constructive talks with LNG workers. We'll bring you our conversation with the CEO, Meg O'Neill, next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
DOJ or other authorities
could face bigger challenges.
Britain's next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
Well, as you can see, Woodside Energy shares are lower in Sydney trade this morning. Australia's biggest oil and gas producer's first half results are being overshadowed by its strike talks with LNG workers. CEO Meg O'Neill weighed in on the current state of the European LNG market.
The fact that the market has responded in such a significant way to the rumor of a potential industrial action suggests to me that the market is still quite fragile. And that European buyers and the European market is concerned about the levels of supply that they will have going into the Northern Hemisphere winter.
So that was the Woodside Energy CEO Meg O'Neill there. The company shares extending losses in Sydney. Now, BHP reported its lowest annual profit in 3 years, and we caught up with the CEO of the world's largest mining company, starting by asking his thoughts on China.
It is fair to characterize it as a bit uncertain. Now, I would start by saying that there's actually a number of sectors in China that are going quite well. That includes green infrastructure, other infrastructure, automobiles, and so on. But the key sector, of course, that everybody's focused on, and which is very relevant to certainly to our business, is the property sector. Now, in property, we've seen strong completions up 19% year on year. But what's lagging is new starts. That's been recognized at the central government level. There's obviously policies in place that are meant to stimulate new starts, but they're not translating as effectively into changes on the ground as certainly we were anticipating, and I think some others were anticipating as well. So that's really what we're keeping an eye on over the next 3 to 6 months, is how effective is that translation of policy into practice. If we do see that starting to take hold, then we think there could be good growth momentum flowing from FY23 or calendar year 23 into calendar year 2024. Outside of China, I was in India about a month back. The energy on the ground there, the optimism is palpable. So we're seeing solid momentum in India. Of course, that's a big market for us for commodities like metallurgical coal and for copper concentrate. So overall, we're seeing India and China comprising about half of world GDP growth in the period ahead. And the other point I would note is long-term fundamentals for this sector and for BHP remain really healthy.
Yeah, Mike, we'd like to talk more about the opportunities there in India, because certainly that is a growing market of yours. I just want to pick up, though, on some of the points you're making on China. So, I mean, almost every CEO we speak with is uncertain over the environment there. There's certainly hope, let's put it that way. I want to ask you about what you're seeing across short-term pricing on many of your products in China. What's the outlook on pricing these next 6 months?
So, of course, it's going to depend a little bit on what happens with the overall economy, with demand for commodities like iron ore. There are some rumors of potential mandated production cuts in steel, but it's not like the industry there is starting with high inventories in iron ore or steel. So any cuts that would occur would very quickly start eating into those inventories. Now, obviously, if there was lower demand, that has implications for pricing. But one very important point to note is that the marginal cost of production across the commodities that certainly we produce is higher now than it was pre-COVID, naturally, given the inflation that we've seen in the external environment. So we expect that's going to provide a downside cushion on pricing at a higher point than may have been the case previously. In the case of iron ore, we're saying somewhere between $80 and $100 per ton is likely where the cushion kicks in, given what we've seen on the inflation front. And of course, from a BHP perspective, because we've done a better job in controlling costs than our competitors, we've doubled our lead as the lowest cost major iron ore supplier.
Manchester, not London, is the best place to find a new job in the UK. That's the surprising finding of data analysed by... But London, when you look at the number of jobs per local worker. Thousands of voters in the so-called red wall seats flipped Conservative in the last election, hoping that the Conservative government would be able to bring more wealth and prosperity to their area. However, the data still show a country where employment prospects are thin on the ground in large pockets of the northeast, northwest, and areas all around the coast. Aside from Manchester, the only areas that are really leading the way are Cambridge, Reading, and Milton Keynes, indicating the good news for the rest of the UK might stop there. With Prime Minister Rishi Sunak facing the prospect of a general election as soon as next year, the pressure's now on for him to find ways to spread wealth outside of London to some of those more neglected areas. In Chancellor Jeremy Hunt's budget, he unveiled plans for 12 new low-tax investment zones around the UK and £760 million of spending on infrastructure and regeneration. Manchester's one of the oldest devolved areas in England, and there are signs that that's really beginning to pay off. What's on Jeremy Hunt's plate now is whether he can spread that success to other regions.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg.
This is Bloomberg Markets Today. I'm Tom McKenzie, live in London. Mark Cudmore, our Markets Live managing editor, joins us from Singapore to take us through all the market action this hour. The cash trade just less than an hour away. Here are your top headlines. Treasury steady after global yields soar on higher for longer rate bets. The US 10-year yield hits a 2007 high. Japan's 10-year yield rises to its highest in 9 years. Chip design giant ARM files for what could be the biggest US IPO this year, targeting a valuation of $60 to $70 billion as it looks to ride the AI boom. Plus, S&P downgrades a slew of small and mid-sized US banks, saying a decline in deposits is squeezing liquidity, making life tough for lenders. Mark, yesterday the focus very much on the bond sell-off once again, and we've seen that ripple across to JGBs in Japan.
Yes, Tom, good morning to you. As you know, I have been in the theme idea for the last couple of years that yields need to go much higher. I remain a structural treasury bear, but I will say I think the move has probably gone far enough as it can go in the short term while we await Jackson Hole for the next catalyst. And if anything, I think probably the risk reward is for Powell to deliver a slightly dovish message relative to pricing this weekend. So in the very short term, over the next few weeks, I think treasuries might have a little bit more upside than downside, but I don't think we've reached the peak in yields of this cycle.
Okay, and you've been consistent on that, Mark. We have not yet reached a new high in terms of yields for 10-year Treasury yields. Breaking news now across the terminal. Really important, of course, in terms of the deals that we're focused on. And this is one that's been held up by regulators here in the UK. Microsoft and its bid, of course, for Activision, the gaming company. And an update for the UK's regulators, the CMA. And we are seeing now, just roll the prompt back so I have the fresh information, because what's happening here, the update is that Microsoft has submitted a new deal. This is really important. The UK CMA saying Microsoft has submitted a new deal triggering a fresh phase one. Under the new deal, these are the details. Microsoft will not acquire the cloud streaming rights to all current and future Activision games released during the next 15 years. So, of course, the question then from any investor in Activision or Microsoft is, will that be enough to assuage the CMA, of course, the Competition Markets Authority here in the UK, to allow them to give the green light to that deal, as regulators globally have so far given their backing. It is the CMA that remains the major roadblock to that deal getting across the line. and Microsoft updating their deal, and we'll see, of course, the impacts for Microsoft when that stock starts trading, and indeed Activision in the US session. Let's check in on these futures then. After the rallies that we saw yesterday, equities pushing past, looking through the higher yield environment to focus on tech in particular, with that focus on Activision. Those earnings coming out tomorrow, and analysts upgrading their expectations in terms of the earnings picture, and that gave a big lift to the Nasdaq, which gained more than 1%, and the S&P ended higher by about 0.6%. Here in Europe, futures gaining by about 0.4%, so looking to a positive start. The momentum again picking up from the gains of yesterday on Wall Street. FTSE 100 futures just up by about 0.1% at 7,270. Over in Germany, you're looking to add about 0.4%, and broadly a positive session as well in the US. We'll flip it over, look at how things are shaping up in terms of US futures. Interesting to hear from JP Morgan's Kalanovic once again putting out a note saying there is no fear left in these markets, only complacency. And he's saying the forward guidance in terms of the double-digit earnings forecasts are disconnected from the fundamentals. A warning there from JP Morgan's Kalanovic. Futures stateside looking to take a little bit of profit taking after the gains of yesterday, down about 0.1%. Nasdaq futures off in a similar range as well, down about 0.1%. And Dow Jones futures looking down by about 27 points. So similar picture. You're looking maybe a bit of profit taking by about 0.1% as we look to that US Open. Mark, on the GMM, what is the standout for you in this trading session so far?
Yes, superficially, this is a GMM, which doesn't look like it tells you much. But give me 1 second, because it's quite interesting. The themes of August are continuing, not yet turning around, but they are softening. So what are those themes of August have been? Well, they have been higher yields, and we're seeing that again today. But US yields did not push higher in the Asia session. So that's a slight kind of softening of that news. This was more a follow-through of what we saw in the US session. Another big theme has been China weakness, and Chinese stocks just dropped off this board. In fact, there they are. They are paring their losses from earlier, but they are still down in the day. Yuan is slightly weaker, but again, it's not at the top of this page, which it normally has been the last few weeks. So we're still seeing China weakness, but not as stressed today. And finally, the other two themes that are going a bit more and kind of softening is that we have seen dollar strength in August. That is, again, a little bit softer today. And it is good for other assets. We're actually seeing both the dollar and the yuan down on the day. That provides a little bit of relief, monetary and financial easing for the rest of the world's countries. And as a result, we are seeing equities generally a little bit higher in Asia, despite the fact that Greater China stocks opened the day very strongly and gave back all those gains by about lunchtime.
Mark, I want to stay on the yuan. What do you make then? It's another record fix from the PBOC. Is this attempt to drive the yuan higher to get some strength into the currency, or is this about managed decline, or at least managed downside for the currency there? What's your take on the fixing strength coming through from the PBOC?
I think the PBOC does not want dollar CNH to break the intraday high of 737.50 that was made last October. Now, the Bloomberg Dollar Index is about 8% lower since then. So therefore, there has been broad yuan depreciation across the trend since that period, even though the yuan has actually appreciated on a broad base in the last couple of weeks. Overall, it is much weaker. So therefore, we've had the policy easing that China needs since that phase. But I think psychologically, letting dollar CNH go above 737.50 at a time when the PBOC is clearly very aggressively defending the currency would show that officials lack power. They show they're losing control. So I do not see them leaving that level break unless we see much broader dollar strength, and I'm just not seeing that at the moment.
OK, and when it comes to Japan, Mark, I know you have very close views. You've been following the Japan story very closely indeed. 0.66 on the 10-year yield. Do you expect the BOJ to come out and intervene? There is this tussle now between investors, the shorts, of course, in terms of JGBs, and the Bank of Japan. How do you expect this to unfold in kind of the days and weeks ahead?
I think they'll continue to intervene at times of pace of moves. So if we walk in tomorrow and we're up at 71 basis points, I expect the Bank of Japan will come in and buy JGBs. And I think that's going to be the ongoing theme. Ultimately, though, I think yield's going to continue going higher, and I think yield curve control should, the abandonment of yield curve control should absolutely be on people's radar for the next couple of months. This Friday, we get Tokyo CPI. If the core number is again at 4% handle, which is expected to be, I think it's going to ratchet up pressure that the Bank of Japan will abandon yield curve control entirely in the next couple of months. And what better time to do that than before we're actually at the limit. So it would be worrying if we go into the next Bank of Japan meeting and yields are already up at 1%. That means there's pressure already on them. The Bank of Japan are already in the back foot. So I think there's a chance that they'll want to do it before we get to that level.
Mark, what's your take on Marko Kolanovic making this call that double-digit earnings forecasts are looking stretched, looking disconnected from the fundamentals?
I am in agreement with him longer term. Look, he has excellent frameworks for analysing markets. I dispute his timing. As you know, I have been generally bullish global stock markets the last year and a half. The mistake I had was I thought US stocks would underperform. I thought they'd be the weaklings. That was in fact the exact opposite dynamic. US stocks led global stocks higher. So in about March, I turned bullish US stocks as well. And I think you still have more upside in US stocks. I don't think they've yet peaked out for this year. I'm open for that idea, but I think US stocks probably keep on going higher for another month or so, and then you start to eye the turn, maybe in September, October type environment. So overall, I'm with Kolanovic that we are pricing a lot of optimism, but I don't think this is the time to be very actively bearish right now. And that timing issue is as good as being wrong if you're way too early.
OK, there's the time frame then being set and laid down for us by Mark Cudmore, of course, who leads our MLive team. Another month or so of upside for US equities. Of course, you can get up-to-date analysis and insight from Mark and the rest of the team. Just go to MLive Go on your terminal. Coming up, Woodside Energy says it is having constructive talks with its LNG workers over a threat to strike. We bring you our conversation with the CEO, Meg O'Neill, as energy prices, of course, LNG prices, continue to remain relatively elevated in Europe. Plus, the BRICS Leaders Summit kicks off today. Chinese President Xi Jinping arrives in South Africa, where he will be hosted by his counterpart. We are live in Pretoria. And up next, SoftBank's ARM has filed for its long-awaited IPO, set to be the biggest in the US this year. We will bring you the details. Listings are back. If you have any of your questions or for us or the guests, send them to us on IB Plus TV Go. And you can also get, of course, more from the Markets Today team on the front page of the Bloomberg UK website by typing TLive Go on the terminal or on the website. Stay with us. This is Bloomberg.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
On the next episode of The Circuit, it's still almost shocking how new you still are to this sort of being famous thing.
When I do, go out and people are like,
trying, that's when sometimes I'm, well, why? There's no rule book for it.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
Welcome back to Markets Today. We are about 45 minutes from the cash equities open. European futures pointing higher, taking that lift from the tech rally of yesterday, gaining 0.5% in terms of your European futures. Talking of tech, UK-based chipmaker ARM has filed for its long-awaited IPO in what will likely become the largest US tech listing since Alibaba nearly a decade ago. The SoftBank-owned company is expected to seek a valuation of as much as $70 billion. For more, we're joined by Bloomberg's tech reporter Aggie Cantrell from Berlin. Aggie, is this then a game changer for the tech IPO space and the chip sector more broadly, given how consequential ARM is within that ecosystem?
Exactly. That's where we're looking. Essentially, this is going to be so critical for in the performance of this IPO is going to be really critical for a market, an IPO drought that we've seen for the last several months. And a lot of companies that were looking at what is going on with ARM to see if they can reflect the similar behavior if they were also going to go to IPO. It's also interesting to see how many banks have got involved in this, from Barclays, Goldman Sachs, JP Morgan, because the banks themselves are also really feeling this IPO drought. And so when you're looking at ARM, I think a lot of the comparisons that are being made because of its ability around artificial intelligence chips, it's really about what we saw with NVIDIA earlier this year, when the company was really the first company to really benefit in a material sense from the push towards artificial intelligence, because they're basically the building blocks of an AI hype.
Aggie, good morning. So this is a game changer for the IPO space, but what does it mean for ARM's business and for SoftBank?
Yes, so essentially ARM's relationship with SoftBank is one that is going to be looked at very intensely over this. And this is also a big deal for SoftBank itself. SoftBank really needs this IPO to do well. And they are banking on this AI strategy as a way of saying, like, actually that they are going to be focused on these sort of companies. And of course, this is after SoftBank has had a couple of difficulties when it comes to other efforts to IPO some of their companies in the past. And so this is a way of them saying, look, this is us still being able to bring something to market at a high valuation. And that's going to be critical for the company.
Aggie, we've also, of course, just had the update coming through from the CMA, the Competition Market Authority here in the UK. Microsoft submitting a new deal then to UK regulators to try and get its Activision deal across the line. What are the details? What do we know about this changed structure of the deal, and indeed whether it's likely to finally get the sign of approval, the seal of approval from UK regulators?
Yes, so essentially this new version is saying that there is a significant difference, so the deal is substantially different as it has been presented to regulators. And that's going to be critical because essentially they're saying that Microsoft won't buy Activision's PC and console cloud rights. So they're trying to essentially divide up parts of the business that are seen as anti-competitive. And this is also not just the only scrutiny that Microsoft is under. It's of course also under scrutiny in the US as well from the competition authorities there. But this is the first real step, because the British were the first to really push Microsoft on this issue. So it could be that the US is also looking at what's going on in the UK and seeing if this is acceptable to them as well.
Aggie, just briefly, what are we looking for from NVIDIA earnings that are coming tomorrow?
Yes, so as we were saying, NVIDIA is essentially the big winner when it comes to AI for the time being, because it's the company that is really retooling a lot of the data centers, the big tech data centers, with AI chips so that they can do processing of generative AI. And so we're probably going to be expecting NVIDIA to still be able to hold up that strength that they had earlier in their past earnings, where we saw them really spike and go near that $1 trillion valuation. And so that's going to be a real focus, is essentially, is this something that is carrying on into several quarters? And really that is expected to be the case, because all the big tech companies are still doubling down on AI as their focus, just as they were last quarter.
OK, another big day for tech news, and we appreciate you running us through the details. Aggie Cantrell in Berlin on ARM. Microsoft, and of course Nvidia, with that preview of earnings coming out tomorrow. Now to China, stepping up its support for its currency by setting the daily reference rate for the yuan at the strongest bias versus estimates in a Bloomberg survey on records. By the way, Treasuries, meanwhile, are steady today after global yields soared on higher for longer rate bets, with the US 10-year yield hitting yesterday a 2007 high. Joining us now is Magdalena Poland, head of emerging markets macro research at PGIM Fixed Income. Magdalena, good morning. Thanks for joining us. Let's start on the China question then. You came onto the show back in March and you cautioned that maybe the impulse coming through from a reopening China would not be as strong as some would expect, and certainly that caution seems to have played out. In terms of the ability for EM to weather the slowdown in China, which parts of the EM space are most vulnerable ultimately to a crisis in China?
Yes, good morning. Yes, indeed. It's a difficult puzzle to put together by the Chinese authorities to meet those multiple goals of both cyclical and structural reform while keeping together that impossible trinity of stable or controlled exchange rates, moderate capital flows, and interest rate policy. Coming back to your question, of course, a lot depends on where the weakness in China is coming from. So in the near term, any weakness in demand, and especially that deep slump in the construction sector, means that anything needed to expand this sector, so especially metals and other commodities, are suffering. And we are really seeing this in the data. Metal prices have fallen. Currencies that are reliant on metals, so especially Chile peso and other Latin currencies, also ZAR, have suffered. And conversely, some of the energy-dependent commodities, but also demand for oil and coal from China, is actually doing quite well. So we see that there's some recovery in that sector. And coming to the demand, just general demand, because... Yes, go ahead.
Sorry to interrupt. I just wanted to ask that if you're still bearish on China from here, how do you if you say there are some areas of weakness, how do you play the bearishness from here? Do you think it's still a yuan story? Do you think it's an onshore stock story? Which bond markets do you sell? How do you play the bear story on China from here?
We're not that bearish on China, to be honest. We think that there is more strength to the Chinese economy that's visible just in the numbers, because some of the numbers we're seeing right now is an effect of the move of relative prices and a real strength in other sectors that is not construction sector, is a little bit obscured by the nominal numbers. But indeed, it is not the easiest story to play. What we're looking at is more the differentiation between the emerging markets that are more exposed to China versus those that are more immune. And especially the US economy is doing well. So the strength of the US offsets the concerns about the hard landing risk for the global economy. And there are definitely markets out there that are much more exposed to the strength of the US demand. And that's, again, parts of LATAM. There are also other commodity producers that are not as exposed to China. And then, to some extent, markets that are more plugged into the global manufacturing cycle, that are a bit more diversified. The parts of CEMEA, these countries are also more immune to the negative shock coming from China, but more positively leveraged to the strength of the US economy. That's really the key factor. The other one is just the fundamentals, the carry that is still high on EM currencies, maybe those where the central banks, after the initial enthusiastic response to declining inflation, are now moderating their rate-cutting ambitions. There, the carry would be still high enough to make them attracting from the currency point of view. And also, some repricing in the local rates is positive because that makes the local market also more attractive to fixed income investors.
Okay, interesting you talk about the offset maybe in terms of the US growth, kind of offsetting some of the slowdown from China. And you talked about the currency strength and of course, the impact on the credit markets and some of the EM space. Magdalena, let me just push you on that in terms of where you're seeing opportunities, where you want to be adding if you're looking at adding local credit, local debt in some of these EM countries. Which nations would you be looking to add in now?
Yeah, that's not a very easy question because EM valuations have improved quite a lot. I think the recent market actions show that investors were getting a little bit uncomfortable with very tight spreads and declining local rates across EM. So one of the, for example, central banks that was, or the local markets that was pricing in a lot of rate cuts, for example, was Czech Republic. I also mentioned earlier central banks that have now rescaled their own guidance towards cuts. That was in Chile. I think these are the markets where, especially the Czech, for example, is a good example, is the one where markets have gotten a little bit ahead of themselves. Following central bank reaction and the external shock, rates have repriced on the local side. And now valuations are getting a little bit more realistic. So I think this is the type of market we'll be looking at to add. Otherwise, I think it's a difficult time for all EM and fixed income investors. As I mentioned earlier, valuations are pretty high already. So the turbulence in China and then another increase in US markets does not make this an easy environment for fixed income investors in the EMs.
Yeah. Magdalena, if I was to ask you what's one EM sovereign bond market to buy between now and the end of the year, what would be your choice? Just pick one.
We still like some of the high credit oil exporters, given the strength of their balance sheets and the fact that oil markets are actually doing quite well. So we definitely like the issuers within GCC. So I think that's one of these. And then we'll be selectively looking at some of the manufacturing exporters that are less exposed to China and more exposed to the US.
Okay, so a call there on maybe adding some GCC plus those exporters that have a little bit more exposure to the US versus China as we weigh up, of course, the slowdown in the world's second largest economy. Magdalena Poland, we really appreciate your insights. Thank you for joining us on the EM space this morning. Head of Emerging Markets Macro Research at PGIM Fixed Income. And talking of emerging markets and the role of China, Mark, you've been flagging to us the turnaround that we seem to be seeing, not just in Hong Kong shares, but domestic shares as well. The CSI 300 now up 0.9%, Mark.
Yeah, absolutely. This is a massive turnaround. I do not see any headline. I do not know the reason for it yet, but it's really quite sharp. So all the mainland shares and Hong Kong shares were negative only half an hour ago. When we started the show, I was expected to highlight Chinese shares were down only about 0.5%. As I observed, in fact, by the time we got to the GMM, it was only about 0.05% down. Suddenly, they're up about 1%. Hong Kong shares have gone from being negative to be up about 2%. We do not yet know the reason, but this is really, really quite a remarkable sudden turnaround at the end of the day. It is extremely positive price action. I'm waiting to find out the real catalyst for it, though.
Yeah, HS Tech as well, up strongly. And, of course, there's the read across from the tech rally yesterday in the US. So that seems to be a clearer drive, up 2.5%. But the turnaround, as you say, pronounced on the HSI and on mainland stocks as well. Currently, the CSI 300, the benchmark there, up almost a full percentage point. Mark, thank you. We'll get more analysis on that, of course, throughout the hour. Coming up, Wood Group's revenue beats. We're going to speak to the CEO of the consulting and engineering company next. How is the order book looking towards the end of the year? Stay with us. This is Bloomberg.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Welcome back to Markets Today. We are 30 minutes from the cash equities open. The Asian session has turned more positive. The benchmark there currently gaining a little over 1%. Futures in Europe pointing to gains of 0.7%. Here are your top stories. Treasury steady after global yields soar on higher for longer rate bets. The US 10-year yield hits a 2007 high. Japan's 10-year yield rises to its highest in 9 years. Chip design giant ARM files for what could be the biggest US IPO this year, targeting a valuation of $60 to $70 billion as it looks to ride the AI boom. Plus, Microsoft submits a new deal to UK regulators to get its Activision takeover across the line. The big concession, Ubisoft will get the cloud streaming rights for Call of Duty and all new titles for the next 15 years. We mentioned the futures looking more positive this morning. The uplift coming through from the tech rally on Wall Street, but also gains across the Asian session. The benchmark there up 1%. A decent session, it turns out, for mainland China and Hong Kong. And futures in Europe pointing to gains of 0.7%. Watch European mining stocks at the open after BHP, the world's biggest miner, reported its lowest annual profit in 3 years and warned the outlook for China was uncertain. This as the nation grapples with a brewing crisis in the steel-intensive construction sector. We asked the BHP CEO, Mike Henry, about the biggest risks going forward.
There's obviously policies in place that are meant to stimulate new starts, but they're not translating as effectively into changes on the ground as certainly we were anticipating, and I think some others were anticipating as well. So that's really what we're keeping an eye on over the next 3 to 6 months.
OK, staying on the earnings story, Wood Group's first half revenue has beaten estimates. The Scottish firm, which offers a range of services to energy businesses, caught the eye of private equity firm Apollo earlier in the year, but the PE giant walked away from a possible takeover in May. Very pleased to say we are now joined by Ken Gilmartin, CEO of John Wood Group. Ken, good morning. Congratulations on the results. It is a beat. I do not see any details there on share buybacks or dividends coming through for investors. Why not reward shareholders, Ken?
Yeah, well, listen, thanks very much, Tom. Delighted to be with you. And as you said, yeah, it's been a very strong first half, and we're delivering on our strategy. And really, we are upgrading our outlook for the rest of the year. So, yes, very strong and very positive. I think, look, on capital allocation, share buyback, dividends, the various different pieces that we're looking at. The big thing for us is we are returning to and we're guiding that we're returning to free cash flow in the second half of the year, which I think is a very important milestone for us. And also, as we look forward, free cash flow into 2024. That shareholder return, capital investment, it is something that we're monitoring consistently, have a lot of dialogue with our board, and we'll continue to look at the various different options as we continue to gain momentum. We're 9 months into a 3-year strategic cycle, building momentum, we're growing, we're winning, and a lot of confidence as we're looking forward.
Ken, good morning. I'm going to press you a little bit further on that because, as Tom said, these are great results. It's a great story to sell, but there has been calls for buybacks. I believe you haven't paid a dividend in a while. Which way will you probably go when you want to escalate those shareholder returns? Will there be buybacks on their card, or is there some promising dividend more likely?
Yeah, no, look, we're going to continue to balance. I think we've always, we've nothing against share buybacks. We've always had an intention to go back to a dividend, but again, I think the important thing for us, Mark, it is that free cash flow. This is, and it has been, a turnaround for a company that has seen a few difficult years. And as we said, we've got a great strategy. We've got great markets. We've got great people executing on that strategy. And how we're going to do that is something that we'll have continued and ongoing dialogue, not just with our board, and also with our investors.
Yeah, Ken, I wonder how much this caution, if we can describe it as that, in terms of the buybacks and the dividends, is linked to the balance sheet. How comfortable are you with short-term debt at about, 18%, long-term debt making up about 35%? You have an average cost of about 6.8% in terms of the yield that you have to pay down on this debt. How much of a focus is that for you in this higher interest rate environment?
Yeah, we did a lot of work last year in order to fix our balance sheet. I think, we sold a portion of our business in the built environment. We'd used a lot of the proceeds in that to pay down debt. So I think where we are right now from a balance sheet standpoint, as we're looking at 2023, we're in a really, really good position. And that is really a testament to all the heavy lifting and hard work we've done over the last 2 years.
You mentioned the proceeds from selling down built environment. Is there potential for further divestments?
We're always looking at our portfolio. The strategy that we went on last year was very much a strategy that was based on how we differentiate, how good we are in the areas that we live, that we work in, and how we continue to provide just exceptional value to our clients. As with any large portfolio, we've got 36,000 people. We're a global company. We're always looking at portfolio rationalization. We're always looking at that discipline, kind of intensity and focus of where we do so. Something we'll evaluate, something that we're continuously addressing, and something that we will be sharing some news as we continue to work through what that program may look like.
Ken, how did the fallout in terms of the failure to kind of get a deal across the line with Apollo? How has that changed the way that you're restructuring this business? And are you in conversation with any other potential buyers of the business?
Yeah, look, I think in terms of where we are right now, we had a new strategy that we unveiled at our Capital Markets Day in November last year. And that was a strategy that was underpinned by growth, but it was underpinned by growth in the areas where we as a company are really good at. And the areas where we're really good at it, where there is complexity in the solution that we provide in the energy sectors as well as in the material sectors. So irrespective of the ownership, we've embarked on this strategy. We've gaining momentum on the strategy. We've delivered a really strong first half set of results. And, we're looking forward with growing confidence. We're building momentum, and there's a lot more to come. In terms of what else is out there at the moment, we can't possibly comment on that, but we are executing on the strategy that we set out, and we are continuing to deliver, and there's more to come.
Ken, what reasons did Apollo give when they walked away from the takeover, or what was your big learning from that?
No, look, I think that's a question that's better addressed to Apollo. To be honest, Mark, I think, where we are, and I'll go back to the kind of the conversation that I said earlier, which was, the strategy that we embarked upon is something that Apollo also recognized and saw potential in. So from that perspective, that was good. I think, as a management team and as an executive and as, the organization that we have, the momentum that we're building, I think is really strong and solid. So we're playing in the right markets, we're winning in the right markets, and we're growing. And so we're going to continue to do that. The one thing I would point out as well is, the approaches from Apollo were unsolicited. So, we're going to continue to play in our public markets, and we're going to continue to try to unlock even more and better returns for our shareholders.
Yeah, and that, of course, remains an ongoing mission. Look, the stock is down, what, 80% from its 2016 highs, and you need to convince shareholders, or at least investors, that there is still value to extract there. John, Ken, I should say, when it comes to the order book, that actually fell 6.7% year on year for the first half. Do you see the order book turning around for the second half? I mean, in terms of CapEx spending, what is the sentiment from your clients and customers in this higher rate, lower growth environment?
Yeah, I mean, we unveiled the strategy in November of last year. And what we have actually seen since then, so since the back end of 2022 to now, our order book has actually grown 6%. So the strategy that we have is resonating. We're winning in the right markets. Our clients are absolutely on board with this. And as we've said today, our pipeline continues to grow. So a lot of confidence, a lot of momentum, and yeah, a lot more to come.
Ken, in your good results today, you announced the retirement of David Kemp as CFO. What's the succession plan?
Yeah, I mean, David's been a fantastic servant over the last 10 years, 8 years as CFO, been a huge support for me as I joined and as I got into the CEO role. You know, we'll have a process. We'll be looking at internal, external candidates, and we'll be finding the right person that's going to be able to bring us and continue to bring us on the journey that we're on.
Okay, Ken Gilmartin, CEO of John Wood Group, on the back of those results, a beat there and upgrading the full-year revenue forecast to about $6 billion from the estimates of 5.77 billion. Thank you for your time this morning. Coming up, your stocks to watch, including BHP, as bad news from China hits demand at the world's biggest miner. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you would hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different, Dijan Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
The best question I get all night.
Bloomberg, top experts, great questions. This week, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go.
Coverage starts Wednesday, August 23rd with a special edition of Bloomberg Surveillance live from Jackson Hole on Friday, August 25th, starting at 8 a.m. Eastern. Bloomberg, your global business authority.
Welcome back to Markets Today. A little over 15 minutes from the cash equities open. Futures in Europe pointing to gains of 0.6%. Mark, what has caught your eye today?
Yeah, absolutely. What I want to talk about is the outflows from mainland shares in China. We've obviously been really focused on the China theme in August, the pain, the stress around China markets, the negative news flow. And you know, I just want to show what's been happening from the foreigner side. So this is the 12th day in a row. It's not the final figure yet, but it is very clear net selling. For the 12th day in a row, the selling on net basis by foreign investors, as measured by the northbound stock connect from Hong Kong into China. This is obviously an incredibly long streak and reflects the very negative news flow. Now, regular viewers will know that I am one of the only people in the world who has a more constructive view on China, Greater China assets. And my theory is not that it's a particularly bullish story there. It's just that the super negative story is priced. One of the dynamics I was talking about is that I think everyone who wants to be bearish this story has already sold. I clearly was wrong because we've got another 12 days of selling in the last 12 days. But I think this is probably the last and final capitulation of a market. And it should be noted that I had plans to do this chart as of about an hour ago. And of course, in the last 40 minutes, we've seen an incredible rebound in China shares, despite the fact that foreigners are bailing out en masse.
Yeah, so maybe the share price movement in the last hour or so is coming to justify your position on this, Mark. I'd still take the other side of that bet. But I'm going to parlay what you've been saying into the must-read of the day. This is by Garfield Reynolds from our fixed income team. And he's pointing out that what is happening in China should not distract from the relative resilience and the gains that are coming through from foreign investors and domestic investors in the Indian market. And here's the pull-out quote that I took from his piece. The bad economic and market news flowing out of China this month has captured a lot of attention. That should not distract investors from signs that India is primed to extend its run as Asia's best major stock market in the post-pandemic era. Here's the context. On an annualized basis, the Sensex, the index over in China, the main index in India, I should say, has returned on an annualized basis about 14% since 2020, making it one of the best performing, if not the best performing, Asian markets. And there's the relative resilience part of this play as well. In the month of August, the Sensex dropped about 2.1% versus the global drop of about 5%. So even in a down market, the Sensex proves relatively resilient. There is, of course, the geopolitics at play, the reshifting of supply chains. But there's also the demographic dividend that India benefits from. They're going to be adding about 40 million workers by 2040 with a secondary education. Compare that to China, where millions of workers are going to be retiring. They have a real challenge in terms of the demographic gap in China. Not the case in India. And then the foreign inflows that you were just discussing there into China, well, they've been much more resilient in India as well. You don't get the big tick ups and the big tick downs. You get a lot more steady capital flow into the Indian markets as well from overseas. And that is all proving and shoring up the Sensex. And Garfield Reynolds says, do not miss this. Do not underestimate the opportunity potentially in India as you look to the travails of China. So I just thought that was an interesting comparison for today's must-read. Now, let's check in on what you need to know heading into the Opens. Sophia Hortery-Costa, talking of China, joins us from our Markets Today blog. And, of course, Sophia has been following the markets in China very closely for a number of years. And so I want to start with you on this, Sophia. It is, of course, a theme we've touched on before in the show, which is the stronger fixing coming through from the PBOC. Again, a record fix. And you consistently made the point, this isn't about strengthening the yuan. This is about ensuring that the downside is relatively measured and contained.
Yes, exactly, Tom. Fundamental weakness in the currency seems to be okay for the PBOC. Anything more than that, the central bank is clearly not comfortable with. So we had a stronger than expected fixing, a strong bias. This is kind of the most visible tool that the PBOC has to influence the yuan, but also it's squeezing funding costs in the offshore market. I think this is interesting because this is a tool that the PBOC tends to use when there's too much bearish speculation in the market, because this essentially makes it more costly to short the currency, to short CNH, which is how most foreign investors play the theme. I do want to point this back to what Mark was showing there with the outflows from the onshore market. There's a currency play here as well. You know, if people do expect the yuan to continue weakening, then it doesn't make sense to hold assets denominated in the yuan. That's kind of the reason behind the outflows from the equity market, but also from the bond markets. This is kind of a significant chunk of foreigners are invested in government bonds, and that's a very, very kind of strong yuan play. And China wants that money to stick onshore. It wants to attract foreign capital. So I think there's a broader story to the currency here. Foreign money is important, and we have seen Beijing in recent weeks really try to entice more capital inflows and more investment inside its borders, Tom.
Sophia, in the last about 45 minutes, we saw a very powerful bounce in both onshore and Hong Kong stock markets. This might be some national team purchases or some other kind of, buying by domestic players in the market, and it might just be a flash in the pan. Do you dismiss this as being relevant, or do you think this is a notable change in price action in China's stock markets?
I think it's quite notable. I mean, especially given the trend in the past few days where, Mark, you've noticed that actually into the afternoon, the onshore market tends to extend losses. This does signal, a stronger close would be good for this market. It's positive sentiment. I don't know if it's state intervention. I think that would not make much sense at the moment. There's a lot more tools that the national team, as we call Chinese state funds, can use to prop up market sentiment. But it could be, mutual funds in China. They've been told to buy more stocks. Also, companies have been told to buy back their shares. So it could be kind of a coordinated effort from onshore investors, institutional investors, to kind of rally the market here. I do think it's important to note if we do get more intervention in the equity space. But again, I mean, this is a market that has fallen quite a lot, quite cheap. It might also be just a good time to buy, Mark.
Talking of valuation, relative valuation, Sophia, the UK, and it's been a withering few days for UK stocks. Any sense of a turnaround for the FTSE 100, FTSE 250? What is the cause of this pessimism, given that relative value? Yeah,
exactly. So we were checking, actually, the size and scope on this. So futures are pointing to a positive open in the UK. That's kind of a read across from a very good session in the US overnight. But seven-day losses for the FTSE 100. That's the worst losing streak since July 2019, Tom. The same size and scope for the FTSE 250, but we had that big losing streak in July this year, so it hasn't been such a bad run for the mid-cap index. What's causing the FTSE 100 to drop? I mean, China is a huge part of that story. We have miners, BHP, kind of really adding to that narrative today. Demand is weak and is set to weaken, a lot weaker than expected. That's a huge play for the FTSE 100, but also the pound. I mean, it's moving inversely. It's inversely correlated to the currency, and the currency has been strong, actually, Tom, and it's likely to continue that strength. Most of analysts are saying that the pound is set to continue to hold on to that. But what's interesting to me is that this is coming at a time when a lot of the guests on the Markets Today TV show and a lot of kind of analyst notes, strategist notes that I'm reading are saying the UK market is cheap. They're saying it's a good time to buy. It's a good time to look at this market. It might be a good defensive play. Is it cheap enough to go in? The market is telling us not quite yet. Yeah, we've had a number of guests, to your point, saying particularly the energy play could prove positive for UK assets as oil prices edge higher. So maybe some of the commodity companies here, which again, relative value compared to their US peers, are looking cheap. So we'll see how that plays out. Really interesting. Sophia Acosta on some of the key market themes this morning. Sophia getting us back. Of course, we will get Sophia back in the next 10, 15 minutes or so. You can get more from Sophia and the team on the front page of the Bloomberg UK website or by typing TLive Go on the terminal. Let's get then to your stocks on the watch with Joe Easton from our equities team. And Sophia was flagging BHP. The numbers not looking particularly pretty because of that connection to China, Joe.
Morning, Tom. Absolutely. We have got a close eye on these mining stocks this morning, given the weakness from BHP's report. They do flag some concerns around the Chinese economy, and that is hitting their earnings, which have missed analyst expectations, and their dividend is also lower than it was a year ago as well. In terms of what that stock did in Australia overnight, we can see it down around 0.7%, came back up slightly given the small rebound that Mark was flagging earlier in the show. Most of the volume in that stock is over in Australia, traded around $170 million worth of stock yesterday, and a bit more than that today. Only around 20 million traded here in London. So as I say, the volume is over there. But all of these shares pretty much in the red over the past year, mainly due to the China concern. And during this earnings season, we have seen other dividends lower than expected, including at BHP's big rival Rio Tinto. Glencore, meanwhile, reported a 50% drop in profits, so it hasn't been a good earnings season for miners, and that looks to continue today with this report from BHP.
Joe, good morning. The Italian aerospace and defence company Leonardo is in the news. What's the story?
Morning, Mark. So there's some uncertainty around the leadership of Leonardo, given that the CEO is being investigated by the Italian government over his previous role as a minister, where he is said to have granted a licence to Solvay, the Belgian chemicals company. Now, Solvay was dumping chemicals on a beach in Italy, albeit legally. This wasn't an illegal thing, but it is now being probed. We brought up some details on the screen there. So the Italian prosecutors looking into that move by the former minister. So as I say, dumping chemicals was the concern. Both Cingolani and Leonardo declined to comment, but as I say, uncertainty there.
How is that legal, dumping chemicals on the beach? Anyway, Joe, we are moving on to what is happening with Ubisoft. Potentially a little upside coming from this company on the deal, on the back of this restructured Microsoft deal.
That's right, Tom. So this is all part of that news that the Microsoft acquisition of Activision is being re-examined, new terms submitted, and as part of that, they're divesting some of the rights to Call of Duty and also other games for 15 years. Ubisoft will have the right to stream and use these on their Ubisoft Plus platform, which goes on Xbox, all our favourite consoles. That one's done all right over the past year, and that one could be a positive one this morning.
OK, equities reporter Joe Easton. And just briefly, Mark, the turnaround in these Asian stocks led by China, it seems.
Yeah, that is the big news. I'm not sure we've still got a good explanation for it yet, but that's what we're looking for.
OK, Mark Cudmore, of course, from our MLive team. Plenty more on the blog and on the terminal. Stay with us. This is Bloomberg.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
A few minutes to go until the start of cash equity trading. Welcome back to Markets Today. I'm Tom McKenzie in London, and here are your top stories. Treasury steady after global yields soar on higher for longer rate bets. The US 10-year yield hits a 2007 high. Japan's 10-year yield rises to its highest in 9 years. Chip design giant ARM files for what could be the biggest US IPO this year, targeting a valuation of 60 to 70 billion US dollars as it looks to ride the AI boom. Plus, Microsoft submits a new deal to UK regulators to get its Activision takeover across the line. The big concession, Ubisoft will get the cloud streaming rights for Call of Duty and all new titles for the next 15 years. So that deal seems to be closing in on maybe a resolution. We'll see how regulators respond to that and whether they get it finally across the line for Microsoft. Across your assets then, we are readjusting to this high yield world, of course, but tech managed to rally in the US session yesterday despite that high yield environment, the optimism, the expectations around Nvidia. Nasdaq futures pointing to build on those gains by about 0.1%. Euro dollar currently gaining 0.2%, so a little bit of strength coming through for the single currency. 433 on your 10-year after yields got to those 2007 levels. And crude WTI $80 a barrel now, again at 0.2%, so above $80 is there further upside for oil on the back of a little bit more optimism around the commodities space. That is the cross-asset look. We'll switch over to futures now. About 20 seconds from the open, you have a positive catalyst coming through from the Asian session as well. A turnaround in sentiment on mainland China and in Hong Kong. DAX futures pointed to gains of 0.6%. It was autos that led the sectors yesterday. FTSE 100 futures pointed to upside of 0.3%. And positive as well for the CAC Garonne. Gains of 43 points is what the futures are suggesting. Let's let the pricing filter through then this Tuesday morning at the open. We'll zero in on the UK, of course. The FTSE 100 currently flat. Sophia Horta-Costa has been talking about the fact that maybe sentiment potentially could churn. There is that valuation gap in terms of some of the industry heavyweights listed on the FTSE 100, but there is also the concern about the linkages with China as well. The FTSE 100 now up 0.2%, so we'll see if it snaps that 7 straight days of losses for the main index here in the UK. The Spanish IBEX getting 0.5%, and over in France, the CAC Garonne posting 30 points so far in the session, again at 0.4%. The German DAX up 0.5% at 15,680. Let's flip it over onto the sectors. It was autos that led the gains yesterday, and they were very modest gains across the European sectors session, and it was real estate that led to the losses. Losses of more than 1% on real estate. A high yield environment, of course, challenging for that sector. Technology is gaining 1%. A lift again coming through from the US session, where the Nasdaq ended up about 1.6%. The optimism related to ARM and also expectations, as I've said, around Nvidia. Basic resources gaining 1%. Energy is down, though, or at least flat. Food currently up 0.2%. So broadly positive across these main sectors. Jumping out for me right now, technology, basic resources, the biggest gain is coming through for those sectors. Industrials also doing relatively well, gaining 0.6%, but energy is flat. Let's bring Sophia Horta-Costa in now then from our Markets Today blog. And we were discussing there the linkages then, Sophia, between China, the downside there, the concerns about China and some of the big cap companies listed in the UK. But you've had a stronger fix today as well, and more attempts by authorities, Sophia, to try and at least slow down the depreciation of the currency, of the yuan. Tie that into the broader market moves that we'd be seeing in Chinese markets.
Yeah, Tom, the PBOC likes to use this word disorderly depreciation. So clearly it considers this current pace of losses in the currency to be too disorderly for its liking. So really pushing back in offshore market. This is what the PBOC does to essentially squeeze those bearish speculators. How does this feed across to the global market? I think you have to look at this from a kind of bond sell-off story. Why is the yuan weakening? It's not just because people think the Chinese economy is weak, but there's also the interest rate differentials. China is kind of the only major economy in the world that's still throwing stimulus at its economy. Yields there are heading lower. That's very, very different to the kind of trend, the higher for longer trend that we're seeing pick up in markets globally ahead of that key Jackson Hole speech from Jay Powell on Friday. You did see Japan, yields in Japan, as you mentioned, Tom, ticking up. US yields, that's the kind of the key one for China. If that gap widens, which is exactly what's happening now, then it doesn't make sense for foreigners to essentially hold yuan-denominated assets. You're seeing outflows from onshore markets, and you're seeing the yuan depreciate on the back of that. I think that's a very important story to look at.
So the next steps of the Fed really consequential for China then in terms of the assets as well. 433 to your point on the US 10-year, 433, and we saw yields, as we've been saying, the headlines up to 2007 levels yesterday. The sell-off becoming more pronounced, it seems, across treasuries, though things have steadied in the session today. What is your take in terms of the sell-off? We still have the likes of Fidelity saying, look, still go long, there's an opportunity. HSBC, Stephen Major saying this is a good buying opportunity. How are markets adjusting to this higher yield environment?
I love that quote from Fidelity in that story by Ruth Carson. Everyone should read it, which is the 101 of bond investing is that you should buy treasuries when real yields are positive. You know, I think that's a really important thing to note, because this is the kind of environment that many bond traders, young bond traders, have never seen before, right? I mean, this is the highest real yields since the global financial crisis. So I do think there's kind of, should we rip up the playbook of the past decade? There's questions around that. Higher for longer, is that positive for risk assets or not? I still think there's some questions around that. You're seeing, you know, the NASDAQ had an incredibly good positive day yesterday. And even though risk assets were completely rocked by this higher for longer narrative last week, because it's meant to be bad for tech, it's meant to be bad for growth stocks. So where is the market going to land on that front? I think that will be very interesting going forward. And also here for the UK, is higher for longer going to be stickier here? I think that's one thing that the Markets Today blog is looking at, because the UK has its structural issues. Inflation is stickier than thought. Wage growth is higher than thought. Andrew Bailey and his team have a very difficult task at hand at fighting those inflationary pressures. And also, the economy is weak. Even though that GDP print that we had was better than expected, it's still a kind of a stagnating economy. That's not what's happening in the US. So again, the question for assets here in the UK is that going to derail the recovery story? FTSE 100 open higher. So I'm glad to say that that 7-day losing streak looks like to be broken.
Yeah, as you flagged for us, the FTSE 100 currently up 0.2%, just getting 14 points, but still a bit of an outlier in terms of the other major indexes, still not performing as well as the indexes over in Germany and France, for example, but at 7,271. And to your point on yield differential, the UK 10-year, the gilt, is at 472, so it's about a 40 basis point higher in terms of the yield versus its US counterpart. And then the context, of course, of the weakness in this UK economy. Sophia Horta-Acosta, thank you very much indeed. Let's get some of the individual stocks on the move. By the way, you can get more from Sophia and the wonderful Markets Today team on the UK website or by typing TLive Go. Onto the terminal, talking of wonderful people, Joe Easton is here. Joe, some stocks on the move for us this morning.
What an intro. Thank you, Tom. So John Wood is gaining around 3%. You had the CEO on the show earlier, and the main takeaway there seems to be that they could soon restart dividends. We had the collapse takeover by Apollo, so that stock is coming up from a low base, but ticking up around 3.3%. Then Ubisoft over in France seems to be the big beneficiary in Europe of the news that the Activision takeover by Microsoft is being re-evaluated by the UK authorities who previously vetoed that on competition concerns. Ubisoft getting the rights to Call of Duty and all of the other popular games from Activision. And that one up 5%, almost a big mover over in France. SBB downgraded their ratings 5 levels by Fitch. Another negative news for the Swedish real estate company. That stock slumped yesterday as well on news of a CFO change at the company. I actually learned how to pronounce that before the market opened today, but I've lost my nerve now and I'm not going to attempt, so we'll call it SBB. That one down another 4% today. Then Adyen, it's a miracle. 7 days of declines finally ending. That stock lost half of its value over the past week, given that massive profit warning we saw the back end of last week. There was already weakness coming into that report, but finally getting a gain up almost 3%, but still a very long way back for that stock over in Amsterdam. Then we're going to flip over and look at these mining stocks. BHP coming down around 0.5% at the moment, 0.5%. Rio holding up some of that bad news priced into that stock. They already did cut their guidance recently. And then not too much movement in Leonardo and Solvay, the two firms implicated in that investigation by the Italian government into the CEO of Leonardo. They declined to comment on that. Those stocks holding up at the moment. Then over to my favourite board, the ratings changes, and we are seeing the best performing stocks today. I'll start down the bottom with Hays, because that was one of the best performers on the Stock 600. We also have Adecco, both of those stocks upgraded at Exane being Paribas and are outperforming. Citi, a new buy over for CRH, they put a new buy on that one. And JDE Peet, the coffee company, downgraded over at ING, down 2%. Trades well below the IPO price and falling even further.
OK, Joe Easton from our Exeter team, thank you very much. Coming up, we're going to take a look at why JP Morgan thinks earnings estimates might be too high to be true. More on that next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Markets Today. Happy Tuesday, 11 minutes into the trading session. Gains of 0.6% across the benchmark. The FTSE 100 breaking, at least for now, snapping 7 straight days of declines, gaining 0.3% at 7,000. 277. Let's focus on tech and one of the big deals that has been in focus for all of us. Microsoft's $69 billion Activision Blizzard acquisition got a new chance at winning approval from UK regulators after the tech giant submitted a substantially different deal to the country's antitrust watchdog, the CMA. Let's get into the details then with Bloomberg's Alex Webb. Alex, what do we know about the reshaping of this deal?
So what Microsoft is now offering is the licensing of its cloud gaming offerings, of Activision Blizzard's cloud gaming offerings, to Ubisoft, a big competitor in the space. The thing to remember here is that the objections from the UK were very different from those both in the US, which were ultimately rejected. The deal was cleared in the US because they focus on that cloud gaming piece. In the US, it was about just whether Microsoft might think about, say, pulling Call of Duty from other platforms. Microsoft, of course, owns the Xbox platform, whether it would stop that going on to Sony. The regulators or the judges there decided that actually that was unrealistic. It was not a competitive threat. In Europe, in the UK specifically, it has been about cloud gaming. Could Microsoft get a dominant position? It's offered now a concession that is aimed at least at reducing some of those concerns.
OK, Bloomberg's Alex Webb on the reshaping, the restructuring of this Microsoft deal and whether or not it will appease the CMA. Thank you. Let's bring in now Patrick Armstrong, CIO of Plurimi Wealth, who owns both Microsoft and Activision, on expectations, presumably, Patrick, that the deal will get across the line. This seems to be good news for you. Your reaction?
Yeah, I'm happy with Activision. It's looking very likely now. I don't think this is just a shot in the dark. I think they've been in discussions with the regulator, and this will get it across the line. Every other region's approved it now. So, yeah, should be getting the $95 in cash for my Activision shares, and I think it's going to be accretive for Microsoft. It would have been nice if they could have kept the gaming, the cloud revenues, but they've probably sold that at a discount, but it's worth it to get the deal.
Do you take the profit once the deal's done?
On Activision?
Yeah.
Well, yeah, it depends where it's trading. If it's trading at 94 and change, I might trim it. But if it's below 94, I'll just wait. I don't think it'll be long now, and probably get the proceeds in October.
And Microsoft, the multiples, I mean, you talked about the fact that multiples across big tech are looking stretched. You hold that position in Microsoft, or do you want to be reallocating that cash as well?
I'm continuing to hold it. It's not one that's screaming value, but it's got its dominant market positions, moving into gaming. It's delivering growth in cloud. So an expensive company. I think the multiple's warranted. I don't think you can hope for any multiple expansion from here. It's got to really be driven by improving cash flows, improving earnings, top-line growth from here, rather than the multiple expansion that's really driving markets this year.
Well, to that point, and stepping back a little bit, to the point made by Marko Kolanovic in his most recent note, of course, of JP Morgan, saying that, look, these double-digit earnings forecasts for next year are just disconnected from fundamentals. He's concerned about the consumer. He's concerned about this higher rates for longer environment. Do you agree with that view?
I agree with it, and it's almost all the time. Consensus estimates are 7 to 10% too high to what's achieved, and as in you get into the quarter before a company's report, estimates are guided down to a level that are just below levels that they're going to deliver on, and then companies beat. But whenever you look at estimates 12 months out, 24 months out, those are almost always uniformly too optimistic. It's just humans are naturally optimistic. Companies are optimistic in their prospects. They pass that to the analysts, and then they get revised down. So I don't know if that's necessarily going to be a headwind because that's a pretty normal environment where earnings just do get revised lower.
And of course, there's scrutiny of margins in the earnings, and that ties to what's happening with the Fed and the impact of higher rates. Yeah. Does Jay Powell take a victory lap in terms of the soft landing on Friday?
I think he should. Yeah, he should be patting himself on the back. This time last year, it looked like he had to choose recession or letting inflation remain persistent, and he's got inflation down, not to his targets, but pretty comfortable levels, and avoided the recession so far.
How are you articulating your view that rates are going to be held higher for longer? I think you've got about a 6-month view. Where does that leave you in terms of your views around corporate debt, around some of the credit that we're seeing available?
You're being compensated to be at the front end of the curve. So I like investment-grade corporate bonds. The yield curve's still inverted. You're being compensated by being short duration. I think the long end may drift a little bit higher, and we're going to get towards a flat as a pancake curve eventually, I think, where the Fed's probably sitting on its hands. Rates are going to stay 5% for an extended period. And 10-year yields start coming up towards those levels, because 4.3, 4.4 seems pretty high from where we were, but it's pretty normal. If you've got inflation expectations at 2.3, that's where the 10-year should be. If inflation does come unhinged, you'll see higher 10-year yields, but if that 2.3 means the Fed's doing its job, that's where markets are pricing right now. probably the 10-year yield can remain around these levels.
Which equities are looking most attractive then in this kind of high yield environment? You flagged for us healthcare, and you also, I think, as well, have a bit of a play around commodities. We've seen energy pick up, Brent is up as well. Talk to us about the opportunities in equities.
Yeah, I think you want to buy the laggards right now. Just the techs really run hard through the first 7 months anyway, August being a bit weak. But companies that haven't participated are healthcare. I love Novo Nordisk, it's our biggest position. Eli Lilly, obesity, diabetes, that's the new pandemic. So these companies really have dominant market shares, have growth. They have vanity products that may turn even into insurable products because the weight loss drugs are showing signs that they reduce heart attacks and stroke risk. So maybe you get a bigger market from those kind of companies.
From vanity to healthcare. What about the commodity space then? How do you stay constructive on energy when China is performing so badly?
The thing is, there's more oil being consumed today than ever before. By the time we get to the end of this year, even with weak growth from China, China's going to be consuming more oil at year end than they are right now because their economy isn't collapsing. It's just not growing anywhere near as well as we hoped or what we thought it would do. But it's going to grow at 4% this year. Energy intensity in Asia is very strong, and it's definitely missing all expectations on growth. It's definitely suffering and it's having to stimulate the economy. But oil demand isn't falling off a cliff in China, and I think that's what everyone's worried about because they see shocking headlines on China. But oil demand's not plummeting. Supply's pretty much constrained, and OPEC's showing levels where they come in to defend prices as well. So I think companies pay back debt, they buy back their shares, and they're paying dividends, and I think that's an attractive place to be in.
Yeah, the returns to shareholders are certainly there, aren't they? Before we let you go, one of the headlines across the terminal yesterday was another downgrade for US banks, the small and mid-cap ones coming through from S&P after Moody's. You have a constructive view on bank debt.
Yeah.
Are you looking at the small caps? Or are you looking for the big blue chip, the JP Morgan names? What are you buying there?
I'm just buying 2-year bonds, senior unsecured debt from the big banks, and you're getting 6% yields on it with virtually no risk. There's no regulator going to let a senior bond go under. So financials, you're priced with a risk premium because people have seen the scary things of 2008, seen Credit Suisse. There's no risk in these bonds, in my opinion, but you're being compensated.
So you just click that 6% coupon?
Yeah, I think that's quite attractive.
Patrick Armstrong, thank you very much indeed with some calls there. The reaction to that deal, the restructured deal around Microsoft and Activision, good news and upside, Patrick thinks, in terms of how that deal gets across the line. He expects it will get across the line. And maybe some opportunities in healthcare as well as energy. Patrick Armstrong, CIO of Plurimi Wealth. Coming up, knock on wood, the CEO of Australia's biggest oil and gas producer says talks to avoid strike action that has sent natural gas prices soaring have been constructive. We get the details, we hear from the CEO. That is next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
Start by saying there's actually a number of sectors in China that are going quite well. That includes green infrastructure, other infrastructure, automobiles, and so on. But the key sector, of course, that everybody's focused on, and which is very relevant to certainly to our business, is the property sector. Now, in property, we've seen strong completions up 19% year on year. But what's lagging is new starts. That's been recognized at the central government level. There's obviously policies in place that are meant to stimulate new starts, but they're not translating as effectively into changes on the ground as certainly we were anticipating, and I think some others were anticipating as well. So that's really what we're keeping an eye on over the next 3 to 6 months, is how effective is that translation of policy into practice. If we do see that starting to take hold, then we think there could be good growth momentum flowing from FY23 or calendar year 23 into calendar year 2024. Outside of China, I was in India about a month back. The energy on the ground there, the optimism is palpable. So we're seeing solid momentum in India. Of course, that's a big market for us for commodities like metallurgical coal and for copper concentrate. So overall, we're seeing India and China comprising about half of world GDP growth in the period ahead. And the other point I would note is long-term fundamentals for this sector and for BHP remain really healthy.
The CEO of BHP, Mike Henry, speaking to Bloomberg a short while ago. Shares of BHP Group, well, we can check in those. Just give me a second in terms of the pricing around BHP, because, of course, there was a bit of a miss when it comes to the earnings picture there. Concerns, as we were discussing with the CEO, around the China exposure. And the stock is currently down. We'll see by how much in just the next couple of seconds. It is down in the session today by about 0.9%. Right, sticking with commodities, the CEO of Australia's biggest oil and gas producer says a recent spike in natural gas prices triggered by labour disputes in the country indicates that global markets are fragile. Woodside's chief, Meg O'Neill, spoke to Bloomberg earlier about the strike action.
We're making good progress on the discussions. We're engaging constructively. We're listening and trying to really understand the areas of concern that our workers have. And I think the meetings are going well. So we will just continue to engage in a constructive and respectful manner.
OK, let's go more with our energy reporter, Stephen Strapinski in Singapore. Stephen, your reaction then to what is happening out of the gas flow, the LNG conversation that continues in Australia, the debate, of course, between workers and their bosses. What are you seeing across the energy markets right now, Stephen? How do you expect this to play out?
You know, we're seeing right now a wait-and-see sort of situation. Woodside is going to have a major meeting tomorrow with the unions. If there is no agreement at that meeting tomorrow, then those workers will strike at Woodside's largest LNG export facility, the Northwest Shelf plant, as soon as September 2nd. It's unclear how long it will take for those strikes to actually affect exports out of the LNG plant, because the strikes could be as little as 30 minutes of not working to full days. It could be to not unloading. It could be to not, maintaining facilities. It could be not restarting if there's a trip. There are a lot of different ways to strike, so it won't be clear until the strikes begin or to get an indication from the unions. But the big thing that the market is focusing is tomorrow, where are those discussions? Now, we did have the Woodside CEO on earlier. You saw her comments. She said that there's been progress, but they haven't made a deal. It's unclear if they will make a deal. And I think the market, when you look at the prices, basically 50% up from the start of the month, I don't think the market expects there to be an immediate deal. I think they expect there will be some sort of disruption. It's just how big will the disruption be and how will it affect global gas markets?
Yeah, currently natural gas futures in Europe pointing lower by about 3.8%, or currently trading lower by about 4%. So prices coming off marginally. Stephen, what is, just very briefly, in terms of the demand impulse out of China for energy and oil, is there more that's going to be sucked in from China in the months ahead?
You know, I think there is a general view that China could perhaps have already peaked, their demand could have already peaked for this year. Now, of course, that could change depending on how refinery run rates go, but that will be something that could move the market if you do see an uptick in that Chinese demand.
Okay, excellent context, as always. Energy reporter Stephen Stupczynski in Singapore. Thank you. Up next, we're going to talk ARM and that IPO. All the details next. This is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Markets Today. We are 30 minutes into the European trading day, and here are your top stories. Treasury steady after global yields soar on higher for longer rate bets. The US 10-year yield hits a 2007 high. Japan's 10-year yield rises to its highest in 9 years. Chip design giant ARM files for what could be the biggest US IPO of the year, targeting a valuation of $60 to $70 billion as it looks to ride the AI boom. Plus, Microsoft submitting a new deal to UK regulators to get its Activision takeover across the line. The big concession, Ubisoft will get the cloud streaming rights for Call of Duty and all new titles for the next 15 years. Shares surge. Checking in on these markets on a day where the sentiment seems to be more positive. Yes, European equities ended just marginally up in the session yesterday, but the lift coming through from the US, the upside, of course, around technology, just pushing through the higher yield environment with a focus on Nvidia and ARM's listing as well, giving a bit of optimism back to the tech sector. Some of the big tech names rallying yesterday and lifting the Nasdaq to gains of 1.6%. The session over in Asia has also been positive, despite the continuing ongoing concerns about China. The benchmark here in Europe gaining 0.5%. Over in Germany, the DAX adding 89 points. Here in the UK, the FTSE 100, at least for now, snapping 7 straight days of losses, 7,265, a gain of just 0.1%. Across your sectors, let's change the screen because we did see autos leading the pack yesterday. Real estate was the big loser across those sectors. The dynamic has changed today. It's tech that's really getting that lift. Not a big surprise given the session over in the US as a sector up 1.4%, but it does really question that narrative that tech cannot perform in a high yield environment. That is not what's playing out today. Basic resources also seeing a bit of a lift, up 0.9%. On the downside, just energy, flat as a sector. But again, broadly, this is a risk-on sentiment, risk-on mood across these European markets. Again, volume slightly slighter and lower given where we are in the season and the month of August. Now, to the big corporate story of the day, really, Microsoft's $69 billion deal. It does look to be back on track in the UK. The Competition Markets Authority here now says it would reconsider green-lighting the deal after the tech giant agreed to sell the rights of all current and future Activision games released during the next 15 years to Ubisoft. Ubisoft shares are gaining as a result of that news. Let's get into the details then with Bloomberg's Alex Webb. Alex, how significant is this change in terms of the structure of the deal, and is it likely ultimately to get the sign-off?
I mean, it's certainly significant because the issue that they were encountering in the UK was an objection to the possible dominance of cloud gaming. This is very much a nascent space at the moment. It's not a very profitable space. What Microsoft is proposing right now is they will then license the online rights to many of their games to Ubisoft, and that they hope will let them clear it. Now, it also gives a kind of down ladder potentially for the CMA itself, which was very much an outlier now in objecting to the deal. The US regulators had also objected to the deal, but then a court there had pushed it through, had approved it irrespective. The EU has approved it. So it gives scope for lots of people to save face. It gives scope for a lot of people to save face.
It seems then, as you're saying, that it gets it closer in terms of the deal. What do you think it means in terms of the broader strategy for Microsoft? The importance of gaming on the clouds. To what extent does it accelerate Microsoft's ability to kind of spread and build out new business revenues?
Look, there are a number of different ways of looking at this deal. The first one is just the pure finances of it. I remember doing maths when the deal was announced, and even without any synergies, there was possibility for them to generate return on the investment within 3 years, which is like so meaningful. Then you think about the synergies, and it becomes even more meaningful. There's also the cloud gaming piece. Vast opportunity, loads of people sense. Again, not quite profitable yet, trying to convince people to adopt it. It could be a number of years out. The third piece, of course, is the metaverse. The heat's kind of come out of the conversation as far as the metaverse is concerned, or if we just talk about it in terms of AR or VR. That is considered potentially a building block for Microsoft to do well in that space. You've got to remember, Satya Nadella, the Microsoft CEO, has done some really canny acquisitions over the years. He did GitHub. You know, of course, he's invested in OpenAI. There's a lot of faith in his vision for what he does with these deals.
So he's got a good track record in terms of deal making at Microsoft. When it comes to ARM, that was a deal, of course, that SoftBank couldn't go across the line. So they're going for IPO. They've come through with the listing details. This is really significant, and it's significant in that AI place as well as NVIDIA, or at least as ARM, I should say, with the backing of NVIDIA, one of its big clients, looks to kind of carve out further revenue streams from AI. What are the details around the IPO?
So we've had visibility into the most recent finances. Well, we kind of knew some of the finances already because they have to file, of course, with Companies House in the UK. The thing, to my mind, the two things that really jumped out. Firstly, yes, they're positioning this as an AI play. The reality is they're not as strong in AI as NVIDIA is. The stuff they do with NVIDIA isn't really in the kind of hardcore AI piece. They do CPUs. AI is really about GPUs at this stage. The most telling number there from that front is the growth. They are not growing at the moment. They did not grow in the most recent quarter. They did not grow in the most recent fiscal year. That is not unique to ARM. Plenty of chip makers are not growing. In fact, that's why ARM isn't growing, because its designs aren't making headway right now. Partly that's because the slowdown in the mobile phone market. Now, that doesn't mean that they can't expand in these other places. They're sort of AI adjacent rather than necessarily always being core to the AI story. The second piece that was fascinating was China. China's 25% of their sales. They do so through what was originally a subsidiary called ARM China. The fascinating detail in the filings, they only now control 4.8% of Arm China. So they have a lot of risk in China. They also don't necessarily control the relationship with the companies there. Some have seen that as an upside because it's at arm's length. No pun intended, sorry. And that gives them a little bit of defensibility when it comes to embargoes and so on, but it also means they don't necessarily control it.
Okay, I'm not going to arm twist you on the arm nod there. Really interesting, 20%, 25% revenues in terms of the exposure to China, so potentially some of the risk, and again, the urgency, as you say, to move away from the mobile devices towards those data centres and the AI upside. Alex Webb, thank you very much indeed on a really massive IPO, of course, massive significance to the chip sector and the geopolitics as well. Now, the explosion, staying on tech, of artificial intelligence technology does promise to offer plenty of positive new tools, but AI is also threatening to turbocharge fraud. Financial crime experts at major banks say the fraud boom on the horizon is one of the biggest threats facing their industry. For more, let's bring in Bloomberg's finance and deals reporter Nabila Ahmed, who is one of the authors of today's Bloomberg Big Take. Nabila, what are some of the ways then that new technologies are making it easier for scammers? I have to say, I read some of the Big Take. It's a fascinating read, but it's also pretty terrifying.
It's so scary, this story, right? So scammers are running their business as a business, just like the banks are. And like any business out there, they're trying to figure out how the latest technology can make them more money. And AI is just another tool that they're now using. And AI is being used on every different level of scam. So you've got something from AI being used to clone a child's voice to appeal to a parent for money, to AI being used to write very realistic looking fake prospectuses that investors, entice investors to invest. And then all of a sudden you've lost hundreds of thousands of dollars before you've even realized it.
And I know as part of the piece, you interviewed some of these risk managers, some of these men and women who are kind of trying to tackle and keep ahead of this fraud. What are the banks doing right now to help kind of curtail these risks and these scams?
So firstly, Tom, they're really just throwing money at the problem, which they do have to do. And the estimates are that by 2025, costs for fraud detection and prevention at global banks will have risen to about $12 billion. And that's about 26% higher than it was in 2021. So you can see the rapid rise in costs. We spoke to people at Deutsche Bank and Wells Fargo, among others. And Deutsche, for example, has rebuilt its fraud detection and prevention system, suspicious activity systems, based on the latest natural language processing tools. At Wells Fargo, they're also overhauling their business, which looks at how to detect these scams using the latest AI technology as well.
So it's a bit of a cat and mouse game, as it often is with these kind of situations. What can we, Nabila, expect next in terms of how this evolves?
So the banks are really trying to spread the costs. So, they're on the hook for billions and billions of dollars each year. In the US alone last year, $8.8 billion was lost, which is up about 40% from the year before. So the banks are now saying, hey, why should it just be us carrying the load of this? How about the tech companies? They're the ones that are hosting some of these fake investment platforms on their search engines. So why doesn't the government go after them as well? And in the UK, for example, new rules are coming in where the big tech companies and social media firms will be held more accountable for fake ads on their platforms. So you're going to start to see some of the costs shifting towards other industries away from just the finance sector.
OK, and obviously some of that cost will ultimately end up in the hands and in the pockets of the consumer. Thank you. Really, really gripping read, unnerving as well, as you say. Bloomberg's finance and deals reporter Nabila Ahmed. You can read more on that Big Take. Just go to NI Big Take Go on your terminal or visit Bloomberg.com. It is essential reading. Coming up, S&P joins Moody's in cutting US banks. But why now? We discuss. This is Bloomberg.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges.
Britain's next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
This is Markets Today. We are 43 minutes into your European trading day. It is risk on across European markets. Gains of 0.7%. The run-up in yields is coming off, and the dollar is slightly softer. US futures pointed to gains of 0.2%. And here in Europe, it is tech that is leading the charge, adding about 1.9% as a sector. Now, it was only 2 weeks ago that Moody's rattled markets by downgrading a slew of US banks. Now, S&P is following suit, downgrading and dimming its outlook for several more, citing a similar mix of pressures making life, quote, tough for lenders. For the details, let's bring in Tom Metcalf, who leads our finance team here in Europe. Tom, which banks then are impacted?
Yeah, so these are the smaller mid-sized banks. So the S&P report is effectively 5 banks. So it's banks like KeyCorp, Comerica. They've all been downgraded, and a few other in that sort of space have also kind of had their outlooks cut.
What is the biggest pressure point then for these banks that are being flagged by these ratings agencies?
So it's obviously the rise in interest environment. That's what's really putting the pressure on, because what it's causing is, people are now going out and looking for deposit, higher paying deposits. So that's kind of cutting their liquidity in one way. And then on the flip side, you've got the poor markets. So, the values of those securities are falling. So the other way banks can kind of restore their liquidity is trying to sell securities. But obviously with the values lower, that's kind of hitting their liquidity too.
What is the outlook? Are we looking? Is there another potential kind of another March kind of banking crisis? Is this contained to the smaller lenders? Are the big names, are they potentially looking at downgrades themselves as well? What is the kind of outlook in the months ahead?
I think there's a bit of a split. So it's particularly the smaller banks that are under pressure, and it's just kind of a grim outlook. It's not sort of existential or anything like that, at least yet. I mean, what everyone's looking at is interest rates, right? If the Fed continues to rise, this painful situation is going to continue. If that sort of reverses itself, then things start to look a bit brighter for these banks.
It all kind of swings back to Jay Powell, doesn't it,
Always.
Ultimately? Tom Metcalf, thank you very much indeed, of course, who leads our finance team here in Europe. Let's cross over now to what is happening on the ground in Pretoria, in South Africa. The BRICS Leaders Summit kicks off today. But before that, Chinese President Xi Jinping is being hosted by his South African counterpart, Cyril Ramaphosa. For more, let's cross over to Jen Dabasaja, who is on the ground for us and will be throughout the week. Jen, what are these two BRICS leaders discussing today? Talk to us about the importance of the South Africa-China relationship.
Yeah, I mean, Tom, as you know full well, it is very important to both of these countries, and it's especially as if you think about it in the context of what's happening this week. There is the BRICS summit, but this is the only state visit that we're going to see. And if you can see behind me, there is a lot of pomp and circumstance preparing for the Chinese president to come here. But just talking about the strategic relationship that these countries have, they say that what they have is a vibrant economic relationship. South Africa really relies on China. It's one of its most important investors into this country. And on the reverse, South Africa is very important to China. It is its biggest trading partner in Africa, and it has been for the past 13 years. So what we're anticipating these two leaders to discuss is really how to deepen that relationship, if whether or not we'll potentially see more partnerships and more opportunities for collaboration. And what we've specifically heard from the South African side is how to diversify South African exports so that they are reaping more of the benefits of this economic relationship. And so there's a lot on the agenda in particular today. And so we're going to have to wait and see whether or not anything actually comes about in this meeting.
Yeah, and another potential friction point, and I wonder if the South Africans are going to be able to kind of navigate this, is India and China. And we're hearing that India's Prime Minister Narendra Modi, of course, is going to be reportedly meeting with Xi Jinping this week. Consequential, given, of course, the kind of historic frostiness between those two nations. What is on the agenda for that meeting?
Yeah, Tom, I mean, I'm sure you know, over the past several months, South Africa's really had to navigate a lot of challenges with this particular summit. So this seems to be just another one that they could potentially be navigating. But what we've learned at this point in time is, yes, Prime Minister Narendra Modi will be here in South Africa, as will Xi Jinping. And it will be the first time that these two leaders are actually sharing a stage since the G20. And what we've heard from both sides is that, yes, they do have this land border dispute that has really been a problem for their tensions for the past several years. But what we heard from the Chinese ambassador is that, yes, they do have a lot of problems, but they also have a lot of common interests. And so whether or not they're going to meet is still on the table. The bilateral meetings between both presidents, or both the Prime Minister and the presidents, were still being finalized as of our reporting. And so we're going to have to see whether or not that actually comes through. And of course, plenty on the table for them to talk to, especially when you think about how significant they are for the success of BRICS as the two biggest countries.
Yeah, a very consequential relationship. So we'll be watching that meeting very closely. And Jen, I mean, every single country involved in this meeting, of course, leaders dealing with their own domestic challenges, whether it's Russia or Brazil or indeed, of course, China. How do they square those domestic challenges with the need to kind of coordinate on this global stage?
The concern is that they may not be able to, Tom, really, because, I mean, if you think about it, this coalition of countries was created so long ago when a lot of these countries were, of course, emerging economies. And as you just alluded to, these leaders have a lot of issues that they're dealing with at home that they really cannot ignore. But what we have heard over the past few weeks is their shared interest in really reforming a lot of these multilateral institutions. And so whether or not they can come together and really produce a common communique with a cohesive narrative of what it is that they're looking for as a BRICS bloc remains to be seen. Because, of course, if we just look at the five within that make up BRICS at this point in time, they're very far apart on a number of political and ideological issues. And then when you factor in potential additional countries that are coming in, that just complicates it even more. But we'll have to see, because they've really zeroed in on this reform of institutions such as the IMF and the United Nations Security Council. So maybe they'll be able to come together on that. But we're going to have to see over the next few days whether or not that's actually possible.
Okay, Jen Pasaja on the ground for us in Pretoria for this BRICS summit. Thank you very much indeed. Coming up, yuan, yields, and yes, chips. We're going to wrap up the top stories this market open. Stay with us. This is Bloomberg.
Why does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. This week, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go.
Coverage starts Wednesday, August 23rd with a special edition of Bloomberg Surveillance live from Jackson Hole on Friday, August 25th, starting at 8 a.m. Eastern. Bloomberg, your global business authority.
This is Markets Today. Happy Tuesday, 53 minutes into your European trading session. We are risk on across equity markets. Gains across Europe of 0.9%. Tech as a sector is leading the charge, up 1.9%. US futures, S&P E-minis, are gaining 0.3. The dollar is softer, and the bond markets are taking a bit of a breath because the yields are coming in across the US Treasury curve after that very steep run-up that we saw yesterday, getting, of course, the 10-year to levels we have not seen since 2007. On that and much more, let's bring in Eddie van der Walt for the key market themes as we come to the close of the first hour of the trading session. Eddie, let's talk about the yield story then. Do you think that, I mean, we're seeing a bit of a breather now. Your views, what are the market's expectations around the run-up in yields and whether or not there's a bit of a pause now ahead of Jay Powell and Jackson Hole?
Yeah, absolutely. Look, I think there is probably a bit of a pause. We saw probably the last bit of that sell-off yesterday, but I think the story of re-steepening is one that's going to have to be with us if we get to a more normal world again, right? So if we see that re-steepening, we're probably seeing that with the back end of the yield curve rising significantly over the next few months, unless we see a recession which brings down the short end. And so if we get a soft landing, re-steepening, then it's going to have to be the back end that moves. And I think, therefore, this is going to be a continuous story that we're going to have to contend with. So I think we get this pre-Powell pause, but then I think that story has to continue.
PPP, the pre-Powell pause.
Absolutely.
There's the ripple effects, of course, from what's happening in the US, the higher yield environment, the higher rates environment, and Jay Powell's next steps and the FOMC's next steps and what's happening in China. And we saw again a record fix from the PBOC. What is your take on how policymakers in China are handling this? The concern about weaker yuan, or indeed if it's going to give a bit of lift to the exporters over in China?
Yeah, so there's two ways of reading this today. A lot of people are saying, look, that the PBOC is really squeezing the shorts and really, going all in to kind of engineer a rally. On the other hand, it looks a little bit more to me like it is part of their step-by-step intervention, little by little, just seeing how much the market really needs and, just keeping a little bit of support. So I think this is more about slowing the decline of the yuan than it is about squeezing the shorts and instigating a new rally.
The other big story, we're looking ahead, and this lifted the tech stocks yesterday, stateside. So you have the NASDAQ ending up about 1.6%. The excitement about NVIDIA.
NVIDIA is about more than just the AI story, right? We're all talking about AI, and that is what's fueled their price growth this year. But that company is going to tell us more tomorrow. They're going to tell us something about consumer demand, because remember, they still make video cards for gamers, of which I'm one. And that's a very high-end consumer discretionary product. At the same time, it is about, you know, the Bitcoin story. So about consumer or investor demand for highly speculative assets. And then, of course, it's about the supply chains. It's about, can they get enough chips to make their video cards? So I think they're probably going to tell us more than Powell's going to tell us about where markets are going for the rest of the year.
Far Cry 6 then, Eddie. That's your game of choice.
That is my game of choice, which I should say is actually optimized for their competitor, AMD. So there's another sub-story there about whether AMD can catch up with
Is there
NVIDIA.
anything you can't bring to these markets, Eddie? This is brilliant. Touch on Bitcoin as well. Far Cry 6, the gamer there on the take as we look ahead to those NVIDIA earnings tomorrow, of course, and the excitement in terms of the AI play. Eddie van der Walt from our Markets Live team. Get more from Eddie and the team, of course, on the terminal and on Bloomberg.com. That is it for markets today. We are risk on. Stay with us. US futures pointing to gains. This is Bloomberg.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
On the next episode of The Circuit.
It's still almost shocking how new you still are to this sort of being famous thing.
When I do, you know, go out and people are like crying, that's when sometimes I'm, whoa, why? There's no rule book for it.
Watch The Circuit with Emily Chang Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Good morning and welcome to The Pulse. I'm Manus Cranny in Dubai. Here's what's coming up on today's program. Microsoft submits a new deal to the UK regulators to get its $69 billion takeover of Activision Blizzard over the line. Treasuries are steady after a global yield soar on the higher for longer rate bets. The US 10-year yield hits the highest since 2007, and Japan's JGBs rise to the highest in 9 years. Plus, we'll be live to Pretoria, where South African President Cyril Ramaphosa is hosting his Chinese counterpart, Xi Jinping. That's ahead of the BRICS summit. Very good morning. Warm welcome to the show. Let's take a look at the European map. I'm surprised. Billy's profit is down by 37%, and yet you have this strength in the minerals and resources. Tech is on the up, partly due to the Nvidia ramping by 8% last night. Their numbers come this evening. ASML, ST Micro also drifting higher. You know, hope lives eternal. Nvidia better not disappoint tonight. There's the pre-market up 1.29%. We're now up 10% in the space of 2 trading sessions. Nvidia had better deliver. Now, Billy's profit dropped by 73%. I can tell you that was a little bit of a shock in terms of the actual scale of decline and the deposits. Is Europe cheap on a relative basis? Billy says terms, while your SPOOs are up 15%. However, your profits are dropping much more aggressively in Europe relative to the United States of America. Across the assets, this is the state of play. I mentioned the bond market. I mean, they are literally on fire. What's the 101 rule of bond investing? When you got positive real yields, buy them. Bob Michael, of course, at JP Morgan Asset Management said he wanted to buy every dip. Sounds like the sound of music to me. But the bottom line is 10-year government bond yields coming off their zenith, the highest since 2007. But it's the real yield that you want to keep an eye on at 2%. What does that do to risk? JGB's testing the mettle of the Bank of Japan as JGB yields rise. What could happen next? The Chinese are nervous, to say the least. They have an unbridled currency, and they step in to try and pull it back on the reins as they do over 1,100 pips stronger in the fixing. Yet still, as New York wakens up, you begin to see a little bit of a drop in the yuan and a rise in the dollar. Stock 600 resources up by 1.42% at the moment. The deal. Microsoft's $69 billion deal for Activision Blizzard, the acquisition, has got a new chance at winning approval from the UK regulators. That's after the tech giant submitted an amended deal to the country's antitrust watchdog. Let's get the latest with Alex Webb. Alex, this is what's called trying to get it over the line with, I suppose, a little bit of acquiescence to the regulator.
Yeah, it is a useful kind of ability to save face for both the companies and, of course, the regulator itself, which was really the only holdout now in terms of preventing this deal from a regulatory perspective. The European Union has cleared it. Regulators in the US tried to block it, but ultimately it was pushed through by a court. The difference is, of course, that in the UK they were blocking it on the basis of potential dominance in cloud gaming. That's where you're playing on the cloud. Microsoft, of course, has its Xbox platform on which it could do that. In the US, the argument was, well, will they just dominate and the platforms and pull games such as Call of Duty away from, for instance, PlayStation? Microsoft successfully made the case in the US that it didn't make economic sense for them to do that. Now in the UK, they've offered this big concession whereby they will license essentially the distribution of their games in cloud gaming to Ubisoft, which they hope, and a lot of the consensus at this stage seems to suggest that people think they will assuage the CMA's concerns.
Yeah, they're going to sell the rights to what the next 15 to Ubisoft. Ubisoft is powering ahead. It's up over 6%. Let me just check for our viewers. 6.69% on the back of that. Now, mud in your eye to London. Arms off to the NASDAQ for the IPO. But I suppose that's about reputation and competition. But what do we learn from the filing from ARM?
The thing that was particularly interesting were 2 points. There was an earnings piece which showed that actually their earnings growth has, well, has shrunk. They haven't actually grown in the past year or indeed the most recent quarter. That isn't unique in the chip industry. And in fact, it's because there are large tracts of the chip industry that aren't growing that ARM itself is having a tougher time of things. That also suggests they maybe don't have the same sort of exposure to AI that their investors would like, or their board would like you to believe, but also that they are not similar to Nvidia, which has massive growth. The second piece is actually the way they're exposed to China. They've got 25% of sales to China. It goes through what used to be a subsidiary, ARM China. It is the really interesting detail was that they only now control 4.8% of ARM China. So that is a little bit of a risk. It means that they don't necessarily have direct control over the way they do business in that country, but yet they have significant earnings exposure to it. So those were the two big jump outs from a financial perspective in the filing.
Okay, Alex, let's see what happens with the Microsoft deal. And just as Ubisoft, as I said to you, is one of the key beneficiaries, let's just check the price. 28.72. The stock rose as much as 7%. The French company has signed a deal with Microsoft, we understand, or it will sign a deal. And this is for Microsoft selling the rights of all the current and future Activision games released during the next 15. Ubisoft, the next 15 that are released. So there you go, the winner. The vicarious winner in the Microsoft Activision Blizzard trade is how to get around the regulators, Alex Webb. Okay, let's talk about the BRICS and the leaders. The gathering, the summit is kicking off today. But before that, the Chinese President Xi Jinping is being hosted by his South African counterpart, Cyril Ramaphosa. Let's get across to Jen Zabajaja. She's on the road. You've left Joburg. You're in Pretoria. Big moment for these leaders to meet. Jen, good morning.
Morning, Manus. Yeah, definitely. And you can sense that on the ground here. We're just a few minutes out as we're hearing from Xi Jinping actually coming to start the one and only official state visit that is happening this week amidst all the other BRICS activities that are happening. But as you mentioned, this is very important. And just the fact that they're hosting this state visit is very strategic and important to both of these countries. From the Chinese perspective, South Africa is its biggest African trading partner and has been for the past 13 years. And from South Africa's perspective, China is one of its most important investors. And South Africa was actually the first African country to sign on to China's Belt and Road Initiative. So this diplomatic relationship goes back over 2 decades. So what we're hearing these two leaders are planning to discuss is how to further deepen that relationship and how to potentially explore new opportunities in various sectors, from mining to agriculture, and of course energy, which is of great importance here in South Africa. And so we're expecting them to speak about that, but also talking about what sort of reforms they're looking for on the multilateral, within multilateral institutions that they maybe can agree on, and also how to diversify South Africa's exports to China. But because of course we know South Africa imports a lot from China, but they do not believe that they're getting the value add that they potentially could. And so a lot on the agenda today. And so we're just waiting here for China's President Xi Jinping to arrive, which we're being told is imminent, Manus.
And another bilateral will be the Indian Prime Minister Narendra Modi reportedly meeting with Xi this week. What do you think is going to be top of their agenda?
Right, Manus. I'm glad you stressed that it's reported, because we're still unsure, and from both sides what we've heard is that there is a potential for this bilateral meeting and that their schedules as of yesterday was still being finalized. But we did hear from the Chinese ambassador saying that despite a number of disputes that they have, of course, the most well-known one is probably their land border dispute, they do share a lot of common interests, and especially if you factor in the point that India and China are the biggest BRICS nations. They make up the majority of the economic activity and the GDP of the BRICS nations. They have a lot on the agenda to talk about. Whether or not they're actually going to meet one-on-one is unclear, but we will see them on a stage for the first time since last year at the G20.
Okay, so big moments all around on the geopolitical front. Jen, thank you so much. Jennifer Zabazaja in Pretoria. Coming up in the show, the global bond yields are soaring. We're going to discuss what does higher for longer really mean to investors as you position for the U.S. economic resilience right here on Bloomberg. Good morning.
Solar energy, wind power, battery-operated cars.
The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. This week, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go.
Coverage starts Wednesday, August 23rd with a special edition of Bloomberg Surveillance live from Jackson Hole on Friday, August 25th, starting at 8 a.m. Eastern. Bloomberg, your global business authority.
It's the conversations that matter, the insights that you need. They're right here on The Pulse with me, Manus Cranny, in Dubai. So the global bond yields are soaring. Investors are positioning for this higher for longer interest rate cycle. 10-year paper in the States hit the highest level since 2007, and 10-year JGBs hit a level we haven't seen since 2014, testing the metal all the way around. Anita Gupta is the head of equity strategy at Emirates NBD. Good morning.
Good morning, Manus.
Here we are, real yields at 2%, a bond market that's lit up earlier than Christmas. What does it mean for risk?
Very strangely, what we found was that in the first half of 2023, yields and equities were highly correlated. So you had yields going up and you had equities in developed markets performing well. Now we've come back to fundamentals, so we saw a sell-off about 5% on global equities as yields have risen, with the 10-year at 4.33%, with the 2-year close to 5%. So definitely there is an impact on risk, but have the yields peaked? That's what's important for equities.
Do you think they have peaked? I mean, I've got Stephen Major saying step in and buy bonds here. You've got Bob Michael saying buy every dip. But yet we have this narrative that this isn't revolutionary, this is returning to norm. So do you think we are going to see 5% on bond yields? Are you ready for 5% on bond yields? What would it mean for you on equity to bond allocation in the portfolio?
I think this current inverse correlation is going to continue. If you continue to see yields go higher, I would definitely be worried about what's happening, especially to US equities, European equities, Japan. We've got all 3 10-year yields at about a 10-year high. What we are looking at is that all further hikes, especially for the Fed, are data dependent, and inflation is softening. So hopefully we would look at maximum another 25 basis point hike.
Well, I hopped into the green room with you earlier and I said to you, so real rates are 200 basis points, what does that mean? And you very firmly said, well, it means the Fed doesn't need to hike any further. And if you look at the op-ed that we have this morning, Kashkari reflected on the neutral rate as being 200 bips above where inflation is. With that in mind, the Fed is done, let's say, if that is the theory. would that mean that you'd be a buyer of dips in these equities? There's going to be a few jolts, all right? We're not going to stop at 433. There'll be a few attacks on the upside in yield. That will deliver entry opportunities for you in equity? Is that the correct way to look at what you're saying to me?
At this point, I would say that yields are the biggest catalyst for equities either way. However, we've just had an earnings season better than expected. Expected to be the trough in earnings for the US at least. So if that's the trough in earnings, eventually equities will perform based on earnings. And this is where we come to the differentiation. Very interesting fact which I read on Bloomberg, which I think was put out by Goldman Sachs. Only 50% of the companies listed in the US are profitable. So again, here we come back to quality. It's not about just buying the dip. It is about buying quality. And if yields are high, buy companies with strong balance sheets.
Tell the truth. Have you got a little bit of NVIDIA?
Well,
I know you don't do individual names.
Oh, we do. It's okay. I can comment on NVIDIA because
I like her. I like a guest that can commit. Yes. Commit to me.
Okay, so what we are looking at for these AI-driven rises in equity performance, and now there is a gap of about 60%. So any company which is an AI enabler or an AI platform is roughly about 60% above another company which is not caught AI in any form. And if you're looking at NVIDIA, you're talking here of about a 50% revenue growth expected this quarter over last year. This is coming back to what was happening with Amazon and Google on cloud. So they were having these 30 to 40% revenue increases, profit increases, cloud growing. Now that's come down a little bit to about a 15 to 20% growth. So the semiconductors and NVIDIA does manufacture the high-end chips needed for AI. So it is currently a win-win for NVIDIA.
Now, if I look at China, I'm desperately trying to talk to every CEO at Woodside Petroleum, saying small fissures in terms of the overall energy demand. You look at MSCI China, down 11% in August alone. They are grappling with the FX market quite desperately, I would say. Can you live, or would you dare to live, without China as an allocation? And if so, how would you allocate at all away from it?
We were a little brave. We went neutral EM Asia 2 months ago, and then we had a China rally. And then was it like, are we wrong? However, what's happening with China is you have this 1 month 10% rally and then it goes down again. So we don't want to be very heavily allocated to a very volatile market. I think, again, as we spoke earlier, markets don't behave on hope. Markets behave on reasonable estimates. And China needs to show some fact in terms of where that growth is coming from. You've had a number of houses downgrade economic growth. Again, we have had issues around real estate. We've had defaults. We've had investment companies that are not paying up. This is worrying. We're not seeing inflows into China. So we are neutral at this point on China. And I think we would be till we see some factual data that would convince us about the resumption of consumption. That's
hope does not pay the bills, does it, Anita Gupta? That is the bottom line. Thank you so much for being with me. That is Anita Gupta, Head of Equity Strategy over at Emirates MBD. She can live without a max allocation to China. Coming up on the show, not just gassing. Woodside Energy says talks with LNG workers have been constructive. We'll bring you our conversation with the Woodside CEO, Meg O'Neill. That's next on Bloomberg. Good morning.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
From New York City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Quick snapshot of how the miners are doing this morning. Profits of BHP Billiton fall by 37%. They are slashing the dividend. The stock down by just under 1% at the moment. The rest of the miners actually aren't doing so badly, even though Billy's talk about earnings in iron ore, coal, copper and nickel all declining. So keep an eye on that. The rest of the energy complex is on the up. Have we hit a trough in China? That's the question I ask myself. Let's focus in on Billy's. They reported the lowest annual profit in 3 years. For more, let's get to Stephen Chichinski. He joins me now from Singapore. What caught my eye, Stephen, down Woodside, down in Australia, and down this morning in London. Talk me through what caught your eye in Billy's. The dividend being slashed to 80 cents caught mine. Good morning.
Yeah, I mean, the dividend being slashed, you could see that maybe coming if you were looking at, like, Rio Tinto did the same thing in July. You know, they're also one of these major miners. But I think the focus, of course, is the outlook on China. It's not so surprising given everything that's been happening in China with the economy, with the kind of real estate troubles that's been happening there. The stimulus in the country, according to, you know, the CEO of BHP, is that, you know, the stimulus in China is not, it's helping propping up some demand. You know, the second half, they said second half demand looked better than the first half in their full year earnings. But still, when you look at where the Chinese stimulus is affecting the economy and affecting growth in the country, it's not coming through in demand for iron ore the way that they were expecting it to. And so because of that, it's looking very uncertain in China. And he was, you know, I think pretty honest in the interview earlier, saying that it wasn't clear what's going to be happening with Chinese demand.
Well, just hold that thought, because, of course, Meg O'Neill over at Woodside, which closed down 1% in Sydney, she talked about the fragility of demand in China. Australia's biggest oil and gas producer, the first half results pretty much being overshadowed by the strike talks with the LNG workers. I caught up with Meg O'Neill, the CEO, a little earlier, and we talked about the current state of the LNG market in Europe.
The fact that the market has responded in such a significant way to the rumor of a potential industrial action suggests to me that the market is still quite fragile, and that European buyers and the European market is concerned about the levels of supply that they will have going into the Northern Hemisphere winter.
Briefly, Stephen, she's not outstandingly bullish on the forward pricing market, is she?
You know, I think one thing that she really focuses on is, there's a lot of uncertainty there as well. While she's not terribly bullish, I think it's really interesting that she called the possible strikes rumors, because there are discussions happening. There are unions threatening to strike. And while the strikes haven't started, they could start, if there's not a breakthrough in talks with Woodside, as early as tomorrow. Those strikes could be in early September. If that does happen, you could see quite a bit of upside on gas prices, not only in Europe, but also Asia as well.
Stephen, thank you much. Stephen Stachinski there in Singapore on all things energy. The BRICS leaders kick off the summit today. We discuss.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
This is Bloomberg.
Microsoft submits a new deal to the UK regulators to get its $69 billion takeover of Activision Blizzard over the line. Treasuries are steady after global yields soar on higher for longer rate bets. The US 10-year yield hits the highest since 2007. Japan 10-year yield also trades at the highest level in 9 years. Plus, we're live to Pretoria, where South African President Cyril Ramaphosa is hosting his Chinese counterpart, Xi Jinping. That's ahead of the BRICS summit. Good morning. It's The Pulse. I'm Manus Cranny in Dubai. The BRICS leaders summit kicks off today, but before that, the Chinese President Xi Jinping is being hosted by the South African counterpart, Cyril Ramaphosa. For more, let's get to Pretoria. Jen Zabazajeh is outside government buildings. These two leaders have a lot, let's say, structurally in common. What will top the agenda today? Jen.
Yeah, Manus, good morning to you. And these two leaders have really, over the past few weeks, days, weeks, and months, really stressed the importance of this relationship. We actually saw yesterday Chinese President Xi Jinping actually take out an op-ed, an editorial in the papers, talking about just how important this relationship is to their country. And from his perspective, it is a vibrant economic relationship that could be potentially deepened and further explored. And he talked a lot about how rich South Africa is in a number of different sectors, and potentially how that is an opportunity for Chinese investors, but also for South African businesses to then export to China. Because for the most part here in this country, in South Africa has been a major importer of Chinese goods, which is significant for China, especially when we look at the African continent. This relationship is very important to both of them, but just going forward, these leaders are really trying to look at what more can be done. And really, they have a lot that they're individually interested in, depending on which region you're sort of looking at.
Jen, they're all lined up there, full red carpet, ceremonial, ready to go. Jen Zabajaja in Pretoria, tracking the BRICS summit. Well, let's just expand that conversation to the EM space. Phoenix Kalen is head of emerging market research over at Societe Generale. We were looking at the theatre of BRICS, and we had Jim O'Neill saying, well, really, apart from China, everything else has been relatively disappointing. So let's focus in on China. How important is it for Xi Jinping to re-grasp control of the yuan, which seems to be failing at the moment, the biggest fixing on record again? How important is that to Xi and to the PBOC? Good morning.
Good morning, and thanks for having me. Yes, I think the currency is definitely one of the key underpinnings of the economic policy around China at this point, given how the data has massively disappointed, especially over the past month. We are looking at indicators that are suggesting that China's facing all-out deflation across all the various economic indicators. There's been a massive disappointment, and the currency fixings, they've tried to fix it much stronger each day. We've seen the fixings rise up to even 1,000 bips. So similar to the levels that they were trying to fix it stronger last summer as well. So very high levels. And this has actually still failed to curb the yuan weakness. And so it is going to be quite a challenge for the premier to try to rein in the economy in terms of all the dysfunction that's happening across the state of leverage, the state of the property sector, the state of consumer confidence. And so I think this forum here that we have at BRICS is a chance to maybe take a step back, maybe showcase how China has allies, maybe expand that kind of grouping in the BRICS, and promote kind of a soft power that China's projecting.
Soft power will not stop outflows and may indeed, as you said, the dysfunction may stymie inflows. When you look at global flow to China from an EM perspective, where are we?
So global flows, I mean, this year we've seen about $100 billion worth of outflows from the Chinese bond markets. So outflows are still continuing. There was a little bit of an uptick in the summer, but that was fleeting. And there was a bit of an uptick earlier this year around the China reopening, and that faded as well. So people are very much concerned around the geopolitical context with which China is operating, and then the strong, kind of the long-term structural challenges that China face that is going to be quite medium to long-term in nature, and that growth decline is curbing the investment appetite from a lot of investors.
And now one other major meeting which we understand or is reported to take place this week will be Xi alongside Narendra Modi. Now you have a vicarious risk trade that I can sort of lay out, which is long rupee, short yuan, which is almost the very personification of that geopolitical meaning. But stand up the trade for me in terms of the narrative, because it is about current account deficits and it is about fundamentals.
Yes, and it's about carry as well. So India's investment appeal has massively improved over the course of this year. It's an economy that's exceeded expectations on the growth front versus China, which has disappointed expectations. India is now being investment-led in terms of its recovery. So that's a really appealing investment thesis for a lot of investors. And then there are, yes, things around the carry structure, the kind of momentum that we see, especially in the bond market, where we think Indian bonds stand to benefit from the positive momentum that we see in Indian assets and the potential for inclusion into the large benchmark global bond indices. So that should encourage flows as well. So I think there are key differences around macro fundamentals in terms of how the growth outlook looks for India versus China, as well as the geopolitical context where India is maybe a bit more balanced in its and more nuanced in its relationships with the Western partners, and less prone to the capital outflows that we might see out of China.
And part of that, part of the underpinning of this is also on the FX reserves. And this is something which I look at, for example, when I'm looking at Saudi Arabia and those FX reserves, et cetera, divesting of treasuries, mega projects going on there. But from the FX reserve point of view, it's also an underpinning of the long rupee on a broader FX dynamic, isn't it?
Yes, the Reserve Bank of India has been very cautious around trying to prevent massive levels of volatility in the rupee. And so they are there intervening on both sides of the equation, trying to prevent excessive weakness or strength and smoothing out the volatility. And that does help to instill a bit of confidence in the stability of the currency and its attractiveness as a funding asset.
We're constantly trying to understand what global weather patterns mean. I had the CEO for Dubai Airports here this morning. What does it mean for tourism? We have El Nino. I've had WhatsApp after WhatsApp from various groups about the longer term ramification. Within the dynamic of commodity pricing, when you look at the things like rice, etc., just talk me through the top level of the risk from El Nino, and to what extent does that play into how we should think about allocating?
Yeah, so I think the changes in global climate patterns is going to severely impact commodity prices over the coming years, decades. And in terms of I think that the key implication is around the heightened volatility that we're likely to see out of commodities markets. The structure of the market is going to be still quite diversified and differentiated. And the things like base metals, things like oil prices, energy reserves, those are still going to be helped by the supply constraints that are implicit in the market. And so prices there can still be supported. I think also the food prices, agriculture prices, because those are so heavily influenced by weather patterns, and those weather patterns are becoming much more volatile, much more violent, those can also exert upward pressure on grains prices and all the components that are necessary to kind of the food basket in a lot of the EM countries. So overall, I think there is structurally still upward pressure on food prices, on commodity prices, and those are going to be notwithstanding the global slowdown that we're experiencing.
I mean, just on the whole rates narrative, which will drive EM to DM, we are in this new zone, aren't we? We're debating about whether 10-year benchmarks in the States will get to 5%, whether the Fed has done enough. Neutral rate, where is the neutral rate? 200 basis points above inflation at the moment, which is where we are with real rates. When you look at the rates, the global rates landscape, where is EM to DM in terms of the narrative? And I suppose that's more on the debt side, on the bond side at the moment that I'm curious.
So the picture is really quite differentiated. So we've got like heat maps of the valuations picture that we map EM versus DM and how that's played out over the past 10 years as a benchmark. And we see that, for instance, LATAM bond markets, fixed income markets are offering very attractive levels relative to where they've been trading over the past 10 years, relative to the kind of real levels of yield that we've seen there. And so in those kinds of valuation metrics, LATAM markets, Mexico, Brazil, even though there have been lots of movements this year already, those still offer quite attractive valuations. On the other hand, places like Asia, those are not so attractive given how far yields have declined already in this kind of disinflation narrative now that we have in place, and the downward drift in yields over the past several years. So it's quite a mixed picture, but what does stand out is that there are pockets of value, especially out of LATAM, and now especially out of a few markets in the CE complex.
Okay, it's all about differentiating, not just in equities, but in the bonds and EM space as well. Phoenix, thank you so much for being my guest this morning. Phoenix Kalan, Head of Emerging Market Research at SocGen, as the BRICS leaders gather in Pretoria and across South Africa this week. Coming up on the show, we're going to take a look at the future of funding for women's football. We're joined by the CEO of Mercury 13, which has just launched a $100 million multi-club fund. Where to invest on Bloomberg. Good morning.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Conversations that matter, the insights that you need right here on The Pulse. I'm Manus Cranny in Dubai. Well, the viewing figures show that Sunday's World Cup final set a new UK record for women's football matches, with an average of 13.3 million people watching the game. Spain's victory, of course, was hard to take for the Brits. As interest and money in the women's game grows, how will the funding of women's football clubs change? My next guest is launching a $100 million multi-club fund to buy controlling stakes in women's football clubs. It is Victoire Coevina Reynal, CEO of Mercury 13. Victoire, welcome to the show. Mercury 13, you're raising $100 million. Have you got there yet? And where's your first major multi-club target? Is it going to be Spain, UK, Italy? Where? Good morning.
Hello, Manus. Good morning, and thank you very much for having me. We are launching Mercury 13 today, and it's incredibly exciting, especially with what happened at the Women's World Cup. Our first target is here in England. We are not allowed to share the news just yet. We will later this week, but it's definitely a club that we're very passionate about and that has tremendous potential, and we're lucky that we're going to be working with them moving forward. Our second target, and this, I promise, was not planned, is in Spain. So we saw both our nations at the final, which was great for us.
Tell me this. You are now going to be in charge of capital. You will decide in part how wages are paid. The money differential is spectacular in the sport, isn't it? I mean, women paid $30,000 a game. The winning team, $270,000. You know, male colleagues get $1 million for an Instagram posting. Will you lobby to raise wages actively and really raise wages in women's football?
Absolutely. I have done for the last 5 years of my career, so this is not going to change right now. Right now, there's also a commercial deal for it, right? There is really data that can back that it's a good business, and raising the wages is part of it and is very much justified. So we're going to be working on this 100%.
Given the viewing figures that we saw in the Australian semi-final, the women's final of Spain, England, what's it going to do to pricing pay-to-view women's football?
Well, we're going to see everything starting to rise, right? It's not only the broadcasting rights, it's not going to be only the commercial, deals that we're going to be seeing, but it's also understanding that women's football is bringing in a whole new audience into football that for the last 100 years we haven't seen, which are women. And to me, that is, a billion-dollar opportunity, if anything. Women, we control spending power in homes, as you know. And we are going to be able to now, as we are welcomed into the sports, to be a part of those decision-makings, whether it's by taking our entire family to a stadium or traveling to watch a club and be a fan of it with everyone, in the household. It really poses an enormous commercial opportunity. And at Mercury 13, we were going to support our clubs with our stellar management team that has been prepared to work on everything from the commercial to the financial to the on-pitch performance, to make sure that we are capturing all of this opportunity and that we are accelerating our clubs' victories on and off the pitch.
You said that you've been an advocate of higher wages, remuneration and deals for women for many years. So the money you lend, the money you give, will there be strings attached to that around remuneration for the girls on the pitch?
Absolutely. I mean, it's going to be a part of the financial model, right? This is a business at the end of the day. There's a lot of people that invest into women's football as a charity, as a form of charity. We're not looking at this as charity. Obviously, women's football is very clearly a gender equality movement, one more powerful than the Me Too movement, in my opinion. But at the end of the day, it is a business. We have investors and we need to create returns. And I think that actually making sure that we build that argument that women's football is an incredible investment asset will end up helping the whole industry at large. And so, increasing wages for players is just the beginning, but it needs to be in tandem with what they're doing off the pitch on the commercial and broadcasting rights. So it goes really hand in hand.
So let's just talk about the Lewes Football Club. It's fan-owned at the moment. What's going to happen to that model, if at all? I mean, can you just give us a sense? I know that you've got some challenges around this in discussing this, but what do you think the biggest fundamental change would be if, and I emphasize the word if, that deal comes to pass later in the week?
I'm really not at liberty, unfortunately, to discuss more about this, but I will say that with all of the investments that we're making, we're looking at strong operational teams that are existing, right? And clubs that need capital to move faster. Right now, women's football waits for no one. It's moving at the speed of light. I actually had a baby girl a few weeks ago, and I'm here. So clearly it hasn't waited for absolutely anyone. And we need to make sure that we're capitalizing on this and making sure that, we can grab the timing, get to the commercial side of things as fast as we can, and start, getting quick wins.
Victoire, we wish you well and well done on raising the funds and deploying them actively. We wish you well with whatever deals may come to pass. Victoire Kohevina Rehnal, CEO of Mercury 13. Women's football is on the up. Coming up, depositors are seeking out better returns on their savings. What does it mean for the US regional and mid-sized banks? We discuss right here on Bloomberg. Good morning.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
It's the conversations that matter, the insights that you need on the pulse with me, Manus Cranny in Dubai. Overnight, S&P Global have downgraded and cut their outlook for a slew of small and mid-sized US banks. S&P says the clients move funds into accounts with higher interest rates elsewhere, deposits decline in the banks, quid pro quo, squeeze on liquidity. Tom Metcalf is with me. You know, Tom, in 2007, in September 2007, there was a physical run on a bank. It's an image that will always be indelibly etched on my mind. It was Northern Rock. These kind of downgrades, are we inching towards another electronic moment of another disruption in flows? Good morning.
Hey, good morning. I mean, look, that's the big question, right, Manus? I think probably it's not really an existential crisis yet, but again, more bad news for these small and mid-sized US lenders. So the Co-Americas, the Key Corps, they're all being downgraded, and a few more kind of having their outlooks sort of cut by S&P. Comes after a Moody's move as well. I think, you know, there are these negative trends, and that is obviously not good for these smaller banks. But in terms of when you look at the broader banking systems, you know, I think those bigger banks are doing well, and that will probably sort of offer a bit of a buffer as well.
Where do you think the biggest pressure point is? I mean, if I'm looking up T-bill ETFs, you know, and looking for the ticker for that, I mean, that spells danger for everybody in the United States of America, because if I'm unleashed on an ETF, but that is the personification, that is the pressure point, isn't it, in terms of the flow?
Yeah, exactly. And, you know, as ever with these things, who's everyone looking at? Jay Powell. You know, he'll be speaking this week. And, you know, what the Fed does with its interest rates is really just going to dictate, you know, as you say, how bad this crisis gets, right? If they continue to rise, you know, that's when we might start asking those questions you posed at the start. Of course, if that kind of whole sort of backdrop eases a bit, then things are going to look a lot rosier for these banks.
And it's going to be a bit of a tight squeeze on some of these lenders. Do you think the worst is past, or just briefly a little bit more turbulence to come?
Yeah, I think probably a bit more turbulence. It feels like we're just kind of still in the midst of this. I remember I was talking about this months ago, right? And I was sort of feeling this regional crisis didn't have too much longer to run. So I'm going to couch my bets and say, you know, there's still a bit further bad news ahead.
Oh, dim and gloom. That wasn't how I wanted it to end, Tom. Tom Metcalf there, our managing editor for finance in London. It could get a bit tricky as we go ahead. Pretoria is the destination for Xi Jinping to meet his host, which is Cyril Ramaphosa, the head of the BRICS gathering in South Africa. The flowers are out, the carpets are laid as they await the arrival of some of their biggest trading relationships onto the red carpet. Narendra Modi is said to meet with the Chinese Prime Minister, reportedly meeting with him later. This is BRICS wrote large. What will the political and economic power and consequence be of BRICS? Kriti Gupta is up next from New York. We're along with Tom McKenzie in London with
world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions. This
sell-off from spiraling. Bloomberg is live in Pretoria as South Africa's president hosts China's Xi Jinping ahead of the BRICS summit. Expansion, currency cooperation and food security are all on the agenda. And Microsoft submitting a new deal to UK regulators to get its Activision takeover across the line. The rare move follows a series of dramatic twists and turns in the deal's global regulatory battles. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie, stepping in for Danny Berger here in London with Kriti Gupta in New York. And Kriti, there's a risk-on mood across these markets.
There is, and it's interesting, even in the bond market, there's a risk-off mood. Some really interesting kind of cross-currents in the markets right now. We'll start with the equity market, though, because, Tom, you're absolutely right. Green on the screen here, stateside, higher by 0.3%. A little bit of that global sentiment feeding in. Again, I'm going to reiterate, it is a summer Tuesday, so we are seeing light volume, but nevertheless, perhaps the sum of all parts trade, because we do have some individual stories that are perhaps moving that sentiment forward. For our radio audience, 44.26 on those futures contracts. But the bond market, as promised, is really where I want to hone in. The 10-year yield, 4.31. And remember, yesterday it closed at the highest level in about 14 years. So you are seeing a little bit of a pullback when it hits those kind of record levels. 431 down about 2 basis points right now. Really not in line with the global bond story, because take a look at what's happening in Japan. The Japanese 10-year yield actually higher, and it had hit its highest in about, I think, a 9-year high overnight. So again, you are seeing the JGB story continue to see some upward pressure as the BOJ really stands put on how they're going to be dealing with inflation. And speaking of inflation, let's go in the opposite direction and talk about perhaps deflation or disinflation. Pick your poison, if you will. Dollar yuan now seeing its strongest fixing overnight on record. So as people kind of try to flood out of the yuan, pull out of China because of that data you're seeing in the property sector, but also from the Chinese consumer as well, it looks like the PBOC continues to step in. Nevertheless, dollar yuan at about 730. Stronger for the greenback right now, higher by 0.2%, Tom.
Yeah, Chris, it's interesting that you highlight what's happening with the yuan, because you did see in the equity space in China mainland and in Hong Kong this kind of late session surge as well, and question marks from some traders over in that part of the world as to whether the national team, the big state-backed funds, have gone in to buy up some of the stocks there. You saw about a 2% gain on the HSI over in Hong Kong in the matter of minutes. But that optimism has followed through into the session here in Europe. You're seeing gains of close to 1%. It's the tech story as well. The lift coming through, of course, from the optimism in the US that lifted Nvidia and other big tech names yesterday, and that continues to lift the sentiment here in Europe. The main tech benchmark here in Europe then gaining a full 2% is the chip makers. It's the likes of ASML over in the Netherlands with that very sophisticated play on lithography machines that are doing really, really well. And again, tying that to the Nvidia story and, of course, ARM and its listing story. Euro dollar currently just slightly stronger on softer dollar, 109 on the single currency. Critty.
Certainly something we're keeping an eye on. Let's really expand with the Chinese story, though. Escalating its defense of the yuan, as you just mentioned, setting a new record with a stronger than expected reference rate for the currency. Joining us now is Bloomberg's Jill Desis. Jill, walk us through how to read what's going on with the PBOC, specifically the stronger fixing. Is this strengthening the yuan or managing a decline? At what point do people just say, look, there's too much intervention, we don't want exposure?
Hey, Critty. Yeah, I think that at this point you're looking at these stronger than expected fixings over and over again, where we've also seen some other tactics that the PBOC that China has taken in recent days to try to prop up the yuan. I mean, honestly, it does feel like at this point it's really about managing that decline, really about managing that depreciation. I mean, this is something that we've heard from the central bank time and again. We just saw this in their quarterly monetary policy report that was released last week. They're trying to guard the yuan against any sort of excessive movement. I mean, they've made that clear in the past, but yes, I mean, when you're looking at what's happening in the economy, the slowdown, a lot of that bearish sentiment movement there, that's a big part of the story. But I also just want to point out it's really not just about the economic activity. There's a lot more at play here. I mean, remember, this is also about interest rate differentials. We're seeing China cut interest rates and sort of prop up their economy at a time when the rest of the world, other major economies really aren't doing that. You're dealing especially with widening gaps between the U.S. and China. There's not a whole lot of reason for foreigners right now to put all of their money into yuan-denominated assets. So I think that that's another part of the equation here too. But yeah, at this point, really sort of about managing that depreciation.
Yeah, and managing the downside for the yuan is just one tool, as you know, Jill, that they have at their disposal. What other measures could policymakers in Beijing be reaching for?
Well, I mean, I think that at this point, there's a lot of different things that they've already kind of tapped into. Part of that was about guidance for state banks. I think that, the PBOC, even in their policy report, as I mentioned that they said last week, they do have additional tools. But ultimately, one thing that I want to bring us back to here, Tom, is that this does still kind of seem like a bit like a crisis of confidence, right? That's something that we've been talking about for several weeks now. There's just a lot of weakness in sentiment right here. I'll just point to one thing that I'm looking out for, regardless of whatever the PBOC is planning, whatever they're doing is, there's still plenty of economic data to come. I know that I just said earlier that economic data is only part of the story, but it is an important part of the story. I mean, I'm looking ahead, for example, about a week from now, we're going to get the latest PMI data out of China. I think that might weigh on some sentiment here and kind of tell us what the PBOC and others might have to do to guide things forward as we wait to see whether sentiment is just going to weaken further.
OK, Bloomberg's Jill Desis on what to watch for out of China then after that record fix coming through from the PBOC. Jill, thank you. On China, sticking with China in the corporate space, this has a dual listing in Hong Kong and in the US, of course. Baidu coming through with second quarter revenues of 34 billion yuan, just coming in slightly above the estimates of 33 billion yuan. A bit of a touch point, of course, in terms of the strength of the US consumer, the Chinese consumer, I should say, with advertising revenues, but also it is certainly part of China's AI play as well, Baidu. So interesting in that context. Let's get more on the geopolitics, though, of the China story. Xi Jinping, of course, the president, is in South Africa for the BRICS summit, where they will be discussing enlarging the group and increasing local currency trade. Joining us now on the ground is Bloomberg's Jennifer Dabasaja. Jen, how are we expecting this meeting to unfold between the two presidents?
Yeah, Tom, well, I can tell you, being on the ground here, we just wrapped up a 21-gun salute. We heard the national anthem from both China and South Africa, and the presidents are now meeting. Xi Jinping has arrived here, and as you mentioned, this is coming for a big week for South Africa, but a really big week for both of these nations, considering BRICS is happening, and yet this is the only state visit that we are seeing. And, you know, reading into that, we can just take a look at sort of the importance of the relationship to these two countries. China and South Africa are celebrating their 25th year of diplomatic relations, and they're both very important to one another. South Africa is China's biggest trading partner on the African continent and has been for the past 13 years. And on the reverse, China is one of the biggest investors and a very important investor to this economy here in South Africa. So we're anticipating the leaders to talk about how they can deepen that relationship, maybe explore more partnerships, and even sort of, you know, enhance their voice as leaders of the global South on the international stage. And so they're meeting just above me here just for a few hours before heading back to Johannesburg to begin discussions around the BRICS summit.
Jen, let's talk about the market read-through here, because I think what a lot of people kind of found interesting is just how much of talk there is about de-dollarizing, something that a lot of different countries say, but then ultimately kind of abandon, just given the strength of the greenback and the fact that it is literally everywhere. Jen, what is the conversation on the ground in terms of de-dollarizing? How seriously should an American audience take that?
Well, Kriti, it's interesting you mentioned that, because just this morning we heard from South Africa's Deputy President Paul Mashatile talking about this specifically and saying that this week the plan is to talk about how to reduce the reliance on the dollar. Tom mentioned there that, of course, on the agenda is how to trade more in their local currencies. But we've heard a number of leaders over the past few weeks talking about, you know, this is not just a world this is not just a world like it was back in 1940. This is a multipolar world, and therefore a lot of these countries who make up the BRICS and potentially who could come into the BRICS need to have another means of benefiting from this economic bloc. So it's definitely going to be on the agenda. Whether or not there's going to be some sort of statement about a joint currency is unclear, but we heard from the Deputy President today that it is definitely something that they will be discussing.
Jen's up as such. I think we can hear some military parade or drum beats in the background there as this meeting between the two presidents continues on the ground for us. There you go, just above Jen. Live on the ground for us in Pretoria, covering the BRICS summit. Thank you, Jen. Now, switching focus, SoftBank's ARM has filed for an IPO on the NASDAQ, taking a step toward what is set to become the biggest US IPO of the year. Let's get the latest from Bloomberg's Alex Webb. Alex, what did we learn then around ARM's listing, about its ambitions?
Well, they are very much trying to position this as an AI play. Of course, we've seen the huge bidding up of NVIDIA and, to a lesser extent, AMD this year, partly because, almost exclusively because they have very compelling AI offerings. ARM is trying to say that it does, but crucially, we see in the middle of this, their earnings in the most recent quarter actually fell from a year ago. Their earnings in the most recent fiscal year also fell. If they really were at the forefront of the AI revolution, one might expect a slightly different story. So there's a certain tension in the middle of that.
Let's go from tech story to tech story if we can, Alex. One of my favorite stories, I'm going to say of the year, I'm going to call it, Microsoft's $69 billion Activision Blizzard has got a new chance at potentially winning approval from UK regulators. We know this has been a major sticking point. Comes after the tech giant submitted an amended deal to the antitrust watchdog. Bloomberg Radio spoke with the CMA chief executive, Sarah Cardell, earlier.
We had a real concern previously that Microsoft would be able to control the way that that market was going to develop. What we see with this new deal, and we will have to test it carefully through our review, but what we see from the announcement today is that rather than Microsoft being able to control how those cloud streaming rights are used, that control will shift to an independent company.
Sarah Cardell there, the CEO of the UK CMA. Alex, the expansion of this kind of remedy is pretty interesting here. We know the CMA doesn't like things like licensing deals, and yet it does feel like Microsoft is giving them just that when it comes to Ubisoft. Square these for us.
I mean, look, if you listen to her, the mood music certainly seems to have changed. She seems, it sounded like she was quite optimistic on the deal's prospect. She said in that interview that their objection had been that Microsoft might have a dominant and controlling position in this developing cloud gaming business. This would seem to assuage that. I think you've got to look at the context here, which is very much that it had been approved on a European level. It had been ultimately approved on a US level, although the regulator had tried to block it, but a court ultimately greenlit the deal. The UK was picking a slightly different issue, this cloud gaming thing. In the US, it had been just about gaming more broadly. This gives an opportunity to save a little bit of face for the CMA, while also letting Microsoft do this deal, which may not really be about cloud gaming. There are other rationales for it. So it's a healthy compromise for a lot of the parties involved.
Okay, a healthy compromise, and we're seeing pre-market those two stocks then, Activision and Microsoft, gaining modestly on the back of that news. Bloomberg's Alex Webb with the details on that CMA change around Microsoft Activision. Coming up, we are tracking European natural gas prices as Woodside Energy CEO says the company is having, quote, constructive discussions with its workers who are threatening to strike. Really important for the European gas complex and energy complex. More on that next. And later this hour, we're going to catch up with Simon French, Panmure Gordon, head of research, get his views on the Fed, the UK, and the trajectory for growth and inflation. Stay with us. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000, 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
On the next episode of The Circuit.
It's still almost shocking how new you still are to this sort of being famous thing.
When I do, go out and people are like crying, that's when sometimes I'm, whoa, why? There's no rule book for it.
Watch The Circuit with Emily Chang Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
We're making good progress on the discussions. We're engaging constructively. We're listening and trying to really understand the areas of concern that our workers have. And I think the meetings are going well. So we will just continue to engage in a constructive and respectful manner.
Woodside Energy Group, Megan O'Neill there, speaking earlier on Bloomberg Television. This comes after labor disputes in Australia triggered a spike in those natural gas prices. Bloomberg's Stefan Stepczynski joins us now. He is all over this story. Stefan, talk to us about the trade here, first of all. We know these strikes have been going on. We know there's volatility in the LNG market. What else is driving the trade?
Yeah, so I think that the main thing to focus on is that Europe is far more dependent on LNG now than they were last year when they were importing a lot of gas from Russia. Since the war in Ukraine, they've had to really replace a lot of that with LNG imports rising 60%. Some of the other factors are other supply disruptions. While the strikes in Australia haven't started yet, there's a lot of focus on other potential supply issues out of maybe the United States with hurricanes, their ongoing maintenance in Norway. And as well as all of that, you're also looking at demand. One of the reasons why gas prices in Europe have dropped from record high levels, about 90% from this time last year, is due in part to the basic demand destruction across Europe and industries there. European demand has not rebounded back to normal levels and has remained subdued over the last year despite the drop in prices. And that's really helped curb it. One last thing to really look at in Europe is inventories. Gas inventories in Europe are above 90% full. That's the highest level for this time of year ever, and higher than the target that they were hoping to hit by November. So all those things combined paint a complicated picture, but right now the focus is on supply. If supply gets hit, whether it be strikes in Australia or other places, you could see gas prices continue to rise in that trend that we've seen over the last few weeks.
Okay, so that's a really good overview of the supply-demand dynamics when it comes to gas. More broadly across the commodity structure, the energy structure and commodities, China, of course, a major role in terms of that demand picture. Stephen, BHP then reporting its lowest annual profit in 3 years in terms of the corporate impact. The CEO warning that the outlook for China was uncertain as the nation, of course, grapples with this crisis in construction. Take a listen.
There's obviously policies in place that are meant to stimulate new starts, but they're not translating as effectively into changes on the ground as certainly we were anticipating, and I think some others were anticipating as well. So that's really what we're keeping an eye on over the next 3 to 6 months.
Stephen, how does that demand out of China translate into gains or not for oil? How is it playing into the oil picture?
I think one thing in the oil picture that, at least if you were talking to me around this time in January, I think there was a big view that Chinese oil demand was going to be the big story, was going to be the big bullish boost. They're going to be removing those COVID restrictions. You could see even some government stimulus. You're going to see people driving again. You're going to see travel. You're going to see the refiners really buying up a lot of oil globally. And there was this view, this bullish view in the market. And I think a lot of that has, to a degree, sort of evaporated. Chinese oil demand, yes, it has recovered from last year's levels. And you have seen quite a bit of purchases. But while you're not really seeing it go into, refining, you're seeing a lot of that go into inventories. You're not seeing the really strong oil demand that I think a lot of people were expecting last year. And because of that, it is putting a bearish sort of element into the oil market. I think oil prices moving forward, it's much more, again, like gas, a supply story where you have OPEC Plus cutting their output, and that is tightening the market for the second half of the year. And that's kind of pushing the market forward and up over the last few weeks.
Okay, Stephen Stupczynski with the latest on the energy markets, the gas market, of course, those potential strikes in Australia and the demand coming out of China for oil as well. Thank you. Coming up, Charles Schwab's plan to cut jobs and offices for a $500 million, $500 million cost reduction. We get the details on that next. This is Bloomberg.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance, the early edition. I'm Kriti Gupta in New York with Tom McKenzie in London. Let's get to some of the stories that caught our eye this morning. Susquehanna co-founder Jeff Yass joined investors Boaz Weinstein, Bill Ackman, and Mark Lazary to bid for hedge fund manager Sculptor Capital. That's according to Bloomberg reporting. Sculptor said in a filing on Monday that the firm received multiple takeover bids, a story we're certainly monitoring very closely. Let's stick with the Wall Street theme here and talk about Charles Schwab planning a $500 million cost-cutting measure, the company responding to investor pressure. Schwab saying in a filing on Monday as well that it will cut headcount and close down or downsize some of its offices. Shares down about 0.3% this morning. And sticking again with the labor theme, a different story over at American Airlines. The carrier's pilots have now approved a new contract that will provide 46% in cumulative pay increases and retirement contributions over its 4-year term. This marks the most expensive labor contract on record for a U.S. airline. The pilots voted 73% in favor of ratification, according to the union. Tom, this is a story that I feel very passionate about. Of course, we've been monitoring the labor story globally, but specifically in the United States, from Hollywood to Detroit to the Teamsters negotiations. Of course, airlines are no different. And the key takeaway of this particular deal is if you look at the 5 major airlines, it really spans the gambit. United and American seem to have negotiated the biggest pay rises. American, as I just said, the record. But then you have the likes of Southwest, for example, which haven't been able to broker a deal, are actively fighting in court right now to get rid of the federal mediation as well. So it's not all clear in the airline space, but definitely all clear for American Airlines.
And what's clear in this negotiation is that pilots have leverage at this point, and they are using it, at least in this case. And why not? Historically, of course, in the last decade or so, the pay for pilots, I was stunned at how low it was, these men and women who are flying us around. So on one level, it's reassuring that they're getting a better compensation package as they continue their jobs. But it's interesting, the labour dynamics as well. We're going to be speaking, of course, to Simon French from Panmure Gordon next, and he's talking about the fact that wage negotiations, the unions make up about 9% of the labour force, and how that plays into the mix as well as we look again at monitoring the health and the strength of the labour market in the US and those increased wages and how that factors into inflation and the Fed's fight. Simon French coming up then, Panmure Gordon, head of research. His views as we look ahead to Jay Powell, of course, that speech in Jackson Hole, and he's also, of course, always excellent on the UK. The stickiness of core inflation here, the challenge for the Bank of England as markets price in potentially 6% terminal rate from the Bank of England. Today, money moving into gilts and yields are lower. Stay with us. This is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
From New York City.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
This is Bloomberg Surveillance, the early edition. Here's what you need to know. Doubling down, China ramps up the fight with yuan bears on two fronts to stop the sell-off from spiraling. And Bloomberg is live in Pretoria as South Africa's president hosts China's Xi Jinping ahead of the BRICS summit. Expansion, currency, cooperation, even food security, all on the agenda. And Microsoft submits a new deal to UK regulators to get its Activision takeover across the line. The rare move follows a series of dramatic twists and turns in the deal's global regulatory battles. I'm Kriti Gupta in New York with Tom McKenzie, stepping in for Danny Berger in London. Tom, if you are an avid watcher of the show, which I imagine you are, you will know that Danny and I love to talk about the Microsoft Activision deal. It has driven markets in the past. It's given the weighting of Microsoft, but it's not really the trade today, is it?
It's not, but what a fascinating development. And whether or not this actually spells a win for regulators here in the UK, or if it's a bit of a fudge so that both sides can avoid losing too much face. But it's a really interesting twist to that story. You are seeing optimism filter through these European markets then. There's the lift, of course, coming through from the gains, particularly led by tech in the States. And then the Asian session performed quite well. And you had this late surge in Chinese shares as well. And whether or not those state-backed funds are coming in to buy up some of the stocks there remains a question, and we're delving into that, our team certainly over in China. The tech play is in force today. As a sector, that is lifting the European benchmark. You're seeing gains of a little over 2%, and it's the chip makers that are at the top of the pile, including the likes of ASML, listed in the Netherlands. Euro-dollar currently at 109, bit flat. You're seeing some money moving into gilts as well, yields coming off, a bit of a catch-up maybe to the move lower in yields that we saw at the start of the session after the run-up, of course, stateside yesterday.
Yeah, green on the screen in Europe, well, green on the screen in the States as well. And I think you really are seeing a carryover from that sentiment. Despite sentiment in China and the rest of Asia not as positive as we were really seeing in the rest of the world. S&P futures higher by 0.4%. Again, the outperformance in the tech space really driving that 44.27 for our radio audience on those contracts. But again, let's bring it back to the bond market because, Tom, you just talked about the move in the UK bond space. Well, you're seeing a little bit of diverging dynamics when it comes to the U.S. and Japan specifically. You are seeing the U.S. 10-year yield close, by the way, at over 10-year highs as of yesterday's session. So you are seeing a little bit of a pullback from those levels. I believe 435 was that level then, about 431 on the 10-year yield right now, down about 2 basis points. But over in Asia, a completely different story, Tom, where, of course, you are seeing JGBs push higher and higher when you look at the yield picture there, putting a little bit more pressure on a BOJ that says, no, we're going to stick to what we are thinking here, especially that yield curve control policy. At what point, though, do you start to see it filter, I think, more strongly into the yen that is circling around, I think, 145 at the moment versus the dollar. Dollar yuan, though, is really where the story is, because you were starting to see the strongest overnight fixing on record coming out of China. Again, as people really have this kind of head for the gates mentality when it comes to not just Chinese stocks, but I think specifically bonds and FX, it looks like the PBOC is stepping in. So 730 on that currency pair, Tom.
Yeah, and it's a yield differential between, of course, Chinese sovereign bonds and US Treasuries that is part of the play there as well in terms of the pressure on the yuan. And talking of which, Christy, sell-off, of course, in those Treasuries, as you marked there, pausing then after that 10-year yield hit a 16-year high yesterday. Investors, of course, betting on interest rates staying elevated. Let's bring in at this point Simon French, Chief Economist and Head of Research at Panmure Gordon. So my question to you, Simon, is to what extent are the markets doing the job for the Fed at this point?
I think it's a really good observation, actually, because if you go back to the dot plot given over by the Fed back in June, the bond market didn't really believe the Fed at that point. And actually, there was something of a softening of financial conditions, which was inconsistent with both the dot plot and the associated narrative about the idea of financial conditions having to remain pretty restrictive for a prolonged period of time to squeeze out core inflation. What's interesting over the last 30 days is how much their bond market has slightly capitulated to the Fed. We always talk about the bond market being the smart money. Well, actually, have the FOMC rather convinced, with a combination of some of the stronger macroeconomic data out of the United States, that actually their reading of the economy was rather better than the market's reading of the economy midsummer.
Do you think Jay Powell does a victory lap on Friday in terms of the soft landing scenario, or does he leave the door open for further hikes? And what do rates at these levels mean for your forecast for the US economy, stretching out, pushing out to 2024?
Yeah, so I don't think he'll do a victory lap. I think there have been too many mistakes on the way up. You know, there's still criticism that allowing inflation to rip, putting the terminology of transitory inflation, which, although we have come back down, and most people would argue that it was largely, at least at a global level, a supply-side phenomenon that has unwound and looks to be unwinding pretty smoothly back towards, let's call it low single digits rather than 2%, because I think that's an important distinction to make there. What does that mean for the United States economy? Well, I think tighter financial conditions actually starts to lean into the kind of momentum that we're seeing in the real-time GDP indicators for the third quarter. But into 24 and 25, and maybe you're about to ask me about some of the payroll numbers, some of the uncertainty there, I think a lot hinges on how much latent capacity there is still in the US jobs market. I wrote a note about 18 months ago now that suggested the US economy could add more than 10 million jobs before it started to be inflationary. Wow. We're about 8 million through that journey, potentially still got 2 million more to add, but there's a big uncertainty on how structurally, based on an aging US labor force, how much can be squeezed out without pushing up that core inflation that, of course, would certainly stop Jay Powell doing a victory lap at this point, although he may defer that victory lap until the data comes in a bit more robust at the start of next year.
Simon, something tells me Jay Powell isn't the victory lap kind of guy, but talk to us about what that metric of success actually is. It felt like for a while it was indeed the labor market, but if the labor market really falls apart, really starts to collapse under kind of perhaps delayed pressure, are we in kind of a Volcker era? Would we start to see that same kind of, I don't want to say hatred, but hatred towards Jay Powell? Is the labor market still the metric of success for the Fed?
Well, it's still certainly the political metric that Jay Powell needs to be very mindful of. And I note that former US President Donald Trump last week was pretty critical of the reappointment of Jay Powell. And I think going into the period of time when whatever path the US economy takes from here, it'll run into the political dynamics of the presidential election. And the idea that the delayed impulse from tighter financial conditions starts to feed into labor market outcomes, the real wage outcomes that US electors are going to consider going into the next presidential election. I think that's going to be something, really important in terms of the metrics that not just Jay Powell, but the whole FOMC are going to have to talk about. They don't want to be only talking about the inflation part of the dual mandate. I think heading into a presidential election, if anything, the dual mandate favors more narrative about what maximum employment looks like.
But if we talk about the employment story, I'm just wondering how you actually model some of the labor negotiations that are happening across the country. I mean, sure, when you look at it from, say, middle class or upper class jobs, it's a much easier thing to put into numbers. When you look at the negotiations happening in Detroit right now or in Hollywood, or even, I would argue, in Silicon Valley, how do you factor that in to the success, again, of the Fed?
Well, this is about expectations for inflation, but also, and I think we have to be mindful of looking through how prices in the labour market are set, not just through this extraordinary period post the COVID pandemic, but actually look at it in the context of the last decade, most of which the last decade we've been faced by stubbornly low wage growth, stubbornly low core inflation. And one of the dynamics there that we've got to be really mindful of is that if workers are taking their, if you like, their price-setting behaviour from the overall price level, not the tightness of the labour market, the stuff that they're going to be talking about at Jackson Hole this week about whether the modelling that underpins a lot of central bank thinking actually works through the cycle is very, very salient to that US wage setting.
Simon, you've been interrupted by SpaceX. Elon Musk is getting in the way of your commentary on inflation. Yes. But here we have SpaceX and the launch of Falcon 9, launching of 21 Starlink satellites. These are live pictures coming from California from this launch to low Earth orbit, again from the Space Launch Complex at the Vandenberg Space Force Base in California. This is the 15th flight, apparently, for the first stage booster that is supporting this mission. So again, it's part of the Starlink process of putting these satellites into low Earth orbit and building out that connectivity. Of course, Starlink has been consequential, we know, on the ground in Ukraine, but further beyond that as well. This is a major business that is proving very successful so far, of course, for SpaceX. Following, by the way, the stage separation, the first stage is set to land on the, here we go, Of Course I Still Love You drone ship in the Pacific. These reusable stages, Simon like that. Of Course I Still Love You drone ship. And we are watching the live pictures still, of course, taking off then from Vandenberg's Space Force Base. It's always pretty impressive, isn't it, Critty, to watch these pictures. It's becoming routine for SpaceX, and in part, that is part of the miracle, part of the genius of SpaceX, that they have made this routine.
Yeah, and I would argue, first off, for our radio and TV audience, we're looking at live pictures here, and Tom did not just make that up. One of those Pacific stations are indeed called the, of course, I Still Love You docking point. But let's talk a little bit about kind of the geopolitics that are associated with this. We know Starlink satellites have come under scrutiny from the likes of China, from their role in potentially the war in Ukraine as well. And sticking with that theme, let's bring you some even more headlines that we are getting. The U.S. Commerce Secretary Gina Raimondo due to visit China next week. She will be the fourth Biden envoy to be visiting China since June. She follows, of course, Anthony Blinken, the Secretary of State, Janet Yellen, the Secretary of the Treasury, and John Kerry, our climate envoy from the Biden administration. It looks like the trip to Beijing and Shanghai are due to take place from August 27th to August 30th. And of course, we know Gina Raimondo has been very vocal about the chip story at a time when Japan and South Korea were recently hosted over at the White House. We will bring you those developments as we get them throughout the next couple of hours and of course, the next couple of weeks as well. Coming up next, China is escalating its defense of the yuan against the bears as the currency remains under pressure. We're going to dive into the U.S. read-through. Stick with us. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1, right. So it's ready right when you pull up your car.
how do you manage these kind of two different staffing needs, right? And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Kriti Gupta in New York. Now, the yuan has been under pressure as China's economy, of course, continues to struggle, and the country is now escalating its defense of the currency. Joining us now is Shuli Ren, Bloomberg opinion columnist covering Asian markets. Shuli, let's start with these attempts then by the PBOC, by authorities, to at the very least, manage the downside for the currency. Do you expect it to be effective? And does it smack slightly to you of desperation?
Well, I think for the PBOC, they do recognize the Chinese yuan has to appreciate a bit more because China is on the rate cutting and the easing cycle while the US is still, tightening its rates. And from the PBOC's viewpoint, if you look at the Chinese yuan compared to a basket of currencies that it looks at, it's actually not that weak. But the Chinese people, they don't look at yuan against a basket currencies. They look at yuan against the king dollar. And to them, it's the yuan, the dollar is very strong and the US stock market is very strong. That just creates a lot of capital outflow. And I think that's why the PBOC wants to slow down the weakening of the yuan, even though it knows that the yuan has to weaken against the US dollar.
Shuli, where does the BRICS summit fall into all of this? So we had Jennifer Sabasacha on the ground in South Africa talking about the conversation of de-dollarizing. It's something that's come up in rhetoric from China and from Russia as well, among many other countries in South America. What are the odds of that actually happening?
I think China, unfortunately, is going into the BRICS meeting with very weak hands, right? Like the President Xi Jinping has been talking about Belt and Road Initiative for like 10 years almost, and then the internationalization of yuan for 10 years as well. And what we are seeing is that the yuan is weakening day by day, and then a lot of Belt and Road countries, they have gone into debt restructuring troubles, just like China's own domestic real estate developers and the local governments.
Well, that's pretty fascinating as an observation that to some extent China has exported some of its problems along that Belt and Road. As you say, flagship for President Xi Jinping. We can see pictures of him there meeting with the South African president earlier in the day, Shuli. So that weakness, that weak hand, I wonder how that translates then into what we can expect out of the BRICS summits. And indeed, the interactions between Xi and his counterparts, and whether or not there is a reassessment in terms
I think there is no doubt that the BRIC countries or other developing countries are a bit more cautious towards China. I mean, it's no longer clear that China can. Actually, it's pretty impossible for China's GDP to take over the US on a per capita basis, right? And also the Chinese government is not as rich as before. I mean, Chinese government debt, including the hidden debt, etc., is already over 120% of its GDP. And Tom, you're right in the sense that China exported its debt problem to other developing world because China thought, oh, we can just have debt-fueled infrastructure. Once you build it, they will come, demand will come, everything will come. And now developing countries are thinking, oh, actually, China now has a lot of debt problem, and maybe we shouldn't have to build so many airports, railways, and roads. So they might have a second thought about China's growth model.
But Shuli, wasn't the growth model essentially, again, I'm really simplifying this from an American point of view, simply the idea that if you were mobilizing a population of billions of people and really trying to industrialize a good chunk of the country over spans of decades, shouldn't that growth kind of be a no-brainer? Why is the slowdown so monumental, given that the entire country isn't fully mobilized yet to the extent of, say, the U.S. or other developed economies?
Yeah, I do think China did a tremendous job pulling 1 billion people out of poverty, right? Like the urbanization rate rose by over 20%. 70% of Chinese households are homeowners. It's tremendous. If you go to China, the high-speed rails are very fast. However, China has not managed to lift its people into prosperity and wealth. And that's the distinction. The China model make you not poor anymore, but would it get you rich? That's unclear.
Certainly something we're going to be watching very closely. Shuli Ren, a pleasure to have you on the show this morning. We thank you as always. Of course, you can find her columns on Bloomberg Opinion. Tune into that, of course, on Bloomberg.com and the terminal. Coming up on the show, more U.S. retail earnings ahead. Macy's and Lowe's on deck ahead of the market open. More on that next. This is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance, the early edition. I'm Kriti Gupta in New York with Tom McKenzie in London. U.S. retail earnings continue to roll in today. Macy's and Lowe's reporting before the U.S. market open. Bloomberg's Simone Foxman joins us now for a preview. She is all over this story. Simone, I want to start with Macy's here because when I first came to New York, and I think I was 15 years old, and the appeal of New York was partially you go to Herald Square, you see the Macy's department store, you see the pretty kind of Christmas setups in the window. Macy's has really fallen from that image for a lot of people across the country and, of course, here in New York as well. they've also had a rough few quarters. Is there any hope for redemption for this company?
On a numbers basis, not so much. We're expecting to see comp sales fall 9.4% this quarter. That would be the 5th quarter of negative same-store sales growth. That said, the company has really pushed towards trying to turn things around. They've launched a new brand on 34th. They're hoping that a resilient consumer essentially will boost their earnings ultimately. And some of the metrics, like some of the Bloomberg second measure metrics, the alternative data sources do indicate that perhaps a strong consumer is going to benefit them. But of course, Macy's shares lagging the broader index. If we get some little surprise here about a better state of the consumer, perhaps that could boost us this morning. But we're not looking for pretty numbers overall.
Okay, and Home Depot then surprising the street last week with earnings that were actually better than feared. Are analysts expecting the same story at Lowe's then?
Both Home Depot and Lowe's very much track the state of the housing market. So when we saw interest rates rise, home builder sentiment really deteriorate, both companies really taking the hit. What's different between Lowe's and Home Depot is that Lowe's counts on DIYers for about 75% of its business. That was something that was seen as kind of buoying shares over the past year or so. But when Home Depot reported, they actually said that contractors, the pro market, were relatively stronger than DIY. That's somewhere that Lowe's is trying to push into as well. But you listen to Wells Fargo and analysts there talking about how Lowe's wasn't necessarily projecting the same sort of decline as it maybe should have. It was a little bit more optimistic about the second half of the year. So is that optimism going to outpace what we see here? I think that's the narrative the market's going to grapple with today.
Well, I think what's so fascinating about Lowe's and Home Depot stock is that if you were to overlay them with some of the housing data, it's almost an identical chart when you look at it, which works beautifully on radio, clearly. Let's talk a little bit about the housing data we're expected to get, because a lot of the tailwinds for Home Depot and Lowe's, to your point, has been that DIY spend. But if people aren't buying new houses, it doesn't feel like that tailwind is really going to sustain. What do you think?
It's such an interesting narrative here because essentially people have invested a lot of money in their homes. They've built up equity and now they're sitting at really low interest rates. I think some 80% of mortgage rates by U.S. homeowners are under about 5%. So we get existing home sales data later today. We get new home sales data. We expect existing home sales data to remain very low because the average 30-year fixed rate is now over 7%. But new home sales, they've been stronger than a lot of us have anticipated for a while. So that's interesting data we could get out tomorrow as well.
Yeah, certainly something we're going to be keeping an eye on. Simone Foxman, all over the retail story. We thank you, as always, for joining us this morning. Let's take a look at some of the other stocks we're watching in the pre-market trade this morning. Of course, we want to get a little bit of a rebalancing. Let's start with Kenvue, specifically replacing Advanced Auto Parts in the S&P 500. So you are seeing moves here. Remember, Kenvue is the spinoff from Johnson & Johnson. We can look up that ticker. KVUE is your ticker this morning. And again, it's already moving based on simply that rebalancing narrative higher by about 1.3% this morning. You also have Advanced Auto Parts, which AVP is your ticker there. So again, pushing down, already seeing that bit of a movement. You want to take a look at the Microsoft Activision deal as well, because look, there is finally potential licensing deal coming through, something the CMA has really pushed back on, and here we are potentially negotiating it, revisiting that agreement as well. Microsoft shares higher by 0.6%. So something, Tom, we're going to be watching very, very closely. That does it for early edition. Surveillance is ahead. BlackRock's Russ Kosterek, Bank of America's Jill Carey Hall, and Vincent Reinhart of Dreyfus Mellon all joining the program. Stick with us. This is Bloomberg.
world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
This is Bloomberg.
This is not an end of bull market run. This is just a correction.
One thing that really stands out is how kind of rational or orderly a lot of the elements of the sell-off is.
I think we are in a situation where we are seeing pressure on many central banks.
The Fed is going to cut rates next year. That's what the equity market wants to hear in order to have a sustainable move higher.
The Fed will back off if inflation comes down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Snapping a 4-day losing streak and looking for a second day of gains. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Your equity market on the S&P 500 positive here by 0.4%, getting closer and closer to Chairman Powell in Jackson Hole. Let's start with this story right here. Does this sound like a weak labor market to you? American Airlines pilots approving a new contract that would provide 46% in cumulative pay raises and retirement contributions over a 4-year term. For the pilots, that sounds like a tight labor market to me.
This is a wonderful way to start the show at a time where people are worried about what this could mean going forward, given the fact that not that there are strikes, but that there aren't strikes because these companies are paying up. They are willing to give the extra money to all of these airline pilots and other workers. You saw that with UPS. You saw that with a whole host of others. So what does that say about how tight the labor market is and where the power has shifted?
$9.6 billion in incremental costs that we can discuss throughout this program. And Lisa, this is the tension. The tug of war for Chairman Powell, the progress they've made on inflation over the last several months, the past year. At the same time, on the other side, a labour market that's still looking tight to me, which could mean perhaps inflation higher for longer, stickier, and rates higher for longer as well.
People are flirting with this idea. You have the likes of Nick Timiraos, who is often in the Wall Street Journal, someone who is thought of as a Fed whisperer, coming out with basically, will they or won't they start to adjust higher with a 3% target? No, they won't, because no, they can't do that because they won't stop there. But are they less willing to compromise a labor market that does look so strong and that a lot of people are cheering? The answer seems to be, not sure.
Let's get it to the bond market. Down 3 basis points this morning, but the move we've seen over the last few weeks has been phenomenal. A 10-year at the moment at 4.30, Lisa in the last 24 hours. Yields we have not seen since 2007.
Do we understand why? I mean, do we have a better sense? I mean, yes, the American Airlines deal that you struck, that you talked about earlier, the UPS deal, the fact that workers are getting paid, it all makes sense. The fact that there's a fiscal imbalance, that makes sense. The fact that suddenly we're looking at potentially the fastest growth in GDP going back years makes sense. Okay, but do we really understand why?
I think we've both said no one can agree on why. Pick a reason. There's 5 of them. pick a reason. Most people sitting here picking their poison, and that's what's uncomfortable about this moment. Typically, when you see moves like this over the space of a month, really, really fast, we can all agree, consensus view on what's driving it. I think consensus view at the moment is all of the above. That's what I hear from most people and ask the same question every day. What's underpinning this move? And the response I get is all of the above.
Pretty much that this is the toxic brew that's causing yields to rise. I do think it's interesting, though, yesterday that you got a rally in tech stocks. You got a rally in stocks that previously were viewed as rate sensitive, even as yields hit their highest levels going back 16 years. What does that say about the consistency of the strength and how it's not going to be torpedoed by yields at these levels? Or at least that's the perception.
Here's another story for you. Yields up, banks down. Story of the month so far. Banks are down by about 8% on the S&P 500. S&P joining Moody's downgrading some banks overnight. Here's the quote from them. Depositors have, quote, shifted their funds into higher interest-bearing accounts, increasing the funding costs of banks. The decline in deposits has squeezed liquidity for many banks, while the value of their securities, which make up a large part of their liquidity, has fallen. That explanation sounds like a decent characterization of what happened 4 or 5 months ago.
I was going to say the
in the
exact
US
same
banking
thing.
system.
This is an old story. Are they just playing catch up, or is this a persistent concern, especially at a time where we're seeing deposits go out of the large banks at a faster pace than some of the smaller banks that are actually offering up some yield? What I thought was interesting is that yesterday there was sort of this 1-2 punch. Charles Schwab coming out and saying that they were going to cut staff and cut real estate to save about $500 million of expenses a year. They were saying they were doing it because of investor pressure. And it comes then right after you get the S&P downgrades. Schwab shares are lower today. Investors aren't satisfied. What's going to satisfy them that there is some opportunity for strength at a time where there is yield to be had if you can capture it?
We'll pick up on that story later in the hour just to get you up to speed on the price action this morning. Equity futures on the S&P 500. A decent pop again. We're positive here, Lisa, by 0.4%.
Today, everyone's going to be talking about dollar and whether people can potentially abandon it. Leaders of the BRICS nations, that's Brazil, Russia, as well as India, China, and South Africa are going to be meeting in Johannesburg. A lot of discussion about moving away from the dollar, a lot of animosity toward the dominance of the U.S. currency. That said, the dollar has really been a lot more resilient than people have expected so far this year. Amid all of that, retail earnings continue. We get Dick's Sporting Goods, Macy's before the bell, Urban Outfitters after the bell. We also get some housing stocks. Lowe's just came out, and we get Toll Brothers after the bell. Lowe's coming in, well, kind of within range. We'll go through that in a bit. And today, Fed Speak includes Richmond Fed President Tom Barkin, Chicago Fed President Austin Goolsbee, Fed Governor Michelle Bowman. Will they say anything? Yes. Will it mean anything for Fed Chair Jay Powell? Probably no, because he often takes a middle-of-the-road view that will probably say as little as possible if he takes the recommendations of you and Mohammed Al-Arian.
Well, I think a lot of people have said the same thing, haven't they? Whether he goes with that recommendation, I don't know. But this week is going to be full of Fed Speak going into Jackson Hole and the annual Fed get-together kicking off later this week. Kicking off this show, Russ Kostrick, Global Allocation Fund Portfolio Manager over at BlackRock. Russ, new cycle high on a 10-year, 435. For you and the team, is that a buy?
You know, I think long term, you probably could look back 6 months, 12 months from now and say that, you know, this was a decent entry point, but I don't think you chase it here. You know, we are still moderately underweight duration in our multi-asset funds. And, you know, again, I think you're getting to a point where you are getting some value back, but the long end is hard. And the reason the long end of the curve is hard, and I mean the 10-year or further out, is this question about how much of a premium should you get paid to own long duration bonds in an environment where inflation uncertainty is much higher than it used to be, at least compared to 5 years ago. And what the Fed is going to do is more uncertain. And that's what's been happening. People have been demanding that higher premium to go further out on the curve. And, you know, that could go higher still.
Russ, pandemic low, 31 basis points on a 10-year intraday, early March. Russ, if I'd promised you 400 basis points more than that 3 years later, you would have ripped my arm off. Can you walk me through what's changed, why you think we're not going back to where we were pre-pandemic?
Sure, there are a bunch of things. And, you know, the first and the obvious one was that was obviously an extreme, you know, at a time when people had no idea if the economy was even going to be able to reopen. But the other two things are, obviously, we had the biggest surge in inflation in 40 years. And while headline has come down, core is still sticky. It's still, you know, bouncing around 4.5%, and it's not collapsing. The labor market is at multi-decade tights. That's not changing very quickly. The Fed just finished the fastest tightening campaign in over 40 years, and there's considerable uncertainty about when they're going to be able to ease. You know, Jonathan, you remember 4 or 5 months ago, the market was convinced that even though you had this rapid tightening cycle, by the end of the year, the Fed will be cutting. And that narrative has gone out the window. And now there's some uncertainty about when they'll be able to cut. So all of that together, the inflation, the uncertainty about the Fed, the resilience of the U.S. economy, that's left us in a very different place.
A year ago, if someone would have said that 10-year yields would be at 4.3, 4.4% almost, people would say that would absolutely break markets. It would break the economy. It would cause a recession. Now we're looking at equities that can look past this and keep rallying. At what point does something give? Can equities keep rallying in the face of yields that are at this level?
You know, that's a great question, Lisa. And we spent a lot of time actually in the last couple of days debating that. And I think that there is a level that is going to be more of a headwind for equities. And obviously, you know, we've had a tough August. But, you know, it's interesting. And the dynamic of the market has changed. Last year, when we looked at how stocks were performing, it was all about this notion of rate beta. In other words, a stock sensitivity to interest rates. This year, it's not like it's gone away, but it's much less important than it was. And, you know, you raised the point. 10-year at multi-year highs, the NASDAQ up 1.5% yesterday. Particularly the parts of the market, even the growth stocks that are stable growth, you know, companies with strong cash flow, strong earnings, they have been able to move higher this year, even if rates have backed up. Now, there's a level where I think that starts to become an issue, but right now, at these levels, I think this is more of a headwind for those early growth companies, the unprofitable tech, than it is for some of the really stable mega cap names that have powered the market higher this year.
You said there is a level. What is that level, Russ?
I wish I could give you an exact number. You know, here's what I'm watching. So we have seen that real 10-year yields are starting to break out of that range. They're starting to break to 2% and higher. I'd be concerned if that continued. I think what would help the market is to see those real 10 years pull back below 180, let's say, in a level that was consistent with the range we've had for several months now. If you keep grinding higher on real rates, then I do think at some point you're going to start to see things break.
Russ, do you think it's odd that we're talking about real yields at 2%, multi-decade highs on nominal yields, and at the same time we're considering one of the biggest IPOs in this country in the last decade?
You know, it's not crazy for a couple of reasons. The first of which is that, you know, if you went back 15, 20 years, no one would have been, you know, traumatized by a real 10-year at 2%. That was about what you'd expect. So we've gone back to normal rather than to some era we've never been before. But the other thing is, you know, why are the 10-year yields up over the last several months? It's because we've all realized just how resilient the U.S. economy is. And back in March, when a recession was treated as a foregone conclusion, now, 5 months later, we're looking at an economy that's likely to have a soft landing, where earnings are decent and may do better as we see that nominal growth hold up. And I think that's why the market's been resilient, and you can see these IPOs come back to market.
The soft landing that people keep talking about is predicated on the idea that the Fed is suddenly going to be patient. Not suddenly, is going to take a look at how quickly inflation has come down so far this year. It was going to do that anyway and say, we're not going to kill the labor market to get to 2% right away. How much is essentially the entire market coming to the view that the Fed is going to be less restrictive and more willing to allow inflation to run hot for longer in sort of this implicit 2-point-something goal for the 10-year Treasury yield and, frankly, for the benchmark rates?
I think there's definitely some of that baked into the narrative, and the question about, are they really going to force it to 2, or, you know, do you get to 2.5 and declare a victory and go home? I think the other question is, you know, the Fed has acknowledged this notion of long and variable lags, and you've already put monetary policy into restrictive territory. You know, are they willing to wait and be patient given the fact that we have seen inflation come down? So one of the things I think is going to be interesting as we get into Jackson Hole is how they address that, how Chair Powell addresses that, and the extent to which she acknowledges that we have seen with this backup in yields, you know, a fairly significant tightening of financial conditions.
Hey, Russ, great to catch up. Get the team view. Russ
Thanks,
Kostrup there of BlackRock. Thank you, buddy. As always, big move in the bond market, just monster move in the bond market over the last month. Major moves over in China as well. Let's go to Hong Kong. The Hang Seng on a 7-day losing streak. Things were difficult. Then all of a sudden, late into the session, in a couple of minutes, Bramo, we rally about 2 percentage points on the Hang Seng. Head scratching, questions being asked, speculation. Maybe some funds have come in and done some buying on behalf of the state.
Well, yes, that's what people are looking at as the so-called national team, or what other people call the plunge protection patrol, coming in and staving off some of these declines. It wouldn't be the first time, and it would kind of pair with what they're doing in the currency market, trying to allow certain declines, but not too fast. Don't make it look too panicky. Stop being so dramatic about the situation. And that seems to be the theme that we keep hearing over in China. It's sort of playing a game of chicken.
Addressing the optics and not the substance of what's underpinning some of these moves. You can do something about the fix. You can come in and do some artificial buying if you want. I'm implying that's what it was. I'm not saying that's what it was because we don't know that's what it was. But ultimately, have you done anything to change the fundamentals? Because the policy shifts we've seen so far, a lot of people concluding they're insufficient, including the world's biggest miner. BHP Billiton came out with earnings, some of the weakest earnings we've seen from that miner in about 3 years. And they said what we've seen so far is just not changing the underlying story at all.
Yeah, but what will, right? Lisa Shallett was speaking with you yesterday. She said helicopter money. Well, are they going to do helicopter money right now? Is that even on the table? Is that really what it would take?
The fact that we are here in August and we've got guests like Lisa Shallett talking up helicopter money in China, when 8 months ago we were talking about reopening and a boom in the second largest economy, just goes to tell you how much things have changed. In the next hour on this equity market, Jill Carey-Hall of Bank of America, live from New York City this morning. Good morning.
Slice through the noise.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. This week, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go.
Coverage starts Wednesday, August 23rd with a special edition of Bloomberg Surveillance live from Jackson Hole on Friday, August 25th, starting at 8 a.m. Eastern. Bloomberg, your global business authority.
The technological revolution that we think we're undergoing right now with generative AI, it didn't negate the idea of a recession. It postponed it, and I think that's part of the narrative. We are going to have a recession at some point. Business cycles are not canceled from things like this.
The brilliant Julian Emmanuel, Chief Equity Strategist over at Evercore, looking ahead to NVIDIA earnings after the close tomorrow. A big event for this market. Some people arguing perhaps bigger than what you may or may not hear from Chairman Powell later on this week. Into the market we go, where equities are firmer and positive on the S&P 500, up by 0.4%. So much attention in the bond market for good reason. 430 on a 10-year. Yields lower by 3 basis points. Yesterday, a new cycle cycle high. For this cycle, that high, 435 on a US 10-year. Lisa, when we thought we'd left the highs behind back in October on a 10-year yield.
This comes despite concerns about banks that have anything but gone away. This comes despite concerns that the Fed is going to have to be more aggressive to curtail GDP that is re-accelerating. People looking out to the longer term and saying this is a new regime. This is a structural shift to higher inflation and higher term premia for U.S. debt.
We're speaking to Bill Dudley a little bit later this morning, the former New York Fed president. Here's a quote from his latest column. Allow me to read this to you. I strongly suspect that the bond bull market that began in the early 1980s is over. For the longer term, the steady economic expansion that followed the 2008 financial crisis is no longer relevant. The paradigm has shifted. Lisa, higher yields are back. The view this morning, and we'll talk more about it in the programme a little bit later on, the view this morning from the former New York Fed President Bill Dudley.
Russ Kosterich got on board with that. He was saying he's leaning in a little bit, nibbling a little bit into yield, into duration, but not that much because we are in a regime shift. So structural shifts, are they going to come out and do a Bill Dudley? We're in a new period of time, guys. Forget about bond returns.
Things you can say when you're no longer a Fed official. I always say that.
Heading into that.
File that firmly in that column, because if you heard that from a Fed official, that would be a big piece of news on Friday.
You remember when people used to say that low rates were actually restrictive in and of themselves and contributed to the low inflation? And all of a sudden now, on the margins, you hear people saying, well, if you're actually earning income on your cash, you can spend more money, and it's actually stimulative. I wonder if there's any discussion about that. It sounds counterintuitive, but it seems on the margins to kind of be true at this point.
I've got a name for you, Drew Mattis, MetLife, okay? I know that's Drew's view of the world. It was over the previous decade. I wonder if that's what he's focused on now as well. It's a curious time. Yields at multi-decade highs. At the same time, we are considering the third largest IPO ever stateside. Bloomberg's Alex Webb joins us now out of London. Alex, we used to cover ARM a long time ago when it was listed in London. Things have changed, buddy. Walk me through what's on the table here and what kind of valuation we could be looking at.
Yeah, so ARM was acquired, of course, by SoftBank in 2016, and we've not really heard much from them since then. Now, finally, of course, we've heard plenty from SoftBank about all the other things that have been going on. Finally, they have decided to bring it back to market, and notably, they're doing it in the US, not in the UK, much to the chagrin of a lot of British politicians. Now, they're talking about, well, the reporting suggests they want a $60 to $70 billion valuation. They might sell as much as 10% of the stock. When you look at the numbers, that valuation looks pretty punchy. It's trading at it would be trading at a multiple that is likely to be a premium to the Philadelphia Stock Exchange Semiconductor Index. That's really the benchmark index for chip makers in the US. But it'd be doing so at a company that isn't growing right now. Now, much of the chip industry isn't growing. That's also why ARM isn't growing, because its designs are licensed to vast swathes of the chip industry. It is seeking a valuation that is not far different from, as a multiple of earnings, the likes of NVIDIA and AMD, but in the most recent quarter and the most recent year, it saw declining growth. That also suggests that it may not be quite as big an AI play as the prospectus would like you to believe.
Alex, before we get into that and talk about how it may go against the likes of NVIDIA, who report tomorrow after the close, can you run us through why this is so important for SoftBank to get a win after the difficulties they've had, not just over the last 12 months, but over the last several years?
To be honest, when you speak to some SoftBank investors, a lot of them sort of say, actually, we just want to get rid of ARM at this stage, that there's so much capital tied up in it. It was a $30 billion deal, 7 years ago, that almost any exit is a good one. If they get the valuation they're talking about, it's likely to be a return of about 100% from what they paid. That sounds like it might be good, but if you compare over the same time period the performance of the Philadelphia Stock Exchange Semiconductor Index, it's returned about 300% to investors. That's excluding dividends. So if you just put the money in a tracker fund, you might have done a little bit better if you're SoftBank. Nonetheless, freeing up that capital is something that they would like to do. The one caveat, again, is that they are only selling that 10%. If the stock performs better further down the line, there's scope, of course, to enjoy a better return on the lion's share of it.
How much is this IPO indicative of a market that's largely been frozen this year?
I mean, there are certainly a lot of people looking at this space. I did a piece for Business Week just last week, where there's some really fascinating sums. Private equity exits are at their lowest in a decade, and that part of that, of course, to do with interest rates. A lot of it is to do with the fact that the IPO markets have basically been closed. This will be a huge test of whether they might open up again. There are lots of companies sitting there ready to pull the trigger. Reporting suggests that Instacart might be about to go public, that the German maker of sandals, Birkenstock, may also be going public sometime soon. If ARM doesn't succeed, there may be some rethinks on that front.
That said, Instacart and Birkenstock aren't exactly established chip designers that are used in every single iPhone ever made. I mean, there's a real question around whether the market is open, but only for select companies. That was sort of what I'm getting at. Is this going to be an anomaly, or is this going to be an example of what market appetite could be?
I think if it's a success, that's no guarantee the other ones will be a success. If it's a failure, that's when you start to have a rethink for those other ones. You know, to your point, yes, this is a core part of the chip industry. If there are investors in semiconductors or what people would say, fundamental technologies, who would say, if you believe in the long-term trajectory of the chip industry, you have to be in ARM. That's for the same reason you'd have to be in, say, TSMC, the big contract manufacturer in Taiwan. It is a massively important and almost systemically important player in the semiconductor industry. If it has a struggle getting out of the gate, then of course the IPO market has far bigger problems.
Can you believe Birkenstocks are a thing?
Yes, I like them.
Do you really? Are you a Birkenstock kind of person?
I don't have them, but
Okay.
I can appreciate them. I didn't take you to be a Birkenstock person.
No.
Not with socks.
Not me or TK. No, no. They wear socks with them too, don't they? Have you noticed? Yeah, I can't get on board with that. Alex, move on from that quickly. London, UK, at the epicenter of this proposed deal between Microsoft and Activision. Alex, can we close things there? Can they close that deal?
It increasingly looks like they might well do. There was an interview that the head of the CMA, that's the British regulator, the Competition and Markets Authority, did with Bloomberg Radio this morning. There was a real change in tone. She seemed very open now to approving that deal. There's been a big concession. The UK objection was very much to do with cloud gaming, whether Microsoft would get a dominant position in cloud gaming through the acquisition of Activision Blizzard. Now it's offering, or it's agreed to license its cloud gaming IP, its games, to Ubisoft for a period of 15 years. That takes the dominance off the table. If you look at the share price for both Activision Blizzard and Microsoft, they're trading up. Expectation is therefore that deal will be closed. Also, interestingly, Ubisoft trading up, as you would expect, perhaps, given the access it's getting to the likes of Call of Duty in the cloud gaming space.
Interesting. Alex, thanks for the update. As always, Alex Webb there out of London. Not lost on anybody that we're talking about yields at multi-decade highs, and at the same time, we're considering the third biggest IPO in US market history. There you go. Marko Kolanovic over at JP Morgan perhaps summing that up. Here's the quote. Compared to the start of the year, investor expectations, market positioning and the equity valuations have moved up. With soft no landing the new base case, there is no more fear. Marko says there is only complacency.
Or there's the battle between AI, the hopes and dreams, versus yields, the reality. Who's going to win?
Heidi Kribo-Rediker of the Council on Foreign Relations on China and the ongoing BRICS Summit coming up shortly from New York City. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Having a look at a second day of gains on the S&P 500. Futures positive here by 0.4% on the S&P. On the Nasdaq up by 0.6%. After yesterday at the close, still down on the month for the month of August by about 4% on the S&P 500. On the Nasdaq after yesterday's gain, trimming those losses to around 5% or so. That's the equity story. In the bond market, I think you know the headlines, don't you? A 2-year yield closing above 5% in yesterday's session for the first time post-SVB. Believe it or not, at least. So the 2-year this morning, 4.9837. I know the 10-year's getting all the headlines for the right reasons, but can't take your eye off what's happening at the front end too.
Especially because suddenly you see almost a 50-50 chance that the Fed's going to hike rates again later this year. Just a couple of weeks ago, that was completely off the table. People were saying they were done. This comes at a time where only 2 other times the 2-year had crossed that 5% threshold since 2007. This is a rare occurrence. We're at new levels as people game out what the Fed has to do.
And we're back there right now, considering that after SVB, people thought cycle over. That was it. We had the ingredients for a tightening of financial conditions that would lead to potentially a recession, a hard landing, and the Fed backing away. The 10-year dropped to about 325, sub 325. Look at us now, 100 basis points north of that level in just several months.
And the problems are still there.
Yep.
So what happened, right? I mean, literally, we're seeing those problems highlighted again and again each morning. And yet people now think it's not a big deal. Everyone can look through it. It's almost, you know, we tried that, tested it. We're good.
Highlighted again this morning, under surveillance this morning, China ramping up its defense of the yuan, pushing up funding costs in the offshore market and setting a new record with its reference rate for the currency. The yuan has been under pressure in recent months as China's economy continues to struggle. And Lisa, arguably this week, that struggle continues.
It's almost a game of chicken. Is it that they really want to keep the yuan stronger, or they just want to control how quickly it depreciates? There's a real issue here with trying to control the message through cosmetic adjustments or interventions in the market that don't address the real issue, and it's not working. So at what point is there some real reassessment of what has to be done, or an acknowledgement that they're not willing to, or they're not able to, or that they have a new paradigm? To me, this is the big question. People are looking at China's weakness and saying it's a positive because it might import disinflation. And they're saying that if it gets stronger, it's a positive because then they'll import goods. Why isn't it a negative for anyone? I mean, maybe it isn't. Maybe it's just, you know, China loses and everybody else wins, but it doesn't seem that simple.
I think for plenty of people it is a negative. It depends what you're focused on. If you're focused on inflation, great. If you're focused on growth, not so good, particularly if you're in Europe. So it depends what seat you're in as well. If you're here stateside looking at above trend growth, maybe you think you're decently insulated against this and less exposed anyway for structural reasons. If you're in Europe right now, Germany, for instance, just coming out of recession with inflation still too sticky, you've got a growth problem and an inflation problem. Rates are high, and the ECB, what's President Lagarde going to do over the next several months going into year end with those kind of forces, those kind of cross currents at the moment?
Especially when a strike over in Australia can send natural gas prices climbing significantly, and all of a sudden that becomes more of a headwind as well. I think there's an incredible irony here that Germany, the powerhouse, the economic powerhouse of Europe, is suddenly losing stature to the tourism-dominated southern nations in Europe that are seeing their economies outpace Germany by significant margins kind of changes the power structure a little bit.
Is there a German word for that?
Schadenfreude?
I think they would say there is a German word
little
for
bit.
that. Yeah, maybe. For the Italians, the Spanish and the Greeks, perhaps. Lisa alluded to this story. S&P following Moody's in cutting their outlook on a number of US banks, citing a tough climate for lenders. S&P lowering their grades for a number of smaller banks, including KeyCorp and Comerica, writing, quote, the decline in deposits has squeezed liquidity for many banks, while the value of their securities, which make up a large part of their liquidity, has fallen. Lisa, I guess you can say it now because it's true, but you could have said it several months ago as well.
And it hasn't really caused the credit crisis, and it hasn't caused profound illiquidity in a lot of these banks. That said, it is a slow-bleeding story. The fact that people have shrugged it off at a time when we are seeing yields continue to rise points to either the strength of these companies that they've convinced markets or just the power of the narrative. It overwhelms everything. Everything is great, and people can power through even at yields at these high levels.
And not great for these stocks, that's for sure. S&P 500 banks closing close to 7% lower after yesterday's session. Worst month since March. You take the KBW Banks Index down almost 9%. Worst month since March, if we closed out August right here.
And I do think that the Charles Schwab move was an important one. They came out yesterday and said that they were going to cut staff and they were going to cut real estate to try to shore up about $500 million of costs a year. Their shares are lower in pre-market trading, even though they're saying that they're doing this to appease concerns of investors. It wasn't enough, or this doesn't work. It's unclear exactly what people are most worried about at this moment.
We opened the program with this story, so let's return to it. Pilots at American Airlines approving a new contract which would provide 46% in cumulative pay rises and retirement contribution over its 4-year term. The contract worth around $9.6 billion, making it the most expensive labor contract ever, Lisa, for a U.S. airline.
So Bespoke Investment Group said perhaps what's most interesting about these labor negotiations is that there aren't the strikes, that actually the deals are getting done and that the companies are paying up because they are that desperate for labor. And that is how much the power spectrum has shifted to workers over companies. I just want to point to this. This contract also prevents against last-minute changes to some degree. I can just suggest that will lead to more plane cancellations. Like, on one hand, yes, it's wonderful for workers because that means that they're going to have a better life and they can plan their existences, which I think is fabulous. I'm just saying there is a, consequence to some of these things that might be felt to the other side, but people are still going to be willing to do it, as we've seen consistently.
Well, perhaps they'll attract the staff because that's been a problem over the last several years.
Did you ever want to be a pilot?
Yes, of course.
Was that like a phase for everybody?
As a kid, you watched Top Gun. Of course, you wanted to be a pilot.
So maybe are we going to get back to that, where people are like, they embrace it?
Not sort of like an American Airlines pilot, but like in a fighter jet, Bramo, which is different, of course.
Did you have like
Did you have that dream? Everyone had that dream. Yeah, I had a leather jacket. Yeah.
No, I actually had a dream of racing horses and stuff like that.
Racing horses?
Of like, doing...
You're telling me
things.
this wasn't the dream? This is the dream, Lisa. Heidi Krivo-Rediker joins us now, living the dream, Senior Fellow at the Council on Foreign Relations and Partner at International Capital Strategies. Heidi, wonderful to see you, as always. If you want to hear about China, I often go to the miners, and this is what BHP and the CEO had to say today. Beijing has put policies in place that are meant to stimulate new starts in the property sector, but we're not seeing that translate as effectively into changes on the ground as we were anticipating. Heidi, what is it about what China is trying to do but isn't achieving?
So I think, the problems are not entirely new that they're facing right now, and they've made a series of very bad policy choices over the course of COVID, the alliance with Russia. So they have, they're facing the demographic challenge, super challenged on debt. And you have this the deflation, disinflation conundrum that's starting to appear. And I think you really need to have some kind of something to actually, some kind of a national stimulus. But Xi is not really there because there is too much debt in the system, and there's been a misallocation of resources. So it's sort of a very big puzzle to solve. And you're seeing a continuation of additional bad policy choices, like let's not tell anybody how bad things are really going, whether it's youth employment or in the banking system or any negative reports could come out. So I think those are they're sort of heading in the wrong direction when it comes to policy to address what is an increasingly challenging situation.
Heidi, you've worked in the Treasury Department, you've worked in the State Department, you've seen the flows of capital, you've really watched them closely. Is there any connection to the weakness that we're seeing in China and the sell-off that we're seeing in U.S. Treasuries?
So I don't know if we're looking at the connection between the two so much. I would keep them. I would think of them, in separate buckets. The challenges that we're seeing and the need for example, PBOC to intervene in yuan is it's really to stem domestic challenges, and I guess you could make the connection of that there's capital that's coming out of China, but whether or not they're going into treasuries or not, unclear.
We're also looking at the questions swirling around China's economy at a time where this BRICS symposium is taking place. This Brazil, Russia, India, China, and South Africa looking to bring in more potential participants and talking about de-dollarization. Does this catch your attention right now in a greater way than it has before, or is this just basically a lot of noise to try to bring people to the table at a time where there's a lot of dissonance between these different members?
So there are, this is the big event that's happening today and tomorrow. It's the 15th BRICS meeting, summit of leaders, and Xi Jinping is actually going to be there. Putin is not, but you really have a mix of interests at the table. You don't have willing participants from you don't have India, for example, wanting to support a Sino-centric ambitious goal to counter the West, and there's not a clear plan of how the BRICS acronym will expand to a lot of other letters, and what that as an institution will actually do. Is it another UN General Assembly that they're putting together? And when it comes to the currency, the BRICS currency, they did take it off of the agenda because I think they realize that it's not particularly feasible. Dollar, until you actually have a deep, liquid, tradable currency that is, that can counter and challenge the dollar, and that would most likely be the euro. You're not going to see a BRICS currency per se actually evolve. One thing I always look to is, Russia and India are using the rupee for trade, and you're seeing Russia with $1 billion of stranded assets in stranded rupees. Because they can't actually convert and use the currency because of sanctions. So it's complicated, but I don't see the challenge to the dollar as a real thing. Not that I'm sanguine, but I don't think this is going to be it. You might see, in addition to the euro, maybe in the distant future, some kind of a digital currency, but the challenge is not going to come for the BRICS.
It's super complex. The president was pretty blunt about some of these issues in the last couple of weeks, Heidi. Let's finish there. He called China a ticking time bomb, referring to their economy. He called some of the leadership there bad folks. He said bad folks do bad things. Heidi, from your perspective, what do you suppose the bad things are that we should be on the lookout for?
So the obvious bad thing is really the big question about Taiwan that hangs in the balance. When we look at the political and national security overlay with the Chinese economy, they've clearly prioritized national security in a way that is much more aggressive than anything that we really understand, and so with youth unemployment, I always look to youth unemployment, and the fact that they are not publishing the statistics anymore is really not going to make the problem go away. You have additional studies coming out with how many Chinese have really taken to not being interested in participating in the labor market at all. You have college grads that are delivering coffee. You had a one-child policy that gave a whole generation of kids whose parents focused on getting them to a better place, and now they can't find jobs in a place where the demographics are that ticking time bomb. I think that is one very big ticking time bomb.
Yep.
So but I think that was probably where President Biden was going with this. But there are multifaceted challenges there, and I do think that if domestic security is going to be an issue, it's because of the youth unemployment issue.
We're certainly focused on it, except we're not going to be able to hear anything about it because they're not going to publish it anymore, as you suggested, Heidi. Thank you. Heidi Kriba-Rediker, that school of thought here that as things get harder with the economy, they become more assertive on national security issues. Heidi Kriba-Rediker. Up next, the prospect of 6% on a 10-year yield. Katie Kaminsky of Alpha Simplex from New York. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This isn't yet about any kind of growth slowdown. Fed is still saying that a period of below trend growth is going to be necessary to get that quote unquote last mile of inflation. The danger is that with growth so resilient, the Fed shouldn't be showing as many cuts in 2024, even as inflation has come down.
The brilliant Luke Howard there of UBS Asset Management in the last 24 hours. AMH writes in, be kind to Birkenstock.
Interesting.
I would not have guessed that AMH was a Birkenstock kind of person.
She'll have to set that record straight
shocked
in
about that, actually.
I don't know, a half an hour time.
Joined us in 40 minutes.
Talk about it.
She thought she'd be talking about the GOP debate taking place tomorrow.
Not. She's going to talk about Birkenstocks.
And the lineup that was confirmed. But yeah, we'll talk about that. An IPO in prospect maybe later this year.
I don't understand your sort of aversion to them.
Sandals and socks in New York City.
Put away the socks for a second.
Time and place.
Okay.
Manhattan.
Okay, but just in general, as a shoe.
I think there's a place for that. And it's not Manhattan.
Do you have sandals?
No.
What the heck do you wear on the beach?
I think there's a place for that.
Okay.
You take your socks off, don't you? You walk around. Why would I wear sandals on the beach? Get in the sea. You wear sandals in the sea.
Well, no, but you take them off. You have to wash off your feet. It's sort of an easy, if the sand is hot and you're walking across it, you want to have something to protect the bottoms of your feet.
Good chat.
Okay, this is good.
I miss TK for this. Tom would be so on board with all of this.
Well,
As this for a quote. Let's play Guess Who. Okay, this is serious now. Here's the quote. Last year, we had a ton of short signals, but the only one that seems to be somewhat persisting going into this year is short bonds. That's really because it's a contrarian signal. It's something that few people really want or are confident with. I'll give you the date, early January of 2023, and I'll give you the name, Katie Kaminsky. Katie Kaminsky joins us now, Chief Research Strategist at Alpha Simplex. Katie, what a call at the start of the year. This short that you've held on bonds is paying off in a big way over the last month. You've put out a headline and you knew it would get attention. You've raised the prospect of going to 6. So let's breathe some life into that conversation. What is it that you saw at the start of the year that's continuing now and you think these forces are here to stay?
Yeah, so we've seen short signals in fixed income all year, albeit not as strong as last year. But what's really interesting about this, particularly recently, is we've started to see the market agree with us. And we've also seen some of the fundamental players out there say, this might have to happen. Higher rates for longer.
So, Katie, is it time to back away, considering at the start of the year it was contrarian? Why is it a move you want to stick with?
Well, this is a really good question because I've been asking myself this as well, is that if we've looked at the data with technical signals, when the curve is still inverted, trend signals short tend to work really well. As we see a flatter curve, it becomes more mixed. And if we can see a steeper curve, I plan that we're probably going to be long. So we're still within that transition period where we could have a very interesting trend environment as we see the curve flatten out and everyone realize, why hold long-term debt when you can have such a good return short-term? And if the data isn't clear that we're going to cut rates quickly, it's a sticky inflation play. It's a question about long-term cash flows. And I think people are starting to really realize this is the real issue.
Katie, every single day we ask people, why now? The bond sell-off is something people were talking about for quite a while. Suddenly, it seems to be reasserting itself. Do you have an answer to the now of the sell-off?
Yes, I really think it has to do with behavior. And I think that everyone would rather wait to see if something is going to come to fruition. And that's exactly what you're seeing this week. Everyone's sitting around waiting to hear commentary. They're pretty sure they know what it's going to be. And I think the real truth is that we're starting to see the data is pretty consistent with the narrative that this is going to take some time and that higher rates could be part of what is the new normal in a world where we've experienced so much inflation and sort of a very different post-pandemic economy. And I think that's where it's starting to turn around and I'm starting to see fundamental investors agree with the technical signals.
How important is it that stocks have been able to rally in the face of higher yields? Does this sort of edify the idea that this is sustainable and something people can lean into, that yields are going to stay this high and the whole world isn't going to collapse as a result?
Yeah, that's a tricky one because I think the backdrop of yesterday, so yesterday definitely brought that to light. You saw an environment where stocks were up, the Nasdaq was up a ton, and yields were up to 16-year highs. That's a weird situation for markets. I think if it's actually the case that those two things coincide, it means the market's accepting higher rates, which could be a good thing. On the other hand, I'd be a little skeptical of how big of a move we've had this month. We could have just had a little bit of relief rally yesterday. So I think we need to watch that correlation trade a little bit more closely going forward and see if this positive correlation environment is actually going to stick.
Hey, Katie, we can see the rates on the screen. I just wonder how many people are paying them. Katie, we haven't had the great refinancing yet. Some people maybe think it begins next year in high yield. Katie, do you think this economy can tolerate these kind of rates beyond, say, 6 to 9 months?
This is the really tough question. And I think that's what March showed us, is that suddenly it seems like people wake up and they say, wait a minute, there's a good deal for yield here, or this isn't working. And I think it's very hard to predict when people are actually going to refinance and when those particular events are either going to change their behavior. The truth is people behave differently in a higher rate environment. We've seen that shift in short-term rates. We haven't seen it in high yield. We haven't seen it in long-term debt yet. This week was interesting to me because it said people might be starting to wake up. You're starting to see headlines about selling treasuries. You guys were just asking about that. Could it be the time? Maybe this fall.
Katie, just one more question. The 6%, the number 6, that gets a lot of attention. Is that actually a call from you Is that a forecast?
No, we don't forecast, but we do see trends in data. And if you look over longer term horizons, 6% isn't a crazy number for a 10-year. I know it is for those of us that have been living in, a decade of really low interest rates, but those of us who look at the technical signals and long-term historical patterns, what you see is that that's not a restrictive rate for many periods in economic history. So it's not strange to think that we might have higher rates if we have surprises on the upside and inflation in the fall.
Katie, great call to start the year. Just fantastic, and great to catch up with you late into August. Katie Kaminsky there of Alpha Simplex on this bond market, and why potentially you can go as high as 6% on a US 10-year. Lisa, it's not the new normal, it's the old normal. It's the old normal that many of these guests keep reflecting on.
Bear with me. Something that I've been thinking about for a little bit of thought exercise. If you're really able to earn 5%, let's say 6%, let's go to Katie's conceptual figure there on 10-year treasury yields. Let's say you're earning that amount of money and you're borrowing money at 7% or even 6%, then it's a wash, right? So at a certain point, if you have assets, you could see how people could extend themselves and it not make a difference, right? It sort of depends on what the assets that people have. In other words, does this end up disproportionately affecting people who are on the lowest ends of the savings and income sphere while allowing the luxury, the top end, to keep chugging along and even doing better when you actually are getting yields, that stimulative effect of yields that are no longer at zero?
Oh, to be blunt, without a doubt. Without a doubt. Obviously, if I'm cash rich, asset rich, I'm fine.
You're doing great.
If I'm not so great. I've been wanting this for ages.
I mean,
if you're sitting there with a ton of savings, 5-6% interest, wonderful.
Yeah,
it's absolutely fantastic.
And you're risk averse and you have certain constraints around you for
you're
which you can invest in.
Right now,
I'm just saying that if you, for a little bit maybe, but I'm just saying, you think about how that changes a dynamic in a more material way that isn't being factored in because people automatically think high rates restrictive, low rates stimulative. And this was really a question, a sort of existential question during the era of monetary repression. Is that contributing to low inflation? Is it going to be the reverse as we start to see yields stay at higher levels?
This operates on different timelines. Wait. It doesn't seem restrictive now. If we're going to have the great refinancing that begins at some point next year, particularly in high yield, look at what they borrowed at in the last couple of years and look what they'd have to borrow at now in this market. It's a monster change that we'd have to digest.
So that's what I've been feeling and thinking. And then I was reading some stories and looking at the data yesterday about all the CCC companies that have either refinanced or restructured and really worked to extend that window out. I'm just raising this prospect that maybe it's more than just 1 year, 2 years, 3 years, that people have insulated themselves. And if that's the case, I don't know. It's hard to understand the transmission mechanism of high rates in this economy, given the lack of effect that it's had so far.
Oh, that's been the huge difficulty over the last 12, 18 months. And it's why we're still sitting here wondering, are those lags super short or just super long? Jill Carey-Hall of Bank of America is going to join us a little bit later. We'll wrap up some of the retail earnings as well with Chuck Grom in about an hour from now from Gordon Haskett. Macy's, just out moments ago, we'll recap this in just a couple of minutes, reaffirming their annual sales and earnings guidance. That news out just moments ago. That stock is up by 1%. Equities up here by 0.4% on the S&P 500, with yields just a little bit lower, but close to multi-decade highs. From New York, good morning.
On the next episode of The Circuit.
It's still almost shocking how new you still are to this sort of being famous thing.
When I do, go out and people are like crying, that's when sometimes I'm, whoa, why? There's no rule book for it.
Watch The Circuit with Emily Chang Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
Forget a degree in finance. Go for a career in tech instead. That's the advice from the latest Bloomberg survey of professional and retail investors. Only 1 in 5 Wall Street professionals say high school seniors graduating this year should follow their footsteps and go into finance. About half say that Gen Z's best bet actually lies in the tech sector, and that's despite all those recent layoffs at companies like Meta, Amazon, and Google. Still, hiring trends paint a rosy picture for those with a background in tech. Industries ranging from auto to the federal government have jumped at the chance to recruit any laid-off tech workers. A degree in tech could set you up for a lot of potential jobs and a safety net if any of those jobs don't quite pan out the way that you'd hoped. Survey respondents also expressed concern about the long-term threat of AI. Think ChatGPT taking all of our jobs. For kids graduating from kindergarten this year, about 40% of investors said to go into healthcare. That way, when they come of age, they may be able to hedge against any potential AI-related job takeovers. Roughly 12% said Wall Street would be the right career given that pending AI threat. The AI concerns come despite traders themselves finding that current iterations of ChatGPT struggle with things like math and corporate earnings. But the idea here is that there's still plenty of time for AI to improve and to potentially threaten our jobs along the way.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges.
Britain's next.
Fed was going to keep rate
World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is not an end of bull market run. This is just a correction.
One thing that really stands out is how kind of rational or orderly a lot of the elements of the sell-off is.
I think we are in a situation where we are seeing pressure on many central banks.
The Fed is going to cut rates next year. That's what the equity market wants to hear in order to have a sustainable move higher.
The Fed will back off if inflation comes down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
This has not been a quiet August at all. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow, snapping a 4-day losing streak on the S&P 500 in yesterday's session and adding just a little bit more weight to the S&P 500. Equities up here by 0.5%. There have been many surprises for 2023. The US economy has been one. Upside surprise after upside surprise. Consumer discretionary, very much in focus with the airlines, and the cruise operators. Bramo retail in focus this morning all over again.
We've been getting a slew of earnings, whether it's Macy's, whether it's Lowe's, Dick's Sporting Goods, and we will work through all of them. But the highlight really is resilience, and we keep seeing that despite some concerns. We've seen that in the shares. So far, year to date, people continue to spend, and that has been the story.
This sets up the conversation for us pretty well with Chairman Powell on Friday. That speech, 10:05 Eastern Time at Jackson Hole, Wyoming, that annual Fed get-together. I'm sure you're all familiar with that time now. Lisa, just how resilient is this economy going to be? How can consumer discretionary spending hold up in the face of 5.5% interest rates?
If people are getting 48% increases in their wages or whatever the latest labor agreement was with American Airlines, then they can afford it. If you can see inflation coming in, wage increases continuing to maintain at the pace that they have, real incomes will continue to increase. And then all of a sudden, disposable income. That's the perfect world. People are shrugging it off and saying, just wait, just wait. But this goes to this question of how long do you wait before you start to say, maybe my assumption isn't so accurate.
46%, but what's 2 points between friends?
I knew you would correct it. Which is good. That's the reason why I was waiting for it.
As well.
Exactly.
Everybody's going to see these headlines. They're all going to see them. UPS at the end of this contract, what is it, 170,000? Something like that. You can correct me if I'm wrong.
No.
The airlines, 46%. Cumulative pay rises, benefits, retirement contributions over this 4-year term. Everyone's going to see these headlines. They're going to go to their employer. aren't they going to ask for the same thing?
Well, and there are reports. There was a Wall Street Journal article overnight that talked about how actually when people are looking for jobs, they're seeing the increases they potentially could get in their wages that aren't as big as they used to be. So there is signs of a bit of cooling on the margins. But yes, I take your point that right now there has been a shift to labor, and it doesn't seem to be diminishing even as we're a year into this tightening cycle and we're at the highest levels going back 16 years.
You've mentioned this a few times. You've raised the question. You've asked it. I don't think either of us have drawn any conclusions on it. But ultimately, is there a window here where you have to deal with it before it gets embedded into the system, before we start discussing that wage price spiral that we've been talking about for the last 18 months?
The Fed does not seem worried about a wage price spiral right now because they keep saying that, yes, wages are coming in, but it raises a question of embedded inflation expectations that are good and inflation expectations that are bad. We keep hearing discussion around whether the Fed will allow 3% inflation as a target. Is that embedded inflation expectations, or is that healthy? Are people going to be talking about that at Jackson Hole? Not out loud, but behind the corners, yes, I expect that to be a significant conversation as people game out what the correct policy is.
If they are behind the scenes, we'll bring them to you on air, of course. Equity futures right now on the S&P positive by 0.4%. There has been a lift in this equity market the last couple of days, but really the dominant story for the last month has been in fixed income in the bond market. A new cycle high on a 10-year, 4.35 this morning. Lisa, yields lower by 3 basis points at about 4.30.62.
You mentioned retail earnings, and we have been getting a slew of earnings. We just got Macy's, Dick's Sporting Goods. I want to start with Dick's. We also got Lowe's, which is positive. Dick's Sporting Goods came out below expectations with net sales and EPS that came in lower than expected. Those shares are lower by more than 18%. Not so when it comes to Lowe's. Those shares are popping as people do look to an upgraded forecast going forward. Contract work because people aren't moving, so they're making their homes nice. That seems to be part of it. And Macy's reaffirming guidance. Those shares 4.5% gain. So again, the strength there. Dick's perhaps a different story. Maybe people have all the fishing rods and hiking gear that they need. Today, we also are talking about the leaders of the BRICS nations, Brazil, Russia, India, China, South Africa, talking in Johannesburg, talking about how to move closer together to counter G7, questions about the dollar, whether they're going to counter that. We just got that shot down in the last conversation with Heidi Kreber-Rediker. We will be talking about, though, on an ongoing basis. And today, Fed speak ahead of Jackson Hole. Richmond Fed President Tom Barkin. He will join in about half an hour, not here, but he will join somewhere. And Chicago Fed President Austin Goolsbee and Fed Governor Michelle Bowman will be speaking throughout the day as they sort of give their divergent views on how to handle this. I'm not expecting to hear much from any of them because all of them don't really have much to gain, John, by really saying anything too aggressive right now. The market is moving in their direction. They want to see yields moving higher. And then the fact that you're seeing the markets hang in there, well, isn't that kind of a good thing?
I hope Tom Barkin knows where he's meant to be. I hope he knows.
I assume. Look, if he shows up here, I won't get upset. You know,
I was laughing as you did the stock check. You know, Dick's call their customers athletes.
I know. I know.
And you start discussing fishing and stuff like that. Is fishing a sport? Athletes.
Do you think that golf is a sport?
I do, yeah.
Okay, then why isn't fishing a sport?
They don't move, do they?
Well, it depends if you're fly fishing. You've got to wade through the water.
You wade through it?
And then you have to cast.
Okay.
I mean, how it's like this versus this.
Okay.
You know, it's like...
Thanks for that. Yeah. That's a good question. Deep stuff here, Bramo. Joe Carey-Hall with us, head of US small and mid-cap strategies at Bank of America Securities. Joe, good to see you.
Good
morning.
To see you, too.
You've upgraded your view on consumer discretionary. It's pretty interesting. Can you walk us through why?
Sure. I think, as you were saying, the consumer has been holding up well. Real wage growth turned positive for the first time in 2 years. Even though we have higher rates in the U.S., consumers are a lot better positioned than a lot of regions with, fixed rate mortgages. So I think, the consumer has been solid. We're seeing a potential shift from services spending doing really well to now, goods spending has been starting to turn a bit. Consumer discretionary is more exposed to goods spending. And I think, positioning when we've looked at, fund manager holdings of consumer discretionary stocks is at extreme lows. So, I think from that perspective and, the sector has started to rank better in our quant work as well. If we are moving into more of a recovery environment, if the Fed is done hiking soon, that's usually when the consumer discretionary sector tends to start to work.
It was supported by all of this pandemic savings, and we're told repeatedly that's being burnt out. Apparently this is the quarter, according to some studies. We've been told that quarter after quarter for the last year, but let's go with it. Let's say this is the quarter. Do you think we can have this seamless handover from the support we got from savings to the support you could get from a tight labour market?
Yeah, I mean, I think, the key part there is that it was excess savings and, returning to obviously just normal savings trends. If consumers are feeling good and have higher wages, I think there's still potential for consumers to spend. And we've seen this earnings season so far, the consumer discretionary sector, obviously still seeing some retail earnings come in, but the sector has seen some of the strongest results among all of the sectors so far, really large beats on the top and bottom line. So, so far the trends for the sector have been holding up well, even this earnings season.
I've been looking at the S&P consumer discretionary bucket. Shares up 28% since mid-March during some of the peak of the concerns going back to the banking crisis. There's already been a lot baked in, and we're seeing yields go higher. If yields continue their sustained move or stay where they are you concerned about going overweight given how far the stocks have already gone?
I think, valuation does look a little bit expensive when you take out some of the largest stocks in terms of Amazon and Tesla. Valuations definitely look more reasonable. And then also if you kind of compare it to consumer staples, so we had downgraded consumer staples when we upgraded discretionary. A lot of our overweight sectors right now have a more cyclical tilt. I think at this point in the cycle, this is when we think it makes sense to be a bit more cyclical. That's where active managers, like I said, are very underpositioned. Both hedge funds and long-only funds, they're positioning in cyclical sectors relative to defensive sectors is at pretty extremely low levels when you compare it to the last, decade or two.
What would you say to people who argue that some of these cyclical companies are more leveraged to where we are in the yield space, have to borrow more money, have to be exposed to higher borrowing costs in a more predictable manner, and that they therefore could be hurt by that?
Yeah, I think there's certainly some sectors where that's a lot of risk. I mean, I think in the high yield market, some of the areas that our strategists have seen the bigger risk has been in, TMT and healthcare. Those are some of the areas where for small caps, which is an area where I'm tactically positive right now, but I think medium term, there are certainly more risks around refinancing. That's an area where a lot of, healthcare and TMT stocks are the non-profitable, non-earners. A number of sectors like real estate have very high refinancing risk. So I think it's something that investors definitely want to pay attention to. Having screens on leverage and on short-term and floating rate debt is a factor that I think is going to become more important than it has in the past.
Jill, banks. Yields up, banks down. Let's finish there. Why are yields up and banks are down? What's going on with banks?
Well, I think, banks, we've started to see, actually, when I look at our flow data, after a long period of, underperformance and uncertainty after March, we've actually started to see a pattern of inflows there. We've obviously been through earnings season. I think right now we're waiting to look at, how banks react, credit conditions, all of that. We've seen a period of stability. I think, when we look at all of the sectors across the board, banks are still one that ranks well in our work, especially in large caps. I think in smaller caps, you want to be a little more cautious given the exposure to regionals and the higher regulation risk, which could impact multiples. But for a lot of the larger banks, these are higher quality. They've after the last crisis kind of cleaned up their balance sheets and look a lot better than they did heading into that crisis. So, again, another cyclical sector that, in our work looks relatively well positioned.
Preference still equal weight S&P 500 for you and the team?
Yeah, so we've had a 4,300 target on the market. I think we saw very strong mega cap leadership earlier in the year. Very narrow leadership that started to broaden out the last couple of months. So that's sort of our continued expectation is that the equal weighted S&P 500 will lead the cap weighted S&P 500 from here. More of a broadening out of leadership. Small caps could see a recovery rally tactically.
It's amazing. 2 weeks ago, that was like consensus view. Few weeks of a bond market sell-off, and it's like, oh no, hard landing, no landing again? Is that what we're doing again?
Well, right now I think that there's that noise on one side, and it seems like stock players are playing on a totally other sphere. They're just basically looking past it, like bond markets are going to freak out, and then they're going to come back, and we're going to just keep chugging along. The earnings seem pretty good.
Hey, Jill, good to see you. Thank you for the update. Thank you. Jill Carey-Hall there of Bank of America. If you are just tuning in, welcome to the programme. The S&P 500 positive here by 0.4%. Coming up in the next hour, Monica DeCenso of JP Morgan. We need to talk about this bond market. The 2-year through 5% at the close yesterday for the first time post-SVB failure. Lisa, what a turnaround. Look at the charts for fixed income, just filling the gap over the last few months.
And erasing the game that was trying to give some reprieve to people from last year's losses in the bond market. I suspect that you've been getting some feedback on sports and what counts as sports and not, and sort of the list of things,
Dressage, artistic swimming, ballroom dancing.
And you think no, right, to all of those?
I'm not going to express my opinion just in case.
Well, you just did.
I offend the many. I might offend the many Bloomberg terminal users that are into artistic swimming.
I personally, I actually.
Know your audience, Bramo.
If you are into artistic swimming, please write in. I want to talk to you because I actually would argue that it is a sport and that curling is a sport. Do you know that when
There's a club for terminal users?
What?
For artistic swimming. Yeah, they get together Thursday afternoons.
You can't even keep a straight face. No, they don't.
They get together Thursday afternoons.
No, that's just not true.
They do.
You're making this up.
Stop stereotyping people, Lisa. It's rude. Kennedy Goldberg of TD Securities on Climate Yields joining us in about 17 minutes' time. This bond market's been phenomenal. New highs on a 10-year, highs we haven't seen since 2007, on a 30-year, highs we haven't seen in more than a decade, on a real yield. Real yields at 2% on a 10-year. And an equity market that's bouncing back up by 0.4% on the S&P.
Not paying attention.
Potentially a second day of gains on the S&P 500. Your 10-year this morning, 431.22. Up next, we'll head down to Washington, D.C. and catch up with Bloomberg's Anne-Marie.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television. How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This week, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go.
Coverage starts Wednesday, August 23rd with a special edition of Bloomberg Surveillance live from Jackson Hole on Friday, August 25th, starting at 8 a.m. Eastern. Bloomberg, your global business authority.
To to come out. If we want the equity market to settle down and we want yields to settle down and then be able to continue the move higher for the equity markets, Powell has to come out and reaffirm what the dot plots were saying, that there will be cuts in 2024.
Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. Everyone looking into their crystal balls trying to work out what Chairman Powell's going to say on Friday in Jackson Hole, Wyoming. It's amazing what Bloomberg terminal users get fired up about. Here's a quote for you, a direct line from a user. It is massively impressive and a brilliant discipline. It ain't a sport. There you go, on artistic swimming.
And here's another one.
For whatever that's worth.
In the South, artistic swimming refers to someone's ability to stay afloat without spilling their beer.
Okay. There we go. That's how people feel about it this morning.
I'm glad that
it's good to know.
Got everyone.
Good to know they're focused on that and
not anything else that we're talking about.
Not going to share any names. The equity market on the S&P 500, by the way, if you're tuning in for that, and I'm sure many of you are, positive by 0.4%. Equities a little bit higher in the face of yields near multi-decade highs. The 10-year this morning is lower by a couple of basis points, 431.42. After Chairman Powell, there's still some data to come. Early September, I think the very first day of September, there's a payrolls report, Lisa, and then it's on to September 13th for CPI, and then the back end of the month, the Fed meeting.
They're data dependent. That's what we hear. So
apparently, yeah.
Evidently, which data is going to actually make it or break it for them? And at what point is it 3-month trailing? Is it the revisions? What's going to exactly cause some sort of reality check where they feel like they're on the right path? Before
we get to all of that, we've got a GOP debate over in Milwaukee. We want to follow the money. That's what we do. So here's the quote for you from the team here at Bloomberg. The former president holds more than a 40-point lead in the Real Clear Politics average of national polls and has the money to match it. Listen to these numbers. His legions of grassroots donors have poured in more than $61 million into his coffers since he officially launched his third bid for the White House back in November. Compare that to second place, the governor of Florida, Ron DeSantis. More than 3 times what DeSantis, the former president's nearest rival, has raised since entering the race back in May.
The fact that the former president, Donald Trump, is not going to be on that stage with the other contenders puts so much focus on Ron DeSantis as the runner-up and who's he going to cede his helm to, because there seems to be a feeling he's losing a lot of momentum. Who's going to pick it up on the other side?
Joining us now down in Washington, Bloomberg's Anne-Marie, our chief Washington correspondent. AMH, follow the money. How much money is just sitting there on the sidelines waiting for these debates to work out where that money should go?
Well, I think a lot of it when it comes to the major donors who everyone thought was really going to pile in heavy throughout the summer on Governor DeSantis. And a lot of them are just taking pause and they're waiting to see if there's a potential another candidate that rises. We have seen this restart from Governor DeSantis' campaign, and it hasn't actually worked. What I think is so interesting about the money, though, is when you look at the grassroots enthusiasm, that's where you can see a lot of the base decide really who they want to put these lower level capital money into candidates. So Nikki Haley is really a star when it comes to that, obviously, besides Trump. And then there's another individual that the data and the money really shows potentially this person could start to shine. And that is Senator Tim Scott. About 40% of his donors also donate to the former president. And that is the biggest amongst all these candidates. So when it comes to a group of people who are giving to the former president, 40% of them for Tim Scott are also going to him. So that's an interesting number to look at. But when it comes to the former president and you look at all this money he has, those resources could potentially be drying up very quickly. And this week is going to prove that. When he shows up on Thursday, he says he's going on Thursday to Fulton County, Georgia, to turn himself in. This is going to be on his 4th indictment.
What do you expect the actual debate to look like without the former president and with his counter-programming on X? That's the latest that we are hearing with Tucker Carlson.
Yeah, and that does look like that interview has already actually wrapped up. They're just waiting to hit play on X, his counter-programming. Former president sitting down with Tucker Carlson, who also used to be a former Fox News host. So I think without the former president on the stage, it does give a little bit more air and breathing room for these candidates to actually talk about policy. And if you looked at some of the latest polls, That's what voters are craving for. They want to hear what these individuals have to say, not about the former president, which they're constantly asked about, but actually about policy initiatives. Most notably, what is their path regarding the economy, and what are they going to do to bring inflation down, which many voters continue to say is still hammering them when it comes to higher grocery bills, higher rent, higher energy prices. So I think without the former president physically in the room, there is going to be these avenues for them to explore actual policy dialogue. The issue is, of course, the hosts are going to have to ask about the former president. These candidates are not just trying to vie to be the nominee to beat President Biden. They also need to deal with this incumbent within their own party who is dominating in the polls.
Do we have a sense of how much the core of the Republican Party are people who are pretty concretely in Trump's camp versus people who are open and are going to be watching the debate to really see what the issues are and parse through who else they can get behind?
Well, Trump holds the base continuously, and that's about 30% of the Republican Party. What was interesting in a recent Iowa Des Moines Register and NBC poll was that individuals are open to their second choice candidate. There is an openness in Iowa, too. So if Trump's there first, they are still open to their second choice candidate. And they also have high favorability ratings for an individual like Senator Tim Scott. But these individuals have yet to break out. So it's not said and done that Trump is going to be the nominee. Obviously, if you look across the polls and you see his wide margins, more than 60% in the latest poll, with his second place individual, Governor DeSantis, not so near at 16%, it does look like this is a done and dusted primary. But when you look a little bit closer into the polls and some of the other questions that are being asked in key places like Iowa, you do see that there is a path for someone to potentially emerge.
AMH unions, just quickly, they're getting pay rises big time. American Airlines, UPS. Anne-Marie, is that in the president's favor?
It is in the president's favor because he wants to campaign on being a pro-union president, and he can then look back and say, look at what unions are doing. I was correct. But, Jonathan, this is going to be a tricky month for the president up until September 14th, where we could potentially see a strike of auto workers. And today is a really important day because the UAW will vote today. Workers will vote today whether or not to give that leverage to their president to put a strike on the table. And they are asking for a lot. And they've even touted that this EV electric push, which is coming from the Biden administration, they say Washington, D.C. needs to know that this is not hitting the right nerve with our workers.
Interesting. AMH, thank you. Dan in Washington. Elisa, you said this morning. We've had the pay rises without the strikes. So far, so good for this White House. As Anne-Marie just suggested, that can change quickly.
UAW asking some pretty aggressive things, and they are looking to really shut down some of the emphasis on electric vehicles that seems to be propagated more broadly from the administration and globally. It could be more of a clash. They're having some pretty big asks, and this is really a concern. Something like $1 billion in extra costs a year for each of the major
it's real money.
automakers. Yeah, it's
real money for the airlines as well, by the way.
Yeah, so where does it come from? But also the fact that they realize they need their workers more than they do the money. And that's the shift.
We've got a tight labour market, unemployment near 3.5%, and we've got tight monetary policy, we're told, apparently, with yields near multi-decade highs. Kennedy Goldberg of TD Securities is going to join us on that a little bit later. And we're going to talk about this, the prospect of a major IPO in the United States of America. Your top three all time for tech IPOs in America: Alibaba, 25 billion, Meta, 16 billion, Uber at 8.1. Arm is looking to raise 10 billion US. It's pretty amazing. I keep going back to it. We're talking about tight monetary policy, supposedly, and at the same time, we've got basically one of the biggest IPOs in much of the last decade.
It's the reason a lot of people think that maybe this is not a restrictive policy. On the flip side, Arm is not Birkenstock. It's not Instacart. It's a pretty established, behemoth. So there are differences. I'm curious how much it can be a parallel and how much it's an example of the artificial
Arm is not Birkenstock. Value add this morning. Do you want more value add? This from TK. True story, apparently. Lagarde was a member of the French national synchronized swimming team as a teenager. Apparently that's a true story. Available on Wikipedia. There you go.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Equities doing okay on the S&P 500, positive here by 0.4%. We have a lift on the S&P, on the Nasdaq as well, attempting to deliver a second day of gains on the Nasdaq 100, positive here by 0.6%, trimming the month-to-date loss to about 5% on the Nasdaq and 4% on the S&P 500, respectively. That's the equity market. In the bond market, shaping up as follows: a 2-year, 10-year, 30-year, looking like this, just south of 5% on a 2-year after closing with a 5 handle for the first time since the collapse of SVB. In the bond market, a new cycle high for the 10-year, 435. Right now, 431.81 with yields lower by a couple of basis points. On a 30-year, levels we haven't seen in more than a decade, Lisa. You've got to go back to 2011 to have a look at 442.68.
It's just shocking.
This year, leaning aggressively into that short on treasuries. We have got the dominant factor in the FX market being US real yields. Positive and climbing over the last month. That means dollar strength. Take a look at the euro. The euro negative by, let's call it 0.1%, 108.84. Lisa, that's the story. It's got to be, right? Positive real yields, dollar stronger, euro in a world of trouble. What happened to 115, 120? Those calls from a month or so ago.
It's everything on its head. You have the U.S. doing better than expected, potentially raising rates yet again. Everyone thought that the ECB was going to raise rates more this cycle. You have Europe suffering more from the slowdown in China that's accelerating, even though it was supposed to be really seeing some momentum pick up because of the reopening. And now you've got real yields. At a certain point, you have to wonder at what point is this going to be self-fulfilling, where the dollar keeps gaining, even as we get higher prices in oil and everything else.
Everything else, all of the above.
Everything, yeah.
Nothing boring about this. Under surveillance this morning, look at Chinese equities. Look at the Hang Seng. The Hang Seng, the chart is unbelievable. In just a couple of minutes, we rallied a couple of percentage points, seemingly out of nowhere, heading into the close. And obviously, Lisa, that move is fueling speculation about what's behind it.
Clearly, it's just people just saying, all right, now it's time to buy it. No, I'm just kidding. It's what everyone thinks is that the State Plunge Production Patrol came in and started to hoover up a lot of stocks. I mean, they're trying to give polite guidance to investors, polite guidance to banks, saying, please, maybe don't, sell as much as you buy and stuff like that. It's not working. So probably people thinking maybe they're taking matters into their own hands. At what point do they have real solutions versus cosmetic shifts to try to control the narrative and the speed of some of the losses that we're seeing?
Control the optics. What about the substance? I've mentioned this quote from BHP a million times. If you want insight into China and you can't get much clarity, you can't do much better than hearing from a miner, the world's biggest miner. And this quote from BHP Billiton, I think, sums it up pretty well. Policies have been put in place that are meant to stimulate new starts in the property sector. We're not seeing that translate as effectively into changes on the ground as we were anticipating. That is overwhelmingly the view right now. They've done all of these little tweaks. We thought they'd deliver something. They haven't delivered anything at all. They've reopened the economy. We thought it would lead to a boom. Consensus view. Well, there's pushback, I know, but that was the consensus view. It hasn't delivered that boom at all.
So unwilling or unable? And that's what people are wondering. Is this an administration, Xi Jinping, who is unwilling to really expend the capital to do this, or unable to really stave off some of these declines because they're pushing on a string with efforts that could undermine the financial sector if they were too aggressive on certain points?
It's the first thing we all look at the moment, every single morning, waking up stateside. Here's another one for you. S&P following Moody's in cutting their outlook for a number of US banks, citing a tough climate for lenders. S&P also lowering their grades for a number of smaller banks, including KeyCorp and Comerica. And they write this might sound familiar. The decline in deposits has squeezed liquidity for many banks, while the value of their securities, which make up a large part of their liquidity, has fallen. Lisa, you could have written that in March, April, May, June, July. In fact, you could have written in January, February, for that matter as well.
The distinction here is back in March, people were wondering, does this mean that they're going to stop lending altogether, go out of business, and suddenly we face a credit crisis that's going to really torpedo the economy and make the Fed's job easier? The answer was no, none of the above, didn't happen. And now you have S&P following Moody's to raise questions around profitability. It is a different question than a question around ability to lend, willingness to lend, and something that matters to the economy on a broader scale. That's the shift in tone. It hurts them, but not everybody else.
If you heard those first two stories, things would sound terrible. And then you hear about this. SoftBank's arm filing for an IPO on the NASDAQ in what would be the largest tech offering since Alibaba in 2014. What does that tell you, Lisa? Things sound terrible when you talk about the banks, about China, about restrictive monetary policy, and then we're staring down the barrel of one of the biggest IPOs in the last decade.
We're seeing risk markets hang in there and then some. Anything that has to do with the tech sector especially. People expecting to be enthusiastic for this. This was a company that NVIDIA had wanted to buy before SoftBank. SoftBank's retaining a bigger than expected chunk of it. Does this say something about the IPO market, or does this say something about the enthusiasm for tech, or both, right? I mean, how much are we trying to parse through two narratives that really are united, with the tech hopes and dreams fueling the sense that everyone can look past higher yields?
I will say most IPOs are unique. This one is particularly unique. I've known that management, the former management, for a long time. Well-established company that was listed in London, taken off London, taken in by SoftBank, relisted. I don't know how much you can learn from ARM because of that, Lisa. It's not like this startup that's come out of nowhere in the last couple of years.
It's a deeply proven company with a hefty footprint in all things smartphones. It's unclear that that's really going to be an example of what's going to happen with Instacart and Birkenstock.
Birkenstock. The one to watch later this year, maybe.
Definitely.
Joining us on Fixed Income, Gennady Goldberg, the head of US rate strategy at TD Securities. Gennady, good to see you, sir.
Thanks for having me.
What are you more surprised at since the failure of SBB? The fact we've got a 2-year yield back at 5% or the 10-year going back through 430?
I think the 2-year back at basically 5%. I think that's the pain trade for a lot of the banks. I mean, you were mentioning things that have slipped from the headlines. I mean, talk about banking pressures, right? We still continue to have banking losses all over the place. And you'll see that once the aggregated Q2 numbers are out. You'll see it in Q3 as well. I mean, if you just track unrealized held to maturity and available for sale losses at banks, the pressure's on. And especially as we head into the fall, it is going to be very interesting to see what happens on the banking side and whether that creates a new round of pressure as we head into the fall.
It's interesting to me that you see the front end as being more surprising than the long end. Are you saying that yields at 4.3% on a 10-year make sense to you and are sustainable?
Sustainable for how long? I guess that's the big question. And the question that I'm asking myself is, how high can rates go before it becomes almost self-limiting, before these real interest rates really start to weigh on the economy, and that actually starts to drive us in the other direction? At what point does the economy effectively break under the weight of real rates? I don't think we're quite there yet at 4.3%, maybe a little bit higher than that. But I still think that the market's ignoring a lot of this interest rate pass-through at their own peril.
We heard this from Russ Kostridge, too. There is a level. We're not there yet. There is a level. How do you even determine how to look for that level at a time when people seem to be looking past this? And yesterday, even tech stocks rallied. NVIDIA was up more than 8% at a time where Treasury yields were hitting the highest levels going back to 2007.
So I'm always a little bit cautious about giving too much credence to what happens in August. Markets are thin. Not to insult the folks who are still on the desks, but markets are quite thin. I can tell you the level of confidence from a lot of the investors is very low. So you haven't really seen very confident investors actually investing in treasuries. They're still waiting for that kind of, that tipping point. They're wondering what that point is, where they're no longer going to be losing money on their interest rate holdings. So, folks are trying to dip their toes. Like you said, they're getting burned, unfortunately, every single day. there's going to be a point where a lot of folks will want to jump in. The question is that enough, or is that a high enough point where the economy breaks and we start to move back the other way? Right now, it doesn't seem like it, but interest rate pass-through is long and variable, unfortunately, just like the Fed's lag. So it's going to take some time for that to show up.
These yields were the stuff of dreams 3 years ago. I want to keep, really hammering on about that. This was the stuff of dreams 3 years ago. And now we're trying to work out, is it the stuff of dreams or the stuff of nightmares? And you touched on it, and I think it's a really important way of looking at things right now. It's highly dependent on how you frame this move. Do you see this move as a reflection of an extension of the cycle or the recipe for the end of one? How do you frame it?
I think it's the latter. I think the higher rates move, the more likely you are to have the cycle end. Now, the question is that level 2% in 5-year real rates? Is it 3% in 5-year real rates? Or is it even higher than that? I mean, you mentioned it. If you look at 5-year real rates on a 15-year basis, these are the highest levels we've seen. Now, if you look at it on a 20 to 30-year basis, we're about halfway through the range. So maybe we're seeing just a normalization of policy, and by that point, we'll actually start to that'll start to weigh on the economy.
Well, you've got to make a risk assessment, and you've got to give me one. Is it highly balanced, asymmetric? Do I want to buy this 10-year right here at 430, or wait?
I think you want to start dipping your toes here. And I think that's been the sentiment from a lot of investors. Unfortunately, it's the next 3 to 6 months that everyone's worried about. It's not so much 12 to 18 months. I would say if you ask most investors 12 to 18 months from now, they are expecting the economy to slow. But 3 to 6 months from now, that's the big fear, is that can we hit something like 5%?
Just quickly, at what point are higher rates like this stimulative more than they are restrictive?
Stimulative for a lot of the lending, certainly. I mean, you do have a lot of investors trying to put their cash into, certainly all sorts of new places. But, just look at what's happening on the money market side. Cash has value once again. And it's the first time in really 20 years that we've had cash have value. Folks can just put their money in a, 3 or 6 month T-bill at 5.5%. Why invest in corporates? Why invest in equities? There's a lot of money that's going to be getting sucked out of the system. And I think it's ongoing right now. There's a point where that's going to start to actually weigh on the economy. I just don't think we've quite hit it yet.
Kennedy, good to see you. Thanks for being with us. Kennedy Goldberg there of TD Securities. You're really pushing that point, aren't you? The prospect that maybe this is starting to become stimulative.
Yes, because if you think about it, if you're getting money for your cash and there's so much liquidity sloshing around, maybe it's come out of Bitcoin, maybe it's come out of unprofitable tech, maybe it's come out of, non-fungible tokens, which for a hot second my son was interested in. There is a question around, okay, yeah, maybe that goes into cash, but there still is plenty to go into stocks, and there's still plenty to go into everything else. So then on the margins, if you're making money off your money, then that's going to give you money, right? You can do something with that.
Who is you, and who has a higher marginal propensity to spend? People with tons of cash or people without much cash at all?
That's a good point.
The timeline's different. So if you look at the UK right now, the interest on savings, of course, that amount of money has gone up loads. But those people don't have a higher marginal propensity to spend. If you think about what's going to happen over the next 12 months with mortgage costs, particularly in the UK, different structure, of course, the people who don't have all of that cash, getting all of those savings, they've got to pay up big time over the next 12 months in interest costs on their mortgage, and those individuals arguably have a higher marginal propensity to spend. So the difference you're going to make on the economy is going to be much, much higher over the next 12 months when you start to see this eat into the people that are carrying a lot of debt, particularly in the mortgage market.
It's a great point, especially as people think about at what point the savings are going to run out. It's for a specific subset of the population that we're talking about most importantly of all.
This is why this argument still stands. You might think monetary policy isn't restrictive now, but wait here, which is arguably, I think, the conversation the Federal Reserve's trying to have going into Jackson Hole. If you're just tuning in, welcome to the program. The S&P 500 positive here by 0.5%. Coming up in about an hour from now, 50 minutes from now, a man who knows way more about this stuff than any of us do. Vincent Reinhart of Dreyfus and Mellon. Lisa, going into that Jackson Hole speech with Chairman Powell just a few days away.
I'm curious to hear whether he agrees with the likes of Jason Furman, who call for a reassessment of a 3% target for inflation versus the 2% traditional target, and whether that's acceptable, whether that starts to leave this feeling that, okay, well, then what's to stop them from kicking it up to 4% or 3.5%? How do you control it if you feel like it's a moving target?
Chuck Grom of Gordon Haskett joining us as well on retail earnings in about 5 minutes from now. What did he call it, Lisa, a few weeks ago? He called it a discretionary recession. Wasn't that what he was calling for?
And that seems to not be happening quite yet, unless you're working for Dick's Sporting Goods, because that seems to be somewhat difficult. But that had been hopping for
specifically the retailers, I think. You're seeing that show up at Walmart, the trade downs, Target, a little bit of difficulty in certain places.
Yeah. Although, that's what they say. And then you look at the results and you parse through line by line. There still is enough discretionary spending. You look at the S&P 500 discretionary stocks.
Yeah.
They're up 27% so far this year, something like that. I mean, this isn't exactly forecasting recession.
I hear you. The new excuse, student loan repayments. We heard that from Target, from Walmart. We'll have that conversation in just a moment. Live from New York City this morning. Good morning to you all.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. Buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
From New York City.
From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
The consumer has been solid. We're seeing a potential shift from services spending doing really well to now, goods spending has been starting to turn a bit. Consumer discretionary is more exposed to goods spending. And I think, positioning when we've looked at, fund manager holdings of consumer discretionary stocks is at extreme lows.
Jill Carey-Hall of Bank of America with us on the last hour, upgrading consumer discretionary. And that's been a surprise of the year, and she thinks it will continue to surprise. If you are just tuning in, your equity market is leading the way, gaining by about 0.5% on the S&P 500, near session highs and potentially delivering a second day of gains. In the bond market, yields still near multi-decade highs, the 2-year pulling back by not even a basis point. Lisa, you made this point. This bond market rally this morning is fading, isn't it, over the last couple of hours? At the moment, your 10-year down by something like 3 basis points. It was lower than that. We're back to 4.31 on a 10-year yield this morning.
Katie Kaminsky finally has company with the bond bears really seeming to gain some steam. All the people saying that they want to buy, the screaming buy, where is that conviction at when day after day, as we just heard, they just get absolutely burned day after day?
30 basis points intraday on a 10-year back in March 2020. If I'd said, Lisa, I'll give you 400 basis points more than that, 4 percentage points more than that, just wait 3 years. You'd be like, promise? I'd be like, absolutely, it's all yours. And then you get here. This is what I love about markets. You get there, and then people are like, it's the only place in the world, I think, where there is a sale and people run away from it. If there's a sale anywhere else in a market economy, people kind of run towards it. With this, it's completely different. It's the psychology of markets that always entertains me.
With a T-shirt, the risk of maybe getting something of lesser value is not that great. With the market, people are all worried about what they don't know. Is this truly a regime change? Are we going to get to 6%? Because then this doesn't look like a bargain. This looks like a time to run and to sell screamingly, because things are still going to get worse in terms of bond prices down, yields up. So these are some of the questions, the existential questions that people are asking ahead of Jackson.
Let's talk retail. Chuck Grom joins us now, senior retail analyst over at Gordon Haskett. Chuck, you named it. You came out with that phrase in the last couple of months on this program. You said discretionary recession. Are you seeing signs of that from the earnings we've seen this morning?
Yeah, generally speaking, almost everybody's comping negative. And I think, you can go back to last week's Target report and you look at the big bellwethers between Walmart and Target. And, Walmart, who sells a lot more food, business was really strong. And Target, whose business is more discretionary in nature, continues to be really soft. But I think, as you guys know, the market's forward looking. And I think we're starting to see some signs of stabilization in discretionary as service spending, we think, is starting to plateau. We're seeing some signs in home furnishings that certain parts of the business are starting to stabilize. We heard from TJ and Ross last week, Wayfair earlier in August. So, we'll see. But there's a lot of mixed data points out there today.
Let's talk about some of the specifics that have come out. Macy's in particular evidently first saw a bit of a pop as they reaffirmed guidance, and then now shares are lower as they're looking at markdowns being insufficient to clear inventory. Is there any larger story to tell here about price tolerance, about the middle tier retailers and how tough it is for them to really move their materials?
No, I think the bottom line for Macy's is that, some parts of their banners were really good. And I think generally speaking, inventory levels across retail continue to be really healthy. But there's definitely weakness across certain parts of retail. There's no really size fits all right now. We continue to watch the trend. And, we'll see how some of the data points come out. Like a company like Lowe's, whose numbers are actually a lot better than expected today. You wouldn't expect to see that with rates moving higher, but their business continues to be really healthy.
Yeah, well, people are renovating their homes rather than moving out because they want to keep their mortgage rates at 3% or whatever. I do want to talk about Dick's Sporting Goods. Shares plunging after they missed their forecast. Talking about theft as one of the biggest reasons. How much more have we heard about theft among all the retailers, particularly over the past 2 years?
It is an issue that is not getting any better. And the problem is retailers can't price to it right away. And that's where the margin surprise comes from. Everybody's talking about it. Target's talked about it. Home Depot has cited it, and even Dick's. But Dick's issue today wasn't necessarily because of theft. Their same-store sales were below plan. And really for the first time since the pandemic, they kind of put up a foul ball for them.
At this point, we're looking at a situation where people are expecting discretionary spending to run out. Is there an area of the market where we're seeing this, or are we just not seeing this? And do you view some of the warnings that we've heard from Walmart CEO and Target CEOs as simply trying to lower the bar so they have an easier time crossing it later?
That's a good question. One of the things that we're starting to see, and we heard it in Macy's report today, and Target called about it last week, was a rise in delinquencies in their credit card businesses, and that's something we really need to keep an eye on. We have not heard that in several years, and we're starting to hear it today. Again, like I said, Macy's credit income was much weaker. So we're seeing some cracks in the consumer, but broadly speaking, we still are pretty upbeat. When you look at real wage growth, 3 consecutive months of positive real wage growth, we haven't seen that in years. We actually think back to school could be really healthy. The weather is certainly breaking across the country like you'd expect to see. Balance sheets for the consumer are in really good shape. So we're more optimistic than we were 3 months ago. I know we talked about that discretionary recession. It's really, really company specific right now.
Chuck, the new blame game, there's a ready-made excuse in the oven from Target and Walmart. Lisa's talked about it a million times. Student loan repayments. Who does that affect more?
It'll affect more the Targets of the world than Walmart. Anybody who has a student loan tends to have, a household income of $75,000 or above. So it's gonna be an issue. I don't think it's a huge issue. Again, we come back to real wage growth offsetting a lot of those student loan repayments. But at the end of the day, people who haven't been paying a student loan are gonna be. It's a net negative at the end of the day.
When you talk about the fact that we are seeing people shift from services back to goods, which goods are getting the biggest pop from that? Is it the idea of investing in your home because you're not moving? Is it clothes? Are there areas you're looking at?
Yeah, that's a great question. We follow Costco, and Costco gives monthly comps. And so you get a really good snapshot on the consumer in certain parts of their business. We're starting to see that stabilization in consumer electronics. We're starting to see it in home furnishings. And when I say stabilization, I mean, we're not seeing declines. We're seeing sort of, flat levels on unit volumes. And we'll continue to see, like I said, the consumer has money, consumer has jobs, so they're willing to spend. And if we see services start to pull back, we think when people are spending more time in their home, they'll continue to invest in their home. And that's an area that we think could continue. And you see, again, like numbers like Home Depot last week, stabilization. Lowe's numbers today were actually pretty healthy relative to expectations. Home furnishings, you're starting to see signs of it. So I think that's what the market wants to start to look for.
Chuck sounded a bit more constructive. Thank you, sir. Chuck Grom there of Gordon Haskett. Quite a change. Just a little bit of a change there, at least from the mood from Chuck, compared to, say, maybe a few months ago when we were talking about consumer discretionary, just a little bit better on the margin.
Join the club. I mean, this seems to be what everyone's feeling right now. Everyone expected, as you said earlier, everyone expected the savings to be over, last quarter, the quarter before that, and this quarter. And it isn't. It's still there. And so at what point do you start to say there's some kind of fulfilling kind of structure here, whether it's higher wages, whether it's less inflation that's letting people continue to spend?
Look, you've asked the question as to whether higher interest rates are stimulative, and I think you're right to ask it, by the way. I think you are. My example is very specific to the United Kingdom. For the UK specifically, whether that carries as much weight here in the United States, I'm not so sure. I think it's a question we've got to ask going into year end.
But, that said, you raise a really good point that who's going to benefit from these higher rates? It's people who are savers, people who have discretionary spending, and those people typically are not the ones who end up spending the most, right? Who aren't going to spend on the margins because they're earning an extra a couple $1,000s from their savings. So that's really the conundrum. At what point is this just, as we were hearing, just simply long and variable lags?
Super long ones.
Super long.
Super long. Monica DeCento of JP Morgan's going to join us shortly. Here's a line from her. Use the coming months and any volatility that comes with it to add to equity risk in portfolios. Monica is going to add to that, Lisa, in about 5 minutes' time.
Again, she's not alone. We heard that from Jill Carey-Hall. We heard that from so many different investors saying that there still is a lot of upside, which is a reason why we've seen stocks hang in there despite yields where they are. I mean, again, can you think about 2 years ago, you say that the yield on the 10-year would be 4.3%.
Laughed out the room.
And then that stocks would be rallying. Tech stocks.
Laughed out the room.
Yeah.
If you'd said 9 months ago tech would be where it was, even with this correction, you'd be laughed out the room. There's been a lot of surprises this year. I would say the biggest surprise has just been the growth profile of the US relative to what we've had from China. The fact you've had significant upside surprises in the US, coupled with significant downside surprises in China, when we thought the economies would be going in completely the opposite direction. We are discussing stimulus in China and the prospect of tighter policy in the US. At the start of the year, we were talking about cutting interest rates at the Federal Reserve. Remember that?
Yeah, I mean, honestly.
By the middle to the end of this year.
Now. We were supposed to be cutting rates now, at least back in March. And now, maybe not until 2025.
Chairman Powell and Jackson Hole, days away. Your equity market positive by 0.5%. Live from New York, this is Bloomberg.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet. An example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port destinations.
Functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How about the Instagram? Can you about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
This isn't yet about any kind of growth slowdown.
We're likely to have a very mild downturn early next year.
Powell has to come out and reaffirm what the dot plots were saying, that there will be cuts in 2024.
We are expecting this higher for longer cost of capital environment.
We might be in and continue to be in a higher interest rate environment.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
We are counting it down to Chairman Powell this Friday in Jackson Hole, Wyoming. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market trying to build on the gains of yesterday for a second day of gains on the S&P 500, snapping that 4-day losing streak. The main event, though, in the bond market, Lisa. Yields we haven't seen since 2007 on a 10-year, since 2011 on a 30-year.
And you put those two stories together, and what do you get? People shrugging off higher yields and saying that they can be managed in an economy that is driven by artificial intelligence and all sorts of other hopes and dreams, as well as people who are not running out of cash to keep spending to improve their homes and to buy things at Macy's.
Who you describe it?
I'm just saying. I mean, that's basically what the story of this morning has been. Consumer discretionary spending still hanging in there, much more than people expected.
Yep.
Yields trying to go down, not really succeeding as much as people would hope. And stocks continuing to tear upward, in particular the tech names.
So what is Chairman Powell's job this Friday at 10:05 Eastern Time? Andrew Holdenhorst, the City, publishing in the last hour. Here's the top line for you. Powell is unlikely to push back against higher yields. Lisa, at this point, given where the data is, why would he?
100%. This is exactly what they've been wanting. I mean, this is what we heard from Claudia Sahm yesterday. What took you so long? This is what we've been saying for so long. And at this point, this is sort of what people were expecting. Is this what it takes for people to actually believe the Fed that they're going to keep rates higher, to get longer-term yields high enough to be restrictive for them then to fall back down? I mean, literally, this sounds crazy, but this is how some people are gaming it out. They need to stay high for long enough for the long and variable lags to actually take effect.
To actually start to bite.
Exactly.
Because they're super long. Is Chairman Powell going to endorse these moves on Friday? Possibly. People are asking for more. Tell me about the long dot, the neutral rate. Explain why it's higher from here. Is he really going to go into that conversation this Friday, given that John Williams, his right-hand man at the New York Fed, has basically poured cold water over that in the last couple of weeks anyway?
And basically talked about the idea of cutting rates going forward.
In 24?
In 24, just because on a natural level, if growth slows, if it slows, and it's actually suddenly a big if, then, you know, rates where they are is much more restrictive than where they are right now, given the growth where it is. I don't know how much he's going to get into any of this, even though the title of the affair is about structural shifts in the global economy. You can say whatever you like.
Come
on.
on.
You could say, but are there structural shifts? I mean, that's the key question. Is this time different? Are we in a new higher inflation, higher rate paradigm that requires a different Fed response?
12 months ago, we knew what he would talk about. We just didn't know how he'd do it. 8 minutes, 9 minutes, sort of down the barrel, really aggressive, pain, lots of pain. Where's the pain? Been asking that question. This time around, it's kind of unknown, right? Going into September, whether they'll hike, whether they'll hike much more after that. What can he say beyond what we've already been told?
I think it's a good point. Some people think he'll just cue really close to the minutes. People are going to be looking for any kind of guidance that they're going to allow inflation to run hotter for longer. We've already gotten that. They're talking about inflation above 2% for a substantial period of time. And that, if they could lean into that, will be interesting.
Equities right now on the S&P 500 near session highs up by 0.6%. The yield of dreams, according to Gargi Chowdhury over at BlackRock. I'll catch up with Gargi a little bit later this morning and see if she's still dreaming about high yields from here or whether this is sufficient. 431 on the US 10-year yields, a little bit lower by a couple of basis points. In studio with us here in New York, I'm happy to say, Monica DiCenzo, the head of global investment opportunities over at JP Morgan. Monica, good morning to you.
Morning.
It's good to see you.
Likewise.
Is this dip a buy in this equity market for you?
It is. It obviously depends where you're coming from. And I think a lot of people I work with started the year being very bearish, waiting for a dip. And then 20% later, they realize they missed it. So now you're down a few percent. So I think if you are under allocated to equities, which most clients I work with are, yes, you should be adding a little bit.
The call
but
at the
acknowledge
halfway
you're going
point of the
into
year,
some bumps probably into your end.
as you're aware, was start buying stocks. For the people that missed it, the argument they were making was it's going to broaden out. Go to the equal weight S&P 500. Look at the things that have lagged. Is that your argument now?
I think you need to be careful going too heavy into tech, even though it is still performing well. And we'll see what NVIDIA does this week and whether that still continues. Because most people I work with had too much tech last year, probably still had too much coming into this year, and they do need to broaden out their exposure for the next cycle. Doesn't mean you can't still see tech work, because if growth is there, there's a secular story there, and that's why semis and all that look very interesting here.
We heard this from Russ Kostridge. We heard this from a host of other people. At some point, higher yields will bite, but not yet. So what are you looking for the higher yields to matter, to sort of throw you off course?
Well, I would argue they did matter last year. It was the pace of the move in yields last year that spooked people, especially growth, especially tech. Now that pace is moderating. So the absolute level matters, but I think a sharp move higher would be what you see bite tech and growth again in a meaningful way. Now, longer term, that's going to weigh on valuations. And so you do need earnings growth to be able to sustain valuations here if rates stay here.
Okay, sharp rise. I want to define that because right now I'm looking at an increase of about 0.5%,
50 bips in a month.
50 bips. I mean, this is a pretty significant move, right? How significant is significant?
Yeah, I mean, what we saw last year, clearly given expectations, last year was very significant. So this is significant, but now the expectation is we hang in here, maybe one more hike. And so with that sort of backdrop, I think the outlook is a little more moderated. And that's why you can be a little more comfortable owning equities. To be sure, though, there is a lag effect. We've been talking about that. That probably still hasn't hit the market. And so that's why, yes, I'd add a little here, but you have to expect volatility going into year end. And so you think of things like low volatility overall in the market. It's a great time if you have equity exposure, instead of selling, to think about hedging, or to use that volatility as we get to later this year to add a little more. And I would leg in maybe a quarter now, and then if you had to add that 100% or $100, you add in like 25 increments over the next 6 months.
Help us out on the fixed income side. A lot of people listening sat in cash, maybe took on some T-bills, 5% start of the year. That was great advice. They're looking at now at yields they haven't seen since 2007 on a 10-year maturity, further out along the curve on 30s, yields we haven't seen since 2011. What do you suggest those people should do? Just sit there in money market funds still, or go out along the curve, look at a 10-year?
I think you need to go out along the curve. Again, I don't think the Fed is done. I think we're in a higher rate for longer regime. And so with that backdrop, you need to be thoughtful. Most of my clients don't have enough fixed income, so they should be adding. But if you're worried about what the Fed might do, and if we're not at the end, look to places like emerging markets where they're already through a central bank cycle, and there you can add a little bit of fixed income. You get that yield buffer, even if spreads widen a bit more. And so that's kind of an interesting way to balance that. I'd add some in the U.S. and some in EM.
Every week on Surveillance, we kind of track the roller coaster that is sentiment and the narrative that is shifting from one to the other, swinging rapidly between no landing, soft landing, hard landing, wet landing, etc. Now, I'm wondering from your clients, is there more fear than greed or greed than fear?
It is shocking how sentiment has changed this year. Now, while sentiment has changed, we haven't seen the money follow it. The money is still sitting in cash. Everyone's still waiting because they feel frustrated by not seeing a more significant pullback. But it does seem very clear to me when you look at this market, soft landing is consensus now. And so if you don't share that view, then you have to be positioned for something other than that. I still think you're going to have pockets of volatility. Those air pockets in the equity market will give you chances to keep adding. But I will say the market's telling you that they expect a soft landing, and so you should be positioned for that in your portfolio.
What is a soft landing that would allow this rally, that would allow this market to continue at pace, given how consensus it's become?
Yeah, I think you need to see earnings actually hold in next year to support, we're looking for 8 to 10% upside in equities. That's not predicated on a multiple expansion significantly. So if you don't see earnings hold in into next year, there's risk to that. That's why this July quarter has been so interesting, because it's actually been pretty good. And so we've seen numbers come in fairly strong in the last week. That's given people confidence. I think that's why you're seeing equities hold up now after this dip. But we got to see how that plays out over the next couple of quarters. Again, it's why you want more ballast. You don't want to be all in equities because you need that insurance, that insulation in a portfolio.
There's some expectation that Chairman Powell might say something significant on Friday. I wonder whether that's just because it's at Jackson Hole in Wyoming. If it wasn't at Jackson Hole, would you expect anything at all from Chairman Powell Friday?
I don't know why you would. You're saying you're data dependent. We have more data coming in the next few weeks. Why? I don't understand. I don't think the incentive is there. And so I would think you stick similar to what you heard in the minutes and hang in and watch that data and go from there. I just don't see the incentive to be that bold. It'd be exciting for us, but I'm not sure that's
the bias, isn't it? Lisa, I think everyone wants something exciting.
Yeah,
totally. But when you strip it all back, Lisa, you just wonder, what's the incentive to say anything new on Friday?
There is none, except maybe to take leadership globally, especially with all the other central bankers there.
Possibly. Is Lagarde on the same page as him on certain issues?
Are they on the same page with themselves from week to week, right? I mean, at what point are they looking at data with some kind of comprehensive view of what it means and what they're looking for?
Can I ask an unfair question, Monica? When they say they're data dependent between meetings, what do you think that means?
Listen, I think they want to see continued proof that this increase in rates is having an effect on the economy. And so they want to see more information coming in the next few weeks. But again, I think it's this tricky balance of you want to do enough to get where they need to go in inflation, but not so much that you break everything. And that's, by the way, an incredibly hard thing to balance. And so that's why me and many other people say, you have to expect volatility. This never is going to end perfectly. And I think if you expect that, you're dreaming.
Monica, this was great. It's good to see you.
Thanks.
Monica DiCenzo there of JP Morgan. We heard something similar to Kelsey Barrow. Do you remember what Kelsey said from JP Morgan earlier this week? It's always at this point towards the end of the hiking cycle, people start talking about soft landings. I think she went back to a Bloomberg Business Week story that had been written about, landing, a soft landing in early 2000 or something like that. It's almost verbatim the conversations we've had time and time again at this point.
It's like spinning around really, really, really fast and then not feeling it until you stop. And then you're just
feel really dizzy.
Yeah. I mean, it's sort of, there's a question of, okay, if you hike rates to this point and then you get to the end, is like when you get to the end is when you can actually understand just what the effects are. That said, I mean, at what point do people get exhausted by all the gloom and doom that some people have been propagating out there that could potentially be
some people
that have been wrong?
Some people. Just to confirm, wrong. Lisa, we've found where Mr. Barkin is over at the Richmond Fed. I understand he's speaking at the Pennsylvania County Chamber of Commerce. And we'll take audience questions.
Yeah.
All right?
And he also said that if the U.S. has a recession, it would likely be a less severe one. So kind of leaning into the whole soft landing, that even if there is a recession, it's going to be a little less painful.
He's raised the question as to whether we are sufficiently restrictive.
Yeah.
President Barkin has. That's the right question, I think, going into Jackson Hole. You've asked that question too. It's an important one.
You did too. And there's a question if people are, this ARM IPO, if it goes really well, and if companies are able to refinance, and is this a restrictive market, or is this sufficient? Because it's fine.
Vince Reinhardt joining us a little bit later this morning of Dreyfus and Mellon. He'll join us in about 20 minutes' time. If you're just tuning in, welcome to the programme. The S&P 500 positive here by 0.6%. We're light on economic data over the next couple of days. But Lisa, after Chairman Powell speaks, within a week you'll get payrolls. A couple of weeks after that, you're going to get a CPI report in America.
I'm glad that you asked about data dependency and the meaning of it. I keep wanting to go back to this because what's our threshold for what's good, right? At a certain point, are we just looking at a market that is strong and a Federal Reserve that doesn't really want to go against the grain, especially in an election year? And I'm not saying that they're being political, but if inflation is going down, they're focused less on the pace of how quickly the inflation is going down and where it's going to, and more on it's kind of going in the right place. So then do we really need to do more?
They want to avoid the accusation of being political, which introduces the political conversation. It's unavoidable, isn't it?
It's unavoidable. It's always unavoidable. Exactly.
In election year. The look of cutting interest rates going into the election next year.
At what point?
It's not great optics, is it?
No,
it's not. And we know that's something they want to avoid.
There is a concern, and I was reading a report from Citigroup on this, that some of the goods disinflation has stopped. And you're actually starting to see it reaccelerate. There are areas that give some people pause for concern. curious to hear more granularly what the Fed is looking at that gives them confidence that inflation is going to return to that 2% target. That's the rhetoric they've used. So what data are they going to really get that gives them that conviction? Is it going to be the jobs report? Is it going to be CPI? I don't know.
Neil Dutta of Renmac have not mentioned his name for 2 days or something. That's like a record, isn't it?
It's like one day. Come on, let's not get carried away.
One full day.
It's been a full day.
I think that's the Neil Dutta argument. Anyway, in just a moment, we'll talk about the airlines. Just an unbelievable agreement between the pilots and American Airlines. An unbelievable sum of money, unthinkable several years ago, which speaks to the moment we're at in this labour market. Equities on the S&P 500 positive here by 0.6% on the S&P. There is a lift in the bond market. Yields near multi-decade highs on a 10-year. Yields are lower here by 3 basis points. Your 10-year 4.31. Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
On the next episode of The Circuit.
It's still almost shocking how new you still are to this sort of being famous thing.
When I do, go out and people are like crying, that's when sometimes I'm, whoa, why? There's no rule book for it.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This week, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go.
Coverage starts Wednesday, August 23rd with a special edition of Bloomberg Surveillance live from Jackson Hole on Friday, August 25th, starting at 8 a.m. Eastern. Bloomberg, your global business authority.
I think over time, the financial sector does look attractive. You were talking about the underperformance recently. I think in addition to some of the cyclical concerns, it might also be regulation and potential refinancing needs coming from the sector. I think once that settles down, that will be a pretty attractive place to look.
She's one of the best. Just a clinic every time we talk to her on fixed income. It's Amanda Lynham there, the head of macro credit research over at BlackRock. Just to get into the market action for you in the equity market, potentially 2 days of gains on the S&P 500. Equities up here by 0.5 to 0.6% higher. Yields are lower by 3 basis points. Your 10-year 430.82. I was just joking to Bramo in the commercial breaks that on the weekend I'm a UPS driver. In the week now, Lisa, I'm flying an aeroplane for American Airlines.
American Airlines, that's your airline?
I'm going to do some training for that, yeah.
Okay.
Pilots approving a new contract that would provide 46% in cumulative pay rises and a retirement contributions over its 4-year term, along with a bonus, Lisa, improved scheduling, sick leave and insurance benefits. It's pretty impressive.
Well, depending on how things go, you'll be a UAW worker.
Yes, maybe.
In the evenings, you'll build cars.
I'll be making Hummer EVs and all that
Not
stuff.
EVs.
No, just Hummers.
Just Hummers. You'll be making those, and you'll be making bank.
Internal combustion engines.
There is a question, and I keep going back to this. Bespoke Investment Management came out with this point where they basically said it's not that there are strikes that are happening. It's that they aren't happening that is the interesting thing, that these companies are paying up. I think that American Airlines, something to the tune of $250 million of expenses that are tied annually to some of these increases, and they are swallowing them because the workers are more important than that extra cash.
I would say this too. This, in many ways, to me, in certain instances, is the revenge of the labour market. This is a decade of sitting there every single year with your boss and being told, inflation's at 2%, this is your pay rise. Inflation's at 1.5%, this is your pay rise. It's 10 years of that, concluding with this. Hey, what happened to the last 10 years? Every time you sat me down and said X, well, this is what's happening now.
I would take that a step further completely. And then you add to the fact that corporate profits have outpaced labor's share dramatically over the past couple of decades. If you take a look at that gap, it's been really widening. Now suddenly they're saying, wait a second, no, you need us. And you've seen again and again how you need us, so show us how much you need us.
Joining us now is Bloomberg's Mary Schlangenstein. Mary, wonderful to catch up with you, just an expert on these airlines. You know them inside out. Let's start with this deal. How much is this going to hurt American Airlines?
Well, American had been accruing for the cost of the contract. They did put out a statement this morning saying that it's going to boost their unit costs because there's an extra amount that was agreed to when they renegotiated this tentative agreement that they had. So that's going to increase their unit cost about 2 percentage points this quarter. But for the full year, it's not boosting their unit cost. So they're really in fairly good shape.
Mary, how does this stack up with the agreements you saw over at Delta back in the spring?
Well, Delta reached an agreement first among the major airlines, and their agreement was valued at about $7.2 billion over 4 years. Americans is valued at $9.6 billion, according to the union, and that includes, of course, a lot of quality of life benefits in this contract. So that's not all pay; that's total compensation. Now, Delta does have some provisions in its contract where their pay will kick up if United and American approve contracts that have higher pay. And United hasn't voted on their contract yet, so we'll see. American also has a snap-up proposal on their pay rates.
Just how dire is the pilot shortage right now? Just how difficult is it for some of these airline companies to retain and attract workers?
Well, for the major airlines, they're doing well on pilot supply. The problem they've had recently is pilot training. There are some bottlenecks in pilot training. Where the real shortage is still hitting is on the regional airline level. There are still a lot of regional jets that are parked and aren't being flown because they don't have the pilots to fly them.
And this raises a question about going forward. What's going to happen if there needs to be a longer lag or a longer warning period for some of the pilots before they're called into work? Is this going to increase the cancellations and the delays, or is it going to just have to be covered by a greater number of staffers?
You know, it depends on airline to airline what their provisions are. A lot of the airlines or the pilots groups are negotiating new rules on reserve and reserve pay. That's part of the quality of life issues that they've gone after in this round of contracts. That's one of the reasons, in addition to the raises, that they're so expensive, is they did seek a lot of quality of life improvements.
Been a decent year to date for some of these stocks. American still up close to 20%. Mary, as you know well, United up by something like 30%. Delta, a similar move. Mary, can we just talk about the performance of the business at the moment? We've seen some domestic-focused carriers flag maybe a softening of demand, lower ticket prices. How do you think the year ahead is shaping up for some of these bigger airlines?
Well, they're hoping for the domestic-focused ones are really hoping that travel is going to rebound for the winter holidays. They did see a fall off in domestic demand because a lot of people chose this summer to fly internationally. For a lot of people, it was the first summer that they could go internationally. It was the first time that all of the COVID restrictions had been lifted. And so they saw this huge shift to international travel, and that produced record revenues for airlines like American and Delta. And so the domestic-focused airlines are really hoping that for the winter that rebounds on domestic, people trying to go visit their families again, visit their friends for the holidays. But it's interesting that Frontier Airlines today offered a sale just for today where you could get a free check bag if you fly September 5th through the 30th. And it's pretty interesting that they would offer that for one day. And it makes you wonder, you know, what is their September booking? What is that looking like for them?
Mary, kind of an unfair question, but we're talking about how the staffing levels at American and Delta and the other major airlines are coming into balance as they offer more perks. What about air traffic controllers and concerns around a lack of staffing there? There was a New York Times article yesterday that caught my attention that highlighted at least 46 close encounters or planes almost crashed into each other just last month alone, that these are increasingly apparent and frequent because of the staffing shortages in some of the air traffic controller units. What's the latest? I mean, how much are they remedying that?
Well, there are certain areas of air traffic control, particularly up in the Northeast and also in Florida, where they are shorthanded, and they've said they're shorthanded. The other problem is you have a lot of new inexperienced air traffic controllers because just like all the other jobs in the airline industry during the pandemic, a lot of them left. They retired early. They went to other jobs. And it takes several years to train air traffic controllers. So you've got a combination of being shorthanded, then having a certain number of people who are not very experienced, especially for the really busy air traffic control centers. And then, you have people that are still going to be in training for a couple of more years.
What is it about checked luggage? Trying to bargain with us, Bramo. When you get to the gate and clearly you want to carry your luggage with you and they offer to check it for free, as if they're doing you a favour.
Yeah. And
Come to the front and check it for free. What's the incentive for me to check my bag for free when clearly I want to take it as carry-on?
There isn't.
I've never understood it.
Well, how much do people actually check their luggage then? They have to actually just make it so that people can't put their luggage over the overhead.
Right.
This is actually a complete pet peeve of mine because they've created this rush where people now jockey to get in line to be the first on so they can get their luggage into the overhead. And then people swarm the front and everyone's really pushy and it brings out the worst in humanity.
In Delta specifically?
No, I'm just saying in
every
general.
airline.
I mean,
Okay.
have you seen it in America?
Sure, yeah.
Okay, so there you go.
I hate the rush.
But they've
They
created
forced me
it.
to put my suit into my carry-on a few months ago, flying from LA to New York, and I complained and they didn't care. So there you go.
Yeah, well, it's the
And I'm
balance
still
of power.
flying with them. So what does that tell you? The things we put up with for airlines.
The violin is out. I am playing it.
Play it loud.
Yeah, I'm playing it loud.
Mary, thank you. It's good to hear from you. Mary Schlangenstein there of Bloomberg just knows these airlines so fantastically well. These are big, big deals, Lisa. Delta early in the spring, that sounded big at the time. And now American Airlines was something even bigger.
And UAW up next, United Auto Worker
Big time.
Union, up next with respect to voting on whether or not to authorize a strike. This is, to me, the sleeper story of 2023. And this is the balance of labor shifting back to the workers.
The revenge of the labour market. Coming up on the Open, about 30 minutes from now, we'll catch up with Kirsten Distenfeld of Alliance Bernstein on fixed income, Colin Martin of Charles Schwab, and Gargi Chowdhury of BlackRock around the opening bell. All of that still to come. Live from New York City this morning. Good morning.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
About an hour until the opening bell, and if we hold on to the gains that we have seen so far in pre-market trading, it will be day two after a 4-day losing streak on the S&P. We can see up about 0.6%, 44.37 on the S&P 500. Earnings coming in sort of plus or minus this morning, but generally stronger than expected. Dollar strength versus the euro and the 10-year yield. This is interesting, trying to go down sort of, but just floating back up there as the session grows older, down just 2 basis points, 4.31% after hitting yesterday the highest levels going back to 2007. It's kind of a light week for economic data. Really, the main event is going to be on Friday with the Jackson Hole Symposium. Fed Chair Jay Powell speaking at 10:05 a.m. Eastern, as well as we're going to hear from Christine Lagarde from the ECB. We do get some housing data, though, in particular today at 10 a.m., and it raises this question when we get home sales numbers. Can we call this a rebounding home market if there are no sales, or very few, or if it's anemic? Or is this something that's evidence of an unhealthy trend that's developing under the surface? Joining us now is Drew Redding, home builders analyst for Bloomberg Intelligence. We did get results from Lowe's earlier today, stronger than expected guidance. We get Toll Brothers earnings after the bell. But just, can we call this a rebounding market when sales are stagnating?
Hi, Lisa. Yeah, it's a good question. And we've been describing the U.S. housing market as a tale of two markets. On one hand, you have the resale market where volumes are down more than 30% still from their peak due to greater affordability challenges and a lack of inventory. On the other hand, you've got the new home market, which has been the beneficiary of that, as that lack of inventory we spoke of is actually funneling demand in towards the builders. And builders are also able to leverage their financing arms. So they've been buying down rates. So when you see someone in the resale market paying, 7.5, someone coming into the new home market is looking at 5 to 5.5. But that being said, the broader housing market, as you said, I wouldn't necessarily call it a rebound. I mean, if you look at total sales in the existing home market, which is the biggest part of the housing market and the largest source of competition for the builders, we're at about a rate of 4 million. So we're still down a long ways. I think the thing to point out is we have a situation where volumes are being depressed, but home prices are stabilizing because of that inventory situation.
Just want to pick up on what you're saying, Drew, and sort of push forward to later today when we get the Toll Brothers results. You said that a lot of these home builders are offering rates of 5 and 5.5% to extend their own mortgages to buyers of their homes. Is this essentially the effective rate in the new home sales market, since the other existing homes aren't really moving? Is this basically what's happening, that no one's paying that 7.1235% yield on the 30-year mortgage? No one's actually paying that who's coming into the market right now.
Yeah, so what we've heard from the builders is that a majority of their buyers are leveraging their national rate buy down programs. And you're right, they're not paying what we're seeing quoted at the market level. That being said, if you look at where rates are now, we checked before we came on this morning, we're up 7.5%. I think the last time we talked last week, we were at 7.25, and we're up more than 100 basis points since the beginning of April. So while people coming into the new home market are getting a lower rate, that rate too is going to go higher. And I think the concern for people investing in the home building space is going to be at what point the buyers start to balk, and at what point the builders have to kind of lever back up on their use of incentives to keep traffic moving. Because we saw from the latest data from the NAHB that when rates rose, traffic fell pretty sharply. So we think that if rates do sustain at these levels, we're going to see that use of sales incentives come back a little more forcefully.
Just real quick here before we get to our next guest, because this really is the topic of the morning as we see yields goes to the highs going back 16 years. How long are the lags? Are we starting to see yields bleed into the housing market in a more concrete way that give you conviction that we're just seeing the start of it rather than already having seen the worst of it?
We've seen a lot of pain in the housing market, particularly in the second half of last year. But we haven't seen the recovery in the existing home market, and that has to do with the fact that rates are so elevated. We have seen a disproportionate benefit, as we mentioned, in the new home market. But broadly speaking, the fact that rates are still elevated doesn't give consumers a whole lot of confidence. And the fact that, we could be heading even higher from here, from 7.5 closer to 8. I think that continues to pressure sales volumes through the remainder of this year and into next year.
Drew Redding of Bloomberg Intelligence, thank you so much for being with us. Really insightful as we parse out, try to understand whether the yields where they're at are sustainable. Vincent Reinhardt's been tracking this for a long time and weighing in on how this economy has been strong but will deteriorate in the face of some of these yields. Chief economist and macro strategist at Dreyfus and Mellon. I want to just start there, Vincent. Are these yields sustainable where they are right now?
Yeah, they sound easier to explain than when they were sub 2% a few years ago. Inflation is going to settle down at 2%. The term premium or the risk premium that investors are going to pay are going to turn positive instead of negative. And the equilibrium real rate or the natural rate of interest is probably higher given how robust economic activity is. So yeah, it's sustainable. It's particularly sustainable because a key message of Chair Powell at Jackson Hole is going to be the policy rate is going to rest on a high plateau for a while. That's going to feed into longer term yields.
We've been talking all morning about long and variable lags and whether they're very long and very variable or whether they're very short. We've already seen the worst of it. And now the market is adapting and adjusting, to use the phrase frequently used on this show. Which is it?
So it depends on sector. And that is the question for Jackson Hole, by the way. It's about shifts in the economy. From a monetary policy maker, it comes down to the question, what's the transmission of monetary policy? How long are the lags? Answer is sector by sector. That the lagged effect of monetary policy is local, not national. You already went through one segment of the economy where it's shorter, real estate. Home buyers depend critically on mortgage rates. Builders depend critically on marketable rates. So that has borne the brunt of the remarkable Fed tightening a lot sooner than any other areas. Other parts of the economy have a cushion between aggregate demand and monetary policy. Households still have a lot of retained saving from the fiscal largesse they got in 2020 and 2021. They're working it down. As that buffer gets smaller and smaller, you'll see the interest rate effect bite more.
Let's develop on that a little bit more, especially as we get earnings from Macy's and Lowe's and Dick's Sporting Goods this morning, showing a kind of motley picture of where the consumer is and how much savings they have left. What's your sense of the fact that everyone's been saying the savings are running out, the savings are running out? Now they're going to be running out, and they still haven't. Does that make you think that they're not going to run out, or that people just were perhaps a little premature in how quickly they thought they would dry up?
So it probably tells us we didn't appreciate how big the cash load was at the beginning. That is, households saved a lot more of what they got from the government than we expected, and continued to save for a while to come. If you just look at a typical saving rate, relative to what households actually were doing, they must have worked down at least a half the cash load, but that's still half. And by the way, we should also remember that states and localities also got fiscal transfers, and they have a cash pile on the sideline as well. And those state governments and localities in particular are the ones that are really very cyclically sensitive. So essentially what the federal government did was lengthen the lags of monetary policy by immunizing, by insulating some of the interest-sensitive parts of our economy to the Fed policy instrument.
This is important, and it really speaks to what could happen if the Fed keeps rates where they are, even if they don't raise them again, but keeps them where they are through the remainder of this year and all of next year, and even potentially into 2025. How long do they have to keep rates where they are to start feeling the bite, to make it so that, it actually has the transmission mechanism that it was intended?
Yeah, there's a couple really important points about that. One is, remember how Chair Powell describes the path for rates. It's how fast you raise them, what level you go to, and then how long you keep them there. We're really at that third stage. How long do they keep them there? And in some sense, it doesn't matter if they raise them an extra quarter point or a half point, or they keep them unchanged. They can compensate by keeping the policy rate there for a longer time. And that's now the strategy of monetary policy. And the longer they keep rates on that plateau, the more effects of the prior increases in rates we're going to see on the economy. So that's the big message to hammer home to investors. They got that the funds rate's going, may go up another quarter point. That's not the important point. The important point is it's not going to be cut nearly as quickly as you might think right now next year. They're keeping rates at a plateau. They're waiting for the lags of the effects of monetary policy to play through. If they're patient and see those lags, they don't have to add incremental restraint because they've got the restraint in the pipeline already.
Just quickly here, do you think that Fed Chair Powell is going to say anything substantive this week?
I think he can tack a little dovish. He doesn't have to talk about pain like he did last year. He just has to be a little more neutral than he came across at his last press conference. He's got markets about where he wants. The main message he's going to want to send is rates are going to be around current levels for a lot longer than you think.
And that seems to be what people are adapting to right now. And the implications for longer term seem to be really kind of giving everyone some angst in terms of what yield is the appropriate yield for the rest of the risk markets. Vincent Reinhard, thank you so much for your insights. We have been looking right now at a 10-year yield that was trying to go down and is now not really going down all that much as people game out what higher inflation and higher rates could look like in the stock market. You are seeing those gains perpetuate, and we have seen them driven in part by the tech shares. NVIDIA shares up more than 8% yesterday, continuing with the gains today ahead of their earnings report tomorrow. If you are just joining the program, S&P futures 44.35, up 0.5%. Coming up, David Rubenstein of the Carlyle Group will be talking about the money management industry at a time of great transition. And there really is this question as we look out to what this new market really is. And I want to bring you this quote from Bill Dudley, the former New York Fed president, who wrote in a Bloomberg op-ed, "I strongly suspect that the bond bull market that began in the early 1980s is over. For the longer term, the steady economic expansion that followed the 2008 financial crisis is no longer relevant. The paradigm has shifted and higher yields are back. Vincent Reinhard, just quick word from you on whether you agree with that kind of assessment. He will be joining us perhaps in Jackson Hole to talk about that, but there is a question around whether that is becoming consensus, that there has been this shift. We heard from Katie Kaminsky that she could game out yields to 6%. There are more people joining her camp. We heard from Russ Kostrich earlier this morning about how he's sort of maybe nibbling at some longer-term bonds, but in general, sees this as the new reality. The question is just for how long can you see that before you start to see it bleed into earnings and into corporate health. We are seeing from ACEs some concern as you parse through some of the earnings about the consumer, more of that we heard from Walmart and Target in terms of worries about some of the savings running up. We also are hearing from Dick's Sporting Goods that they are going to be cutting some corporate staff members as they try to deal with a situation that's not as positive as it has been. In the markets, we will keep track of those real yields, tracking around 2%. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays.
We look at a 20-year rate of return of 6.8%, so that is our current target. And I'd say over the last 20 years, we've been able to hit that. The last 10 years, we've also been able to exceed that. In the last 5 years, we're just below the 6.8. But over a 20-year, as long-term patient investors, we're targeting a 6.8% return.
That was Nicole Musico of CalPERS CIO, and you can watch more of that with David Rubenstein on Bloomberg Wealth with the man himself, David Rubenstein, tonight at 9 p.m. in New York on Bloomberg Television. And it comes at a time where finally pensions are able to get the yield that they've been looking for. I remember when people used to say 8.5%, that's a pipe dream. You're going to have to lever up to get that in a zero rate world. Not anymore. David Rubenstein, I am so happy to say, joins us now, host of that show and co-founder of Carlyle. Let's just start there. Isn't this the golden era for pensions where they can actually get the returns that they need to get to meet their obligations?
Well, clearly, fixed income returns are much better than they were a year or 2 or 3 ago. But money pension funds in the United States, state pension funds, are underfunded still. And even CalPERS, which is the largest state pension fund at $465 billion, is underfunded. Underfunded in the sense that actuarially, it's about 20% below having full funding. Now, these pension funds are still in better shape than the U.S. government's Social Security program, which is not funded at all. That's a completely pay-as-you-go program, and that's much worse shape, relatively speaking, compared to the state pension funds. But some state pension funds are massively underfunded. Kentucky, Connecticut, Illinois are funded at maybe 40% of their overall obligation. So it's a challenge, and the fixed income rates that are now higher than they were before are a plus for those funds for sure, but there are many state pension funds that are still massively underfunded.
And this is a reason why there had been a concern in a low-rate environment of how much some of these funds would have to lever up to get the returns that they needed to become funded. At this point, do you feel like the risk-taking appetite, I should say, among some of these funds is diminished or has grown as they see the opportunity to actually meet those obligations without asking for additional contributions from members?
Well, I think a lot of the state pension funds are pleased that the fixed income element of their portfolio is now going to perform much better. So if you can get 5% yields on treasuries, you're getting very close to what you need to do, which is a 6.8% in CalPERS case. But most of the state pension funds are designed for actuarial purposes to yield about 6 to 7% or so a year. Some of them are able to do it and some are not. But I would say the easy money is probably behind them, which is to say the high-tech world, which showed some really great equity returns in recent years, that's probably behind most of the state pension funds now. They're really going to have to do the hard work of getting this without the high rates of return that you often got in venture capital or other kinds of private investments.
Money never feels easy, David. Come on. At what point has it ever been easy money at a certain time when people are looking forward? How much are they looking to private equity to sort of give that same kind of feeling going forward?
Well, private equity has performed pretty well over the last 10, 20, and 30 years or so for large public pension funds. And those that have done very well are the ones that have done enormous amounts of private equity. For example, the best funded state pension fund in the United States is probably the state of Washington. The state of Washington is overfunded by more than 100%. It has about 120% or so what it needs. And they have used a lot of private equity to get there. So those that were participating in private equity from the 1980s, 90s, and on have actually done pretty well. Some have lagged behind. I think the biggest issue you have now is that you have expectations are very high among employees about what their retirement benefits are going to be, and we have to make certain that we can actually achieve those retirement benefits. It's very easy for state legislatures to say we're going to give you certain benefits, but it's actually not as easy to earn those benefits, and therefore you either have to increase the taxation on everybody in the state, or you have to which means the state contribution to the pension funds is greater, or you have to increase the tax in effect that the pensioneers or future pensioneers are paying. And that's the only way you deal with it. You can sometimes get a higher rate of return, but there's no easy way. You either you either tax people higher, or you have to have higher rates of return. It's no easy way to get to the desired results. Now, as I mentioned earlier, Social Security system we have in this country is a pay-as-you-go system. So when I pay my Social Security out of my salary every week or so, that's going to fund benefits right away. We don't have a system like Canada or Australia or most countries where you have a funded national pension system. We're never going to be able to afford that, unfortunately, because we have promised benefits that are so high that we're just not going to be able to achieve the kind of system we have in Canada, where they've fully funded, or not almost fully funded, the pension benefits that they promised their workers.
Not to diverge too much from the point, but isn't this part of the reason why yields have risen as much as they have on treasuries, particularly on the long end, as people take a look at that fiscal situation and don't really see an answer for how it's going to come more into balance?
Well, yields have gone up because interest rates have gone up, and that's made it easier for people who are fixed income investors to get a higher rate of return, and that will probably continue for some time. But I do think that it's an issue that all of us have to deal with, because we have a demographic issue in the United States. People are living longer than they were before. For example, when the Social Security system was set up in roughly 1934 or so, the average American lived to about 65 years old. And so you were able to collect your Social Security at 65. So there wasn't a big gap, because most people weren't living too much longer than they were going to be eligible to get their pension benefit from Social Security. Now, if the average age is, let's say, 81, 82, 83, you've got a big gap there, because people are retiring, let's say, and collecting their Social Security at 65 or 67 or 70, but they're living much longer. And in addition, we've taken the Social Security system and used it for so many other purposes. So we have a big gap. And in the end, the only way to solve that problem is increasing taxes on Social Security, which is hard to do politically, or you have to reduce benefits, which is even harder to do. So there's no easy way out of that problem. And it's something that we're going to hear about politicians speaking gingerly about, certainly in an election season. Going back to this question around how some of the pension plans that do have to be funded are handling this, do you expect them to lean more into alternatives at a time where some people are questioning whether the golden era is over, whether we've already seen, particularly with the IPO market in stasis and the sense of takeouts not really happening to the same degree, that it's going to be more humdrum rather than the explosive returns and growth that we've seen over the past few decades? Well, the market is more saturated than it was 20 or 30 years ago, there's no doubt. The returns will be harder to achieve, but there's no doubt that alternative investments, which may mean, I'd say, distressed real estate, distressed debt, buyouts, growth capital, venture capital, those things tend to outperform public equities by a fair bit. And as long as people need to get higher yields, you're going to see a fair amount of money going into these so-called alternatives. Will they outperform by the same amount that they did 10 or 20 years ago? Maybe not, but it will outperform. There's no doubt about it, in my view. David, there's also a question around this. The person I... Go ahead. Go ahead. Well, I was just going to shift real quickly. I'm saying the person I interviewed to talk about whether there's going to be also a continued focus on ESG, et cetera, given the fact that there has been quite a bit of pushback. And I know that you did speak with Nicole Musico about that. What did she have to say about that? Right. Well, ESG has become controversial in the United States. The controversy over ESG does not really exist so much outside the United States. Obviously, we politicize it in the United States to some extent, but I don't think ESG is going away. I think people will talk about it less. Larry Fink, for example, says he doesn't use the word ESG anymore, the phrase ESG, because it's so incendiary in the minds of some. But the truth is that most investors want to have some sense that the investments they're doing are not destroying the environment or doing things that are, I'd say, not appropriate. But there's no doubt that some people have fought back, and there is a reaction against ESG in the United States. I don't think it's going to mean that ESG is going away, but people are talking about it more gingerly, let's say. David Rubenstein, thank you so much for taking the time and for your really insightful interviews. David Rubenstein of the Carlyle Group, thank you. You can catch his interview with CalPERS Chief Investment Officer Nicole Musico on Bloomberg Wealth with David Rubenstein tonight at 9 p.m. in New York on Bloomberg Television. A fascinating conversation at a time where, yes, yields are higher. A question, though, about what that means for longer-term returns on some of the riskier parts of the market, especially given some of the gains that we've seen so far this year. Coming up on Bloomberg TV at 12:15 p.m., Kelly Steckelberg, CFO of Zoom, after they delivered somewhat better than expected earnings, just slightly, as people continue to use that method of meeting, although perhaps less so than during the pandemic. Right now in markets, clawing onto those gains, second day of gains this would be if it holds on, although fading just a touch as the session gets closer to that 9:30 a.m. open.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others.
Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
What a bond market move in the last 24 hours. Trying to add to the gains of yesterday in the equity market. Live from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, Treasury yields hitting multi-decade highs, S&P joining Moody's cutting the ratings on US banks, and China attempting to squeeze yuan bears. We begin with the big issue, a bond bear market.
Look at the bond market.
The rising bond yields that we've seen.
Rising yields.
Yields are up to 16-year highs.
It feels like bond buyers has essentially gone off to vacation.
People might be starting to wake up.
Why are the 10-year yields up over the last several months?
It's indicative of how not only resilient, but amazingly strong the U.S. economy has been.
We're looking at an economy that's likely to have a soft landing.
If you continue to see yields go higher, I would definitely be worried.
We may see bond yields back up still further from here.
6% isn't a crazy number for a 10-year.
That to us is the scariest thing about the bond market. It's the degree of momentum that yields have to the upside.
We need to watch that correlation trade a little bit more closely going forward.
There is more pain to come.
It's not strange to think that we might have higher rates if we have surprises on the upside and inflation in the fall.
We've had plenty of them over the last 12 months. To discuss, Colin Martin of Schwab, Gershon Distenfeld of AllianceBernstein. Colin, first to you. Start of the year, I think you were looking for something like 3%-ish on a 10-year. What now, Colin?
We think over time we'll probably see yields fall, but obviously that arrival date has been pushed back a little bit. In the here and now, and especially with the recent move up in yields, we think yields can move up a little bit, but we're not in the camp that we're going to see a sustained move higher in the 10-year Treasury to say 5 or 6%. If we look at what's driving the move, we think a lot of it comes down to higher for longer Fed policy, and also I think a bit of the increase in Treasury supply. You need to see yields reset a little bit to bring in that demand at auction, but I really think a lot of it has to do with higher for longer. But at the same time, when we look at Fed policy and expectations for Fed policy, markets aren't expecting another rate hike. They're expecting this to be it and then hold for a while. And even if there are more hikes, it might only be one and done. And if you look at inflation expectations, whether it's market-based with TIPS yields or survey-based, they're still well anchored. So we're trying to figure out what's driving this. And I do think it is this leveling off, higher for longer, and the soft landing possibility. But if we see the next move in the Fed ultimately being a cut, or even if we get another hike and then a cut sometime next year, it's tough to see how we'd see yields move sustainably higher. We need to see this soft landing and then sort of in perpetuity, where we saw this soft landing growth right at or slightly above trend, and then everything's kumbaya. But we don't necessarily see that happening. We do see downside to growth over time, given how high the Fed funds rate is and how long we expect the Fed to hold.
The yield's up again this morning on a 10-year, just short of 435 in the last 24 hours. Cycle highs on a 10-year. Yields up by almost a basis point on a 2-year, back through 5%. Gershon, from your perspective, how much oxygen is up here at these levels? How sustainable are these kind of numbers?
I think they're very sustainable. I think we have recency bias. One of the clips you played at the Open saying this is the highest rate we've seen in 16 years, that's exactly the issue. When I started my career in the late 90s, yields were 5.5%, and that was at the low end of what they had experienced over the past 25 or 30 years. I remember a very wise person telling me there's no way that yields 10-year could ever go below 3%, much less 1%. And I think we're seeing the opposite right now. People have a recency bias. Let's look at the actual facts. The Fed is trying to get back to a 2% inflation target. A lot of talk about whether they're going to revise that, where Chair Powell might speak about that later this week. But for reasons I've discussed in the show before, rise of populism, deglobalization, we think it's going to be hard to achieve that 2% rate. It might be closer to 2.5%. And real yields have averaged about 2% over the past 100 years. So you look at that, and why isn't a 4 to 5% range on the 10-year the appropriate range? So everyone's, I understand the consternation in the bond market. I understand yield selling off. It causes people angst. But I don't think that yields are so unfairly priced here.
So, Gershon, not the new normal. Is this the old normal?
Well, it's, in financial markets, believe it or not, we look at markets every day, but even a 15-year period is just not that long. And, again, I'm not talking about what might happen today or tomorrow. It wouldn't surprise me if we had a rally back to 4%. It wouldn't surprise me if we go to 5%. But, again, this is the kind of range we should be in. Real rates being negative is not the normal. Real rates, I actually saw a chart of 10-year yields going back to 1790. I have a question about how they actually, maybe it was usury rates or something. But the reality is that, rates if you even go back to the turn of the last century, 4 or 5% is kind of average. And, and we could be I would be much more worried about the mortgage rate. I was looking at a chart this morning showing the spread between the 30-year mortgage and the 10-year treasury. It's the widest it's been in a long time. Now, that's definitely a concern. But the 10-year itself, I'm not that concerned about it.
Colin, can you get on board with that?
That makes a lot of sense. I mean, I do agree that we've been looking at this, last 10 years as a template for what the next 10 years may or may not look like, and clearly that's not the case. And if you look at a 10-year treasury of around 4.3% right now, I mean, that seems about right. I mean, we do think the yield curve should remain inverted as long as expectations are for rate cuts. But to look at that, initial, say, 3% range that we were focusing on earlier this year, that just doesn't seem appropriate in the environment we're in right now. It goes back to how tight is tight. Is Fed policy restrictive or not? And you can look at it right now, and clearly it isn't. It's impacting parts of the market, but it's clearly not having the effect that we would have thought coming into this. You see a Fed funds rate upper range of 5.5% in absolute terms. That seems really high, but it's not getting the job done. We do think it will over time, but again, the likelihood of a soft landing, it's not necessarily our base case, but it seems to be rising, and it could happen. But again, we think over time, it will slowly trickle into the parts of the market. Right now, higher mortgage rates aren't impacting a swath of consumers and investors because we're locked in at very low yields. But the longer rates stay high, the longer it trickles into other parts of the market, whether it's auto loan. I mean, we're seeing these, but auto loans, home equity loans, credit card loans, how long can we sustain this pace? And will there be a re-acceleration in growth or re-acceleration in inflation? We just don't see that. We think we can stay at maybe a trend level, but we don't see an uptick.
Gershon, you've made this point as well, that higher for longer is more important than higher. Can you speak to that?
Yeah, pricing the Fed funds rate to a 25 or 50 basis point increment is not the issue. It's not like you go to a certain point. It's how restrictive are you? And, Chair Powell reiterated that at the last press conference about how, he's going to remain in restrictive territory in all likelihood for a while. That's what really matters.
Look at the scores now on a 10-year, 435. Think about where we were in the depths of the pandemic, March 2020, the 10-year yield dropped to 31 basis points. The 30-year dropped to 0.6987%. The 30-year right now, 4.45. I want to turn to Ira Jersey of Bloomberg Intelligence. Ira, if I promised you these yields 3 years ago, you would rip my arm off, wouldn't you?
Well, I think that every single bond investor would be fretting just because of the massive losses in your portfolio that implies and that we've seen over the last couple of years. So, I agree with the idea that, bond yields right now are actually reasonably close to our estimate of fair value, which is just slightly under 4%, which means that, maybe we've gotten a little bit over our skis. But we have to remember, liquidity is poor. Plus, we have this excess supply that we weren't expecting. And then, and I think this is the most underappreciated part, is the hawkishness out of some of the central banks overseas. So between what's happening in Japan, the fact that Europe is going to see probably higher yields, global sovereign yields are correlated, and we're going to have higher sovereign yields in other countries, and treasuries won't be immune to those moves.
Ira, one point, in fact, several points that Gershon made. He made a bunch of them as to why yields at these levels can be sustainable. Do you think they can be sustainable?
Yeah, I think they can be. I agree with the idea that real yields are probably not going to go back to negative. But at the same time, at 2% on a 10-year real yield, those are levels that I think people will take that as being reasonably attractive, given that people are concerned about inflation going forward, number one. And number two, the last time we saw inflation spikes like we've had, we didn't have TIPS. TIPS didn't exist in 1979, 1980 when inflation was so bad. So I think at this point, we're kind of learning what people's propensity to hedge their inflation exposure actually is.
Ira Jersey of Bloomberg Intelligence. Ira, thank you. Colin, back to you just briefly. I assume you believe the 10-year right now is a buy. Is that the way you think about it at the moment? Start legging into the longer end of the curve?
That's right, Jonathan. We've been talking about that for a while. We think it is an opportunity. I think there's been slow adoption, whether it's with our clients at Schwab or pretty much, I'm sure, across the country with a lot of investors. There's a hesitancy to move further out in the curve, especially when you see such high yields with things like money market funds or T-bills. If we take a step back, I like to look at it from a portfolio diversification standpoint. And at its simplest level, a diversified portfolio can include stocks, bonds, and cash. And if a lot of investors are holding money market funds or short-term T-bills or short-term certificates of deposit, that really can be considered a type of cash. And then you're looking at a portfolio that's stocks and cash. You're really not getting those diversification benefits. And also, if you're looking at stocks, if stocks are falling, kind of like bond prices are falling now, a lot of investors are saying, I'm going to buy the dip. We're not really seeing that with treasuries. We don't think investors are going to miss their opportunity over the next few months, but rather than waiting and try to time the market, we just lock in some of the yields some of the highest yields we've seen in over a decade, and that can be great from a long-term investor standpoint.
Gershon, given what you've told us so far, just for treasury specifically, are you more comfortable just sitting in the front end?
Yeah, I actually am. I mean, look, we focus on the 10-year a lot, but the 10-year is trading at the lowest point on the curve. You don't have to go out that far. You're actually getting closer to 4.5% in the 5 to 7-year part of the curve. So I kind of like that here. One thing just to go back on that on the point you made earlier, like the higher for longer. Remember, most lending isn't done at the overnight rate. The Fed needed to get longer-term yields higher, needs to get mortgage rates higher, needs to get all kinds of things that are pegged off of the 5 and 10-year higher, and that's starting to be restrictive, and that's going to hopefully squash inflation, and that was always their goal.
Depends how many people are going out and getting mortgages, I guess, Gershon, but we can talk about that a little bit later. Gershon Distenfeld alongside Colin Martin. Equity futures right now, positive by 0.4%, fading just a little bit. We had a rally in the bond market earlier this morning. That's faded a touch. Yields now basically unchanged on a 10-year at 4.34. Let's get you some movers. Here's Abby.
John, let's start out with the shares of Microsoft because they are popping by about 1% or so. This as they make another pass at the $69 billion Activision deal. They have made concessions to the UK around the catalog of games, and it seems as though investors think that this may be what gets the deal done. Zoom had been up much more earlier. They put up a great quarter, and their outlook is good, too, on enterprise sales, but apparently investors are looking to something more. We'll be reporting on that throughout the day. And then Dick's Sporting Goods, not so much, down 21%, basically its worst day since March 16th of 2020. The stock is plunging on a massive miss. Adjusted earnings were 26% light on what they're calling, quote unquote, inventory shrink. This, of course, has to do with shoplifting, employee theft, and then damaged goods. The outlook has come in on this, too. Investors not liking this at all, with the shares of Dick's down sharply.
Abby, that stock absolutely hammered. Abby, thank you. Much more from Abby around the opening bell. Coming up, China ramping up its fight with yuan bears.
The problems are not entirely new that they're facing right now, and they've made a series of very bad policy choices over the course of COVID, the alliance with Russia. They're sort of heading in the wrong direction when it comes to policy to address what is an increasingly challenging situation.
We'll talk about some of those policy choices facing an increasingly challenging situation in China. That conversation up next.
Why does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
This is Bloomberg.
The challenges that we're seeing and the need for example, PBOC to intervene in yuan is, it's really to stem, domestic challenges, and I guess you could make the connection of that there's capital that's coming out of China. They're sort of heading in the wrong direction when it comes to policy to address what is an increasingly challenging situation.
Beijing escalating its defense of the yuan, pushing up funding costs in the offshore market and squeezing short positions. The yuan sustaining pressure for several months now as the economy continues to struggle. Joining us is Bloomberg's Tom McKenzie. Tom, the question we've asked continuously over the last couple of weeks, is it enough?
Is it enough? Not for this economy, not for the Chinese economy, and not yet. And there's an expectation that there's going to be further downside for the yuan. That expectation coming through from the likes of Nomura, JP Morgan and UBS. Look, the challenge for China and the focus for them is avoiding disorderly depreciation in the face of a slowing economy, in the face, of course, of deflation and the risks emanating, the crisis ultimately around the real estate sector. So they came out again, and this is not the first time we've heard this, another day and another record fix with this 2% margin either side around that trading band, another record fix, but also leaning on the banks, leaning on the brokerages, John, in Hong Kong and on the mainland to suck up yuan and to put in place and to sell US dollars. So this is exactly likely to continue because of the pressures facing that economy. What's really fascinating as well is that the PBOC and the man at the head of that organisation, of course, the Central Bank of China, he was the one, Pang Gongsheng, who actually crafted the policy, the restrictive policy around the real estate market back in 2020 that kneecapped that sector. And now, whatever the rationales of that policy is coming back to bite, and the yuan and the fixing around that, obviously central. The yield differential, really interesting as well, John. Just worth noting, you were unpacking the yield story in the last few minutes stateside. That jump, that divide between the twos on China and the US is about 300 basis points. You're about 2%, of course, in the 2-year China versus, 5% now in the US, and it's about 180 basis points on the 10-year. That yield differential and what Jay Powell has to do next is also consequential, of course, for China.
The widening has been incredible. Just to wrap things up, Tom, woke up this morning, looked at a chart of the Hang Seng, and it looked pretty curious. Lots of speculation as to what happened in just a couple of minutes, that rally towards the end of the session. What was behind that?
I mean, to your point, in the space of about 2 minutes, we saw the HSI, the Hang Seng Index in Hong Kong, rally about 2% in the space of a couple of minutes. Now, there's speculation that, again, policymakers in Beijing were leaning on the national team, so those big state funds, to go in and buy towards the end of the session in Hong Kong. You also see upside, by the way, on the benchmark in mainland China, the CSI 300. That closed in the green as well. We're still unpacking that story. It would not be a surprise, John. You know this. It's not the first time they've called out the national team to support these equity markets. It does all smack a little bit of desperation from China's policymakers.
As she makes an appearance on the international stage, Tom. Curious coincidence, that. Tom McKenzie there, the latest on the market. Tom, thank you. Great work, as always, around the opening bell over on Bloomberg out of London. Colin Martin, Gershon Distenfeld, back with us. Colin, the surprise of the year. There have been many. Here's a couple. Upside surprises in America, relative to downside surprises in China. That divergence between those two economies, can we continue to see that divergence through the rest of this year?
I think we can. If we look at the U.S., I mean, bringing it all together with what we've talked about, we've had a lot of positive surprises. The economy appears to be on solid footing, and we haven't really seen those cracks develop too much. So I think it's possible that we continue to see, above trend growth and, a relatively strong labor market. We've seen signs that in the U.S., the labor market might be loosening a little bit, but it's still tight with the unemployment rate still near a 50-year low. And wage gains, although off the recent highs, still rising modestly. I think that's really important when we look at what's the outlook for the next 6 months or even 12 months. We hear a lot about XX savings, how much is left. But if consumers and people still have jobs and they're seeing even modest wage gains, we think consumption trends can continue and spending can continue. So we do think there's a possibility that in the near term, we see positive economic surprises, but we're sticking with our base case that over time, higher for longer should slow things down.
Gershon, credit, your world. What are you advocating for now?
People still seem to be pretty bearish. I'm not pounding the table bullish, but I think the earnings are coming in supporting the thesis that we had, that, the starting point was really, really important. And the starting point was really good. Remember, companies did not spend the past 2 or 3 years levering up their balance sheets, spending on capital expenditures, share buybacks, making acquisitions. Instead, they were turning out and paying down debt. And, even this maturity wall that people are citing in 2025, besides it being kind of the normal part of the high yield investing that you tend to have a maturity wall out 2 to 4 years, companies are making the conscious decision. They were able to issue 4% and 5% coupons, even a double B company, for example, 3 or 4 years ago. And some of that debt's now callable, but to refinance it would be 200 basis points more. So it's not usually if a company has credit concerns, you're concerned about maturity in the next couple of years. These are companies that are doing really, really well. Just the basic yields have gone up, so they want to have lower cost of funding for as long as they can. So we don't think that maturity wall is a big deal. Also, that being said, valuations are not particularly attractive. So we think credit will probably hold its own here and outperform over a long period of time, but I wouldn't be pounding the table as a buy right now.
Gershon, just to pick up on that, are you saying the state of these companies are strong enough to absorb the additional interest rate costs they'd have to take on if that maturity wall materializes, let's say in an adverse way, we don't get those rate cuts and they have to come into the market and borrow at levels consistent with these kind of numbers?
Yeah, well, first thing we have to understand, just like the federal government, right, there's a lag in these things. They've locked in rates. The point you're making, John, is a good one, and you have to pay attention because there are a subset of companies that are paying higher rates already because they chose to issue in the floating rate market, in the bank loan market, or in the private credit world. Some of those companies have had their interest rate costs go up 500 basis points. But, we look at the average company that's decided to smartly term out their debt, have very, very low coupons. If they had to market, profitability would go down. But we don't see a lot of stress in there. But again, we don't know what the rates are going to be 2-3 years from now. It's certainly not a problem today.
Gershon, thank you, sir. As always, Gershon Distenfeld there alongside Colin Martin on fixed income. Big moves in Treasury and the latest calls there on credit as well. In the equity market at the moment on the S&P 500, just a quick update, up by 0.4% on the S&P. Into the bond market, looking at the 10-year Treasury, yields just about unchanged. Yields were lower this morning, coming back now, 4.34. Your cycle high, that was yesterday at 4.35. Came really close to it again this morning. Yields up by another basis point on the front end, the 2-year at 5%. We had a close on the 2-year yesterday of more than 5% for the first time since the failure of SVB. Remember back in March, April time, we were talking about the end of the cycle, rates being too high, financial conditions being too tight, and ultimately growth would have to roll over. And here we are in Q3 talking about growth doing anything but. Coming up, the morning calls, and later, BlackRock's Gargi Chowdhury on what she calls the yield of dreams. That conversation 7 minutes away.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England. Have all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Looking potentially at a second day of gains on the S&P 500. Equity futures positive here by 0.4%. That's the price action. Let's get you some morning calls. First up, Wedbush adding Amazon to its best ideas list, expecting growth to re-accelerate over the course of the next year. That stock is up by 0.4%. Goldman downgrading Evercore to neutral, 140 price target, highlighting the risk to near-term revenue growth. That stock negative this morning. And finally, JP Morgan upgrading Emerson Electric to overweight, seeing an attractive valuation, strengthening balance sheet and improving visibility. That stock is up by 2%. Coming up, bond yields at multi-decade highs. BlackRock's Gargi Chowdhury on whether it's time to buy. That conversation up next. Your opening bell just around the corner.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Snapped a 4-day losing streak just yesterday on the S&P 500. Can we make it 2 days of gains? Equity futures up here by 0.4% on the S&P 500. On the Nasdaq, higher by 0.7%. The fate of this market at the moment seemingly in the hands of what develops in the bond market. The opening bell rings in New York City. Switch on the board and get to the bond market. Yields up and away this month by more than 40 basis points, close to 40 basis points higher on a 10-year specifically. 434.40 on a 10-year this morning. Yields we haven't seen in this cycle in the last 24 hours. Yields we haven't seen going all the way back to 2007. In the FX market, the dollar stronger, the euro weaker, 108.59 on that currency pair. We're negative by 0.3%, and crude just a touch higher, up by a little more than 10 cents, up by 0.15% to $80 and about 84 cents. The broader market, we're doing okay about 30 seconds into the session, up by 0.4% on the S&P. On the Nasdaq here, up by 0.7. One stock to watch at the open is Macy's. The retailer topping earnings estimates but delivering another warning about the US consumer. The CEO saying, quote, "We continue to see uncertainty in the macroeconomic environment." Abby has more. Hey, Abby.
Hey, John, and it's all weighing on the shares in a big way right now, down about 9%, the worst day since June of 2022. And how often do you see a company beat adjusted earnings by 93% and the stock falls in this way? Well, in the case of Macy's, we're talking about small numbers, 26 cents per share versus the estimate of 13.5 cents. But more importantly, it's the composition of the earnings, because markdowns, seasonal markdowns on spring and summer merchandise, that was what drove that earnings beat. Relative to sales, they did beat slightly, but it's another quarter, I think the fifth quarter in a row of negative growth, down about 9% year over year. And we do have, as you mentioned, CEO Jeff Gennette pointing to that macro uncertainty. Yet another company here, John. This is really interesting, a theme that's emerging. They are expecting added pressure as the student loan forgiveness expires, that is going to weigh in terms of discretionary spending available from those with those loans. As for Lowe's, well, this stock is popping. Analysts are saying that it bested Home Depot, and it literally did in terms of sales comps, down 1.6%, much better than Home Depot. Plus, they have driven by a strong spring recovery in online sales. They reiterated their annual guidance. That's a positive. This stock now up 10% year to date, beating, I think, Macy's on the year, but certainly Home Depot, which is up closer to 2% on the year.
Abby, thank you. That issue around student loan repayments, we heard that as well in the last week from Walmart, from Target. Interesting, because there is a one-year on-ramp to those repayments. So you just wonder where exactly that falls in the calendar year over the next 12 months or so. Let's stick to earnings. Zoom Video raising its annual forecast. The CEO highlighting the company's progress in AI, writing this: "We continue to innovate with new AI features like Zoom IQ meeting summary and intelligent director. I'm proud of the team for reinventing modern customer experiences." Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. Actually, Zoom is open markedly lower, down 2.5% currently, had briefly been down more than 3%. Revenue for the year, the fiscal year ending in January 2024, will now be as much as $4.5 billion. That's a modest adjustment higher for the previously stated guidance that Zoom had given. As many analysts note, what Zoom has done well is use cost cuts and, as you mentioned, AI internally to boost the bottom line, and that's where the most market adjustment was. Annual earnings, excluding some items or on an adjusted basis, will be $4.63 per share to $4.67 a share. That compares with the previous forecast of $4.25 to $4.31. The story is really clear. There was a lot of enthusiasm and optimism about the enterprise side of the business. If you look at the period just gone, which was their fiscal second quarter, revenue was up 10% to $659.5 million. But there's two diverging paths here. Sales to consumers and small businesses actually fell in the quarter 4.3%. So that growth of 10% year on year in the quarter just gone is mostly all just enterprise. Other non-video products like Zoom Phone, for example, starting to gain traction. But the stock's actually markedly lower. CFO will be on the show with me, Bloomberg Technology, later, John. And I think the question is here, what conditions are needed to return to growth? Because that is one that JP Morgan in particular is posing in its note this morning.
The kind of conditions none of us want to see, a pandemic and a shutdown, Ed. None of us want that. Yeah. Ed, all the jokes aside, big show coming up for you a little bit later on this afternoon. Microsoft Activision. Ed, just quickly, can we strike that deal? Can we close it?
Yeah, I mean, the concession that they made to the UK CMA was even greater than what I'd reported earlier in the summer, right? I had reported with colleagues that they would just fence off the UK cloud gaming business. But what they've done is gone to a competitor, Ubisoft, and said, have the global rights for cloud streaming. And we've seen the response from the CMA already in an interview with Bloomberg. They're going to look at it very carefully. These are highly unusual circumstances with the CMA looking at it a second time. But it looks like it's a big offer. And I think the chances of this deal now happening are good. It was only when I left for vacation on Thursday, John, we were pretty skeptical.
Ed, thank you, sir. Ed Ludlow, Caroline Hyde, a little bit later on this afternoon. A don't miss programme going into NVIDIA earnings tomorrow after the close. NVIDIA right now, all-time high. Year to date, I've got that stock up by more than 200%. Year to date, just absolutely unreal. I mentioned Zoom. A number of analysts remaining cautious despite those strong results. Ed talked about some of the issues around it. Piper Sandler had more to say, reiterating its neutral rating and saying this: we expect shares to be range-bound with compensation remaining high and shares lacking a catalyst. Similar message from Evercore as well. We're still in the very early innings in a very competitive market, and we will struggle to find a near-term catalyst and thus remain on the sidelines for now. That stock is down by more than 3%. Let's turn to the financials. S&P Global Ratings downgrading a host of US banks and saying this: the decline in deposits has squeezed liquidity for many banks, while the value of their securities, which make up a large part of their liquidity, has fallen. Shonali has more. Hey, Shonali.
More ripple effects to higher interest rates, John. You're looking at deposit betas rising at these banks, those interest rates being passed on to consumers, meaning that for the regional banking system, it's still expensive to hold on to client money. Now, if there is a silver lining to be found in this S&P report that downgrades another set of banks after we've seen Moody's already downgrade a number of banks, as well as put another set of banks on negative watch. When it comes down to S&P, they said 90% of the banks that they rate have stable outlooks, while only 10% have negative outlooks. So the rate of change of bad news for these banks might be starting to pair off, although clearly they are still feeling the pains of this interest rate environment. S&P's analysis showed that interest-bearing deposits have fallen 23% over the past 5 quarters for the banking group. And if you take a look, since the last downgrade for KBW's bank index, the drop has been about 7% out of a 19% drop this year so far. Now, there's another implication here that's for the bond market. When you take a look at these banks, a lot of them have already been tapping the bond market. When you look at the bigger banks, this is $2 trillion raised globally in the bond markets for the big banks that are trying to shore up more capacity. When you look up their total loss absorbing capacity, these are regulatory standards they need to meet. It becomes more expensive for these smaller banks with lower ratings now to keep tapping the bond market. According to Bloomberg Intelligence analysis, they expect U.S. Bancorp and Truist among the banks to keep tapping that market. But again, for the rest of the group, question about where they get their money moving forward.
Shonali, thank you for the update. Let's stick with the financials. The latest on Schwab planning to cut jobs, downside its real estate to achieve at least $500 million in annual cost savings. The spokesperson saying this: We intend to take a series of actions aimed at removing cost and complexity from the firm. This will result in eliminating some positions in the coming months. Katie has more. Hey, Katie.
Hey, John. Yeah, Charles Schwab responding to investor pressure with those plans to lower costs. The company said Monday it will either close or cut down on its offices and reduce its headcount, mostly in non-client facing areas, according to that spokesperson. And as a result, like you said, Schwab expects to incur costs of roughly $400 to $500 million, but that's en route to saving about $500 million annually. And Schwab followed up on that announcement from Monday with a multi-part bond sale this morning. John, will be really interesting to see how that's received. And of course, Schwab has come under a lot of pressure in recent months alongside those mid-sized banks. And it said earlier this month that it's temporarily seeing lower net flows from clients. You've checked in on shares this morning. They've been hovering between gains and losses. If they do end in the red, though, John, that would be an 11th straight day of losses, and that would be the longest streak since 2004.
Brutal. Katie, thanks for the update. About 8 or 9 minutes into the session, the broader equity market on the S&P 500 still just about positive for a second session on the S&P by 0.26%, up by 0.4% on the Nasdaq. BlackRock's Gargi Chowdhury highlighting potential upside within both equity and fixed income markets, writing this: we see key opportunities in the belly of the Treasury market, so the focus there on the 3 to 7 year part of the curve. In stocks, this is the view: we remain constructive on quality tilted exposures and see opportunities in energy as well. Gargi Chowdhury, I'm pleased to say, joins us for more. Gargi, I remember you called it the yield of dreams. Let's start there in fixed income. Is this the dream?
Good morning. Hi, John. It's good to be here. So definitely in the front end of the curve, and as you pointed out earlier, sort of focusing on the very front end, so say up until the 5-year point of the curve, I think it is a dream, especially if you're an investor that can stay invested for the next 6 to 12 months instead of sort of getting spooked by some of the daily volatilities that we've seen. I think in 1 year, if we look back to what is available in terms of high quality Treasury yield in the 5-year part of the curve, I think it's going to be an excellent opportunity. We look back and think that there was an excellent opportunity to earn some income, earn some yield in our portfolios. I think if we look further out, though, looking at the 10-year point, 30-year point, I think that is probably still not safe yet, because I would imagine that there's going to be a little bit further yield curve steepening coming our way, and some more term premium getting built into the yield curve as we learn more about where the R-star might be, as we learn more about where inflation rests, and of course, as we try to digest all the supply that's coming our way.
436. New high of the session, new high for the cycle. Gargi, just go one step further with me. How would you frame the move at the longer end? Do you see that reflecting an extension of the cycle, or potentially maybe the perfect storm that leads to the end of one?
Yeah, we just wrote a paper on this because we had so many clients asking us about this move in the longer end. So a few things. In July, the long end was mainly moving because of the Fitch actions, because of the BOJ relaxation of the yield curve control, and of course the Treasury supply that I guess we knew, but sort of learning about the magnitude of that. I think more so in the last week, or a little more than a week, last 10 days, I think the recent bear steepening move has much more been driven around what I call R-star gazing, and this expectation that we are definitely going to get something around a higher level of neutral interest rates from Chair Powell in Jackson Hole. And while it's, one can never say never, I think we've heard plenty of times from Chair Powell, especially when we look at previous speeches that he himself has made at this forum, that he wants to look at more tangible data as opposed to looking at something that is not quite as measurable. So more recently, I think it is the R-star fears. And of course, needless to say, this whole time over the last 5 or so weeks, we have been getting stronger than expected data in the US, and that's also been another driver of this bear steepening. I think it's created some incredible opportunities, especially if you are an investor that can be invested in the 3 to 7 year part of the curve with an iShares ETF ticker like IEI, which gives you that duration of right around 4.3 years, which we think makes a lot of sense.
Gargi, I'll be doing tons of R-star gazing on Friday in Jackson Hole. I'm going to borrow that phrase from you, okay? Given the outlook for fixed income then, given the call you've got in treasuries, what's the outlook for the equity market against that backdrop?
Yeah, I think if you had told anyone that real rates will have moved up to above 2% in the 10-year part of the curve, and that the S&P would broadly, or at least the tech sector would broadly have, yes, weakened, but not as much as we would have expected it to weaken, given the 60 basis point move in the 30-year Treasury, I think that is showing us that the equity markets remain quite resilient. Obviously, as always, we want investors to think about certain areas that are more likely to do better. Given the volatility ahead, I will not be surprised, especially if there's more yield curve steepening, to see some more pressure on the equity markets. But I think investors that are allocating to higher quality, and what do we mean by quality? Because we know investors always ask us that, really looking at companies with strong balance sheet, thinking about companies that are able to generate very stable earnings. And we, again, saw that being very strongly, doing very well in this earnings season as well. Looking at higher quality companies that we think will be able to better preserve their principal and preserve their cash flow, really, in volatile times as well. So stay invested, look at high quality companies. The QUAL ticker from iShares does give you access to that. But at the same time, I will say that if the yield curve steepening continues to take place, if 30-year yields go up another 15 to 20 basis points, I would expect the S&P and broader NASDAQ and more tech names to come under a little bit more pressure. I think it's shallow, though. I think the economy remains very resilient. I think there are dip buyers waiting to buy the equity markets in any 5 to 7% backups.
Hey, Gargi, thanks for the update. As always, Gargi Chaudhry there of BlackRock on fixed income, on equities as well. Is it resilience or complacency? Marko Kolanovic over at JP Morgan calls it this. He said the following in the last 24 hours. Compared to the start of the year, investor expectations, market positioning and the equity valuations have moved up, with soft no landing the new base case. Finishes with this. There is no more fear, only complacency. The broader market about 15 minutes into the session on the S&P up by 0.3%, with a bond market looking at yields of 4.36 on a 10-year and a new cycle high for the yield on the 10-year maturity for this cycle. Coming up, labour market power making a comeback.
Layoffs and firings are way lower than they were before the pandemic, and workers still have retained an enormous amount of leverage.
The pilots over at American Airlines negotiating a monster pay package. Team coverage up next.
Names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really it's not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
Layoffs and firings are way lower than they were before the pandemic, and workers still have retained an enormous amount of leverage, especially in in-person, face-to-face industries where recruiting and retaining workers remains difficult.
Economists weighing in on the labour market. It's a tight labour market where labour market power is back in a big way. Pilots at American Airlines are approving a new contract that increases their compensation by more than 46% over the next 4 years. The union's president writing this. This contract is a big first step towards restoring the wages, benefits and work rules that were lost during the past 2 decades. This as UPS feels the effects from its own union deal just last month. The spokesperson saying this. We've seen strong interest in UPS jobs as a result of media leverage of the tentative agreement with the Teamsters. Let's get to our coverage. Bloomberg's Anne-Marie in DC, George Ferguson in New Jersey. George, let's begin with you, sir. Just how big is this deal that's been struck between pilots and American Airlines?
So good morning. So the pilot deal with American, it looks bigger than Delta's deal, right? Delta came in about $7 billion, American about $9 billion. But part of that, there's a differential that American pilots are being paid compared to Delta. So really, we think when it's all done, all 3 groups at American, United, and Delta pilot groups will be paid pretty similarly. It is a big deal. I mean, it's what we think 20% pay increase here in the first year, a bunch of retroactive pay. Pilots are in high demand. There's a real dearth of them. And it's just going to add to the inflation we're seeing in the expense line, labor expense line for the airlines. We think up about 10% in the year, given these contracts. It came in line, like I said, with what we saw at Delta. And it's against the backdrop, we think, of potentially a slowing consumer. We see domestic fares under pressure, international doing better this summer. We're waiting for business to come back. It puts the airlines in a real challenging position, I think, if the consumer slows down and isn't willing to pay as much for airfares.
Anne-Marie, here's the good news for the White House, for the president. The good news is these companies are given these pay rises. Here's the good news again, what they aren't doing. These workers aren't striking. Anne-Marie, is that going to change anytime soon?
Well, it's a big win when you don't have workers striking, and this president wants to be the most pro-union labor president in modern history. So obviously, when you see a deal strike, this White House is likely breathing a sigh of relief. But Jonathan, there's really 2 important stories that could be developing today, and one comes to that UPS deal. Yes, a contract for a 5-year deal that was agreed upon, but has yet to be ratified. So we are going to see Teamsters workers today likely come out, and we'll know whether or not that was ratified today. And that could mean that if it doesn't get ratified, they go back to the drawing board and the bargaining table, or potentially a strike. Workers are going to vote whether or not to authorize their leadership to put a strike on the table for leverage, and that would just up the ante in these negotiations and also potentially draw some stressful conversations here at the West Wing.
Anne-Marie, thank you. AMH, George, to both of you, thank you very much. Important to frame this the appropriate way. The revenge of the labour market, not just for the last couple of years, the last decade. That quote from the union there, I think it's an important one. This contract is a big first step towards restoring the wages, benefits and work rules that were lost during the past 2 decades. 2 points to emphasise. First step, Second point there, the last 2 decades, you've all been in those meetings year after year, pay increases in line with inflation when inflation was 1 to 2%. This is about repairing some of that over the last decade and payback, if you will, for those that didn't get what they thought they deserved. The first step, I think, is interesting. They believe this is a first step. Maybe there's more to come. The equity market at the moment, slightly positive on the S&P. Let's get you some sector price action. Here's Abby.
To borrow your phrase, John, not a lot of drama here, as you would expect. We do have more sectors higher than not, with the S&P 500 up for a second day in a row. Small gains and losses, though, to the downside, making the day more risk on consumer staples and utilities. Those are, of course, defensive sectors, so they are down, again, making the growth stand out. And then on top, it's discretionary technology, and it's been tech over the last 3 days, John. Take a look at this rally that we've had. Some of the tech buyers stepping back in after options expirations over, up 2.8%, the best since the middle of July.
Abby, thanks for that. Coming up on this program, your training diary.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
"25 minutes in here, stocks up for a second day on the S&P 500. Here's something I wanted to say, something we haven't been able to say for much of the last 16 years. A yield on a 10-year, 4.36. That's the price action. Let's get to the trading diary. Some Fed speak for you. Fed President Austin Goolsbee, Fed Governor Michelle Bowman speaking this afternoon. Then it's a busy Wednesday with US PMIs coming at 9:45 Eastern. Nvidia earnings coming after the closing bell. And then the first GOP presidential debate in Milwaukee, Wisconsin. And finally, Jackson Hole kicking off on Thursday with Fed Chair Jay Powell speaking Friday at 10:05 Eastern Time. From New York, that does it for me. Thank you for watching Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.
why does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority. Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in with Ira Jersey. He's the chief U.S. interest rate strategist for Bloomberg Intelligence. See if he's got some thoughts on this upcoming meeting of all these smart economists and central bankers out in Jackson Hole. Then Bailey Lipschultz, he's our markets reporter at Bloomberg News. He's give us the breakdown on this IPO of ARM Holdings. I've got some questions, so we'll see if he's got some answers. Anna Skazafava, general manager and VP at Choice Hotels, joins the show to talk about her company and the outlook for the hotel biz and all travel. But first, let's kick this whole thing off with Mr. John Tucker in the Bloomberg Business Wire.
All right, we're always data dependent, so let's start right there. I'm not sure if this is a matter of inventories or those high mortgage rates, but getting U.S. July existing home sales, let's call them used home sales, falling 2.2% to an annual rate of 4.07 million homes. As we look at the major stock indexes right now, they turned mixed. S&P 500 is up 4 points right now. The Dow Jones Industrial Average 10 points lower, and the Nasdaq 100 is 21 points higher. That is up 0.1%. And tech does remain a focus ahead of NVIDIA's earnings tomorrow after yesterday's 8.5% close yesterday. They were up again this morning. Sam Stovall, Chief Investment Strategist at CFRA, he still sees plenty of worries out there for investors.
Well, they're all pretty much lined up in terms of yields. How much higher will the 10-year yield go? What really is causing the yield to be moving higher? How aggressive will the Fed continue to be? How aggressive will they sound when Chair Powell speaks on Friday?
Right now, the 10-year yield up 1 basis point. That's at 4.35. The 2-year, 2 basis points higher, 4.02%. Among some of the individual shares on the move, Lowe's topping Wall Street estimates for quarterly profit and comparable shares. Those shares, sales that is, those shares are up 2.4%, and Macy's tumbling after results show the company relied on markdowns to clear out a lot of their items. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
John Tucker, thank you so much. Appreciate that, as always. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We are streaming this thing live on YouTube as well, so just head over to youtube.com and search Bloomberg Radio or Bloomberg Global News. Either one will get you where you need to go. Let's see what's happening in the world of stocks. Lots of movers out there.
What happened here?
What's that?
I'm just looking at the GIP, at the intraday price chart, and we started up at 44.20, and now we just dropped down to 44.04 in the last half hour.
People aren't buying houses, maybe. I'll tell you who's going to help us out here is Bloomberg Equities reporter Nora Melinda. Nora, what do you got for us?
Yeah, so of course we had existing home sales data come out this morning, just a couple minutes ago, and it did show that existing home sales fell ever so slightly. That's, of course, got me looking at home builders. Of course, we know that home builders have begun taking market share of existing homes with more people, less people willing to move from their existing homes because of the high mortgage rates. And so that's got me looking at companies like Toll Brothers. Toll Brothers is a luxury home builder, and it actually reports its third quarter earnings results post-market today. And it's a little bit kind of in a class of its own in the sense that, you have Lennar, KBH, and all these other home builders that target, first-time home buyers and make it a little bit less expensive. But Toll Brothers is on the luxury end. We actually had a Barclays analyst, Matthew Boley, say that they forecast that third quarter earnings will be up about 79% year over year, but down about 3% quarter over quarter. And so that's a really interesting statistic in my head.
And these stocks have had great runs. I mean, on a trailing 12-month basis, they're all up 70, 75%. So nice run for the home builders.
Yes, Toll Brothers is up more than 50% year to date.
Yep.
So lots of action in the home builder space. They've really just been on a tear.
And I guess if fewer people are willing to sell existing homes or used homes, as John Tucker puts it, which is very bad marketing, by the way.
Yeah, there's the pre-existing.
Yeah.
I like used.
That's great. That's great for the builders, right?
Right.
Because if there's no supply coming on from you and me, they put up the new stuff, and that's the only stuff you can get.
It's like no competition.
Yeah, exactly.
But here's my thing. Maybe this is just a New Jersey thing. There's no roads to carry these people. Like they're building all this stuff in my town. I'm like, where's this traffic going? I don't know where it's going. So maybe that's just a Jersey thing.
Is this Jersey Shore talk?
No. This is North Jersey talk.
You're not aware, but we've been reprimanded and told we talk about the Jersey Shore too much.
So you got to stop.
We've decided to start talking about Long Island more.
Ooh.
Yeah.
Love to learn more about that one.
Oh God. All right, what else you got for us?
Yeah, so looking at Lowe's, as we're talking about home builders,
right.
Let's talk about some of those companies. So for Lowe's, their results came in stronger than expected, outperforming Home Depot ever so slightly, but it really does show that fears aren't building as much going into home builder earnings, which, of course, as I said, Toll Brothers will report post-market today, but most home builders don't actually report until toward the end of September for the third quarter. But it is interesting to see Lowe's, Home Depot, and those stocks, up, and it really does create a positive picture when you think about the home building space.
Matt, you're a homeowner now. Are you a kind of a handyman around the house?
Well, I mean, I try. I'm no John Tucker, but
no. Who is?
Did you ever buy that table saw?
I'm looking at a saw stop right now as we speak.
They're expensive, but
they're
great.
Very expensive. So that's why I haven't pulled the trigger.
It's a big ticket item for a Lowe's or
right away.
Home Depot.
Yeah, but I am stuck in the house that I bought, right? Because it was like already more than I could afford. Plus,
but you got the low mortgage rate.
Plus, I got a low mortgage rate. So I just can't leave unless I could sell my house for the price I bought it or more, and everybody else's house drops in value.
Good luck with that one.
And rates come down. So yeah, like if right now I have a baseboard situation going on in the pool house. One of the baseboards broke off.
Pool house, John.
So I've got to.
John, do you have a pool house problem, John?
I have a backyard with a septic tank.
In any case, let's get to the tech stocks. What's up with NVIDIA? I mean, I know the earnings aren't out until after the bell tomorrow, but we still have this stock kind of driving markets, it was up earlier, 2.5%, and now it's down.
Right. It hit an intraday record high this morning at the open. And as we know, NVIDIA has really been a bellwether in that space.
Yep.
Tech really has driven a lot of the gains this morning and off of yesterday as well. But, you know, as we think about everything on a monthly basis, of course, we've been rallying for 2 days straight. But on a monthly basis, we're not doing so well for August.
Okay.
So I think, if I'm not mistaken, we're down about like 4.6% monthly for the S&P 500, and that's like the worst monthly performance since last year.
It's just a little breather for the market. That's how I'm taking it.
Exactly.
Yeah, we just spoke to Ash Alankar at Janus Henderson out in Denver. He's still pretty bullish on this market. He made some good points here. But I think for NVIDIA, we just had Mandeep Singh on, the tech analyst from Bloomberg Intelligence, and we were saying, boy, these guys better not only beat, but beat big time.
Right.
Because this stock is just ripped. It's at an all-time high. And I'm going to be really paying attention to what they reported after the close tomorrow, because it's not just for the company and that sector. I think it's for the market. I think it's got implications.
Expectations are high.
Yeah. So, all right, we'll pay attention to that one after the close, because that's going to be a big one. Nora, thanks so much for joining us here. Nora Melinda, she covers all the markets for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. And we want to talk to Ira Jersey here. We'll get to soccer with Ira, because the seasons are back in full force over in Europe, and Messi's just tearing it up here in the U.S., probably even outperforming expectations. But let's talk a little bit about the Fed and rates and so on and so forth. Ira Jersey joins us. He's the chief U.S. interest rate strategist for Bloomberg Intelligence, joining us from that Princeton campus, the HQ of Bloomberg Intelligence, the brain trust, if you will, of Bloomberg Intelligence. That's where we created BI 14 years ago. It was down in Princeton.
Wait, were you there?
Yeah. So that was it.
Oh, you worked in the Princeton office before?
Yeah.
Was that a sweet gig?
Sweet gig.
Because you never had to come into the city.
Never had to, and we fought like crazy to be able to get to come into the city, because this is where it's at. Nobody, you got to be in the city, in my opinion. That was my argument, and we are now. So we're everywhere. Ira, you're everywhere. Everybody wants to talk to you about rates here. I see the real yield, which I didn't even know was such a thing until recently. The real yield on the 10-year Treasury is 2%. Lisa Bromwich tells me that's important. Is it, and why?
Well, I think the 2% number is just a number, but I think what's important is two things. One is we're at now a multi-year high, right? The highest we've been since around 2009 or so. And I think it tells you that investors are really demanding a premium over inflation now, whereas they weren't worried about inflation very much just a few years ago, and now, suddenly, it's not so sudden. I guess it's taken a year and a half to get here, but it's but investors have to demand that premium over inflation. Importantly, too, is that now that we've broken that yield high of 1.98%. There is the possibility that we can see an extension of this move to significantly higher yields. And from an economic perspective, what that means is that you're just going to see even tighter financial conditions than we've seen in the recent past.
We heard last week from Larry Summers. He was on Wall Street Week with David Weston, that he thinks we should see yields over 4.5% as the average for the next decade. It seems like a strong call. What do you think of that? Did you see the math that he did for that?
Well, so the way that you can get to a 4.5% yield is really, think about what a nominal Treasury yield is. A nominal Treasury yield is your real yield, so what we were just talking about, that 2% TIPS yield, plus whatever inflation expectations are. So I guess the question is, what do we think inflation expectations are going to be going forward? Right now, for 10 years, they're in the low twos, right, about 2.2, 2.3%. So if inflation expectations kind of hover where they are and real yields are 2.2%, then 4.5% would not be a complete surprise. If you go back to the early 2000s, you go back to the 1990s, that's more or less where Treasury yields kind of were on average. I guess the question that we have to ask ourselves, and what investors need to ascertain, is, are we going back to an environment more like the 1990s, where we have 2.8%-ish inflation, and then on top of that another 2% real yields? Then yeah, that's completely possible. I think there's still, we're still not a lot of people still aren't completely convinced, and I'm among them, that we're going back to the 1980s, 1990s, or even early 2000s in terms of the economic environment. So unless there's no way that the Fed is able to get inflation down more significantly, then we're probably going to see yields at some point go back down. But will they get to 4.5%, say, the next cycle? Yeah, completely possible.
Just so you know, Summers says he thinks inflation is going to trend at a faster pace, about 2.5%. Real return could be 1.5% to 2% over time, and the term premium, he said, will be between 0.75 and 1 percentage point. So overall, he said 4.75% over the next 10 years. That's
well, the TIPS yield takes into account that term premium, right? So that 2% number that Paul mentioned before was, includes some kind of term premium. The problem is when economists and a lot of people, when we try to model what is the term premium, that's the difference of, how much extra you should be paid for buying, say, a 10-year versus an overnight bond or a 3-month bond. All the measurements of that, in my opinion, are absolutely terrible, quite frankly. Yes, academically they might make some sense, but the thing is you can't trade them, and if you had tried to trade on any of those term premium models, you would have lost so much money, you would have been fired 5 or 6 times just in the last 3 or 4 years. So you can't use those models as a good gauge for exactly where Treasury yield should be. So I like to look at things that can be traded. So let's look at the 10-year, let's look at the 5-year, let's look at the 2-year. And right now, if you had a judge term premium, some models say that it's positive, when in reality, if you just look at where we are with the inverted yield curve, it's not. So I'm not so worried about that, but I am concerned about investor demand for real yields. And the fact is that at 2%, TIPS might be kind of attractive if you're a long-term buy and hold kind of investor, but that doesn't mean that they can't go higher. And I think that that's important, because if you go back and you look at where we were in 2005, for example, we had around 2.5% 10-year TIPS yields. So there's no reason to think that we can't go back there, at least temporarily.
All right, so anything going to come out of Jackson Hole this week? I mean, our surveillance team will be out there for some great programming on Friday from there, and Michael McKee, I believe, is out there already, so we'll be getting some reporting from him throughout the week.
Hey, if they're all out there, it must be important.
It must be important. So what do you expect, Ira?
Yeah, just a little bit maybe of nuance compared to what Jay Powell told us at the last press conference. The problem with Jackson Hole now is that it's less useful as a signaling tool, primarily because there's a press conference at every single meeting. So, but it is just like a speech, right? So it does give Jay Powell and some other members of the Federal Reserve who are out there, and indeed global central bankers, right? Because it's a symposium for global central bankers to kind of highlight what the next policy action is, and there could be some little tweaks that Jay Powell might make in terms of Anna Wong at Bloomberg Economics put it interestingly, saying he's going to have his be more like Greenspan than Volcker, for example. So not necessarily going to say, hey, we're going to hike interest rates more, but more be confusing or neutral and not say much of anything at this meeting. But I think the market might take that as a little bit as hawkish, because again, I think Jay Powell will reiterate that the Fed is not going to be cutting interest rates until inflation is down and the employment situation deteriorates a lot. So neither of those two things is, those are both the necessary conditions for the Fed to cut. And we're not going to be there until sometime next year, probably in the late next year, which is one of the reasons why we've seen the sell-off in the 5-year and 10-year Treasury.
I'm looking to refinance a mortgage. You're not helping things here. Ira, Lionel Messi has, I think, outperformed even the highest expectations. Just incredible what he's doing in the Major League Soccer this year.
Yeah, it's the problem when you take one of the best players, if not the best player in the world ever, and put him in a league that has a salary cap, right?
Yep.
Like, you think about the back lines and the defenses of Major League Soccer teams, and you look at what they get paid versus, say, the people in La Liga or or in League One in France, or the Champions League teams for that matter, you know, they don't get paid anything. Like one player might get paid what the entire back line gets paid for a year in Major League Soccer. So it's not a huge surprise that he's tearing some of these defenses apart.
Are you going to go see him somewhere in New York or Philly? Or?
I've seen him already, not playing in Major League Soccer, but I've seen him play for Argentina, and I've seen him play for Barcelona back in the day.
You've seen him play for real.
For real, I guess. Yeah. That's kind of what he's trying to say to us. All right, thanks so much, Ira Jersey. Ira Jersey, our soccer strategist. He's also our chief U.S. interest rate strategist for Bloomberg Intelligence, giving us thoughts on the markets. The 2-year Treasury, 5.02% to park your money 2 years with the U.S. government. We'll have more coming up. This is Bloomberg. Let's get some company news right now with, I'm going to say, Lisa Mateo behind that wall.
Yeah, that's me. Good morning. Microsoft's $69 billion acquisition of Activision Blizzard has a new chance of winning approval from UK regulators after the tech giant submitted a substantially different deal to the country's antitrust watchdog. Now, Bloomberg's Alex Webb has the details.
So what Microsoft is now offering is the licensing of its cloud gaming offerings, of Activision Blizzard's cloud gaming offerings, to Ubisoft, a big competitor in the space. In the UK specifically, it has been about cloud gaming. Could Microsoft get a dominant position? It's offered now a concession that is aimed at least at reducing some of those concerns.
Now, the Phase 1 probe will now restart. The CMA has set a statutory deadline of October 18th. Right now, shares of Microsoft are up about 0.8%. Activision Blizzard up more than 1%. And images and videos made with artificial intelligence are getting tougher to spot, and that's leading to a new wave of fraud. The Federal Trade Commission, it says so-called deep fakes, they cost U.S. consumers nearly $8.8 billion a year. That's a 44% jump from the year before. Bloomberg's Nabila Ahmed says it's also costing major banks big money.
By 2025, costs for fraud detection and prevention at global banks will have risen to about $12 billion. And that's about 26% higher than it was in 2021. So you can see the rapid rise in costs.
Now, Ahmed says Deutsche Bank has rebuilt its fraud detection and prevention system. Wells Fargo, they're also overhauling its unit that works to detect these scams. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Zucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Let's start off with shares of NVIDIA. They have turned lower. The selling comes after yesterday's over 8% pop. They're getting to ready to report earnings after the close of regular trading tomorrow. It has now become among the biggest laggards in the S&P 500 and the NASDAQ. Down right now, let's give you the updated quote if I have it. down 0.6% for shares of NVIDIA. Anticipation of Friday's speech by Fed Chair Jerome Powell at Kansas City Fed Jackson Hole Symposium. Another factor for higher yields for bonds. Powell's commentary is widely expected to be hawkish. That's according to the latest MLive Pulse survey. Some of the other individual shares on the move. Macy's, that's tumbling, down over 9%. Now, among other things in their conference call, they highlighted credit problems. So that is raising a red flag, perhaps, about the health of the U.S. consumer. S&P 500 now 7 points higher. That's up 0.2%. 4406 on the index. Dow Jones Industrial Average 59 points lower. That's down 0.2%. And the Nasdaq 100 45 points higher. That is up 0.3%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you very much. We appreciate it. Matt Miller, Paul Sweeney, live here in the Bloomberg Interactive Broker Studio. We're on that, what is that internet thing called? YouTube. We're on that YouTube thing.
Oh, we are? I keep forgetting.
So you can go over there and search Bloomberg Radio. You can check it all out, the live
Do you
feed.
honestly not use YouTube very often?
No, I do.
Okay, because I use it like literally every day.
Oh, yeah.
I think it is the greatest learning tool that there is. Anything you want, like if you wanted to learn about bond convexity, there's actually a bunch of people who do a great explanation of it.
And how to hang a door, Johnson, because if it doesn't shut, you need to rehang a door. I watched that video.
Described my viewing habits.
See?
After hours.
I recently learned about a new way to tune my motorcycle.
Really?
You just drive it at extremely high RPMs for like 20 or 30 minutes.
I thought you were banned from, now that you're a dad, from...
I'm allowed to ride bikes, just not in the city.
Yeah, so you...
And you violated that this morning.
Like you can't
Did
ride
you
into the city.
Well, let's hope my wife isn't listening.
Exactly. All right, John Tucker, thanks so much on that. Hey, we actually have an IPO to talk about, a big one coming up here. We want to get right to it. Bailey Lipschultz, he covers all that IPO stuff and all the new market stuff for Bloomberg News. He joins us here in our Bloomberg Interactive Broker Studio. All right, so Bailey, ARM, it's part of SoftBank. They need to convince the market that as a chip designer, they are a great play on AI. How do they do that?
The big sales pitch is being in AI, being in machine learning, being in, and we looked at the filings, the company actually only mentioned AI about 50 times, but the big focus will be when they're talking to investors is how they can get and become really a staple of those chips that are going to increasingly be used to bring AI to things like your cell phone and be able to incorporate their technology into data centers, which obviously are very, very lucrative for the technology in the semiconductor space.
Now, the challenge there for me, Matt, sorry to interrupt, Matt, but is because the challenge is if I'm sitting on the other side of the table or I'm at the Rubber Chicken lunch in New York, my thing is, but you guys aren't. So I have to believe that you aren't now really an AI play, but I have to believe that you're going to get there, right?
Yeah, and they, according to their data, are in something like 99% of smartphones. So their whole pitch is that smartphone market is drying. We've seen that play out with earnings from Qualcomm, earnings from Apple. Well, now they're trying to skate to where the puck's going to be, data centers, AI, and being able to use their technology and have customers use their blueprints, which they sell, collect royalties, some nice royalties off of other companies using that. And that's kind of where they're trying to position themselves, really. Not saying NVIDIA is one of their many customers, but they name dropped NVIDIA a few times as people who they're operating and working with and letting them use some of their AI technologies.
So what has NVIDIA said about ARM? I mean, aren't the two pretty closely connected, more than just sort of a customer relationship?
Yeah, NVIDIA was set up to buy the company a few years ago, and that deal fell apart. The big thing when you look at some of these Bloomberg reports is that ARM is talking to what they're framing as strategic investors. NVIDIA, according to Bloomberg reports, among those potential investors alongside the likes of Amazon and Intel to actually buy into the IPO. So you're trying to look at the way ARM's positioning itself to benefit from not only selling to these customers and benefiting from their sales, but also getting them to buy into the stock, which, you know, creates kind of that familial environment for SoftBank, which has had a pretty rough go, losing $30 billion last year.
Yeah, this will be a big home run for them. Great story related to this on the Bloomberg Terminal by my buddy Alex Barinka and Min Young Lee. It says ARM needed 3,500 words to explain its China risk before IPO. Wow. So they've got a China risk here. So I guess investors have to get, what is that risk, I guess?
ARM laid out that they generate about a quarter of their revenue from China, and that's driven by ARM China, a unit that basically them and SoftBank are partnered with, but they don't control. So there's uncertainty around slowing demand in China, which we've been seeing play out. We've seen in the filing that the company's royalties coming from China actually slowed in the last fiscal year. They warned that that could continue to slow, and that's all on top of geopolitical risk with the US, UK, anything going on as it relates to China and Western countries. And you look at some of the reactions we've seen from Bloomberg Intelligence, really laying out that China risks paired with slumping smartphone and consumer electronic sales, those are the key concerns for investors going through this filing that hit yesterday evening.
By the way, in terms of the proceeds, this is a $60 to $70 billion valuation, right?
As far as we've reported.
As far as we've reported. Which means what? They walk away with...
SoftBank, last we've reported, SoftBank would walk away with the $8 to $10 billion because they bought back the remaining 25% from their own Vision Fund. So they're selling shares into the open market. 8 to 10, we've been reporting that maybe it's going to be a bit lower because now they own the entirety of the company. So SoftBank actually brings in all of the sales. None of that money is going to ARM's
Exactly. That's the point. So none of these proceeds get reinvested into ARM's business.
Yep.
That's an important point.
And it goes back to SoftBank being able to take that cash and redeploy it to some of the other startups that they've tried to back and are looking to back and try to create returns.
Here's another thing on what our reporting is showing, because last quarter the company had little to no revenue growth.
Dropped about 1% year over year.
Okay, so given that background, is there any view coming from the street on valuation yet?
We saw, and yours truly reported on this, we saw a Bernstein note laying out expectations around $40 billion. That was last month. When we crunched the numbers, looking at some comps, we've been hearing investors in Wall Street talking up Synopsys and Cadence as better comps. When you look at a price to sales trailing on a 12-month average, valuation comes closer to 32 to 43 billion. So,
and the company's looking for what?
60 to 70 as far as we've, and they bought back
that's a bid-ask spread there, my friend.
Well, they also bought back with that repurchase from SoftBank. They paid about 16 billion for that 25% stake, so $64 billion baked in. But the one thing that was interesting in the filing is SoftBank warns, and this is verbatim, investors are cautioned that the purchase price paid may not be indicative of and is not intended to reflect expectations regarding the completed deal. So they basically are warning that they paid a valuation of $64 billion. Forget that. That's part of a different deal. Don't worry about ascribing that valuation.
It's funny because that's the first place I would go to.
Exactly, and that's what we're talking to investors and people who watch
this is not
going
to be an easy deal, is it?
It's going to be a fascinating deal. I mean, we've talked about at length about the dearth of IPOs, and the one view that I've been getting from a number of my sources is that ARM is the type of company, and they've stuck to their plans to go public this year, that could really go public in most any market. Okay. It was public once before. Back in 2016, SoftBank took it private. It's more of a almost PE style play as opposed to your traditional money-burning VC-backed company.
And it's the only game in town if you want access to a new issue. If it does well, I guess there'll be a cascade of IPOs that follow.
Yes and no. We're expecting potentially Instacart to flip their S1 sometime as early as this week. Clayvio's another company. The big thing that I've been talking to my contacts, their view is fourth quarter 2023 will be interesting with some of these big companies that probably should have or could go at most any time, but the big focus is going to be early 2024 when you're going to get more of those sweet spot IPOs.
Just on a different topic completely. We were talking and have been talking for a long time with Ira Jersey about soccer, and I know Messi's come here, so it's pretty exciting for a sport that otherwise is just deadly boring to watch. Why doesn't professional lacrosse get a big pickup in this country? And I ask you, Bailey, because I've noticed that you were a lacrosse beat reporter at Citrus TV.
Yeah, man. I cut my teeth at Syracuse University covering, which I still view as probably the best men's lacrosse college team that did not win a national title. They were absolutely stacked.
Yeah, and back when we were kids, that was it. It was them and Johns Hopkins, and then now everybody plays.
Big Ten's all getting in on it. No, but that's interesting, Matt, because coming from the West Coast, I knew like 2 people who played lacrosse. It was a rich kid San Diego sport that, being east of LA, was like, we play football. That's what men do.
And in Ohio, by the way, same thing. Growing up in Ohio, lacrosse was something only kids in like New Jersey and Connecticut played. But now, at the schools all the schools I got kicked out of in Central Ohio, they all play lacrosse.
Well, it's accelerating. The issue is this is the pitch, and I did a small stint covering sports here at Bloomberg and sports business. Is lacrosse is going to be gaining from parents who maybe don't want their kids to play football for fear of injuries, head injuries. The issue, the one kind of drawing factor is, and the reason it's compared to hockey is it's not a cheap sport. There aren't a lot of fields to play. So if you don't have a tremendous amount of income where you can find a stick and a ball and find someone to play with, you can't go pick up and play like soccer or football or basketball where there's a court or there's just a grass field. You need
and the number 1 high school team in the country this year, the Lawrenceville School. Thank you very much. Thank you, Bailey. Good stuff. Bailey Littleship covers the markets. Amy Marsh, she covers the world and national news in Washington, D.C. Amy.
That's right. Thank you, Paul. Former President Trump is set to travel to Atlanta Thursday to surrender in his Georgia election interference case. He's charged with racketeering in connection to alleged efforts to overturn the state's 2020 election results. And now there's a new poll out that shows more than half of voters likely to attend Iowa's Republican caucuses believe Trump's false claims that he won the 2020 election. The survey by NBC News and the Des Moines Register found 51% of respondents believe Trump, 41% do not, and 8% say they're just not sure. One leading political watcher says Trump was smart to skip tomorrow night's Republican presidential debate. Bloomberg's Nancy Lyons is that part of the story.
The former president has definitively said he will not take part. He cites his wide lead in the latest survey of likely GOP voters. The decision does not surprise Charlie Cook of the Cook Report.
Former President Trump should have his head examined if he did go in the debate. He's got everything to lose, nothing to gain from it.
As for the eventual nominees for the presidential race, Cook tells Bloomberg Sound On the only obstacle he sees preventing it from being a Biden-Trump face-off would be health-related issues. In Washington, Nancy Lyons, Bloomberg Radio.
A federal judge in Texas is taking up a lawsuit today over the so-called floating border wall. Critics say the string of buoys that are meant to discourage illegal immigration is nothing more than a political stunt. Democratic Congressman Henry Cuellar of Texas says the state will eventually have to take them down.
It's a federal responsibility. The Supreme Court has already said when they took up the case in Arizona that it's a federal responsibility.
The lawsuit filed by the Department of Justice is trying to get those giant plastic balls removed. Texas did move them closer to shore as a way to address concerns that they're floating in international waters. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. Stocks under pressure right now. Shares of NVIDIA sell off this morning after yesterday's 8.5% pop. The AI darling down close to 2% right now. This comes ahead of their earnings report, of course, tomorrow after the close of regular trading. Among some of the other stocks on the move, Dick's Sporting Goods sinking. They're cutting the profit outlook for the full year. The retailer dealing with slowing growth, and they're blaming theft at its stores. As for bonds and yields, with the 10-year Treasury this high right now, it currently is at 4.34 this morning. Russ Kostrich at BlackRock doesn't think this is the time to buy.
Inflation uncertainty is much higher than it used to be, at least compared to 5 years ago. And what the Fed is going to do is more uncertain. And that's what's been happening. People have been demanding that higher premium to go further out on the curve, and that could go higher still.
Existing home sales, they're down for a second month, looking at a 2.2% drop in July home resales. Data does illustrate the impact of high mortgage rates and a lack of inventory. Right now, the S&P 500 3 points lower, 43.96 on the index. The Dow Jones Industrial Average down 127 points, and the NASDAQ 100 right now unchanged, 14,937. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We're doing that streaming thing on YouTube. So just head over to youtube.com and hit Bloomberg Radio. Will get you where you need to go. That'll work.
Go to youtube.com and search Bloomberg Radio.
There you go. You're into this thing. You know what's going on here.
All right, let's stream us live.
Let's talk about the hotel business, particularly the extended stay part of the business, which is probably a part of the business we don't talk about enough. Anna Skazafava joins us. She's the general manager and senior vice president of extended stay brands at Choice Hotels. Choice Hotels, of course, is a New York Stock Exchange listed company. CHH is the ticker to load into your Bloomberg Professional Service. Anna, thanks so much for joining us. We appreciate you coming in all the way from Rockville, Maryland. Talk to us about the extended stay business. What are the drivers of your business, and what are the trends been, I guess, over the last several years as the world's kind of reinvented itself a little bit?
Yeah, no, that's great. So extended stay caters primarily to non-discretionary stays. So think traveling nurses, construction crews. So we have a lot of tailwinds coming to us with the infrastructure bill, the CHIPS Act, et cetera. So we see a lot of demand in our future ahead of us at this point in time. I would say the one thing about the extended stay brands is that they're pretty resilient. So even in face of recessions and pandemics, we tend to have an occupancy premium over the rest of traditional hotels. So even right now in the first half of the year, economy extended stay has a 19% occupancy point percentage over just regular economy transient hotels. So it's a very resilient business model.
I guess your biggest competitor right now would be Airbnb. Is that fair to say? I mean, if I was going to go someplace and I had to stay there for 2 weeks, that would be, sorry to say, my first thought.
Yeah, I think Airbnb, though, when we look at that, their price points are a little bit different, and those guests don't tend to look for kind of the standard guest experience that we provide across that. So the way we think about extended stay is that it's apartment-like amenities with a hotel level flexibility. So you still get the services, the cleaning, et cetera, that you would expect from a hotel, but you have a full-size kitchen in your room. You have some of those larger spaces and suites versus a small traditional hotel room.
So are you primarily a franchise company? Okay,
yes.
So how do you grow your business in terms, is it simply going out there and recruiting franchisees? How does that work? How does that growth
Yeah, absolutely. But I think developers at this point in time are looking at extended stay as one of the hottest segments within the lodging industry. Really, it's a hedge. It's a really different type of asset class than a traditional hotel. So over the last couple of years, even during 2020, Woodspring Suites, our largest brand, they ran GOP margins of 50%, and they've gone up from there. So last year we were on average at 60%. So smart money is really kind of chasing us at this point in time and wanting to get into the segment. We've been able to capitalize on that. We've had over 50% more openings in the first half of this year than we did last year. We've grown our pipeline 17% just in the first half of this year. So while we are, yes, of course, going after some of the larger developers, they are certainly seeking us out as well.
So does the does the change in work from home or the evolution of the way we work have a big effect on your business?
Yeah, we've seen a lot of stays now where, I mean, I hate the word leisure, but where you get the business traveler, right, and they're staying for 5 days and then they tack on.
Wait, is that a word that people use?
I mean, we do in the industry, yes.
Leisure?
Leisure.
Business
and leisure.
I cannot believe that you're allowed to use that word.
It's pretty standard industry jargon for sure.
It works.
No, but that certainly has changed. And then honestly, the reshoring of American manufacturing has also been a great tailwind for us at this point in time. So any of those large semiconductor plants that you're starting to see move in, battery plants, et cetera, are also creating a lot of demand for the extended stay segment.
How about, I mean, can I build a hotel these days? I mean, the banks are just pulling back on lending across the board. How does that impact, I guess, your franchisees?
Yeah, so we're the only company that has 2 entry points into extended stay for both the economy segment and the mid-scale segment. So what we've done, knowing that new construction lending is a challenge, right? And some of our franchisees can get that. They have community banks that they've got local relationships, proven track records, and so they're still getting that lending. But a lot of folks, where we have markets that have no extended stay supply, there are a ton of traditional hotels. We came up with a really innovative solution that we call kitchen in a box. So we worked with engineers, architects, the trades, mechanical, electrical, plumbing, et cetera, and came up with this concept where you can take a traditional hotel room and convert it into an extended stay room. And we have 20 of those transformations going on across the country.
Now, what's an extended stay room entail?
So you must have a full-size kitchen.
Full-size kitchen?
Full-size kitchen.
Okay.
And the way that we like to think about it is guests use these rooms for both work, play, me space, right? They need to be flexible spaces so that it's more kind of like your home. Even thoughtful things like, you know, you want a larger vanity in the bathroom because if you're going to be there for many weeks, you want to be able to put all your stuff out, right? So that's how we think about designing that with the consumer first and how they're going to use that space.
How have labor costs been? Because I know, you know, in the pandemic or even at the end of the pandemic, Paul and I would interview hoteliers. Do you say that? Hoteliers?
That's pretty good.
Yeah. And they told us, you know, it's very difficult to get people to come to work.
Yeah. So the beauty of extended stay is in the economy segment in particular, there's only 6 or 7 full-time employees. And the reason that is because we only do housekeeping bi-weekly. So the labor model is super light in these hotels, which also enables those high margins that I spoke about earlier. So yes, we are not immune to that, but it certainly lends itself a little bit easier than what you're seeing in traditional hotels.
So extended stay facilities are not housed within your traditional hotel facilities. They're actually completely separate.
Yeah.
entities.
So take a Woodspring Suites, for instance. Prototype is 122 rooms, and they come standard with the kitchens, etc. There's also guest laundry, fitness facilities, etc., so that you can really maintain your lifestyle there. So that you would not see them inside a traditional hotel.
But no, like restaurants or any of that type of stuff. No. This is just stays. Okay.
Yeah.
Who do you compete against, really? Matt mentioned Airbnb, but in terms of the traditional extended stay, who's the competition for you guys?
Well, I mean, we're starting to see a lot of new competitors come into the space. So Marriott, Hilton, Hyatt have all announced brand launches at this point in time. I think for us, though, we've been in the space for a really long time. We acquired Woodspring Suites back in 2018 and have kind of reinvigorated the segment. We have over 400 open and operating extended stay hotels right now with another 300 in the pipeline.
And where are those? Are there regional areas that you guys are focusing on, or?
I mean, coast to coast, we certainly see a lot of demand right now in Texas and Florida. Yeah. Relocation has been big for us as well. So think places like Boise, Idaho, that are fast-growing kind of urban areas at this point in time.
Talk to us about rowing.
Yeah.
So what do you row?
She's in the Athletic Hall of Fame.
I mean,
that's no joke.
What's a coxswain? Is that the one that says stroke, or go?
It's a little more sophisticated now. So you actually have a microphone and there are speakers underneath the seat, right?
Really?
And so I could whisper and the crew would be able to hear you. But yes, I steered the boat and then made sure that we were making race moves.
But you sit in the front, though, right?
No, in the back.
Oh, in the back.
So you can see.
I see. Yeah. So you actually do steer, literally.
Yeah, literally.
And then you're the motivator of the crew.
Correct. Absolutely.
So what's the Athletic Hall of Fame like? Do you have like your jersey there, or?
I have my plaque, and it's on the riverfront. So we have our boathouse out there. So that's
and
where
what river is that? Washington.
Chester River. So in Maryland.
Nice.
Yep.
See, I don't know anybody who rows.
I know some row. I actually only know women who row. But
it's a big D3 sport.
It's huge.
Yeah, it's huge.
I mean, I know a lot of Boston women who row on the Charles.
That's amazing. We came in third, I want to say, one of the years on the Charles. And of course, it's a big tradition to throw the coxswain in if you win.
All right, good stuff. Anna Skazafava, General Manager and Senior VP of Extended Stay Brands at Choice Hotels. We're going to more coming up. This is Bloomberg. Let's get some company news right now. Elise Mateo.
Fun fact, I actually tried out for the crew team at Rutgers. The 5 a.m. wake-up calls, I didn't last. Now I get up at 2:30 a.m. Go figure. Macy's, they topped earnings estimates but delivered another warning about U.S. consumer spending. Bloomberg's Abigail Doolittle says, although earnings were impressive, it's all about the composition.
Seasonal markdowns on spring and summer merchandise. That was what drove that earnings beat. Relative to sales, they did beat slightly, but it's another quarter. I think the fifth quarter in a row of negative growth, down about 9% year over year. And we do have CEO Jeff Gennett pointing to that macro uncertainty.
Shares of Macy's down about 11%. Meanwhile, the Associated Press reporting that Macy's is opening more small stores in the West and Northeast to attract more customers. This month, the retailer opened a location in Highland, Indiana, and plans to open small stores in Boston, Las Vegas, and San Diego. And from retail to home improvement, Lowe's opened their books today. Bloomberg's Gina Cervetti has more.
Lowe's is seeing a strong recovery in sales to professional contractors, along with demand online. That helped the retailer report second quarter earnings and comparable sales that beat estimates. Lowe's did say it's seeing lower discretionary spending by do-it-yourself customers.
Now, checking in with shares of Lowe's right now, they are up nearly 4%. And BJ's Wholesale cut its comparable club sales guidance for the full year, missing estimates. Now, that excludes gasoline sales. Its CEO said the company will continue to monitor consumer behavior as the company forces them to tighten their spending. Now, shares right now of BJ's are down about 2%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Hi, Matt Miller and Paul Sweeney here in the Bloomberg Interactive Broker Studio, looking at these markets mixed. We got red and green. The S&P is kind of unchanged here. The Dow's off 90 points. That's about 0.3%. NASDAQ up about 0.5%, 64 points. Again, NVIDIA after the close tomorrow, really, really important, not just for the company, but for the tech sector overall. And many strategists and fund managers are saying for the overall equity markets in general. Also, just want to call out WTI crude oil. That's off about 0.3%, sticking right around $80.50. Yields, just call out the yields here. 10-year Treasury, 4.33%. It's pretty steady right there. The 2-year will call out above 5%, 5.03% gets our attention. We will continue to pay attention to all that stuff. Right now, let's go to Amy Morris. She's down in Washington, D.C., and she's got world and national news for us.
All right, thank you, Matt and Paul. Conservative attorney John Eastman, who pushed a plan to keep Donald Trump in power, has just turned himself into authorities on charges in the Georgia case alleging an illegal plot to overturn the then president's 2020 election loss. Eastman has been booked now at the Fulton County Jail before he was released by authorities. He's expected to face a judge to be arraigned in this sprawling racketeering case. As we get more, of course, we're going to bring it to you. The Biden administration is accepting applications starting today for a new income-driven student loan repayment plan. It's a new effort to shore up student loan borrowers facing a cliff as pandemic-era benefits end. The so-called Saving on a Valuable Education, or SAVE plan, is meant to disproportionately focus on low-income borrowers, calculating payments based on income and family size rather than your loan balance. Airlines and aviation officials facing another wave of criticism after a new study showed the number of near misses at airports happens way more often than previously thought. About 300 reports of close calls involving commercial aircraft over the past year, 46 in the past month. Airline safety expert Captain Sully Sullenberger tells ABC's Good Morning America Congress needs to provide predictable long-term funding just to keep it all safe.
We're long past the date where we could define safety simply as the absence of accidents. For decades, we've had to do much better than that, much more than that. And by looking at these incidents before they can lead to harm and take effective action, that's how we keep everyone safe on every flight.
Now, the Controllers Union says that the U.S. aviation system is not sustainable. Congress needs to address staffing issues, as the FAA said that the one close call, it may be too many, but the aviation system is the safest in the world. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg, Matt and Paul.
All right, Amy, thank you so much. We appreciate that. Matt, we've been looking for, when we talk about corporate real estate in office buildings, we say we haven't seen a lot of transactions to get a sense of where this market is. Well, we got one in Chicago. Amancio Ortega, the billionaire founder of the Zara clothing chain, snapped up a luxury apartment building in Chicago for $232 million to add to his growing U.S. property portfolio. And I'm reading down in this story, and I wanted to get a sense. It was Jones Lang LaSalle was hired in 2020 to sell the building in the trendy neighborhood of the West Loop, where Google has its Chicago offices. It was expected at the time to fetch $250 million. That's according to Crane's Chicago business. And again, it traded at $232 million. So a discount, but I wonder where that is relative to maybe pre-pandemic levels, because you're trying to get a sense is in some of these big cities and commercial real estate, what kind of discount will they trade for now vis-a-vis pre-pandemic?
Right. Now keep in mind, this is a residential building, right, and not office space.
Yep.
So
good point. Yep.
That's where you get the big discounts. Also, in Spain, the C is pronounced like a TH.
Thada.
So it's, and the Z, so it's Amancio.
Amancio Ortega.
Amancio Ortega.
Thank you.
I once saw his yacht floating off the coast of Canedo in Galicia.
And how is his yacht, would you say?
I mean, I don't know if he only has one yacht, but this one was pretty cool.
Yeah.
So
but when you're around like the family in Spain, when you go over there, and you're going over there again Saturday, right?
Yeah.
I mean, you don't speak Spanish, and the Spanish you do speak is probably lousy.
Well,
and no th, nothing. You're saying, you're saying Amancio, and then the people they just roll their eyes.
That's
right?
the one rule I can't break. And the thing is, I understand Spanish.
Okay.
So I just reply in English.
All right, that's the ugly American in Spain. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, a busy hour coming up. We're going to start off. We're going to talk a little bit about the retailers. Simone Foxman's going to join us real quickly at the top of the hour because they've got some sell-offs here at Macy's. Drew Redding, he's a home builders analyst with Bloomberg Intelligence. The home builder stocks are just ripping. I guess the bottom line is we don't have enough homes in the United States. You got to build more, and let's go buy those stocks, I guess is the call. And then probably the smart conversation of the day, because this dude is very smart. Jay Hatfield, CEO at Infrastructure Capital Management. He'll join the program and give us his thoughts on where these markets are going and where this Federal Reserve is going as well. But let's kick things off. Speaking of smart conversations, John Tucker, Bloomberg Business Flash.
Well, thank you. S&P 500, little change right now. And a lot of the focus right now, NVIDIA, it is down 1%. This has been bouncing all over the place this morning on the eve of the quarterly results. Earnings at consumer-facing firms, they were mixed. You had a beat from Lowe's that kind of easing the fears of lower home improvement spending. But then you have Dick's plunging after a miss there for the sporting goods store. And Macy's tumbling after results showed the company relied on markdowns, among other things, to clear out their items. And ahead of Fed Chair Jay Powell's speech to central bankers in Jackson Hole on Friday, Vince Reinhart at Mellon Investment says investors have to stay focused on higher for longer.
And the longer they keep rates on that plateau, the more effects of the prior increases in rates we're going to see on the economy. So that's the big message to hammer home to investors.
And I know you're going to talk about this coming up with the latest existing home sales data featuring more evidence housing is in short supply, so that can continue to help home builder stocks, which, as you say, have been on a month-long tear. S&P 500 right now, 4 points higher. That's up about 0.1%, 44.03 on the index. The Dow Jones Industrial Average down 102 points, and the Nasdaq 100 right now up 55 points. That is a 0.4%. 2-year yield 5.03%. The 10-year 4.33. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker studio. We're also streaming live at youtube.com, where you can go search Bloomberg Radio. I was promising you smart conversation, and boy, we got to kick it off the hour right here. We're going to talk stocks with a couple really smart market folks, and we're going to focus in on what's happening out there. Jess Menton, she covers the equities for Bloomberg News, and Simone Foxman, she is Bloomberg Television, and she covers the retail space as well. So both of them joining us in our Bloomberg Interactive Broker studio, which is a good thing. Jess, let's start with you here. Kind of red and green on the screen here. We started off in the futures market looking good, but then kind of petered out a little bit. What are you looking at?
Yeah, well, I know that we are going to get into some of these retail names that Simone's going to cover with Macy's and some other names here. So I wanted to point out a note from Nick Colas of DataTrek, who I know Paul and Matt like to follow very
love
closely. He's great.
Yeah.
So he had a note this morning. So he was going through and looking at some of the Google Trends search volumes for some of these back to school type of items here. So when you're looking at supplies, notebooks, backpacks, those are at and close to about 5-year highs there. But unfortunately, when you're looking at queries for girl jeans and then boy jeans, those are down about 24% and 5% respectively versus this time last year. So when you're thinking about some of these discretionary
But maybe that's just a
items.
thing, like, did he check out khakis? Because maybe people are wearing jeans less often now. And just
Perhaps, especially after what's happening with the pandemic. And then also things coming out of COVID, right? I mean, especially when you're thinking about some of the back to school type of items maybe a year ago versus, I mean, a year ago we were still probably doing some COVID tests as well. Things weren't like they are now when it comes to how things are operating, but some interesting stats.
I won't even talk to Sam.
We should ask him though about the khakis.
Were you even allowed to wear jeans to school?
I went to Catholic school for 8 years, and the answer was no. We had a uniform.
And at
then at
Lawrenceville?
Lawrenceville, you could wear anything.
Oh, you could wear anything you want? Oh, really?
Yeah, no uniform.
No,
my brother had a uniform. We had no uniform. So people went really, really downscale, and then they let girls into Lawrenceville.
Ooh,
and the
okay,
boys
there you go.
up their game big time.
Started wearing ties.
Exactly.
Khakis
Just you know, they up their game. You know.
I feel like I was able to wear khakis and or jeans.
Yeah. Sure, why not?
I'll admit, I went to a prep school. The boys were not on the top of their game.
No?
They got used to the girls, I expect, and they were like...
Interesting. All right, hey, Simone, on these retailers, let's start with Macy's. I mean, I walk past Macy's every day going to lovely, beautiful...
Penn Station.
What's going on at Macy's these days? I mean, I thought that they'd weathered the storm and they were doing well, but... Inventory, is that the issue?
Now, they managed inventory relatively well.
Okay.
I mean, I think every retailer had at least some inventory problem. But now the idea is, yes, they're continuing to get traffic, but the sales they are doing are mainly on the back of really big promotions. I mean, you look at Bluemercury, for example. That's the beauty and skincare area of their business. That was what held up comparable sales, up 5.8% over last year. But then you listen to the call. All about markdowns.
So that's how you move it. Okay.
Yeah, exactly. To some degree, maybe they're not having necessarily inventory issues where they have this massive glut of stuff, but the only way they're really able to sell the stuff that they do have in the stores is by coming to these markdowns. I mean, there's some seasonal issues as well, some seasonal inventory stuff. Some of this is traditional. You know, retailers they're never going to get it perfect, and as best they try and manage it, they will. But I think the concern here really is that the sales they are getting are mainly driven on the back of these big promotions, and that cuts into margin and a weak consumer.
So what are the other, I mean, the competitors, I guess, would be Nordstrom, Dillard's, right? Kohl's.
Yeah, to some degree.
Kohl's
and then some of the specific retailers themselves. You know, Macy's has a lot of, its own private label brands. And we've heard really mixed messages. I think when we look across the space, to some degree, you can go to a Macy's and buy homeware stuff. They cover a lot of different areas.
I bought a couch once at Macy's. It was high quality.
Yeah.
Yeah.
That's a couch at Macy's.
You know what? They had a pretty decent furniture section there over on Herald Square, and
Nice.
now my kid brother is the owner of said couch, and likes it.
On, yeah.
I was just looking at over the last 5 years.
Oh, here we go. COMP.
Macy's has
Love it.
really underperformed the index and also the other consumer discretionary stocks. It's down 57% over the past 5 years. But Nordstrom is down 67%, and Kohl's is also down 57%. So in general, these department stores are doing very poorly.
Right. And I mean, Macy's is trying to kind of turn things around. That's been the focus under Jeff Gannett. He is leaving in the next year, and the head of Bloomingdale's, the higher end part of its business, is going to come in, Tony Spring, and come in and take over. And the idea is to make Macy's a little bit more luxurious, not the sort of bargain basement hunting through treasure trove that you might experience at a discount retailer. I mean, easier said than done, though, especially when you're starting to see weakness among that aspirational consumer. I should mention one of the improvements, by the way, coming in the textiles and housewares sector this month, adding, I think, a little bit to what we saw with Lowe's, maybe even Home Depot. People still willing to sell for their homes to a degree.
Jess, anything else you're looking at in this market? Again, kind of red and green on the screen.
I like to look at the equal weight ratio between staples and discretionary.
Okay.
So when you look at that, exactly, it bottomed at the last summer, actually. So when you see that, it's pointing higher. But obviously, when you think about discretionary, obviously including beyond just the retail names, have the home builders in there that have been on tear this year, travel-related stocks as well. But that tells you, because you'd want to have discretionary outperforming staples to tell you how investors are viewing the economy. So that has been pointing far higher here and continues to move higher. So that shows you more optimistic, especially when you look at the ECFC function, right? In the terminal, you no longer, even on a quarterly basis, you no longer see a contraction there for the economy. So Paul and I, whenever we keep interviewing people about, especially economists, about a potential recession, you're not seeing that there on a consensus perspective there when you're looking at on aggregate in the terminal right now.
I mean, again, the ECFC function kind of economic forecast. 2024 still a positive GDP, a year-on-year
Right.
0.8% is a consensus. So.
And you do equal weight to get the noise out of Tesla and Amazon, of course.
I was going to say, you know, some of the members of consumer discretionary versus consumer staples, a lot of that seems arbitrary.
Also, it's tricky because you do have Walmart and Target, as well as the dollar stores now in the staples category. Target and those dollar stores used to be in the discretionary category with Macy's and others.
You break them. I look at each index, right? And so in consumer staples, Philip Morris.
Right.
Is that because you need cigarettes?
Some people do.
Okay, but you don't need coffee because Starbucks is consumer discretionary.
It is.
But do you need coffee from Starbucks, or can you get it at
Well, you can get
Walmart
cheap,
/
trashy
grocery
cigarettes
store?
too somewhere, right? If you desperately need your smokes. You know, that's a brand also. I get what you're saying, but
negotiating index composition, that's probably not
right.
Well, I just think it's very interesting because they've switched a lot of them.
Right.
The MSCI controls this, or
Yeah, so it's the GICS changes there from S&P, and so actually Target moved because of its grocery sales percentage.
Which
that's
is only
what pushed it
20%
over.
of its business, though.
But it was high enough to where that's what pushed it over.
Okay.
And that's actually what had held it up in the pandemic when it had been performing well, and we haven't seen it do that as much. And that's been also a big factor because of the changes we've seen coming out of the pandemic.
Fascinating discussion of index composition here, courtesy of Bloomberg Radio. Simone Foxman, Jess Metten, they're all the smart people. They can talk about this stuff all day long.
Sarcasm is the lowest form of wit.
Is it? All right, you guys, thanks very much. We appreciate hearing from you guys here. Let's talk about the home building stocks, because why not? They're just ripping here. Drew Redding, he joins us. He's a home building analyst for Bloomberg Intelligence, and he's also the master of working from home. We certainly admire that. Drew, talk to us about the home builders. What's going on here? They got to build more houses because nobody's selling their existing house, and if the prices are just going crazy here. What's going on with the home builders?
Yeah, so the home builders have actually done well to step in and fill the void left by the resale market, where we have a historically low lack of for sale inventory. So that dynamic has funneled buyers towards the builders, and we've seen over the last couple of quarters their businesses really take off. We've seen strong order books from them, demand exceeding seasonal trends. That being said, we have seen rates, we checked before we came on, we're at about 7.5% now. I think the last time we talked, which was just last week, we're at 7.25. We're up more than 100 basis points since April. So we do think that if rates sustain at these levels, we're going to have to see the builders maybe push the gas a little bit more on the sales incentives to keep traffic coming through the door.
in terms of what they're building, how's the mix look right now? Because, you know, as Paul often points out, a lot of them seem to want to build the higher margin McMansions and not so much the starter homes that the kids need.
Yeah, that was certainly the case earlier in the cycle. Over the last couple of years, there has been a noticeable shift to the lower end of the market. We've seen a couple builders really transform their entire business model to cater towards the low end. So we do think that they're going to continue to try to make that business work, because if you think about the next several years, just from a demographics perspective, you have more and more millennials getting to what has become kind of the new normal age for first-time home ownership. That's really what's going to drive the market. So we do think we're going to continue to see the push towards the lower end of the market. And, you know, at the same time, building smaller square footage homes is one of the ways that builders are combating the affordability challenges out there.
So I'm looking at the chart for Toll Brothers. It just recently hit an all-time high here. I mean, this doesn't look like a cyclical business here. I mean, we got interest rates, you know, over 7%, and yet stocks are still doing well. What's kind of the investment call here from this point right now? Do I put fresh money into the home builders?
Yeah, so one of the things that's been driving the strength in the builders outside of just the overall demand environment coming from resales into the new home market has been the expected trajectory of gross margins. We've actually seen over the last quarter or so, pricing power has returned to the market, which when you think of how far prices have risen, it's kind of a scary thing. But we do think they're going to be conservative on price increases. But what we have to worry about now, as I mentioned, with rates increasing again, you may see a greater use of sales incentives, which could kind of erode that margin trajectory. So in the near term, you know, with rates at a cycle high right now, we do think that there could be some pressure relative to what we saw earlier in the year.
How about lumber? It looks like lumber had that really big move higher during the pandemic, but it's really fallen. How helpful is that to the margins?
Yeah, so lumber, the benefit from lower lumber prices, which as you would expect is the largest component for a builder in terms of construction costs, is benefiting margins this quarter, and it should over the near term. That said, there has been a little bit of a tick higher. So as you get into next year, that benefit starts to erode, and maybe it becomes a little bit of a headwind.
What can home builders do with rates? Are any of them offering deals on mortgages? Because if you look at bank rate right now, we're up over 7.5%.
Yeah, so this has been one of the primary factors driving the strength of the builders, is the fact that they've been able to leverage their financing arms and offer buyers low rates. So that's 7.5, or 7 to 7.5 we've seen over the last several months. For someone coming into a new home, that's probably somewhere around 5.5 to 6%, and it's really that 5.5% is what we've heard from numerous builders is kind of the sweet spot where buyers want to be and appear to be comfortable. Now, that being said, the headline rate has risen up to 7.5. We think we're going to start to see that creep up, maybe to 5.75 or closer to 6%.
All right, Drew, good stuff. It's a good story for these home builders. And again, the stocks are just ripping. Toll just hit an all-time high a couple of days ago. Drew Redding, home builders analyst with Bloomberg Intelligence, joining us here. And it's interesting. I mean, you see it all over. But to buy down that kind of interest rate, that's pretty a good incentive. I mean, if you're going to tell me I can get in there at 5 or 5.5%, and I see the bank rate thing at 7.5%, that's a good incentive.
Yeah, no, it's a great deal, and it's something that I just noticed myself. Looking through real estate sites and seeing advertisements. It's one of the ways that they can give themselves an advantage, but they have to have access to good financing as well.
Yep, and that's why I don't, these independent home builders, which is what I see generally in this part of the country, just tearing down homes, building new homes, that kind of thing. I don't know where they're getting their financing, and I got to think that's a challenge for them, and they don't have that flexibility to offer the home buyers. But so we'll see. But interesting to see the stocks have had a really, really nice run for the home builders, and you got to catch them at the right time is kind of whatever I've heard from the kind of a cyclical play. A couple of big drivers there, and obviously interest rates being one of the drivers. Looking at this market right here, the S&P 500 absolutely unched on the day. A little bit of a move down, 0.3% on the Dow. The Dow sitting at 34,350. NASDAQ, it's up about 0.4%. So no real direction when looking at the indexes. On the yields, 10-year Treasury, 4.32. The 2-year, 5.03% on your 2-year Treasury. This is Bloomberg. Let's get some company news right now. Lisa Mateo.
You got it, Paul. The biggest stock debut of the year could be coming out of the chip space. ARM Holdings, the British chip designer owned by Japan's SoftBank, has unveiled its filing for an IPO that could value the company at $60 to $80 billion. Bloomberg's Alex Webb has more on where ARM stands in the chip space.
Look, a lot of people say that ARM is one of the kind of core pieces of the chip industry, that if you believe in the long-term health of the chip industry, you have to be in ARM in the same way you might have to be in TSMC and the same way you might have to be in NVIDIA. They have been trying to strengthen their positionings in, for instance, data centers. Whether it can continue to grow at the pace that it was 5-6 years ago, even before it was acquired by SoftBank in 2016, that is a bigger question.
And since we're talking chips, we'll check in with shares of TSMC right now. They're up just a fraction. NVIDIA shares right now, they're down about 1.5%. And Google's YouTube and Universal Music are joining forces with artists, including the estate of Frank Sinatra, to take on artificial intelligence. Bloomberg's Kimberly Adams has more.
The newly formed Music AI Incubator will explore and offer feedback on AI-related tools with the goal of getting more artists involved with the technology and help prevent the use of voices, instruments, or likenesses without their authorization.
And shares of Alphabet right now down, up about 1%. And Zoom says it sees better profits and sales ahead. It's planning to sell more products to large businesses, everything from customer service systems to chat features, fueled by advancements in artificial intelligence. Now, the company has already invested in AI startup Anthropic and said it would acquire WorkVivo as well. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Right now, stocks struggling for a direction. Major averages, they have turned mixed. NVIDIA, that's been bouncing around after its 8.5% rally yesterday. Analysts say they had better meet their $11 billion sales forecast. Otherwise, could be a chance of a nasty correction. National Association of Realtors saying sales of the previously owned homes falling 2.2%, an annual rate of 4.0 per million in July. That is a 6-month low. Right now, the S&P 500 2 points higher. That's at 4402. The Dow Jones Industrial average 99 points lower. That's down 0.3%. The Nasdaq 100 still up 53 points of 0.4%. The 2-year yield 4.33. The 2-year yield 5.03%. The 10-year is at 4.33. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Matt and Paul.
Okay, John Tucker, thank you so much. We appreciate that. You know, Matt, I don't know about this whole, yield curve thing. It's, I'm an equities guy, so this is kind of something new for me. But Lisa Abramowitz has been schooling me for years on this. And the latest thing she says I have to focus on is this real yield for the 10-year hit 2%, the highest in a very long time, I think since 2009. What does that mean? I don't know. So I'm going to ask somebody who's smart about this kind of stuff.
This is what the Fed wanted, right? They said they wanted to get real yields positive. At the time that Powell was complaining about it, they were negative.
Yep.
And now they're way up there. So the question is, are they then able to achieve their goal of reducing inflation to 2%?
And let's ask somebody about that. Jay Hatfield, he's the CEO and founder and portfolio manager of Infrastructure Capital Management. He's been kind enough to join us here in our Bloomberg Interactive Broker Studio. So, Jay, talk to us about your call on inflation. I got this real yield thing at 2%. That's the highest since July of 2009, so that gets my attention. What's going on out there?
Thanks, Paul and Matt, for having me on. Well, we actually think that the Fed is a little bit of out of play right now.
Okay.
So in other words, they may or may not raise one more time. We don't think they will. There was a story in the Journal today, but we did some data in preparation for this. The labor market's really weakening. About 60% of jobs added are in the medical sector. And we all know that that's more of a secular increase than cyclical. And also wages are attenuating. So I think that data, we don't think the Fed's going to raise. They don't know that yet, but they're going to get some more data, particularly on the labor side, even though that doesn't really matter, but that's what they focus on. And also, inflation is going to gradually cool. The measurement of inflation already has cooled, but the measurement of inflation will continue to cool. So we're optimistic that the Fed will not raise again, but we're very concerned about the ECB, in case you want to talk about that, because we think that's critical to.
Well, let's get to that, but I do want to talk about your view on inflation, because you have your own index, CPI R. I'm looking at it on the infrastructure, on infracapfunds.com on your website. How do you see this working out in terms of inflation? Is it really going to come back down to 2%? And is that going to be anytime soon? Maybe they hike one more time, but do we hold at that level, or are you worried it bounces back?
Well, the two things to focus on in terms of potential bounce back are energy prices and housing prices. So energy, we do a lot of work on that. We think that we're kind of stuck in this 75, 95 range. And also in the fall, it should weaken up. So we're not worried about energy. And also it's important in the US, we have natural gas that trades at the equivalent of about $18 a barrel. So it's highly deflationary here, not true of the rest of the world. Rest of the world, natural gas trades roughly BTU-wise the same as oil. So we're not concerned about that. And I think the chances of housing prices taking off like a rocket when mortgage rates are 7.5% is close to zero. So we're not concerned about a re-acceleration. And then we know that the current measurements for CPI and PCE are flawed because of their shelter component. And also, we don't like PCE because it has 20% medical. But I would say we don't stick this on our website, but we calculate PCE-R, so that corrects for shelter. And that's only at 2.6% right now.
And well, CPIR is only 1% year over year, right?
Correct. Yes. So we think inflation's already behind that problem behind us, and no signs. You know, again, looking at the forward indicators, because we were massively concerned about inflation early 21. So we think that's behind us. Whether the Fed raises one more time or not, we don't think is that critical, but we do think the global tight monetary policy is an issue, and I think that's what is driving long-term rates up right now.
So, all right, let's get then to Europe. What's the inflation picture look like to you over there? If it's subdued here, but you mentioned we have deflationary natural gas prices, and of course they don't. How does inflation look to you on the continent?
Well, I think that is a real problem because they've had an enormous increase over the last 2 years, and they're less competitive. But our biggest concern is that global monetary base, and we will publish this on our website as well, although you can get the data. You can just, if you can add, you can get it on the terminal as well. But it's still good to publish it because even I haven't focused on it enough. Dropped by 700 billion in the last 2 months, which is an enormous drop. That's at 3%.
Now, what dropped by 700?
The global monetary base.
Okay.
So the global central bank sucked out $700 billion of capital.
And we've seen M2 fall here as well.
Right, yeah. So those are a little bit more lag. But if you look at I would suggest look at the monetary base because that's the leading indicator because it's the major component. And I would also say don't ignore this. So I made a good call to at least our clients. When the Fed intervened, I said, okay, that's a sign. Back in the pandemic, they're adding, 1.2 trillion of capital to the capital market every year. That's just enormous. That's like Warren Buffett, putting his 100 billion to work 10 times. So I wouldn't ignore the monetary base and those radical changes in particular. So if they're small, you can ignore them. So we think that's the key driver behind this big rise in rates. And we did that work because really, frankly, our call was they were going to drop and it was dead wrong. So we said, well, how can this be? And that's when we discovered, because we should have been tracking it as well more closely, that the ECB has just done this massive QT, and that affects all rates in the world. If you look at it, our bond is 85% correlated with all the benchmark bonds. So coming up with an explanation just focused on the U.S. is not going to be correct when you're talking about the world bond market.
So what happens to interest rates? When can I refinance my mortgage at a lower rate?
Paul is single-minded and focused on the high mortgage rate that he got. It's adjustable, though, because he was figuring at the time, well, next year I'll be able to refinance at a lower rate.
Yes, so I have adjustable rate mortgages as well, so I'm very focused on this. But I don't think that we're going to get any relief till probably mid next year because the Fed's about a year behind what they should be doing. So they should have cut when the banking crisis started. And that is another reason why they should pause, and I think that maybe even they'll figure this out, is that the banking system is under pressure, being downgraded. They were downgraded this morning. They should be focused on that. So I think we'll get relief next year. But the thing to watch, and the reason that we're sticking with our bullish call on interest rates, is that we do think that the European economy is going to crack. They have mostly floating rate mortgages, way more than they do in the United States. They have this natural gas problem. Germany is levered to China, and their ECB is a single mandate central bank. So they're going to continue to tighten really probably till their economies crack. So I think that's when rates will come down, long rates will come down, when it becomes more obvious that Europe is headed into a recession, which is our call that they're almost certainly going to probably even a substantial
Despite
recession.
all the Americans over there traveling?
Yeah, that, at the margin, that does help.
Okay.
Yeah, the U.S. definitely does prop up the rest of the world, but still, when you think about all those factors are negative, then what is the bull case for Europe?
So how about China? Just because we've been talking a lot over the last several weeks, reporting on the weaker than expected economic data out of China. How do you kind of view all that?
Well, with regard to oil, which is what we mostly focus on China about, is that the thing to keep in mind is that, of course, reporters have to write stories. So why is oil down? We talked to them about this. Oh, it's because of China. Well, that's usually not the case. They have very slow growth in oil demand that's very sticky. So we don't think that demand's going to drop. But we also think that could be positive for long-term rates because the Chinese central bank is definitely going to cut rates. There's a disappointment when they cut last time, but they're going to continue to cut rates. They've really hammered their economy through regulation. It's a good example why maybe capitalism is superior to communism. And so when you do that, it hurts economic growth. And so they're going to offset it with monetary policy, and that should also be bullish for long-term rates.
And I'm just reading your notes here real quick, 30 seconds. Fourth quarter for the stock market, S&P, range of 4,500 to 5,000.
Correct. Although I would say that that's dependent on rates at least stop rising, as fast as they have been over the last month or so.
Okay. And anything added, Jackson Hole?
We think it's going to be a non-event because the Fed's already signaled what they want to do. They have the dot plot, and we know there's a dovish camp so that we won't get a repeat of last year where Powell comes out and kind of talks the market down.
Right. Interesting. All right, Jay.
So you don't think there'll be a hawkish bent?
Little bit, but not anything significant like it was last
Nothing
year.
to write home about.
All right. But let's send the team out there anyway.
Yeah,
why not?
Two teams.
Yeah, sure.
Yeah.
Jay Hatfield, CEO, founder, and portfolio manager, does it all. Infrastructure capital management, one of the smarter discussions Matt and I have as we try to think about these markets and navigate through these
And I like
markets.
his website, infracapfunds.com.
Boom, there you go. Go check it out. Right now, let's head down to Washington, D.C., world and national news with Amy Mars.
All right, thank you, Paul. Trump attorney John Eastman, who pushed that plan to keep Donald Trump in power, has turned himself in to authorities in Georgia. Eastman has been booked at the Fulton County Jail. He's also been released. He's charged alongside Trump and 17 others. Trump himself says he'll turn himself in on Thursday. A new poll shows more than half of voters likely to attend Iowa's Republican caucuses believe Trump's false claims that he won the 2020 election. The survey by NBC News and the Des Moines Register found 51% of respondents believe Trump, 41 don't, and 8 say they just don't know. More cities are making room for asylum seekers as the debate over busing migrants heats up. Reverend Cindy Jacobson in Massachusetts says churches are now collecting baby formula, diapers, and some cash donations.
The response was overwhelming. And coincidentally, our lessons on Sunday had to do with welcoming the foreigner in our midst. It was perfect.
And state workers are turning a hotel in Woburn, Massachusetts into an emergency shelter for migrants. A federal judge in Texas hearing arguments over the so-called floating border wall. Critics say the string of buoys meant to discourage illegal immigration is nothing more than a political stunt. Democratic Congressman Henry Cuellar of Texas says the state will eventually have to take it all down.
It's a federal responsibility. The Supreme Court has already said when they took up the case in Arizona that it's a federal responsibility.
Texas moved those buoys closer to shore to address concerns that they're floating in international waters. A heat wave sweeping the Midwest is threatening to dry out grain crops in the final few weeks of this growing season, putting a bumper U.S. harvest at risk. Temperatures are forecast to reach as high as 115 degrees in parts of the Midwest this week. The global food supply is increasingly dependent on the U.S. harvest. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg.
Bloomberg Television. Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Major averages right now, they have turned mixed, a little change. In the S&P 500, you have the financials. Right now, they're the biggest drag after the S&P, that is, joined Moody's Investor Service in cutting some lenders in the U.S. And on the eve of its quarterly report, you have NVIDIA shares. They've been bouncing right now down close to 2%. So where should investors put money to work? Jill Carey Hall at Bank of America Securities is looking at consumer discretionary stocks.
If we are moving into more of a recovery environment, if the Fed is done hiking soon, that's usually when the consumer discretionary sector tends to start to work.
Traders also watching the catalyst later in the week. That's when the Federal Reserve Chair Jerome Powell is scheduled to deliver the speech in Jackson Hole. Now, at least according to the MLI Pulse survey, Powell's commentary widely expected to be hawkish. Right now, the S&P 500, I'll call it unchanged, 43.98 on the index. The Dow Jones Industrial Average, 99 points lower. That's down 0.3%. The NASDAQ 100 in the green, that's up 24 points. That's up about 0.2%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney here in our
He was out getting food.
Interactive Broker Studio. Yep. No, there's no food in this studio.
I was getting
water.
water.
Do such a thing.
Oh,
yeah,
well, you know,
only
that's
water,
more
Anthony.
dangerous because you could potentially pour it on the electronics accidentally.
Well, he's got the lid on the cup. I think he's in pretty good shape. I'll vouch for him. Let's get right to our next guest, Brian Crawwez, president of Sharp Investments. And this guy is all in at Berkeley. He gets his undergrad from Berkeley, then his MBA from the Haas School at Berkeley. Unfortunately, the Cal Bears do not have a conference. Where are you guys going, Brian?
The rumor is that there might be a meeting today on the ACC, so we'll see. I think flying across the country is going to be a little unique experience, but yeah, the Pac-12 is down to the Pac-4, so we'll crossing our fingers we'll land
It's
somewhere.
unbelievable what happened. Anyway, I'm a Duke guy, so I would welcome you, and Stanford be a great addition. And but yeah, it's crazy. I mean, you can fly the the women's field hockey team across the country. Where's the revenue to support that? I have no idea how that all works. But Brian,
it's crazy. Yeah, we're crossing our fingers. I was just on campus yesterday. They're optimistic. We're going to find a home soon. So
all right. Yep. Love to have the Cal Bears. As long as you guys continue to play Stanford every year, that's kind of all we care about. Brian, what are we doing with this market here? I don't think I was really fully invested in the Magnificent Seven stocks that just ripped so far year to date. So I'm kind of left with so performance. I got yields pushing higher. What's your call here on this market?
I mean, what's interesting, we took a look back over the last 30 years, and if you look at the average stock within the S&P 500, so the S&P 500 is 500 companies. Obviously, it's market cap weighted, so the return of the S&P 500 index is not the same as the average stock. The average stock actually outperforms by about 0.3% per year on average over the past 30 plus years, and that makes sense because you got smaller companies in there. Smaller companies tend to grow faster. So you get a little bit of a return premium for owning the average stock. This year, though, is the worst since 1999. The average stock's outperforming,
I remember what happened there.
The S&P 500 by about 11%. So we think there's a lot of opportunities within the average stock, but we'd be careful of kind of those Magnificent Seven and kind of the index more broadly. What's interesting is if you look at the next 5 years after 1999, the average stock went on to outperform, by about 8.5% per year over the index. So we think it's a good time now for investors to be looking outside of the sort of common theme of investment that you're hearing from most people.
So you're basically saying active beats passive in the future, I guess midterm future.
We would think so, yeah. If you're not sort of concentrated in those big names, everyone's holding their breath for NVIDIA, for example. But while NVIDIA is a great company, the expectations built into NVIDIA are substantial. So you need to see really great growth over the next 5 years to justify the price. Where there's a lot of stocks that are trading at much lower multiples with much lower expectations that'll probably outperform in the end.
All right. So what are some of the individual stocks that you like if not the big magnificent seven.
Yeah, I mean, you talk about AI, right? And you think about all the need for all the internet and broadband and stuff, and sitting in plain sight is a company like Comcast. Comcast is trading at under 10 times. People think of it as a cable company, cable TV. They're all worried about cable cutting of cable. And in fact, it's really the broadband that's driving the business. Broadband continuing to hold up. They're actually growing their wireless subs, pretty nicely. And so we see Comcast continuing to grow earnings at double digits, and sitting there trading at 10 times earnings.
That's interesting because it's a name I know well, and I'm just wondering. We've got, as you mentioned, cord cutting, so that that they haven't led with their cable business for a long time. They've been leading with their broadband business, but they're facing a lot of competition in the broadband space. Is that still a growth driver there for Comcast and some of the other cable companies?
Yeah, there's some of the wireless companies now have kind of fixed wireless, and in some markets that makes sense, but it still doesn't have the broadband capacity of.
What VR use cases are there in healthcare?
Physical therapy. Like, let's say there was a patient that had wrist surgery. They would actually see in the goggles and visualize trying to catch the butterfly, right? Get that movement going in your wrist in a way that is enjoyable for the patient.
Which, a lot of the telcos have. That's going to be an additional cost for them, which will make it harder for them to continue to build out fiber and actually compete with the cable companies. We just think that the cable companies, both Charter and Comcast, have a core advantage over the wireless competitors, and so ultimately we think they'll continue to be able to grow profits in the broadband side.
By the way, I'm just looking at a breaking headline here. Marks and Spencers and Diploma are two companies that are going to join the FTSE 100 index. What do you think about international investing? Do you solely focus on the U.S.?
No, we do international. We have Global Fund. We do international investing. If you look at, I think most commentators would tell you that international stocks are a lot cheaper than U.S. stocks. And outside the U.S., we are finding names. In fact, Baidu is a name we own that they reported today. 15% sales growth, beat on revenue, beat on earnings. Trading in under 15 times calendar 2025, has a leadership position in autonomous driving in China. Also has their Ernie bot, which is going to come out and compete with ChatGPT. But yet it's trading at a low multiple because it's in China as opposed to being in the U.S.
But that makes sense, right? I mean, you never know what they're going to do. They could decide to regulate that company out of existence if they wanted to.
It's certainly possible. Certainly that is a risk that investors have to consider. I would point out, though, when you look at the big indexes, there's Tesla, Apple. Those are companies that are fairly dependent on China growth for their long-term growth outlook, and they're having very, very high multiples. So there's a little bit of a bifurcation in our mind in terms of how investors, if it's direct in China, investors don't want to touch it at all. But if it's a U.S. company with China exposure, investors seem to not be that worried about it right now.
You've got a name on your list which I didn't even know was public, but it's a name everybody knows, U-Haul.
Yeah.
Talk to us about that company and that stock.
So U-Haul is one of those companies that we love. It's a company that everyone knows, great brand name, dominant position, really hard to compete with. And yet the stock is under the radar. It's not big in indexes. There's the founding family owns 50% of the voting shares. So liquidity is lower than a lot of stocks, and it's not widely held in the indexes as a result of float being lower. But to give you a quick snapshot on the truck business, they've developed all of these independent networks as well as company-owned stores. And so you really can't compete with them. There's nobody with anywhere near the size and scale of their network. And on top of that, we've talked to the company, and to build out a truck-only facility now is basically uneconomic, given how cheap they can rent these trucks for. What a lot of people don't realize is they also have 82 million square feet of self-storage. And there was a couple of deals recently. Public Storage bought Life. There was a Life Storage deal. And if you look at the price of that, it was about $200.
Interesting. Okay. Hey, Brian, you're going to have to leave it there just in case of time. Brian Crow is president of Scharf Investments. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it. Shares of Dick's Sporting Goods are falling right now. They are down about 23%. And this after the company cut its profit outlook for the full year. Now, the retailer has been dealing with slowing growth and more theft at its stores, and it's now making some staffing adjustments. Bloomberg's Gina Cervetti has that story.
Now the retailer has laid off about 250 employees in the corporate offices. A source tells Bloomberg that retail workers were not affected by the cuts, and some of the savings from the layoffs will be used to hire workers in other areas.
Now, cutbacks are hitting a major brokerage as well. Bloomberg's Scott Carr has that report.
Charles Schwab is planning to cut at least $500 million from its staff, its professional services, and real estate costs. It appears to be the latest step by the brokerage to respond to pressure from investors as it continues to integrate TD Ameritrade into its business. Charles Schwab acquired TD Ameritrade in 2019.
Now, shares of Charles Schwab right now down about 4%. And Walgreens has agreed to pay $16 million to settle a whistleblower's False Claims Act suit alleging overcharging for generic drugs. Whistleblower Jay Douglas Strouser had claimed that USA Drug, which is a regional pharmacy acquired by Walgreens, overbilled Medicare and Medicaid millions of dollars by charging more for generic drugs than the regular prices that are paid by those without prescription drug insurance. Strouser will receive 29% of the federal government's recovery. Right now, checking in with shares of Walgreens, they are down just a fraction. Those are the company's stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio in New York City. Bloomberg World HQ, 59th and Lexington Avenue. The S&P pretty much unchanged on the day. Dow Jones off 0.3, NASDAQ up about 0.1%. 2-year Treasury spot on 5% right there. The 10-year Treasury off about 2 basis points, 4.32%. WTI crude oil, it is absolutely steady, $80.73. So we've got some oil, definitely higher than what it was. And we're going to talk about gasoline because that is a lot higher. And that's got my attention as you drive around here towards the end of summer. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Mars.
All right, thank you, Paul. Trump attorney John Eastman has turned himself into the Fulton County Jail. It's part of the 2020 election interference case in Georgia. He was booked and then released. He agreed to a $100,000 bond yesterday. Eastman is one of 18 people charged in a sweeping racketeering and conspiracy case, including former President Donald Trump. Trump says he'll turn himself in on Thursday. All 18 have until noon on Friday to surrender to authorities. New York Congressman George Santos is calling for the border to be closed while protesting an asylum seeker shelter in Queens. This was earlier this morning.
We have homeless people through the wazoo in this country. Homelessness is a crisis in America, and yet we're taking in more people and diverting resources and diluting resources away from Americans.
Santos is calling on New York City and federal officials to put migrants in Democratic districts where he says people voted for policies that led to the crisis. Tropical storm Harold is crashing into the Texas coastline, bringing some much-needed rain to Brownsville. Cameron County Judge Eddie Trevino says they're expecting about 3 inches.
Just like the entire country, we're in dire need of water. So hopefully it won't all come at once.
Judge Trevino says there is no flooding, not yet. The Biden administration will start accepting applications today for a new income-driven repayment plan, a fresh effort to shore up student loan borrowers facing a cliff as the pandemic-era benefits end. The so-called Saving on a Valuable Education, or SAVE plan, is meant to disproportionately focus on low-income borrowers, calculating payments based on income and family size, not so much your loan balance. Officials said borrowers' monthly payments could be reduced to nothing. Others should save about $1,000 a year. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Amy Morris, and this is Bloomberg. Matt and Paul.
All right, Amy Marsh, thank you so much. We appreciate it. Matt, we're just calling out WTI crude oil at $80.73 a barrel. Gasoline prices. Regular gasoline now stands at an average of $3.85 a gallon. That's just 5 cents below last year, but it's the second highest seasonal level in records going back to 2008. We need more refineries, dude. That's my call.
Yeah, I mean, it does seem like that when you look at the gap between the pump price and what you're paying for a barrel of oil. We did have, though, low inventories. That was one of the problems. And, of course, refinery operations are hurt by
hurricanes.
Record heat.
Record heat, right. Okay, yep.
So that's, this is the kind of thing that, who was talking to us about this yesterday? Claudia Sahm was saying that heat is problematic, and she's written a Bloomberg opinion piece about it as well for the U.S. economy. Add the hurricanes or the storms that we see to that as well.
Yeah.
And it's a real problem. We need more refining capacity, and probably in different places than it currently is, which is going to mean more pipelines.
Right, and that, A, almost impossible to build a refinery. B, same thing goes for a pipeline.
Yep.
So you got the Caribou and all that kind of stuff. But I don't know. It just seems like, the whole thing just seems, a little bit risky, particularly when you think about what's happening over in Europe, with, no longer really having access to Russian fuel. And I'm not sure when that changes, if ever. So
I mean, they have access to it, right? They just have to do this silly thing where they pretend they don't buy it, so the Indians buy it, and then the Indians refine it, and then they sell the refined product to the Europeans.
That's right. So that's how it works. So we'll keep an eye on that. Again, regular gasoline, $3.85 a gallon across the U.S. A little bit cheaper down at the Jersey Shore, but not much. And people still got some driving to do this summer, so paying attention to the price at the pump. We're going to have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to talk about the regional banks here. Herman Chan and Arnold Kokuda, they're both from Bloomberg Intelligence, so they're smart folks. S&P just downgraded the banks. I guess it's better late than never, but we'll check in with the smart folks who do this stuff for a living. Jennifer Rhee, she's a senior antitrust litigation analyst. Microsoft, Activision, is this deal getting done?
Looks like it's going to happen.
I think so. Looks like the UK folks are going to re-look at this thing. And then we're going to talk about private credit, one of our favorite areas, one of the really fast-growing areas within Wall Street. Jackie Ward, Director of Private Investments at UMB Bank, will join us to talk about the private credit business. But first, let's kick things off with Charlie Pellet.
Hi, thank you very much. And here's what's going on. The Dow, the S&P lower, NASDAQ higher. Do want to begin with the headline right now on the Bloomberg Professional Service X. JP Morgan gold trader Greg Smith gets 2 years for spoofing. The headline right now on the Bloomberg Professional Service. Stocks, for the most part, trading lower. We have got stocks struggling to find solid footing after a technical rally in big tech. Traders bracing for NVIDIA's results tomorrow, which are set to test Wall Street's fervor around the artificial intelligence hype. We have got the S&P now lower by 6, down 0.1%. The Dow down 132, drop there of 0.4%. NASDAQ, though, in the green, up 32, up by about 0.2%. 10-year yield at 4.32% with the 2-year, 5.01% right now on the 2-year. Spot gold up $3.50 the ounce to $18.98, up by about 0.2%. And West Texas Intermediate crude, just talking about refineries, little changed, up 1 cent right now, 80.73 for a barrel of WTI. So we've got NVIDIA tomorrow, but has the stock gotten ahead of itself in the run-up to earnings? Ashwin Alankar is Global Head of Allocation and Risk Management at Janus Henderson, and he was a guest right here on Bloomberg Markets.
Right now, the rage, and there could be a bit of over-exuberance here, is in the catalyst of artificial intelligence. And you're seeing names like NVIDIA, names like Microsoft, names like Oracle, Google, really, reaching new highs. And that might be putting the cart a bit ahead of the horse.
And again, NVIDIA shares trading down by 2.6%. He mentioned Microsoft up 0.6%, Oracle down 0.3%, and Alphabet right now higher by 1.3%. So it is a mixed Tuesday here. The Dow, the S&P, they are both lower. NASDAQ is advancing up 38 points right now for the NASDAQ Composite Index. S&P down 5, a drop there of 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Matt Miller, Paul Sweeney, coming to you live from the Bloomberg Interactive Broker Studio. We are also streaming live on YouTube, so just head over to youtube.com and search Bloomberg Radio. Let's take a look at what's happening under the hood with these equity markets today. We can do that with Bloomberg Equities reporter Nora Melinda. Nora, what are you looking at today?
So the market is definitely in a different place than it was a couple hours ago when I joined you both. But looking at some banking stocks, we're seeing banking stocks underperforming the broader market this morning as we're moving into the afternoon. And that's after S&P Global Ratings joined Moody's in downgrading a handful of lenders. KeyCorp is down. That's one of the ones that it lowered by a notch. Commercia, Valley National Bank Corp, UMB Financial Corp, and Associated Bank Corp. KeyCorp and Commercia have been some of the worst performing stocks this year in the banking index. So those are some interesting moves happening this afternoon.
And was this just the macro stuff that we kind of know about?
Yeah, it's really just the impact of higher rates and deposit moves across the industry. That's mainly what the S&P is citing.
We're going to talk to Herman Chan about that.
Yeah, we're going to have Herman Chan and Arnold Kokuda from Bloomberg Intelligence coming up in just a moment. So we'll break it all down.
Definitely.
And financials are the worst performing industry group on the S&P 500 right now. One of the big gainers is real estate. Another one is consumer discretionary. I guess the housing data that I mean, looked bad, right? Existing home sales were less than we anticipated, but that's good for new home builders.
Definitely. It will make them really perform well. I mean, of course, home builders are building off of the fact that they don't have as much competition, and it allows them the opportunity to take market share from existing homes. So they really have an open runway to really rally and continue to build. And especially since there is still demand for people who are looking for housing, there's a lot of places where, there's limited housing inventory. And so they're able to up prices. Some of them are even pulling back on the incentives that they used to have as demand remains high.
Yeah, stocks have been. We had Drew Redding on from Bloomberg Intelligence earlier, who covers the home builders, and the stocks have done great. The backlogs, remain pretty strong here, and they are trying to, entice some first-time buyers with buying down some of that mortgage, maybe at taking your 7%, 7.5% in the marketplace right now for a 30-year, and maybe offering you 5.5%. So that kind of incentive. How about some of the retailers? They continue to kind of report some results today.
Yeah, so over in the retail space, I'm looking at Dick's Sporting Goods. That stock's declined more than 25% today for its biggest intraday drop since 3 years ago, back in March 2020. Essentially, the company missed its sales and profit for the second quarter, and it cut its profit forecast for the full year. A lot of that is due to shrink, which is an industry term that focuses more so on the theft and the employee theft, damaged goods.
So it really is materially higher than average, right?
Yes.
Okay, because I see the videos on social media, and I don't know if that's just, here or there, but it's really just a
sensationalism.
Yeah, but it's a real thing.
Right, everyone's...
We hear from multiple retailers.
Definitely, and we are seeing more of an uptick of that happening in the past year. So,
what do they call that? Inventory slippage or something?
Shrinkage.
Shrinkage.
That's right. Not like George Costanza, but
not like George.
Although it is at Dick's. Looking at them over a 5-year period, they still have done relatively well. I mean, Dick's is up 250% over a 5-year period.
Nice.
Even with today's drop.
Wow.
That's insane, right?
Well, that's a pandemic stock, don't you think? I mean, weren't people going out and buying stuff?
It did really do. I mean, it got hit hard, obviously, at the beginning of the pandemic, and it had come down substantially, but it did rise a lot. And I've noticed in a lot of malls around the country, you had previously Dick's with other competitors like REI, for example, in the Ridge Hill Mall in Westchester, New York, and REI's out of there.
So okay.
Dick's is the last man standing.
A standalone store.
Yeah, no, I mean they were next to each other. Is my point.
Oh,
so
I see what you're saying.
you had REI, you had LLB, and you had Dick's, and now it's just Dick's.
Okay.
Wow.
All right. Interesting. And Nvidia's after the close tomorrow, right?
Definitely, all eyes are on NVIDIA. It's really been moving the market as investors are really anticipating their earnings tomorrow. Stock was up at the open, but now it's down almost 2% after hitting that earlier record intraday high. Tomorrow will really be a testament as to whether or not the AI hype may last.
I'm going to pay attention to that. That's for sure. Nora, Melinda.
It's tomorrow after the bell.
Yes.
Yes.
So, but is it, when you say you're going to pay attention, does that mean you're going to turn on the TV or turn on Bloomberg Radio on Wednesday night, or are you just going to read in early on Thursday morning?
I'm going to have my phone at 4 o'clock to see the print, and then I may even listen to the conference call.
Set a timer.
Yeah.
Wow.
Because I think this is going to really. It has moved the market this year. Since they reported the quarter,
for sure.
And I think it's going to have it could have an impact.
And the CEO is kind of a superstar. He's a big leather jacket guy.
Yeah, I didn't know him until this all burst onto the scene. All right, Nora, thanks so much for joining us. Nora Melinda covers all of the equities for Bloomberg News. All right, let's get this banking thing. We got S&P coming in, better late than never, I guess, kind of saying, hey, there's challenges for the regional banking sector, and they take down some names here. Let's break it down with our experts. That would be Herman Chan, and that would be Arnold Kakuda. Herman joins us live here in our Bloomberg Interactive Broker Studio. Arnold Kakuda making use of the Zoom functionality out there. He joins us as well. Arnold, let's start with you on the credit side. Where do you see kind of the pressure that we're seeing across the regional bank space in the credit side?
Yes, I think some of these actions by Moody's and S&P, I think just gives us a reminder that this, now I guess I wouldn't call it a crisis anymore, but, these issues still exist where there is pressure on these banks and their balance sheets, right? Funding costs are rising, deposits have fled. Yes. So I think a lot of these things that the rating agencies are coming out with now are, yeah, it is backward looking, but it is a reflection that all things aren't all fine and dandy in regional bank land.
So if I wanted to go out, I'm a regional bank, a reasonable credit quality, can I go out there and raise capital in your credit markets? And if so, like, am I going to really have to pay through the nose?
Oh, I mean, the before March, regional bank debt, it was, we're in a totally different world. It used to be they trade really tight and you couldn't get enough of it, right? And it trade tight for the credit rating. Now we're in this opposite world of, it trades wider. I mean, things have, gotten better, obviously, since the heydays of March and May. But, compared to before, spreads are wider. And a lot of these will be hit with new debt requirements. So we expect debt issuance to pick up for a lot of these. And we have seen a couple of regional banks tap the market. We have Charles Schwab today. And then we had, Huntington and PNC come, in the past week or so. So it is available. If the debt does come, with some a little bit meat on the bone, let's put it, then there will be demand.
Herman, what do you think about the the banks that were specifically downgraded by S&P? You've got KeyCorp, Comerica, Valley National, UMB, and Associated Bancorp.
Right. So I would say that the issues that the rating agencies have highlighted, a couple of them, KeyCorp, Comerica, they're facing some weaker net interest margins than some others that in our peer group. That's really driven by some higher deposit costs. They actually, these two banks in particular, have mishedged their balance sheet a bit, where they were expecting interest rates to decline potentially next year, and it seems like we're in a higher for longer environment. So that's actually crimping their margins a bit more than some others.
Is the deposit flight the kind of thing that's still ongoing? I was actually at a cocktail party.
Shocking.
I think like 3 or 4 weeks ago.
Okay.
With a group of ladies talking about how they got high interest rates in this one bank account, and I saw one woman just over the course of a conversation at like 6 p.m. on a Saturday say, you know what, I'm just going to move like $100,000 from my savings account and my bank that I've always used into this. I can't remember if it was the Goldman Sachs account or some other, but 4.5% yielding savings account, and just boom, done.
Right. So what we've seen since the fallout in March and April is that the deposit balances have actually stabilized across the industry, and how that's happened is they're just paying up for those deposits. So you're seeing high interest savings accounts, high yield savings accounts, approaching 5%, even above 5%, CDs above 5% for a 1 year term, 15-month term. So that's really the gist of it. The banks are paying up, and that's really crimping net interest margins and pressuring profitability going forward.
Arnold, are you seeing any investors come in your market and saying, boy, I see some real value here in some of these bonds?
Well, I mean, I think, definitely for, in a market, let's say until from May to August, right? It was a classic risk on, treasury yields higher, spreads tightening. And in a world where everything seemed to be pricing to perfection, one of the things that were still cheap is kind of the regional banks, right? And given what they went through. So yeah, I think there is a lot of demand for regionals, but I think at the right price, right? And if you look at credit spreads now, where they are, tighter, if you would have woken up today versus, not knowing what happened from all of this year, you wouldn't even know that there was a banking crisis this year, right? Given how things have recovered. So, I think at the right price, there'll be demand, but things have, we've had a bit of a kind of, everything sell off in August, right? That's coincided with these rating downgrades, rate negative outlook cuts. But I think things had been pricing a little bit for perfection. But I think if these new issues come to market with a little bit of meat on the bone, then I think you'll see investors step up and go for it.
The stocks haven't really recovered, Herman. If you look at, if I look at KRE, for example, which is the regional S&P, Spider S&P regional banking ETF, it's still at the same levels that it hit after the big problems that we had, the drop that we saw in March.
Right. The stocks have rebounded a bit from the lows back in April and May, but still well below pre-SVB fallout. So,
I mean, the KRE dropped to 44.5 on March 13th, and right now it's trading at 43.60.
Right. Valuations are really reflecting the tough environment that Moody's and S&P have articulated. So, tougher profitability, weaker lending, regulatory requirements are going to increase, and we still haven't really seen the shoe to drop on the asset quality side, in particular office commercial real estate, quite yet. So there's going to be a lot of headwinds, and the banks will just need to navigate that, and any upside really is going to be dependent on where interest rates go and potential cuts down the road.
So Herman, what do we know about the regulatory changes coming along?
Mm-hmm. So the regulators and the Fed have put out a 1,000-page document that outlines some changes to the regulatory requirements for particularly the largest banks and the largest regional banks of $100 billion and above. That's really focused on tightening how capital ratios are calculated, including unrealized losses in the securities portfolio, in the AFS securities portfolio, into capital calculations, increasing the debt stack, as Arnold mentioned a bit earlier. But there's still going to be some other areas that the regulators are focused on. I recall during the SVB crisis that uninsured deposits was a big thing. So the FDIC is looking at that. And then the Fed's also going to come out with some regulatory issues on liquidity as well. So there's still more down the road. And so the banks will just need to have to manage through it.
All right, guys, really appreciate getting the update there. Again, S&P following Moody's and downgrading some of those regional banks. Really nothing new in kind of what they're doing, but simply kind of reflecting kind of what I believe the market's known for some time. Herman Chan, Arnold Kokuda, they cover the regional banks, all the banks on the regional side for Bloomberg Intelligence. Arnold on the credit side, Herman on the equity side. So we got you all covered there on the regional bank space. S&P 500 off about 0.3%, so a little bit weaker. Dow off 0.5%. The NASDAQ kind of hanging in there, kind of flattish on the day. No real change there. DXY index, that's higher today, so the dollar a little bit stronger. 2-year Treasury yield, 5%. How about that? This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Labor deal that was reached with its pilots yesterday will not hurt its outlook for the year. The $9.6 billion pact is the most expensive labor contract ever for a U.S. carrier. Bloomberg's Mary Schlangenstein spoke with Bloomberg Surveillance.
Well, American had been accruing for the cost of the contract. They did put out a statement this morning saying that it's going to boost their unit costs because there's an extra amount that was agreed to when they renegotiated this tentative agreement that they had. So that's going to increase their unit cost about 2 percentage points this quarter. But for the full year, it's not boosting their unit cost. So they're really in fairly good shape.
Now, that new package would provide 46% in cumulative pay raises and retirement contributions over its 4-year term. Shares of American Airlines right now down nearly 2%. As climate change brings on more natural disasters, the cost of insuring against them keeps going up. Bloomberg's Tom Metcalf has the numbers.
2023, unfortunately, is going to be another year where this $100 billion threshold of insured losses from natural catastrophes is going to be breached. So last year, I think it was about $125 billion in 2022 already so far, just in the first half. 2 reinsurers, Munich Re and Swiss Re, have shown $93 billion of losses.
Now, Metcalf says about more than 2/3 of this year's losses are just from severe thunderstorms in the U.S., and the Atlantic hurricane season isn't even over just yet. Those are the company stories we're following this hour. We'll have more Bloomberg Markets in just a bit. I'm Lisa Mateo. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Lows of the day right now on the S&P 500 index. We are looking at a 12-point drop for the S&P. Stocks are retreating, down now by about 0.3%. Dow Industrials down 166 points, a decline there of 0.5%, while NASDAQ is down 3 points, little change, down less than 0.1%. 10-year yield at 4.31% with a 2-year now yielding 5.01% on the 2-year. Spot gold up almost $3 the ounce to $18.97. That's a gain of about 0.2%, while West Texas Intermediate crude is up 0.3%, $80.97 a barrel on WTI. Investors are awaiting the latest earnings report out of NVIDIA tomorrow. That stock down right now by 3.2%. IBM is going to be selling its weather business to Francisco Partners, which will operate it as a standalone company. IBM's consumer-facing weather services such as Weather.com and business-oriented offerings will be acquired by the tech-focused private equity firm for an undisclosed sum. IBM shares down now by 0.3%. Again, recapping, the S&P lower by 12, down 0.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here in the Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Radio. Let's talk Microsoft. It would like to buy Activision. In fact, so much so that it's got a $69 billion transaction on the table. Needs regulatory approval, and the UK was really a sticking point, but maybe they're rethinking their strategy here. Maybe this deal gets done. So let's go to Jen Rhee. She's a senior litigation analyst. She's covering all the antitrust stuff for Bloomberg Intelligence. She joins us here in our Bloomberg Interactive Broker Studio. So, Jen, it looks like the UK is taking a little bit of an about face and may take a fresh look at this deal.
Yeah, and that looks like what's happening. As a matter of fact, they've been looking at it again for about a month. And I think Microsoft actually tried to push this through on a second look without doing what it's done now, which is made some concessions to transfer some games to Ubisoft. And that didn't really work. We thought maybe there'd be a final report by August 29th by the UK. Now it's been pushed to October because the deal's been restructured and they have to take a look at the new concession. But it's looking pretty good for Microsoft. You know, they've been talking to the UK. They know where they are. There's been open communication, and I really doubt they'd be moving forward with this unless they thought that they were going to get clearance at the end of this road.
Yeah, just looking at the stock of Ubisoft, which trades on French exchange, up 8.5% today.
So are those concessions going to be what the UK wanted to see? Isn't it all about Call of Duty? I mean, does anything else matter?
I mean, really, this was about Call of Duty, but the UK has made it beyond, you know, they don't know what's coming out from Activision. These are content creators, right? And maybe it'll be the Activision that creates the next Call of Duty or, you know, the next really popular game. So they were really just concerned more about the future because they think the future will be more of what they call these AAA games. And also the future will be streaming games through the cloud rather than downloading them to hardware. So that's what they're trying to protect. And that's what they've done by requiring or Microsoft agreeing that they will transfer all of the Activision games, including Call of Duty, for the next 15 years to Ubisoft. So Ubisoft can then license those games to be streamed through the cloud.
Where do we stand in the U.S.?
Yeah, well, the U.S., you know, it's been really quiet and you don't see much in the news. There's still an appeal. The FTC is still fighting this deal. In the U.S., they lost in court, and then they lost their attempt to get an emergency stay after they lost their attempt to block the deal. They do have an appeal pending. The briefing's going to be done in September. You could probably have oral argument maybe by the end of this year. I mean, if this deal gets UK a clearance in October and the deal closes, it means the FTC's appeal will be ongoing after the deal's already consummated and integrated.
So does that typically happen? There's still going to be a review of a deal that's closed?
It can happen, and the FTC has done that. I'm a little surprised by it. You know, after they lost in the district court and then lost their effort to get an emergency stay, I didn't really think they'd continue to pursue this appeal because they lost pretty soundly in court. I mean, the judge really said you just don't really have any evidence to prove out your theories of harm in this case. And I don't see this, I see it as a losing battle. And I'm a little bit surprised that they're continuing on that road. They may still withdraw it after this agreement with the UK. That might give them the ammunition they need to say, okay, things are different now.
Is it political so the Biden can go on the campaign trail and say, I'm tough on business?
Of course it's political. It's always political.
I'm trying to ask a nice down-the-middle-of-the-road question.
You know, antitrust decisions on mergers are not supposed to be political. And really, honestly, in the past, they mostly were not. I would say now it has moved into the political realm for sure.
Yep.
I mean, you have a political viewpoint right now that we've allowed too much consolidation in the market and we need to stop it. We need to slow down M&A activity in many industries. And that's why we're seeing these aggressive actions by the FTC and DOJ. And that is political.
All right, so what else do we have out there? So it looks like this deal's moving forward. What else is in your...
Hang on, let me just get quickly...
Sure.
So if the FTC and Con, I mean, clearly they're going to appeal and appeal and appeal, but at some point that's over. And if the UK approves this, who else has to give it their blessing? I mean, is there an EU regulator that they need? Is there a Chinese regulator that they need? Is there a Asian, African regulator that they need? Does Australia want to block the deal? I mean...
they have everybody else they need, and it's really telling because almost all of these jurisdictions, and some of which are very serious when it comes to antitrust, like Brazil, cleared this deal without concessions. Now, the EU is saying, look, this is a new deal. It's been restructured, and we reached a settlement with Microsoft, and we need to make sure this doesn't impact our settlement, so we may have to take another look. I don't think that's going to be a hindrance to getting the deal closed by the deal's end date in October, though.
And just refresh our memory, the UK gets a look at this deal because of Brexit. So they no longer abide by the EU review of the deal.
Right.
Ah.
Right. That's
the
UK used to be part of the EU, and it was part of Brussels review. It got, glommed in with all the other EU countries that were part of that. There were thresholds that could be triggered in just the UK previously, even before Brexit, but most big deals were assessed by the EU and not by UK.
Oh, well, that maybe makes Brexit all worth it then. to get the review deals.
Yeah, destroy the economy, but review deals. By the way, in terms of not political, I'm looking at the FTC board here. Lena Khan, it says she's a Democrat, right? Went to Yale Law School, by the way. Rebecca Slaughter, she's a Democrat.
That's right.
Went to Yale Law School, by the way.
Oh, I'm sensing something.
Alvaro Bedoya. He's a Democrat.
Also a Democrat.
Went to Yale Law School, by the way. What's the deal? I mean, if it's not political, why do they stack the board with Democrats who went to Yale?
Well, any administration, right, can appoint commissioners, right? And there are 5 commissioners, and no more than 3 can be from one political party. So generally, when we have a Democrat in the White House,
the other 2 spaces are vacant.
The other 2 are vacant, right? Now, there's some talk of nominees and appointees coming, right? But there's really no pressure on Biden to do that and move forward with that. I think he probably will, but at the end of the day, it doesn't really matter because it requires a majority vote. So when you have 3 Democrats and 2 Republicans, which you'll eventually have once those 2 spots are filled, you're still likely going to have the majority vote be along the Democratic lines. And these 3 have pretty much aligned on almost everything so far.
And in my world of media and telecommunications, it's the Federal Communications Commission, and it's the exact same gig.
Situation.
Whoever's in power gets the gets the role there. And Yale, is Yale the best law school? Most rankings?
Certainly on the left.
I don't know. Apparently, they like the antitrust regulators.
But don't they go on the rankings, isn't it? I guess it's Yale.
I think it's up there. I don't know.
But
I think it's up there. Look, it's Yale.
Yeah,
of course it's great.
Exactly. All right. So what else on the antitrust front are you looking at here? What are some of the big trades out there that still need some approval?
Well, we're looking at Adobe Figma. Now that obviously one is a private company, but that's been sort of lagging. I suspect the DOJ is likely to challenge that deal. We're waiting for Kroger and Albertsons. That's before the FTC. I wouldn't be surprised at all if the FTC went to court to try to block that deal as well. And trial will start in October in the JetBlue Spirit deal.
See, who cares? I mean, JetBlue and Spirit, do we care? I guess if you're in the markets that don't get a lot of service, and you care about, I want both JetBlue and Spirit to serve my market.
I mean, they have 2 very different models, right? JetBlue is considered a low-cost carrier, whereas Spirit's ultra-low cost, which really means everything's a la carte, right? You can get the absolute cheapest fare without any other perks, no food, no luggage, nothing else, and you can't pick your seat. There is a set of consumers that prefers to have that option, right, for when they travel. And what will happen is that this deal, at least the allegation is, carriers will take that option out of many markets, or reduce the option from 2, which were Frontier and Spirit, down to just 1, which would be Frontier when JetBlue takes over.
On the other hand, it's hard for JetBlue and also for Spirit and Frontier to compete with the duopoly that we essentially have here, right? You've got Delta, United, and American who hog all the slots.
You know, and
that's what JetBlue says.
Right, and that's their argument. And that's been an argument in airline mergers with some of the low-cost carriers and the ultra-low-cost carriers in the past. I will say that in 20 years that I've been watching this, the argument that we need to merge in order to better compete with the top guys never seems to work. It just doesn't really work, because if you take that merger on its own and it's anti-competitive and might have a price increasing effect or an output reducing effect, it doesn't really matter that much. It can't be outweighed by that argument.
I'm looking at the Spirit map. I mean, they fly pretty much everywhere. I mean, including the Caribbean and Central America and stuff like that. So it's a much bigger, more denser map than I thought. So,
but only in this, essentially, only in sort of North America.
Yeah, right. North and Central America. Yeah, so not any international stuff other than.
And JetBlue is now branched out, so now they go to London, they go to Amsterdam, and they go to Paris, I believe.
Yeah, but that was hindered a little bit because the Department of Justice challenged their Northeast alliance with American, right, which kind of hindered some of that.
All right, Jen, thanks so much. We appreciate it. Jen Reese, Senior Litigation Analyst, Bloomberg Intelligence. Right now, let's head down to Washington, D.C., World and National News with Nancy Lyons.
Thanks, Paul. Attorney John Eastman, one of the 19 people indicted in Georgia on state charges for allegedly pushing to overturn election results, well, he's surrendered in Fulton County. He's one of the first to turn himself in with the deadline of midday Friday. Bloomberg's Jody Schneider says former President Trump plans to report on Thursday.
He will be surrendering to authorities in Atlanta. He will have a mugshot. It is his fourth appearance on criminal charges this year, but obviously it's different in state court.
Bloomberg's Jody Schneider. Trump's bond has been set at $200,000. U.S. companies say they will be ready for new green reporting rules that require them to outline their climate impact. We get more from Bloomberg's Amy Morris.
69% of corporate leaders surveyed say they're prepared for pending disclosure rules. Half say they see climate change as a risk to their businesses. And while most are watching how the SEC finalizes climate disclosure rules, they're focusing more on European requirements. They take effect next year for large listed corporations, under which they'll have to report a broad range of sustainability issues, including water resources, climate, and their financial risks. Companies are still figuring out how to track and report those metrics. Amy Morris, Bloomberg Radio.
It's up to a federal judge in Texas to decide whether to remove a floating buoy barrier that Texas officials installed on the Rio Grande to stop unauthorized border crossings. Judge David Ezra is hearing arguments today from both sides. The Justice Department, in a lawsuit filed last month, argues the buoys constitute an unauthorized and illegal structure obscuring U.S. waters. Texas officials say the federal government has failed to secure the state's southern border and has a right to defend itself. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story, and sources tell Bloomberg Thoma Bravo will close its $2.3 billion acquisition of ForgeRock this week after the Justice Department declined to challenge the deal. That headline on the Bloomberg Professional Service. ForgeRock shares up 5.6%. ForgeRock makes identity verification software. Stocks are trading mixed right now. Choppy session. We do have the S&P lower, little change now, down by 3 points, down less than 0.1%. The Dow down 123, a drop there of 0.4%. NASDAQ, the composite index, up 30 points, a gain there of 0.2%. The NASDAQ 100 index, though, lower by less than 0.1%, little change. 10-year yield 4.33% with a 2-year that is now yielding 5.02%. Spot gold up $2.50 the ounce to $18.97, up by about 0.1%. And West Texas Intermediate crude up 0.1%, $80.32 a barrel on WTI. Wall Street is awaiting the latest numbers out of chipmaker NVIDIA tomorrow after the closing bell. NVIDIA's report is set to be a big test of AI fervor. Brian Crawes is the president of Scharf Investments, and right here on Bloomberg Markets, he told us he'd be looking elsewhere.
Everyone's holding their breath for NVIDIA, for example, but while NVIDIA is a great company, the expectations built into NVIDIA are substantial, so you need to see really great growth over the next 5 years to justify the price. Where there's a lot of stocks that are trading at much lower multiples with much lower expectations that'll probably outperform in the end.
And right now, NVIDIA is down by 2.5%. By the way, you can hear more of that conversation on the Tape podcast. You can download it wherever you get your podcasts. Lots of retailers out with earnings today. Among them, Macy's. That stock now lower by 13.1%. Lowe's, the home improvement retailer, up 3.8%. And after earnings, Dick's Sporting Goods down now by 24.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate it. Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio, streaming live on YouTube. So just head over to youtube.com and search Bloomberg Radio. One of the areas of the market that we've been talking a lot about over the last several years, increasingly so, is the private credit market. We all know about the private equity business, but the private credit business has been been getting a lot of capital flows and has been very active. I want to get a little bit more details on that market. Jackie Ward joins us. She's a director of private investments for UMB Bank Family Wealth. She joins us via Zoom. Jackie, talk to us about how you guys at UMB, address and deal and play in the private credit business.
Absolutely. Thanks for having me. Here at UMB, there's a number of different ways we kind of play in the private credit business. In my world, we have a couple of bank-owned funds that invest in private credit. So we're regularly looking at opportunities in the private credit space, mezzanine debt, junior lien debt, and working with companies that way. From UMB Bank's standpoint, as a senior lender, we also often work with junior capital providers to fill out the rest of the capital stack. So we get to interact with private credit, whether it's from a senior position or actually doing investment in private credit ourselves.
So my understanding is the private credit business really kind of took hold in terms of growing after the great financial crisis, when a lot of the banks, from a regulatory standpoint, had to pull back a little bit from certain types of loans in terms of what they could own on their balance sheet. Is that still the primary driver of what's driving the growth of this business?
I think it's a little bit of both. I think 2008 put private credit on the map because the question in 2008 was, when are big banks going to come back into lending? And I think the answer was it might take some time. And so you saw the launch of private credit. But these days, I think private credit is growing a lot just around direct lending efforts. Also, as banks kind of tighten in general, you're seeing less senior stretch debt. You're seeing more debt fall into the private credit space. And you're also seeing unitranche financing become a huge spot of the market. So with syndications down in general, a lot of companies are looking for a single provider that can provide a senior junior credit type blend through one instrument versus working with two different providers. And that's driving a lot of growth as well.
You know, Jamie Dimon, I think, probably talking his own book, but, he kind of says, hey, this private credit market's not regulated. Do we really know what's going on out there? How do you respond to that?
You know, private credit, these are funds. They're regulated as funds and asset managers. They're not regulated by bank regulators. I think there's a few different ways to look at that. One, they're not regulated by bank regulators because they have a different source of funds. So private credit funds are raising money directly to invest in private credit as opposed to using depositor money. And because of that, they're able to take a little bit different outlook and potentially longer point of view. I do think with any private investment, you know, the lack of regulation makes it really important to know who you're working with. You know, private credit funds that have long histories or attached to institutions like UMB that have long histories tend to do well because, of course, we're working with a broader market. I think it just goes back to diligence and knowing who you're working with and who you're investing your dollars with.
What types of deals are you guys seeing these days?
You know, in our group, we're seeing a lot of deals in the manufacturing distribution space, especially in distribution where you might be dealing with an asset-light company that still has a lot of working capital needs, a lot of growth. We're also seeing a lot of bolt-on deals. So in our portfolio, the vast majority of our companies are platform companies. So we're actively looking for new opportunities and looking for M&A opportunities. And it's a great way for us to put in more junior debt. So with bank credit kind of tightening, some of that senior stretch debt falling into our space is creating a lot of opportunity in both of those industries.
And do most of the deals that come across your desk, are they private equity sponsored deals primarily?
Yeah, we work primarily with private equity sponsors as well as, you know, LBO type funds. We're often working with them or independent sponsors where they're taking down the entire opportunity and they're looking for partners in the capital stack.
Interesting. So what is deal flow like these days? Because we've heard from, you know, some of the larger publicly traded investment banks that not a lot getting done per se. What are you seeing in your market?
You know, we work kind of in the lower middle market and we're actually seeing a lot of opportunity. Most of the deals that we're investing in, you know, we're looking at enterprise values of 100 million or under. And activity in that space, you still have a lot of companies owned by generations that are looking to make exits. You still have a lot of companies that are seeing an opportunity for M&A. So we're still seeing a good number of deals in our space. I think as you move up market, the markets get a little bit tighter and a little bit harder to raise debt. So we're very happy to be in the space we're in.
And you guys, UMB, you're based in Kansas City, right?
Yeah.
And so do you try to lend your regional expertise to the private equity sponsors out there, the companies out there? Is that kind of where you guys, kind of do your knitting?
So, you know, we get to work with the private equity groups in a lot of different ways. We have ways on the commercial bank side that we work with our private equity groups. Our bank is largely located, you know, Midwest focus. Groups like mine, we operate coast to coast working with different private equity sponsors on direct investment in their deals, either using mezzanine or minority equity. But we often, you know, UMB Bank is one large family. So we're often working with all the different divisions, you know, in concert to make sure that we're looking at the deal the right way.
Interesting. So here we've got a big increase in the interest rates over the past 12 to 18 months. How's that impacted your business? Maybe what kind of deals you see, what kind of structures you put in place?
You know, in our world, a lot of our deals, you know, slightly higher interest rate, interest only, we still have a lot of room and flexibility on that spread. I know one thing that we're watching just in the market in general is private credit is doing really well right now. I think there are a lot of funds that might have put out notes 12 to 18 months ago in a different rate environment. So we're keeping a really close eye on defaults coming into the back end of this year and early next year to make sure that doesn't have an impact on them. But kind of going back to the source of funding for a lot of private credit, because we're not utilizing deposit dollars in that sense, we have a different kind of cost structure that we get to compare against, and that gives us a little bit more flexibility.
And so for your funds, who's a typical investor?
For our funds, so on our family wealth side, we do have a number of single asset holdings that tend to be institutional and high net worth. The primary fund we invest private credit out of is a bank-owned fund. And so a number of years ago, the bank seeded us with cash, and we've been recycling that capital since.
All right, fascinating stuff. Always love talking about the private credit business. Again, a fast-growing business within financial services. Seemed to spring out of nowhere after the great financial crisis, and now it's a major player. Jackie Ward, she's the director of private investments at UMB Bank Family Wealth, located in the great city of Kansas City, Missouri, Kansas City, Kansas. I'm not sure how that all plays out between those two folks, but always love going to Kansas City. Looking at the market here, S&P 500 absolutely unched on the day. We got the Dow off about 0.4%. The NASDAQ pretty much up 0.25%. Let's get some company news right now with Lisa Mateo.
You got it, Paul. Microsoft's $69 billion acquisition of Activision Blizzard has a new chance at winning approval from UK regulators after the tech giant submitted a substantially different deal to the country's antitrust watchdog. Now, Bloomberg's Alex Webb has the details.
So what Microsoft is now offering is the licensing of its cloud gaming offerings, of Activision Blizzard's cloud gaming offerings, to Ubisoft, a big competitor in the space. In the UK specifically, it has been about cloud gaming. Could Microsoft get a dominant position? It's offered now a concession that is aimed at least at reducing some of those concerns.
Now, the Phase 1 probe will now restart, and the CMA set a statutory deadline of October 18th. Shares of Microsoft right now up about 0.5%. Shares of Activision Blizzard, they're up about 1%. And Amazon.com is deploying its Pay by Palm device to more retail locations, but not everyone's happy about it. Bloomberg's Steve Potus explains.
It's becoming more common, consumers using their hands or faces to pay for purchases. But while companies hype the ease of biometrics, privacy advocates have raised concerns about the risk of information being stolen. Digital rights group Fight for the Future is organizing an online petition calling on grocery stores to resist Amazon's palm scanning technology.
Amazon shares right now up just a fraction. And IBM will sell its weather services, such as weather.com, to Francisco Partners for an undisclosed amount. The technology-focused private equity firm will operate it as a standalone company. IBM will keep its sustainability software suite. Shares of IBM right now down a fraction. Those are the company stories we're making this hour. I'm Lisa Mateo.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio looking at these markets. S&P 500 unchanged. Dow Jones Industrials off 0.3%. That's 100 points. NASDAQ up 0.25%. On the yield front, 2-year Treasury, that's up 2 basis points, 5.02%. We were up at 5.04 earlier today, so marked move in the short end of the curve. 10-year Treasury pretty much off about 1 basis points, 4.32% here. So we'll keep an eye on that. Right now, we're going to head down to Washington, D.C. and get world and national news with Nancy Lyons.
Thanks, Paul. The first of 19 defendants in the Georgia election fraud case has turned himself in. John Eastman, the conservative attorney who pushed the plan to keep Donald Trump in power, has been booked at the Fulton County Jail. The district attorney has accused him and the others of scheming to subvert the will of Georgia voters and to keep Joe Biden out of the White House. Former President Trump says he'll surrender to Georgia authorities on Thursday. President Biden and First Lady Jill Biden are back in Nevada vacationing after a trip yesterday to see the devastation in Maui. Biden promised those impacted by the wildfires the government will be there throughout the recovery. Lahaina resident Kayamona Bramell is hopeful.
His words will be hollow unless there's action behind it. So when he says, I'm behind you, Washington is behind you, the country is behind you, we all hope that those words come true.
Bramell says she was impressed that Biden listened to their concerns. The administration has appointed a special coordinator to handle recovery efforts. UAW workers throughout the country began voting today on whether to go on strike against the big three car manufacturers. Bloomberg's Anne-Marie Hordern says the White House will be watching.
Those workers are going to vote whether or not to authorize their leadership to put a strike on the table for leverage. And that would just up the ante in these negotiations and also potentially draw some stressful conversations here at the West Wing.
Bloomberg's Anne-Marie Hordern, the 43,000 union members are seeking higher pay and a new two-tiered wage system which would pay new hires substantially less. They're also seeking a return to cost of living adjustments and pensions for all workers. The union contract expires September 14th. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul and Matt.
All right, Nancy Lyons, thank you so much. We appreciate it. Looking at the shares of Dick's Sporting Goods off 24%. I mean, just an extraordinary move here. This is a $9.6 billion market cap company, so a big move there. Dick's Sporting Goods sank after cutting its profit outlook for the full year as the retailer deals with slowing growth and more theft at its stores. Chief Executive Officer Lauren Hobart said earnings for the second quarter fell short of expectations due, quote, in large part to the impact of elevated inventory shrink, end quote. That's an industry term that refers to factors such as shoplifting, employee theft, and damaged goods. Comparable store sales, a key gauge of retail performance, also trailed analyst estimates in the period. The slowdown in Dick's is another piece of evidence which suggests consumer spending is under a bit of pressure. Neil Saunders, an analyst at Global Data, said in a note to clients on Tuesday. As I said, the shares fell as much as 25% in New York, their biggest intraday drop in 3 years. Before Tuesday, the stock had surged almost 600% since the end of March 2020. This is Dick's first hiccup in a number of quarters and puts them in the penalty box, Will Gardner, an analyst at Wells Fargo, said in a research note. Dick's has been one of the retail's biggest winners of the pandemic, buoyed by strong demand for athletic wear and sports gear. Hobart has been opening more stores and adding square footage, including new experiential retail spaces with activity areas like putting greens and climbing walls. Now, cost-cutting has taken on a bigger focus. Dick's lowered its forecast for capital expenditures this year and also laid off about 250 employees from its corporate workforce. A person familiar with the matter said customer support jobs were most affected by the job cuts. Again, Dick's, DKS is your ticker. It is off 24.3% today. The stock trades at $111.30 a share, so a big move in that name. S&P 500 today off about 0.1% The NASDAQ up about 0.1% as well. Sound On with Joe Matthew. That starts right now.
pressure as it comes off its worst week since November because Treasury yields are sitting around multi-year highs, posing a challenge to many risk assets.
So we'll have more on the price action. Plus, we speak with EY Global blockchain leader Paul Brody about the potential approval for Ether futures ETFs.
And Coinbase takes a stake in Circle and dissolves the group governing the stablecoin USDC. We'll discuss what that means for the regulation picture.
All right, so all of that is ahead, but first, let's get a snapshot of the market. The best way to do that on your Bloomberg terminal, CRYP Go. And what you will find is we are seeing continued pressure on Bitcoin. Matt, it was just a week ago today. I was standing here doing this show talking about how we'd been hanging out at $29,000-ish for weeks on end, and then that all changed over the course of the last week. We actually had a break below $26,000 earlier in the session. We're basically hovering right there at that level right now with Bitcoin down about 0.3%. It's even worse for some of the other digital tokens. Ether down by about 1.4%, and Polygon, one of the big underperformers today, off by around 4.5%. What is interesting, Matt, is to see Coinbase kind of shirking off the broader downward pressure in digital assets and related stocks. That has everything to do with that stake in Circle you were just mentioning. We have more on that coming up later on in the show, but Coinbase at the moment up by about 0.8%.
All right, if there's a silver lining for those who are long Bitcoin in terms of the drop, it's that it's fallen so far that one technical market measure shows that it's oversold. This is the RSI, the Relative Strength Index. And right now you can see that we're far oversold on Bitcoin as it holds right now under $26,000. One of the reasons for the sell-off may have been the jump in Treasury yields. We saw the U.S. 10-year yield rise to 4.34, the highest level it's been since 2007. And if Treasuries are yielding that much, it offers a lot more competition to assets like Bitcoin, which don't yield anything, Kaylee.
All right, Matt, let's get more on the charts and the price action now. Joining us is Noelle Atchison. She is the author of the newsletter Crypto is Macro Now and is former head of market insights at Genesis. Noelle, thank you very much for joining us today. Can we just talk about what happened exactly in the last week? Where should we cast blame on the action we have seen?
Very, very good question, Katie. And, we're all asking ourselves that. One thing, I haven't done the statistical analysis on this yet. I really should. But I can tell you anecdotally that every time we see crypto commentators start to jokingly call Bitcoin a stable coin, we get a further leg down. I've seen this many times. And sure enough, the stability has been unnerving. We were waiting for a move. We were hoping volatility would come back. We were just kind of hoping it would be in a different direction. The fact that there are some strong tailwinds building under the Bitcoin asset, Ethereum, all the others, the strong tailwinds building and still very little movement, that is a fascinating story that largely has to do with the lack of liquidity and the lack of volatility.
Okay, so to the point on the lack of volatility, now that we have seen somewhat of a spike in it, should we expect it to stick around, or are we going to revert back to what seems to be the new normal in that regard?
I wish I knew, to be honest. And here's the interesting story behind that. First of all, a reminder that volatility in crypto, it's a feature, not a bug. And the lack of volatility, rather than make people feel more confident in coming into the market, it's actually keeping large investors on the sidelines because market makers and other liquidity providers, such as high-frequency traders, they need volatility for it to be worth their while. Obviously, there is some activity going on there, but not nearly as much as there used to be. And with low liquidity, because of the low volatility, then there's greater risk for large investors, both on slippage and exit liquidity, with greater risk, especially given so much uncertainty on the macro environment. They're still hesitant to step in. Liquidity needs liquidity. What will it take to change that? Well, there are some signs of liquidity, some signs of volatility coming back in. It's very much a case of you go first. No, you go first. No, I insist after you. But, eventually some brave investor is going to go first, and then others are going to see the uptick in activity, which maybe we've seen, maybe not. They're going to see the uptick in activity, and maybe they'll step in as well. And then liquidity, one day, someday, eventually, it will be back, and then things will move fast. The uptick that we've seen with this last leg down, maybe it's too soon to say we're back, but it could be the start of something. The tailwinds are not inconsiderable.
I want to get your take on use cases, and we're going to talk about that with our next guest surrounding Ether. But in terms of Bitcoin, you often hear it's digital gold, in which case volatility would be more of a bug than a feature, wouldn't it?
Depends on your time frame. Longer term holders, when you're talking about digital gold, I mean, the traders, sure, volatility gives them trading profits, right? But for longer term holders, they don't really care. It's the longer term perspective. And while we can debunk the fact that Bitcoin has been an inflation hedge in the US, cast your eyes outside. That's all we really need to do. Look at Argentina, 114% inflation. Bitcoin in Argentinian peso terms has tripled year to date. Turkey, they're expecting their already mid-level double-digit inflation to increase further. Bitcoin in Turkish lira terms up over 120% year to date. So again, investors in areas outside of the United States, outside of Europe, do see Bitcoin as a hedge. That's the use case that I think is being very undercovered, underappreciated at the moment.
Noelle, what do you think about the correlation to stocks, or the lack thereof right now? You know, for a long time, every uptick in the NASDAQ 100 was coupled with an uptick in Bitcoin and vice versa. And we've now seen that correlation break down. What does it mean?
Correlation is a wonderful narrative device, Matt. I personally very much enjoy talking about it, but we have to remember it's just a narrative device. What's more, it's a backward-looking narrative device. The fact that Bitcoin has been very uncorrelated to stocks recently, lowest correlation in a very long time, is because of its lack of activity recently, while stocks have been pretty active. That's the only reason. Will this continue going forward? I don't think it will. I think we're going to see correlations start to take up, and they can move fast. They look slower on the charts because correlation is always smoothed over whatever time frame we happen to be applying to the calculations. But you know that when there's a crisis, when there's panic, when there's blood in the water, correlations head to 1. And I believe we have a stock market correction coming. We'll see some correlations tick up there. Longer term, the correlations are breaking down because of the use cases that we just touched on, Matt, because of others that will be emerging. However, it's not really something we can use to predict the performance going forward. And I have heard some analysts say this means investors can start to put it in their portfolio again. And my answer to that is not so fast. The correlation hasn't gone away. It's resting.
I want to also ask about the Ether Bitcoin ratio. As I said, we're going to talk with Paul Brody in a moment about his new book and use cases for Ether. And it started to move a little bit in the last couple of sessions. What do you make of Ether versus, you know, the OG crypto token?
I do believe we're starting to see signs of ETH waking up. And frankly, Matt, you know, about time. It's been very asleep for most of the summer for several reasons. One, the regulatory uncertainty. DeFi has been very lackluster, partly because of some exploits, or high-profile exploits, as we can confidence, partly because many tokens that run on Ethereum have been declared securities. That does impact Ethereum activity, which impacts the price of Ether. However, also the macro attention that you mentioned, that has been directed at Bitcoin, but that is starting to change. We're seeing more investors start to finally take a look at ETH because of the likelihood of an ETH futures-based ETF sometime this year, because of the potential regulatory clarity that will eventually happen, even in the United States. And ETH stands to gain much more from that than does Bitcoin. And also, Matt, this is a very overlooked feature of ETH. It's reflexive. It's leveraged on itself. When the price goes up, there are more Ethereum transactions because there's more interest in ETH. And with more Ethereum transactions, more transaction fees. On Ethereum, transaction fees paid in ETH, that ETH is burned, which reduces the net supply, which has been pretty low, slightly negative anyway. So lower to tending negative new supply. All things being equal, will increase the price, which will increase more activity, which will increase more transactions, more fees, more burns, and so on. It's reflective, which is why I think that when we start to see ETH move, again, it'll be fast.
All right, Noelle, thanks so much for joining us. Noelle Acheson there talking to us about the crypto world. Coming up, as I've been saying, we're going to talk to EY's head of blockchain, Paul Brody, about crypto ETFs, about the ETH futures that Noelle was mentioning, and of course, about his new book, Ethereum for Business, a plain English guide to the use cases that generate returns from asset management to payments to supply chains.
And Coinbase shares are rising after taking a stake in stablecoin issuer Circle. We'll have more on that coming up.
Plus, to access all the latest data and news on crypto, check out CRYP Go on the terminal. This is Bloomberg.
would you worry most about your economy and Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
We see one position from the SEC, which is regulation by enforcement. Nowhere has it really been established what assets are considered securities and which are not. And even in the two Ripple rulings we've seen, which were not even a month apart, we have dramatically different interpretations. The only way that we get clarity is not through these piecemeal regulation by enforcement steps we've seen, but through clear regulatory guidance. And that, in my view, at this stage can only come from Congress.
That was Meltem Demirors of CoinShares speaking to Bloomberg a few weeks ago on this show after federal judges for Ripple and Terra cases split on whether those tokens are securities. And now the SEC has asked a federal judge for permission to appeal the Ripple ruling. Bloomberg's Sonali Basak joins us now for more. Sonali.
Yes, it's the latest in the saga between the SEC. Remember, back in July, District Judge Annalisa Torres had ruled that the XRP token of Ripple Labs is not a security when it's sold to the general public, and the ruling was a preliminary motion and not a judgment. So the SEC is now seeking permission for its immediate appeal, saying that the ultimate answer to these questions could affect a number of pending cases involving crypto assets. In the latest twist between the two industries here, you do have a very significant amount of pushback here between the two parties. Now, we do have this appeal from the SEC. We also have the fact here that the early response of the XRP token has been a huge rebound, but those gains have since waned since then, and it's becoming clear that that ruling may not have been the industry clarity that has been needed to move forward. Now, remember, as you were just talking about, there's a separate case between the SEC and Terraform Labs, where a separate judge, Judge Rakoff, said the Terra USD might be a security when it's sold to retail investors, and that is just one of many suits between the SEC and the different industry giants, including the largest crypto exchange, Coinbase, which is fighting the SEC on its current stance while also working closely with the watchdog on separate matters in the crypto world, including the advancements of ETFs tied to Bitcoin. Now, for its own right, Ripple is fighting the SEC's appeal. The company's executives, in their own legal response with the judge, say the next step should be a trial, which they say should happen expeditiously and is in the interest of the public. Yet they say that the SEC's appeal should be denied.
All right, Shonali, thanks very much. Shonali Basak bringing us the details of that case that's ongoing. Let's bring in Paul Brody, EY's global blockchain leader, to talk to him about Ripple as well as Ethereum and all things crypto. Paul, I want to first get your take on the SEC case, maybe not as a judge, but just as someone who watches crypto. How important was it that Ripple won at least part of that case?
So I think it was actually pretty important because any step forward towards clarity is a positive step. And I think if you look at the draft legislation that's coming from Congress, it's very, very reasonable. And so all of these things, I hope, are converging towards pressure towards we should have more clarity of rules. And I think what Meltem said in your introduction was fantastic. She's right on target. Clarity is good for business. And hopefully between the legal decisions and the pending legislation, we're getting there in one small step at a time.
Okay, so as we talk about the pending decisions around what is and is not a security, also all waiting with bated breath each and every day to see if a spot ETF approval actually may come, or Grayscale may actually have its ruling come down in the D.C. Circuit Court. Didn't happen today. We'll see if it happens on Friday, so we'll all wait for that. In regard to ETH futures, though, and that potential ETF, that one seems like it maybe is more likely. What real difference would that make, Paul?
So I think it would make an enormous difference because we're really starting, and your prior guest was amazing on this topic, we're really starting to see the difference between Bitcoin, which is a kind of digital gold, and people want to see it as potentially an inflation hedge or a global asset, versus Ethereum, which is becoming a global computing infrastructure. And so by having ETFs for the two separate ones, and specifically having Ethereum ETFs, you can start to sort of take a stake in the Ethereum ecosystem, in the cash flow of transactions, in the value of the overall asset infrastructure that's being built there. And for people to see these two properly as separate, I think is really important for the development of the overall marketplace.
Okay, so on the subject of Ethereum, you are a somewhat expert on the subject. You actually just wrote a book that was released earlier this summer, Ethereum for Business. It's called A Plain English Guide to the use cases that generate returns from asset management to payments to supply chains. Paul, how should businesses be thinking about using this technology?
So we have a very simple saying at EY, which is that we believe blockchains are going to be the glue that tie business ecosystems together. And even though everyone tends to focus on finance and DeFi and SEC rulings, in fact, Ethereum is an incredible infrastructure for tokenizing assets, tracking supply chains. If we look at the kind of things that I talk about in the book and that we're doing at EY, they are tokenizing carbon offsets, tokenizing carbon traceability, tracking pharmaceuticals, managing procurement agreements, right? There's a tremendous amount of operational business stuff, none of which is finance related, but is essential for how companies interact with each other. And Ethereum provides a neutral, decentralized infrastructure in which enterprises can transact with each other on level, equal terms.
On the subject of things being level, is this a zero-sum game, Paul? Are we going to head into a world where one chain actually is dominant, Ethereum perhaps?
So I do believe that. I think if you look historically at the world of computing infrastructure, we like standards, right? Basically, you know, a single operating system represents 90% of all PCs. 2 operating systems represent more than 95% of all phones. We like standards. Standards scale really well. So I think we are headed for a global infrastructure where Ethereum is a global base layer standard for digital business transactions in the same way that TCP/IP is a global network standard, and that others over time will gradually wither away. Just like, you know, 20 or 30 years ago, we used to have an alphabet soup of different networking standards, and now we just have TCP/IP.
That reminds me that I love the metric system, Paul, and we're kind of nowhere there in the U.S. Are we going to face a similar disadvantage when it comes to the global blockchain? I mean, is the U.S. regulating itself out of competition here, or not regulating itself into competition?
I worry that there is some risk of that happening. I just actually got back from 4 weeks in Asia, and it's very clear Japan, Hong Kong, Singapore, and additionally Europe and the Middle East, these are all places that are moving really forward. If we look at kind of our volume of work and deals, we're up in every sector and we're up in every geography, but the places that are growing the fastest by far in terms of our blockchain and core crypto work are Europe in preparation for the MiCA assets law, and Hong Kong, which is growing rapidly as China tries to reopen, and then obviously Dubai in the Middle East, where the regulatory environment is maturing very quickly. So the U.S. is growing again, and that part is good, and I've been telling all the people on our team, summer is coming, but we are definitely lagging compared to other regions.
Summer is coming.
Here in D.C., I have to say I'm really eager for summer to be over, but that's just because I've been drowning in humidity for weeks now. Paul Brody, thank you very much for joining us. He is EY's global blockchain leader and author of Ethereum for Business. Now, coming up, we're going to have more on the story that we promised you we would have more of: Coinbase taking a stake in Circle. We'll have the details next. This is Bloomberg.
Why does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
This is Bloomberg Crypto. I'm Kaylee Lyons in Washington with Matt Miller in New York. Well, Coinbase has taken a stake in stablecoin issuer Circle, citing, quote, growing regulatory clarity for stablecoins in the U.S. This comes as competition among stablecoins is increasing, even as the overall market value of the sector is shrinking. Let's bring in Bloomberg's Olga Karev for more. She is joining us from the West Coast. So, Olga, what do we need to know about the terms of this agreement? I don't think they were fully disclosed, but what do we know?
So what we know is that the two companies were previously part of the Centra consortium. Now they are essentially getting rid of it. And Coinbase is going to take a 50% share of all interest income that is earned off of USDC. And it's a little bit of a change versus the prior agreement. Of course, the details of that aren't known, but many analysts estimate that Coinbase took a 40% share of interest revenue. So it's a little bit of a benefit for Coinbase. Plus, if Circle at some point decides to go public, which it has ambitions to do that, then as an equity owner, Coinbase could benefit as well.
What do we know, Olga, about the competition in the space, specifically between Circle and Tether? And is the overall market really looking weak?
Absolutely, it is, Matt. And essentially, what's happened this year is that USDC's market share has shrunk and Tether's has increased. So if you look at market cap, Tether's has increased, USDC's declined. Part of it was due to the banking crisis earlier this year. In March, Circle had some deposits trapped in Silicon Valley Bank, and it very quickly got the money back, but the concerns have lingered, and so the market cap of USDC is quite a bit down, while Tether has actually increased its market cap.
Olga, just quickly, we only have about a minute left, but it strikes me they cited growing regulatory clarity as being a reason why this move is being made. I understand that House Financial Services did pass a stablecoin bill, but that hasn't actually become law yet. How much real clarity do we still have yet to see?
Absolutely. So the company definitely said that, but I think we are still ways away from real regulatory clarity on the stablecoin issue. So, you know, I'm not sure if maybe some of the motives for this reshuffle were different, but this is at least what the companies are saying publicly.
Olga, great to have you with us. Thanks so much for filling us in on this important story. Olga Karif there talking to us about Coinbase taking a stake in Circle. Coming up next week, we are going to talk to Clara Medali from Kaiko. She's going to talk to us about the data involved in crypto and how we can look at that to analyze just exactly what's happening. For Kaylee Lines, I'm Matt Miller. This is Bloomberg.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Lines.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
insight,
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
and analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle. It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
Welcome to Bloomberg Markets. I'm Amber Kanwar.
And I'm Matt Miller. Let's get a quick check on what's going on in markets today. Bit of a seesaw day. We started out the day up, then dropped, then rose. Now we're back down again. Currently off about 0.25% on the S&P 500. 43.88, 43.89 is the level we're looking at right now on the benchmark index. We're being dragged down by financials after S&P downgraded a number of regional banks in a move that follows Moody's. We also have big losses in some of the retailers, and we're going to talk about those, but that's a weight on the index. You can see the U.S. 10-year yield coming down as investors buy those bonds. The yield right now at 431.81. Remember, yesterday we rose up to 434, the highest level that we've seen since 2007, and we're up really across the curve. Today we're giving back some of those gains in yields as prices rise. The Bloomberg U.S. dollar index right now very little changed, but holding at the 1240 level. We've seen it over the last few sessions, relatively strong level, because with high yields come more investors in U.S. dollar assets. And then NYMEX crude down 17 cents, even as prices at the pump rise to the second highest level we've seen them in recorded history, seasonally priced. NYMEX crude going at $80.55 a barrel today. Amber, what are you looking at?
Well, you mentioned financials are a pain point on the S&P 500. So is retail. Take a look at Macy's, which is under huge pressure right now. Sales dropping. And what are they doing in the face of that? They're resorting to discounting to clear inventory. Investors never like to see that. They also did not like what Dick's Sporting Goods had to show in its latest quarter. Profit plunging. They have a huge problem with theft. It's one of the reasons they've had to cut forecasts and ultimately will be cutting jobs. On the flip side, we have shares of Hasbro as one of the best performing stocks right now. Bank of America sort of pounding the table on this one. And NVIDIA briefly touching a fresh all-time high this morning. It's retreating right now. A very interesting setup, Matt, into what should be a big set of earnings releases tomorrow.
All right, we are definitely waiting for NVIDIA earnings tomorrow, but we're seeing a lot of option trading already. Bloomberg's Abigail Doolittle has more on that. Abigail?
We are certainly seeing a lot of options trading, Matt, because we've had lots of volatility for big tech up until today to the upside. And last week, of course, on Friday was options expiration. A lot of times that clears the decks for the bulls to come back in, but I was speaking to Steve Sosnick of Interactive Brokers earlier, who's actually joining us for Options Insight later today around 3:15. Please tune in. Great insights there from Steve always. But he was saying he doesn't think it's really that clearing of the deck, that it's more FOMO buying on some of these big tech names, people wanting to buy that dip. That happened on NVIDIA up until today, basically, where we have this 2% decline. One reason could be, Matt, of course, this stock's huge move. The last quarter, there's so much to live up to. They basically raised their guidance by 50%. We are likely to see a big move after Wednesday on Thursday. In the third quarter of last year, up 18%, up 8%, and then down in a big way on one of the other quarters. Right now, we're looking for a move of up 10%, and that's not the last quarter, though. So this is, I think I'm guessing that was the move that we had the last time when $143 billion was added. So this is chronologically a little bit